For listeners, this signals a shift in focus from dominant cryptocurrencies to precious metals, suggesting that investors may diversify into silver if they anticipate a prolonged rally, but should remain mindful of volatility and broader macroeconomic factors that could temper the projected gains. The United Kingdom's financial watchdog has moved to tighten its stance on stablecoins that could pose systemic risks to retail investors. In a fresh draft of regulatory rules slated for finalization by 2026, the regulator proposes capping the value of such systemic stablecoins at £20 per user. This cap is aimed at curbing exposure and limiting potential losses in a market where volatility can hit hard. The move signals a more cautious tone from UK authorities, likely to dampen speculative enthusiasm around high-yield stablecoin offerings. For traders and holders, the new limits may mean reduced liquidity for large-scale positions, but could also bolster confidence in the overall stability of the crypto ecosystem. As regulators across the globe tighten standards, market participants will watch closely how this cap influences pricing dynamics and investor sentiment in the coming months. Internet Computer, ICP, is nearing a pivotal breakout point after its price has been tightening within a falling wedge pattern that traders are watching closely. The asset's recent move suggests a potential climb toward the $10 mark, with some analysts pointing to the wedge as a classic bullish signal if it holds. Behind the technical backdrop, ICP's ecosystem is seeing a steady rise in stablecoin liquidity. More users are minting and holding stablecoins on the network, which could bolster demand for the native token and support upward momentum. Market chatter has shifted from cautious FUD about scalability to growing FOMO as the wedge pattern gains traction. Traders note that a breakout would likely trigger renewed buying interest across major exchanges. For listeners, this development underscores how technical formations paired with underlying utility metrics, like stablecoin supply growth, can converge to create short-term catalysts for price action in the crypto space. Brazil's central bank has rolled out a new regulatory framework that now treats stablecoin transactions as foreign exchange operations, subjecting them to banking-style oversight and the same AML scrutiny that applies to traditional currency exchanges. The move means crypto firms operating in Brazil must register with the Banco Central, comply with stricter reporting requirements, and align their anti-money laundering protocols with those of licensed banks. Market sentiment is cautious. Investors see increased regulatory certainty, but also a heavier compliance burden that could slow rapid growth. For traders and institutional players, this shift signals tighter controls in one of Latin America's largest crypto markets, prompting a reevaluation of risk exposure and operational readiness as the sector adjusts to the new rules. Ethereum has slipped sharply over the last quarter, falling from a peak of roughly $4,960 to lows near $3,000 before rebounding above $3,500. The drop mirrors the 2020 correction when ETH slid from about $490 to $308, after which it surged again, sparking speculation that a similar cycle may be unfolding now. Analysts point to key support between $3.0 and $3.100. Holding above this zone could trigger a robust rally, while a break below would signal further downside. Technical chatter highlights the 20-day EMA at $3,695 as looming resistance and a MACD bullish cross on the horizon, suggesting momentum may soon shift. Whale activity shows mixed signals. Some large holders began buying near $3,200, yet several top whales have sold or reallocated positions in recent weeks. Trading volume and open interest hit record highs, indicating heightened speculation and liquidity grabs around pivotal levels. The market remains poised for a decisive move, either a breakout toward the $500 target or a deeper test of the lower support zone. Bitcoin has entered a do-or-die phase days after sliding from its October 6 peak of roughly $123,500 to a low of about $99,900 on November 4, then rebounding to around $106,350, still some 14% below the earlier high. The key technical hurdle is the 200-day moving average near $110.0. Breaking above that level would signal renewed upside, while falling below could trigger a deeper slide into the one buying pressure, with resistance firmly set between $108.0 and $110.0. Clear breakouts here could lift altcoins even more aggressively than Bitcoin. Institutional activity remains robust. Michael Saylor's firm added nearly 487 BTC for about $50 million, yet ETF outflows hit $122 billion last week. Market sentiment has nudged higher, with the Fear and Greed Index rising to 29 and a 36% uptick in the past day following progress on a U.S. government shutdown deal. Event contracts price roughly a 28% chance of hitting $130.0 this year, and only a 9% chance of topping $150.0. Near-term catalysts include potential tariff changes and fiscal clarity, but continued ETF drains and rising leverage could still dampen the rebound. Traders and institutions are keeping a close eye on whether Bitcoin can reclaim $110.0 or slip below $100.0. Each outcome will shape the narrative for this critical juncture in the crypto cycle. Bitcoin has hit a critical pivot point as CryptoQuant founder Kai-Young Ju released a bold price projection that could reshape market expectations. The analyst's forecast, grounded in on-chain metrics and supply-demand dynamics, suggests the digital gold may either surge past current resistance or retreat sharply if liquidity evaporates. Traders are reacting with mixed emotions. Some see bullish momentum, while others warn of potential FUD as volatility spikes. In the broader context, Bitcoin's recent consolidation after a prolonged rally has left investors on edge. Institutional play continues to weigh in, and regulatory chatter adds another layer of uncertainty. For listeners following the crypto corridor, this development signals a heightened need for vigilance. Price action could pivot dramatically within days, influencing hedging strategies and speculative positioning alike. Zcash, a privacy-first cryptocurrency that lets users toggle between public and shielded transactions via zero-knowledge proofs, has surged back into focus after recent wallet usability upgrades and a shift towards stronger privacy narratives. The network's latest improvements, unified addresses for single-format receiving, and the new Halo proving system that eliminates trusted setups, have made private transfers easier and more secure. This tech push coincided with a sharp rally. ZEC broke through resistance, peaked near $740 in early November, then retreated to test support around $480, mirroring its previous $480. Derivatives heat fell from overbought levels, indicating a healthier slide than sustained high funding rates. Market sentiment is mixed. FOMO from privacy advocates fuels buying pressure, while volatility and regulatory scrutiny inject caution. For listeners, Zcash's momentum hinges on continued developer releases, deeper liquidity on DEXs, and broader adoption of shielded payments, factors that could tilt the next leg of its price action. Gold remains the headline asset as India and South Africa report their October 2025 reserve snapshots. India's gold holdings climbed to roughly $102.4 billion, with its physical stock steady at about 880 tons. The value jump stems from price appreciation rather than new purchases. South Africa's reserves rose from $67.9 billion to $69.4 billion, reflecting a modest increase in net gold and FX holdings, though specific tonnage changes were a lack of transparency from other BRICS members. Russia, China, Brazil inject some FUD into the narrative, leaving analysts to weigh the benefits of diversification against potential policy opacity. For listeners, this snapshot shows that while India and South Africa are stepping up their gold balances, the full picture of BRICS-wide accumulation remains incomplete, suggesting a mixed sentiment as markets digest the implications for global reserve strategies. Tether, the long-standing stablecoin that once served merely as a digital dollar peg, is now adopting the playbook of a central bank. The firm's latest disclosures reveal a shift toward managing reserves, reporting profits, and making policy-style decisions, an evolution that blurs the line between a simple liquidity provider and an institutional money-minded entity. This structural change has already rattled markets. Traders are weighing whether Tether's new governance will stabilize or destabilize its one peg. Some see a bullish angle. A more disciplined reserve strategy could restore confidence after past scrutiny, while others warn of potential bearish fallout if the firm overexpands and triggers a loss of trust. The buzz is a mix of FOMO around a central bank grade, stablecoin and FUD, about regulatory pressure and liquidity risks. For listeners on the trading floor or in portfolio management, this development underscores a broader trend. Major stablecoins are no longer just passive anchors. They're becoming active monetary actors. Understanding Tether's pivot is key to anticipating ripple effects across DeFi lending rates, spot crypto volatility, and the overall appetite for dollar-pegged assets in an increasingly regulated ecosystem. Zcash, ZEC, has hit a critical technical juncture after a meteoric rise of nearly 850% from its October trough. The digital privacy coin just crossed the $256 threshold, triggering a classic bearish double-top pattern that traders are watching closely. The chart now shows resistance at $256 and potential support near $200. If the top holds, a sharp pullback could follow, sending the price lower into the mid-$150s. Market sentiment has swung from FOMO-driven enthusiasm to cautious dread as volume spikes but momentum stalls. Investors who entered on the rally are bracing for volatility, while short sellers look to capitalize on any downward swing. For anyone tracking Zcash's trajectory, the next few days will be decisive. A break above $256 could signal continued upside, whereas a collapse would confirm the bearish bias and trigger broader risk-off sentiment, leaving the digital gold on the sidelines instead of catapulting into a full-blown bull run. The price failed to hold at that critical support level, prompting traders to flag a potential resurgence of OG selling pressure that could push the market lower again. Market sentiment is leaning bearish. Fear and uncertainty are mounting as investors weigh the risk of another pullback against any lingering hope for a quick surge. For listeners tracking BTC's trajectory, this rejection signals a pause in upside momentum and suggests that short-term traders may need to reassess their positions while awaiting clearer directional cues from upcoming on-chain data and macro developments. Bullzilla has taken center stage in this week's meme coin presale frenzy, launching its Castle Bravo Stage 10A at a price of $24,573 per token. The project touts a deflationary model with a roar-burn mechanism and offers staking rewards up to 70% APY through the HODL furnace, while a referral vault turns community engagement into upside potential. Market chatter is bullish, with FOMO driving early participation. Holders count already tops 3,500 and liquidity locks signal growing confidence. This surge comes as other meme tokens, Moonbull and LaQlex, push structured staking to balance risk, positioning Bullzilla as a frontrunner in the next wave of high-growth presales. For listeners, the takeaway is that while the hype is strong, the underlying tokenomics and lock-up structures suggest a more mature approach than typical meme coins, offering a clearer path for early adopters looking to navigate the 2025 bull cycle. X402, an on-chain payment protocol that lets autonomous AI agents perform verifiable automated transactions via standard web infrastructure, has seen a sharp contraction in recent activity. Daily trading volume fell from about $28 million to roughly 329,000, while transaction counts dropped 56%, settling at around 13 million on the latest snapshot. The decline is mirrored by retail sentiment. Google Trends interest plunged from a peak of 100 to just 10, creating a bearish tone and FUD about the ecosystem's momentum. Despite this slump, institutional traction remains strong. Chainlink's recent integration of an X402 endpoint into its runtime environment enables agents to verify outcomes on-chain and earn per use, while Bio Protocol is deploying X402 for instant USDC micropayments on Base, opening new DeSci use cases such as hypothesis review marketplaces and pay-per-query services. These developments have pushed the ecosystem's market cap from $800 million in late October to over $12 billion, a 1,300% jump, suggesting that, while retail buzz is cooling, deeper infrastructure adoption may still be building momentum. Ethereum's upcoming Fusaka upgrade, slated for December 3, 2025 at 21:49 UTC, brings a suite of consensus and execution layer enhancements that could shift network dynamics. The update introduces erasure-coded blobs via PeerDAS, initially limiting blocks to 10 blobs, but planning expansions to 14 and eventually 48 through BPO hardforks. Nodes failing to serve data will be blacklisted, tightening reliability. Proposer scheduling is hardened with EIP 7917, keeping the schedule 2 epochs ahead in state, so contracts can verify it via Merkle proofs, reducing do-s vectors on the beacon chain. Security gains also include adding SEC 256 RON support for hardware wallets and tightening gas limits. EIP 7934 caps execution blocks at 8 MB to curb oversized block attacks, while other EIPs adjust precompile costs and operand sizes. Market chatter leans bullish. Developers view Fusaka as a robust step towards scaling and safety, though some FOMO may be tempered by the technical complexity of the changes. For listeners, this upgrade signals Ethereum's continued push for higher throughput and stronger security, potentially smoothing transaction flows and reinforcing confidence in the loan platform ahead of its next major milestone. Ripple's flagship token XRP is picking up steam this week as speculation swirls around a wave of upcoming exchange-traded funds. Canary Capital has announced that its XRP ETF could launch later this week, adding fresh institutional momentum to the asset. The buzz is already nudging prices toward a $270 breakout, with traders watching for a confirmation rally. Market chatter remains largely bullish, driven by FOMO from the potential regulatory green light and the prospect of broader market access. However, some voices caution that ETF launches can be volatile, and any delay or hiccup could trigger short-term pullbacks. For listeners, this development signals a possible inflection point for XRP. If the ETF debuts as expected, liquidity will surge and price action may accelerate. If not, the rally could stall. Stay tuned to see whether the market capitalizes on this institutional push or reverts to caution. Bitcoin faces a potential shift in market dynamics as CryptoQuant founder Kai Young-ju warns that if the buying momentum from strategy-based and spot ETF inflows tapers off, sellers could take the upper hand. The analyst highlighted that current price support has largely been buoyed by institutional demand through these ETFs. A cooling of those flows would remove that cushion, tightening supply constraints and likely putting downward pressure on the digital gold's valuation. Market chatter is already turning bearish as traders fear a pullback once ETF inflows wane, while some FOMO-driven participants still see short-term upside from recent gains. For listeners watching the crypto landscape, this serves as a reminder that institutional liquidity can be a double-edged sword. It fuels rallies but also creates a fragile support layer that, if withdrawn, may trigger a rapid sell-off. A newly launched DeFi token priced at roughly $0.35 has caught the attention of market watchers as the crypto space gears up for its next bullish cycle. The project, built on a Layer 2 scaling solution, announced a strategic partnership with a major liquidity aggregator that will unlock instant swap functionality and automated market maker pools across several chains. This integration is expected to boost trading volume and attract institutional participants looking for cross-chain exposure. The announcement has stirred a wave of FOMO among retail traders, while analysts point out the token's still nascent roadmap and limited on-chain data as potential risk factors. Sentiment skews bullish overall, with early price action showing a modest rally after the partnership reveal, but caution remains due to the token's thin liquidity and high volatility profile. For listeners tracking upcoming opportunities, this development signals that the market is increasingly favoring projects that can demonstrate interoperability and real utility. The token's performance in 2026 will hinge on its ability to maintain liquidity, deliver on its promised integrations, and navigate the broader macro environment that has historically favored strong fundamentals over hype alone. XRP has experienced a sharp reversal in market sentiment, as bearish pressure intensified and pushed its price toward the $240 threshold. The digital asset's value slipped after a series of negative signals, ranging from regulatory uncertainty to declining trading volumes, prompting traders to tighten risk positions. Market participants are reacting with caution. FUD has spread across exchanges, leading many to reevaluate their exposure and move liquidity out of XRP holdings. In the broader crypto landscape, this dip underscores the volatility that still plagues the market post-SEC proceedings and the lingering uncertainty around Ripple's legal battle. For listeners monitoring asset performance, the current trend suggests a consolidation phase ahead, with potential for a rebound if positive developments materialize or further downside risk persists. Best Wallet, a non-custodial hot wallet startup, has announced that its Best Utility token is entering a presale, expected to raise roughly $20 million before the November 28 deadline. The platform's architecture relies on multi-party computation, MPC, via Fireblocks, splitting secret keys into encrypted shards so no single breach can drain funds, and adds biometric two-factor access plus planned anti-fraud and MEV protection layers. It also earned Wallet Connect certified status, ensuring smoother DApp interactions and reducing approval errors that often lead to losses. This move comes amid a sharp uptick in crypto thefts. By mid-2025, Chainalysis reports over $217 billion siphoned from exchanges, DeFi protocols, and users, surpassing last year's total of $22 billion, and the recent $15 billion Bybit hack, linked to Lazarus Group, has become the largest single heist yet. The spike underscores attackers' evolving tactics and the urgency for stronger key management solutions. For traders and holders, the presale signals a bullish sentiment around security-first wallets. Investors are looking for products that mitigate hot wallet risk while integrating seamlessly with dApps. However, the market remains cautious. The token's price trajectory will hinge on adoption rates rather than speculative hype, and buyers should weigh the regulatory backdrop and recovery prospects of stolen assets before participating. Signum Bank's latest global survey reveals that a majority of institutional investors, 61% to be precise, intend to increase their crypto exposure in the fourth quarter. The data signals a bullish stance for the remainder of the year, with firms eyeing growth opportunities as regulatory clarity improves and digital asset adoption expands across portfolios. However, sentiment takes a cautious turn when looking beyond 2025. Respondents expect a downturn around 2026, citing macroeconomic tightening and potential market corrections. For listeners tracking institutional flow, this dual outlook underscores that while Q4 may see a surge in capital inflows, the broader horizon is marked by risk-adjusted positioning and a readiness to hedge against looming volatility. The Central Bank of Brazil has rolled out a comprehensive regulatory framework targeting virtual asset service providers, VASPs, and stablecoin transactions. The new rules aim to shore up financial stability and curb the use of digital assets for illicit activities, according to Regulatory Director Gilnu Vivan. Market reaction is mixed. Some traders view the tighter controls as a potential drag on liquidity and cross-border activity, hinting at bearish sentiment in the Brazilian crypto ecosystem, while others see it as a step toward greater legitimacy that could attract institutional interest in the long run. For listeners, this marks Brazil's most significant policy shift since the 2021 stablecoin guidelines, positioning the country as a stricter regulatory hub and setting a precedent for other emerging markets grappling with how to balance innovation with oversight. DBS and JP Morgan have announced a joint effort to build an interoperability framework that would allow tokenized deposits to move seamlessly 24/7 between public and permissioned blockchains. The new system aims to bridge the gap between traditional banking infrastructure and decentralized finance, enabling instant cross-chain transfers of digital assets backed by fiat deposits. Market reaction is cautiously bullish. Liquidity providers and institutional investors view the partnership as a step toward mainstream adoption, while some skeptics worry about regulatory hurdles and technical complexity. For listeners, this development signals a tightening integration between legacy financial institutions and blockchain networks, potentially lowering friction for tokenized securities and expanding the use case landscape for digital deposits across multiple chains. NFTs and memecoins are back in the spotlight as the crypto market shifts from caution to a tentative bullish stance. Over the past week, global NFT market cap leapt nearly 12%, climbing from about $35 billion to $39 billion, while memecoin valuations grew 11% from $47 billion to $52 billion. This rebound follows a steep 46% decline in NFTs between early October and early November, suggesting traders are eyeing potential bottoms amid lingering macro uncertainty and U.S. fiscal debates. The rally is uneven. High-momentum collections such as CryptoPunks, plus 22.8%, and Mutant Ape Yacht Club, plus 36.5%, saw sharp sales surges, whereas blue-chip names like Bored Ape Yacht Club and Pudgy Penguins slipped 10-23%. On the chain side, BNB Chain, Polygon, and Flow posted gains of 53%, 93%, and 43% respectively, while other ecosystems lagged. Memecoin performance is more uniform. Top 10 tokens all gained last week. Dogecoin up 8.7%, Shiba Inu 10.4%, Pepe 7%, and Solana-based Bonk and Dogwifhat climbing 11.14%. The uptick is driven by speculative interest, with the Trump-issued memecoin leading at 14.2%. Overall, sentiment leans bullish for risk takers, but liquidity remains concentrated in a few collections, and volatility persists as regulators keep watch. Bitcoin closed the week at a new low, slipping to $106,800 after briefly breaching $107.00 before being rejected and falling $2,000. The rally that pushed it above $107,000 was short-lived, leaving market cap below $21 trillion and dominance under 58%. Altcoins followed suit. Privacy coin ZEC plunged 25% to roughly $485. ICP fell 12.5%, and XMR dropped about 10%. In contrast, Uniswap's token surged 20% to just over $8. Ethereum retreated 2% to $3,550. XRP slid more than 3% to $245, while BNB, Sol, Doge, ADA, Link, Hype, and XLM posted notable losses. The market sentiment is decidedly bearish today, with FUD surrounding the U.S. government shutdown prospects dampening bullish momentum that had briefly appeared after Trump's dividend announcement. Overall, traders are watching closely for any reversal signals, as volatility remains high across the crypto spectrum. CleanSpark, the Nasdaq-listed Bitcoin mining powerhouse that sits just behind Marathon in global hash rate, has announced a $115 billion senior convertible note offering to fuel both its mining expansion and an ambitious push into artificial intelligence infrastructure. The deal is slated to close on November 13, with net proceeds estimated at roughly $113 billion, potentially rising to $128 billion if underwriters exercise their full option package. CleanSpark plans to earmark $460 million for a private stock buyback at about $15 per share, while the remaining capital will go toward enlarging its power and land portfolio, building out data center capacity, repaying Bitcoin-backed debt, and covering general corporate expenses. Market sentiment is cautiously bullish. The announcement comes amid a broader industry pivot to AI and high-performance computing, driven by post-halving profit pressure and declining block rewards. CleanSpark stock already surged 13% after revealing its AI strategy, signaling investor confidence in the dual-stream model. For listeners, this move underscores how leading miners are diversifying beyond pure mining, leveraging surplus energy and infrastructure to capture steadier margins from AI workloads while maintaining their core hash power operations. Tapit Exchange, a global futures trading platform founded in 2021, is celebrating its 4th anniversary on November 17 with a worldwide event titled Number Tapit S4. The company will launch permanent zero-fee spot trading for selected pairs and host a $1 million rewards gala featuring trading contests, referral challenges, and lucky draws that could net luxury prizes such as a Mercedes-Benz S450. Tapit has already amassed over 500 zero users across more than 200 countries, with daily spot volume near $384 billion and futures turnover surpassing $5365 billion, all while maintaining zero security incidents backed by a $50 million insurance fund. The announcement is likely to spark FOMO among traders eager for fee-free exposure and high-value incentives, while reinforcing the platform's bullish narrative of user-first, innovation, and regulatory compliance through licenses from the U.S., NFA, and SVGFSA. For listeners following crypto market dynamics, Tapit's celebration underscores a broader industry trend toward low-cost trading, aggressive promotional strategies, and an expanding ecosystem that blends traditional finance with blockchain technology. Paystan, a beat-woe billion payments engine that moves $20 billion in transactions each year, has just snapped up Bitwidge, a crypto payroll platform that has disbursed more than $400 million in stablecoins to workers across 200 countries since 2014. The deal will embed USDC and USDT salary payouts directly into Paystan's enterprise workflows, giving its 1.0 corporate clients instant access to stablecoin payroll without the delays of ACH or cross-border FX fees. Bitwidge already supports over 90 freelancers and converts fiat wages through Circle and Tether. The merger will push settlement onto Layer 2 chains and Solana for faster execution. The move comes as stablecoin transfer volume hit $9 trillion in 2025, nearly half of Visa's annual throughput, and USDC cleared $23 trillion last quarter alone. Investors are watching closely. A growing share of CFOs now see stablecoins as a competitive edge, and institutional players like BlackRock and MasterCard are integrating on-chain dollar flows. For the broader market, this acquisition signals continued mainstreaming of crypto payroll, easing cross-border remittances, and reducing traditional banking friction for global workforces. Blockchain FX has surged past an $11 million presale milestone, drawing over 300 participants at a current price of $0.03 per token, well ahead of its projected launch rate of $0.05. The platform's unique proposition blends crypto with traditional markets, allowing users to trade stocks, forex, ETFs, and digital assets from one interface, while recently securing regulatory clearance under the Anjuan Offshore Finance Authority. Market chatter is bullish. Early buyers are riding a FOMO wave as the token's potential upside is highlighted. $10.0 could translate into roughly 500 BFX tokens if the bonus code is applied, implying near double value at launch and substantial upside should the token hit $1. Traders note that Bitcoin's slight pullback offers an entry window for high-growth projects like Blockchain FX. For listeners, this development signals a rare convergence of real utility, regulatory approval, and early investor enthusiasm, key ingredients that could propel the asset beyond presale hype into broader market adoption. Bitcoin-aligned meme project Hyper has surged into the spotlight after a wave of political-themed tokens. Trump and $MELANI jumped 14% and 35% respectively in recent days, rekindling appetite for culture-driven assets. The rally stemmed from concentrated on-chain buying and macro optimism, pushing Hyper's presale past $26 million, with whale inflows topping $300K in the last 24 hours. The token trades near $133 today, but is expected to climb as liquidity follows the meme momentum, offering a second-order bet on Bitcoin settlement integration. Meanwhile, new meme brand Maxi Doge, $Maxi, focuses on staking flywheels and community hype, while listed Solana play Useless Coin, $Useless, delivers immediate liquidity with a $185 million cap. Together they illustrate three avenues for traders: BTC-aligned throughput, staking-driven virality, and liquid meme beta. The sector's renewed vigor signals bullish sentiment amid FOMO from political rallying, but volatility remains high. Listeners should monitor on-chain activity and market flows closely. Standard Chartered has teamed up with DCS Card Center to launch Decard, a credit card that lets users spend stablecoins in everyday retail environments across Singapore. The partnership means the bank's payment infrastructure will now process transactions settled in US dollar-pegged tokens, giving merchants and consumers a bridge between crypto holdings and conventional spending. Market chatter is bullish for this move. Industry analysts see it as a step toward broader institutional adoption of stablecoin payments, while some skeptics warn about regulatory headwinds and potential volatility if the underlying token dips. For listeners, Decard represents a tangible example of how banks are beginning to embed digital assets into their product suites, potentially expanding the user base for stablecoins and setting a precedent for similar initiatives in other Asian markets. Bitcoin remains entrenched in a prolonged sideways consolidation around the low $100,000 zone, despite recent market rallies and speculation about a U.S. government reopening. The price has slipped below its 200-day moving average, yet continues to hold above key support levels, including the 44-point RSI line that historically shields against deeper drops. Technical analysts note that the asset is in a corrective impulse. If it can maintain this stance, an upcoming bullish swing could target the $107,500 resistance and potentially breach the 0,618 Fibonacci level near $115,750. Weekly charts still favor the bulls, with stochastic RSI at a low that may trigger a cross-up early next week, hinting at renewed upward momentum. For listeners, this means Bitcoin is in a holding pattern but not yet exhausted. Market sentiment skews cautiously bullish, with traders watching for a breakout that could reset the trend higher. Allora's native token, ALLO, has landed on MEXC's innovation zone, with spot pairs ALLO/USDT and ALLO/USDC going live on November 11. To kick off the listing, MEXC is running a zero-fee promotion for the first 2 weeks on USDT and permanently on USDC, plus an Airdrop Plus event that rewards users with $60 worth of ALLO and an additional 25 USDT in futures bonuses for completing lucky draws. The move signals bullish sentiment from MEXC's side, aiming to attract liquidity and trading volume to a self-improving decentralized AI network that uses ALLO for inference payments, staking, and reward distribution. For listeners tracking emerging AI-driven projects, this listing could boost ALLO's visibility and trading activity, but it remains essential to assess the token's fundamentals and market depth before engaging. Hyperliquid, a rising decentralized derivatives platform, has announced that its founder Jeff will forego venture capital funding to preserve the protocol's neutrality. In an October 22 interview with TBPN, Jeff explained that early external capital could skew development priorities and compromise the egalitarian vision he likens to Bitcoin's original ethos. The decision signals a deliberate slowdown in feature rollouts and resource acquisition, aiming instead to build trust through community-driven growth. Market reaction has been mixed. Some traders view the lack of VC as a bullish sign of long-term integrity, while others see it as bearish due to potential capital constraints that could stall innovation. For listeners, this move underscores a broader debate in crypto about balancing rapid scaling with decentralization ideals, highlighting how governance choices can shape both perception and trajectory for emerging protocols. Uniswap's native token UNI has surged more than 35% in a single day after founder Hayden Adams announced a sweeping governance proposal that activates protocol fees and channels them into a deflationary burn mechanism, dubbed UNification. The plan includes turning on trading fees, using those funds to buy back and permanently destroy UNI, adding fees from the Unichain blockchain to the same pool, and immediately burning 100 million UNI from the treasury. Market reaction was swift. The price leapt from roughly $6.70 to nearly $10. Volume spiked past $3 billion, and UNI outpaced the broader crypto market with a 74% weekly gain versus a modest 6% rise overall. Analysts see this as a bullish catalyst that could trigger a supply shock. Projections range from $500 million in annual burns to roughly $38 million per month in buybacks, suggesting sustained downward pressure on supply. The move also addresses earlier governance centralization concerns by tying Uniswap Labs' actions to community voting. For listeners, the development signals a potential turning point for DeFi protocols seeking sustainable token economics, while keeping an eye on how regulatory scrutiny and market sentiment will shape UNI's trajectory in the coming weeks. Stacks STX has secured a major infrastructure boost ahead of its November 11 hard fork. Binance confirmed it will pause deposits and withdrawals for STX on that date, while keeping spot and derivatives trading live. The exchange will handle all technical adjustments internally, so users need not act. Simultaneously, Hex Trust, Asia's leading digital asset custodian, announced custody and staking support for both Stacks and its BTC wrapped token SBTC, adding Wallet Connect integration to link institutional clients directly with decentralized applications. These moves signal growing confidence in Bitcoin layer DeFi. STX is hovering near $0.42, with MACD and RSI indicators pointing to moderate buying pressure and a potential climb toward the $0.46 $0.50 resistance zone before targeting $0.55 over the coming weeks. If the upgrade proceeds smoothly, bullish sentiment could drive further upside. Any hiccups might temporarily pull prices back to the $0.38 $0.40 range before rebounding. For listeners, this development underscores that exchange support and institutional custody are key levers for a token's ecosystem growth, especially as Bitcoin-based DeFi gains traction among regulated investors. Consensys's legal team has blasted a Senate draft bill that seeks to regulate decentralized finance, arguing it fails to provide clear protection for DeFi operators. The criticism centers on the proposal's vague, safe harbor language, which lawyers say could leave blockchain projects exposed to future regulatory uncertainty and enforcement risk. In reaction, crypto markets have edged lower, with several leading tokens dipping 2–3% as traders weigh potential delays in a comprehensive market structure bill that may not materialize until 2026. The debate underscores the growing tension between lawmakers aiming for oversight and the DeFi community's push for flexibility, leaving investors cautious about how upcoming legislation could reshape the sector's operational landscape. Shiba Inu has posted a staggering sell-off of over 15 billion tokens in the last 24 hours, sending the meme coin sharply lower on most exchanges. The dump is driven by a sudden trend reversal that caught many holders off guard. Price action has shifted from a modest rally to a pronounced bearish slope. Despite the heavy outflow, exchange inflows remain weak. Most SHIB continues to sit in wallets rather than being moved for liquidation, which could blunt an immediate crash and provide some breathing room for short-term buyers. For listeners, this means the market is currently experiencing heightened FUD around Shiba Inu's long-term viability, while traders monitor liquidity levels closely before deciding whether a temporary dip might present a buying window or signal deeper weakness. Bitcoin steadied near $105K today, holding its position after a modest 0.7% rise and a volume of roughly $70 billion in the last 24 hours. The rally is largely driven by Uniswap's governance overhaul. Founder Hayden Adams announced a new fee structure that burns UNI tokens, propelling the coin up 44% and sparking bullish sentiment among holders who see this as proof that protocol changes can deliver value. At the same time, attention has shifted to Monad, an EVM-compatible layer once slated for mainnet launch on November 24. The project is opening a public token sale on Coinbase from November 17, 2022 at $0.25 per MON, releasing 75% of its 100 billion supply. Backed by $240 million in VC funding, Monad promises 10K TPS and sub-second finality, positioning itself as a direct competitor to Solana. However, the sale has faced criticism over heavy insider lockups, 64%, and concerns about a potential dump at token generation event. For listeners, the market today shows a mix of calm and opportunity. Bitcoin remains anchored above $100K. Uniswap's governance-driven surge fuels FOMO among DeFi enthusiasts, and Monad offers early entry for those eyeing high-growth Layer 1 exposure. The coming days will test whether these developments translate into sustained momentum or trigger corrections, as the broader crypto landscape adjusts to new supply dynamics and investor sentiment. BlockDAG BDAG has launched its Amazing Chain Race, a six-phase global buildathon that already drew over 100 projects and promises to exceed 500 by launch, backed by $50 in developer grants and bounties for both solo coders and teams building dApps on its testnet. The network's live infrastructure boasts 15K TPS, positioning it as a high-throughput platform for next-gen financial products. This event-driven momentum fuels bullish sentiment among developers looking to capitalize on fast execution and grant incentives, while the focus on cross-chain DeFi tools also supports Ethena (ENA) and Memecore (MNT). Ethena's expanding DeFi suite is attracting developers keen on liquidity provision, and Memecore's gamified smart contracts have spurred a 230% jump in testnet activity. Ethereum Classic (ETC) remains the stable choice for Solidity projects, offering consistency amid these emerging ecosystems. For listeners, the takeaway is that BDAG's institutional backing and developer-centric initiatives make it the leading candidate for those seeking high ROI through active participation in 2025's booming blockchain landscape. Ripple Labs, the company behind XRP, has announced a strategic pivot toward becoming a global financial infrastructure provider. At the Swell 2025 conference, CEO Brad Garlinghouse revealed that Ripple is now focused on integrating its blockchain technology with institutional-grade finance through acquisitions of Hidden Road and G-Treasury, and the launch of Ripple Prime. These moves have pushed the company's valuation to around $40 billion after a recent $500 million raise. Market reaction has been cautiously bullish. XRP sits near $246, with short-term sell signals but a potential upside toward $270 as institutional adoption gains traction. The backdrop includes growing U.S. regulatory support for crypto, though the stalled Clarity Act and ongoing government shutdown still keep banks hesitant to fully deploy blockchain products. For listeners, Ripple's expansion could signal a tipping point where traditional finance starts embedding decentralized tech into its core operations, potentially boosting XRP's utility and long-term value. Uniswap's native token UNI has surged roughly 30% after the community-approved UNification proposal went live, pushing prices above $870 and sparking a wave of FOMO among traders. The move introduces a fee switch that reallocates between 1/4 to 1/6 of protocol fees into a smart contract, dubbed the token jar, allowing holders to burn UNI in exchange for equivalent crypto assets. CryptoQuant's CEO Kai-Young Ju predicts the mechanism could trigger parabolic growth, estimating up to $500 million in annual burns based on current volumes. Market sentiment skews bullish as investors anticipate higher scarcity and a cleaner revenue model. However, some analysts warn that the switch will eliminate scammy pools that rely on zero fees, potentially reshaping trading dynamics. The proposal also marks a structural shift. Uniswap Labs will absorb most foundation staff, drop interface and API fees to zero, and launch an annual 20 million UNI development budget starting January 2026, signaling a pivot toward long-term protocol sustainability amid a more favorable regulatory backdrop. Uniswap's core governance token UNI has taken a new turn as founder Hayden Adams unveiled the UNification proposal, a sweeping overhaul that could unlock up to $38 million in monthly buybacks. The plan would re-engineer UNI's tokenomics, potentially tightening supply and boosting scarcity for holders. Market chatter is already split. Bullish voices point to higher demand and a stronger price floor if the buyback engine activates, while skeptics warn of dilution risks if the proposal fails or stalls in voting. For listeners tracking DeFi dynamics, this move underscores how protocol-level changes can directly shape token economics and investor sentiment, making UNI's future trajectory a key watchpoint for anyone exposed to liquidity pool governance. Bitcoin and Ethereum remain in a consolidation phase despite fresh institutional inflows. Bitcoin is trading around $105,368 after a 15% pullback, while Ethereum sits near $3,581 following a modest rebound from early November lows. Market cap has slipped 19% to $354 trillion, and the Fear and Greed Index registers at 31, signaling lingering apprehension. Technicals show Bitcoin testing resistance near $107.60, with a double-top neckline still intact. Ethereum holds above its April trendline, but faces potential pressure if it dips below $3,425, which could trigger further support breaches. Institutional activity. $137 billion of ETH added to holdings and continued BTC spot ETF inflows has helped cushion the slide. Yet whale selling remains evident as major holders shed positions post $100,000 peak. For listeners, the market is in a holding pattern. Volatility is muted, but any shift below key support levels could reignite bearish sentiment, while sustained institutional backing may sustain the current equilibrium. U.S. Treasury and IRS have cleared a regulatory path that lets cryptocurrency exchange traded products, ETPs, stake digital assets while keeping their current tax-qualified status. The new guidance confirms that staking rewards earned by these investment trusts will be treated as ordinary income, preserving the favorable 0% capital gains treatment they enjoy under Section 1441. Market reaction has been largely bullish. Investors see a fresh avenue for yield generation without jeopardizing tax efficiency, sparking FOMO among passive holders and institutional players alike. The decision comes amid growing demand for staking exposure in regulated vehicles and follows recent Treasury proposals to codify digital asset derivatives. For listeners, this development signals that the U.S. regulatory framework is finally aligning with the evolving crypto ecosystem, potentially boosting liquidity and adoption of staking-enabled ETPs across the market. Coinbase has relaunched U.S. token sales after a 7-year pause, unveiling a new platform that blends community fundraising with regulatory safeguards. The first offering will launch on November 17 for Monad, a Layer 1 chain that is releasing 75% of its supply and had already raised $248 million in prior rounds. Investors can bid over a week using USDC. An algorithm favors smaller bids to broaden participation, while a 6-month lockup and anti-flipping rule penalize rapid resales. Coinbase's move follows a $375 million acquisition of Echo, the angel list-style crypto fundraising engine that has powered high-profile launches like Mega ETH's $50 million raise in 5 minutes. The new system promises greater transparency for projects, verifying teams, token structures and vesting plans, and removes buyer fees while charging issuers a cut of proceeds. Market sentiment swings between cautious optimism and FOMO. On one hand, the regulated framework may attract institutional capital and reduce volatility. On the other, stricter rules could dampen the speed and scale of token launches that previously fueled hype. For listeners, this development signals a shift toward more mature, compliant public offerings in the U.S., while still offering everyday investors access to fresh projects under tighter oversight. Abu Dhabi-based Phoenix Group has just switched on a new 30 MW hydropower-backed mining complex in Addis Ababa, partnering with Ethiopia's state-owned Ethiopian Electric Power. The activation marks the firm's first major footprint in Africa and expands its portfolio of renewable-powered facilities worldwide. For market watchers, the move signals Phoenix's aggressive push into emerging markets, potentially boosting its hash rate capacity and reinforcing a narrative that sustainable mining can thrive outside traditional hubs. Sentiment skews bullish for the company, as the project promises lower energy costs and regulatory support, but some investors caution about local grid stability and geopolitical risks in the region. Overall, the launch positions Phoenix at the intersection of clean energy and crypto mining, hinting at broader industry trends toward greener operations amid growing scrutiny over environmental impact. Oak Mining has launched a mobile-first mining platform that lets users earn Bitcoin and Dogecoin straight from their smartphones without any hardware or technical setup. The service claims to automate the entire process, handling node operation, pool selection, and reward distribution behind the scenes. While the move taps into the growing demand for decentralized earning solutions, it also raises questions about scalability and security as mining becomes increasingly centralized in cloud services. Market chatter is mixed. Some traders see this as a bullish signal that lower barrier access could broaden the user base, while others warn of potential FUD around regulatory scrutiny and the environmental impact of off-site mining farms. For listeners, Oak Mining's debut highlights the trend toward frictionless crypto participation, but it also underscores the need to scrutinize new platforms for transparency, fee structures, and compliance before diving in. Bitcoin's rally has stalled as ETF inflows and institutional buying have slowed, dampening the bullish momentum that carried the market this year. After a strong run powered by fresh spot ETF capital and large strategy-level purchases, recent data shows those inflows are flat, leaving Bitcoin hovering near its 52-week low. The lack of new institutional demand has triggered a mild bearish tilt, with traders citing uncertainty over U.S. regulatory timelines and the looming federal shutdown as key factors eroding confidence. For listeners, this means that while Bitcoin remains a high volatility asset, the current pause in inflows signals a potential consolidation phase, an important context for anyone watching the market's next move. Stablecoins are under a new pressure test as institutional players tighten their grip on the market. A wave of banks and asset managers is now committing capital to only the most resilient projects, pushing smaller issuers toward consolidation or exit. This shift has sparked a mixed reaction. Bulls see it as a quality filter that could shore up confidence in digital fiat, while skeptics warn of heightened volatility if liquidity dries up for fringe coins. The trend reflects broader regulatory momentum, with regulators demanding stronger reserves and transparency, and market participants scrambling to align with the new compliance standards. For traders and investors, the key takeaway is that only stablecoins with robust backing and clear audit trails will weather the storm. Those lacking institutional endorsement risk a sharp pullback as liquidity providers retreat. Signum's Future Finance 2025 report, surveying over 1,000 institutional and professional crypto investors across 43 countries, shows that the focus is shifting from pure speculation to strategic diversification. The data reveal that 61% of respondents plan to bump up their digital asset allocations, while only 4% intend to pull back. Yet the sentiment curve suggests a pivot toward caution. Within 12 months, many investors expect neutrality or even bearishness on crypto exposure. This signals a mixed market mood. FOMO still fuels allocation growth, but FUD looms as short-term volatility remains a concern. For listeners navigating the current landscape, the takeaway is clear. While crypto is gaining traction as a portfolio component, institutional players are hedging against near-term risk, balancing optimism with prudence. Numes, ticker $NNZ, is pushing a new meme coin model that blends hype with real utility. The project has just closed Phase 3 of its presale, raising $20,831 from 125 holders and lifting the token price to $0.151. The sales burn mechanics cut unsold supply each phase, tightening scarcity while locked liquidity protects against rug pulls. Market chatter is bullish. Early participants already see a 22% gain, and FOMO is building as community-driven staking, rewards promise higher yields for longer lockups from 30 to 365 days. The narrative positions Numes as the next breakout story for 2025, offering transparent burns, a growing holder base, and partner drops that stream extra tokens into wallets. For listeners tracking emerging ecosystems, Numes exemplifies how a meme coin can evolve into a structured platform with real incentives, potentially reshaping short-term sentiment in the altcoin space. Bitcoin faces a fresh legal setback, as the U.S. 11th Circuit Court of Appeals has dismissed a massive $364 million claim against the federal government. The lawsuit, filed by convicted fraudster Michael Prime, sought compensation in Bitcoin for alleged losses tied to his illicit schemes. In its ruling, the court cited the claim's extreme lateness and insufficient evidence, effectively crushing what could have been one of the largest crypto-related restitution cases ever attempted. The decision sends a clear signal to the market. Regulatory bodies remain resilient against sizable private claims, reinforcing the notion that U.S. institutions will not be easily held liable for crypto disputes. For traders and investors, this outcome dampens any potential bullish narrative around government liability in digital asset litigation, maintaining a cautious stance amid ongoing FUD over legal exposure. In broader context, it underscores the importance of timely, well-substantiated claims in a rapidly evolving regulatory landscape, where courts are increasingly vigilant against unverified allegations. Uniswap's native token UNI has surged over 30% in a single day, catapulting it to the top of both daily and weekly performance charts. The rally followed CEO Hayden Adams' announcement on X that he will submit his first governance proposal, which seeks to burn 100 million UNI from the Treasury using network and Unichain sequencer fees, and introduce protocol fee discount auctions to tighten liquidity incentives and internalize MEV. Investors reacted sharply. FOMO-driven buying pushed UNI to its highest level in nearly 2 months, while the broader market remains muted amid a bearish backdrop. Analysts note that if Bitcoin's bullish momentum resumes, UNI could sustain its uptrend. Otherwise, a correction looms as overall crypto sentiment stays cautious. The move signals Uniswap's push for protocol growth and tighter tokenomics, potentially reshaping liquidity provision dynamics across the DeFi ecosystem. The IRS has rolled out a new set of regulations that clarify how cryptocurrency investment funds can collect staking rewards while staying within defined tax boundaries. The announcement means that pooled crypto vehicles, such as ETFs, trusts, and other managed structures, can now legally claim staking income without triggering immediate taxable events for investors. Market chatter is already picking up. Many analysts view the move as bullish for institutional adoption because it reduces compliance friction and removes a major uncertainty that previously made staking a gray area. The guidance also signals to retail participants that staked assets may become more attractive once tax treatment stabilizes, potentially easing some FUD around long-term yields. For listeners tracking crypto's regulatory trajectory, this development marks a tangible step toward mainstream integration, offering clearer pathways for both managers and investors while maintaining the IRS focus on revenue integrity. Ripple's chief technology officer, David Schwartz, recently stepped into the spotlight to clarify how Bitcoin can serve as a viable medium for payments, even when its price trajectory remains volatile. In a concise briefing, Schwartz outlined that Bitcoin's underlying protocol, specifically its settlement speed and low transaction costs, makes it suitable for cross-border remittances and retail point-of-sale scenarios. He emphasized that the network scalability improvements, such as Taproot and Lightning Network integration, are key to reducing latency and enhancing user experience. The announcement has sparked a muted bullish pulse among market watchers, with traders noting that institutional interest in Bitcoin-based payment infrastructures could bolster demand for the digital asset. However, some analysts caution that price swings may still deter mainstream adoption until regulatory clarity solidifies. For listeners, this insight positions Ripple as a bridge between traditional finance and decentralized payments, hinting at a broader trend where crypto assets evolve beyond speculative instruments to functional transaction layers in global commerce. Aptos Apt is heading into a critical week as it prepares to unlock 11.3 million tokens, worth roughly $38 million at current prices, on November 12. The release adds about 1% of the total supply to circulation, and traders are bracing for potential selling pressure that could test the support zone around $280-$30, a level already probed 5 times within a descending channel. Despite a brief fake-out below key support earlier this week, Apt has rebounded to about $330, indicating that bullish sentiment remains active but fragile. The price sits near the 200 EMA and SMA, where resistance could trigger a pullback if the new supply floods the market aggressively. The broader context shows Apto's continuing ecosystem growth, with Chainlink integration and partnerships that fuel adoption. Yet competition from Solana and Sway keeps expectations tempered. If buyers absorb the unlocked tokens, Apt may hold steady in the $330-$350 range. If not, a temporary dip could occur before a recovery. The coming days will reveal whether the market can sustain this supply wave without eroding its technical structure. Bitcoin is hovering near $105.00 after slipping past the $107.00 level that had acted as support since April 2025, and now turns into a hard resistance zone. The drop comes as BTC has shed both its 200-day MA and EMA, which converge around $107,000, amplifying bearish pressure until a breakout occurs. Despite this short-term pullback, longer-term structure remains intact. The weekly candle closed above the 50-week EMA, a support line that held since 2023, and an unfilled fair value gap near $90.00 is still drawing liquidity. Market sentiment skews cautious. Risk markets have steadied after U.S. political uncertainty eased, but traders eye the active liquidity pocket below $104,950 for potential short-term moves. Overall, Bitcoin's path forward hinges on whether it can reclaim the $107,000 resistance and sustain momentum above the 50-week EMA. Bitcoin sits at the center of today's market chatter as U.S. politics and fiscal policy converge on a potential liquidity boost. A 41-day government shutdown is poised to end once Senate approval moves into the House and receives the president's signature, with polymarket odds over 90% that the closure will lift this week. The announcement has already lifted equities, gold, silver, and Bitcoin, sending BTC higher on a risk-on wave driven by expectations of fresh capital flowing into the system. Concurrently, former President Trump unveiled a tariff dividend proposal, an estimated $2.0 benefit for every American, that could inject hundreds of billions into the economy if enacted. While the exact form remains uncertain, any fiscal stimulus is likely to lift consumer spending and bolster Bitcoin's appeal as an alternative to a weakening dollar. Historically, BTC rallied sharply after shutdowns ended in 2018 and 2019, though those moves were often part of broader market recoveries and typically lagged weeks behind. Today's sentiment skews bullish, fueled by FOMO around potential liquidity and a risk-on momentum that could spill into global markets. However, if the legislation stalls or the dividend fails to materialize, a short-term correction may follow, potentially resetting the stage for a longer-term accumulation cycle. Zcash, ZEC, and its emerging AI partner DeepSnitch AI have become headline-grabbing assets after former U.S. President Donald Trump announced a potential $2.0 tariff dividend for most Americans via Truth Social. The proposal has already lifted crypto's total market cap by about 2% in just 2 days, sparking bullish sentiment across the space. Traders view ZEC's recent surge, over 700% since early October, as driven more by substantive upgrades than hype. ZK Snark enhancements, a new Zashi wallet, and Solana integration that speed up private transactions. Meanwhile, DeepSnitch AI, whose token has climbed roughly 50% thanks to its real-time market scanning agents, is seen by some as the next big play if the dividend materializes. Market watchers note that while Supreme Court approval odds hover around 20–25%, the mere possibility of a stimulus injection fuels FOMO and inflates valuations, positioning ZEC between $850 and $1,200 in late 2026 under continued bullish conditions. BNB Chain, the backbone of the world's largest smart contract blockchain by daily volume, is rolling out a 2-day push in Buenos Aires to turbocharge local builders. From November 15–16, developers will compete in BNB Hack Buenos Aires, part of the new global BNB Hack local series that opens direct access to a $1 billion builder fund. Teams can tackle 8 tracks: trading, RWA, AI, DeFi, payments, and wallets, and vie for a $160 zero prize pool plus up to $50 zero in ecosystem support, with fast-track interviews for the most valuable builder residency. The event kicks off pre-hack onboarding on November 12, with registration closing on the 10th. On the 16th, BNB Chain will host Demo Night, offering live demos, keynotes, and panels to connect builders, investors, and ecosystem leaders. Latin America's Web3 scene is booming. BNB Chain's move signals bullish sentiment for regional innovation and a clear push to lower entry barriers for developers seeking funding and mentorship. Dogecoin remains the focus of today's market chatter, as its price has stalled in a tight sideways range between roughly $0.176 and $0.118, according to recent technical analysis. The coin is currently exhibiting lower highs and lower lows, a clear bearish pattern that signals limited upside potential. Analysts point out that any brief rally could simply serve to drain liquidity around the $0.188 level, after which the price may quickly retreat back toward support near $0.165 or $0.176. With the broader crypto market leaning downside, sentiment around Dogecoin is increasingly FUD-laden. Traders are wary of a false breakout that could trigger a sharper decline. For listeners watching the scene, the key takeaway is that without a decisive break above resistance at $0.188, the coin is likely to continue its downward drift, and support at $0.176 will be critical for any attempt at recovery. Tapbit, a fast-growing futures exchange founded in 2021, announced it will celebrate its 4th anniversary on November 17 with a global event titled Number Tapbitan S4. The company will roll out permanent zero-fee spot trading on selected pairs and launch a $1 million rewards gala featuring trading contests, referral drives, and lucky draws that could net luxury prizes like a Mercedes-Benz. Tapbit's daily spot volume sits at roughly $38 billion, while futures turnover hits $536 billion, backed by a $50 million insurance fund and compliance licenses from the U.S., NFA, and St. Vincent's SVGFSA. The announcement is likely to spark FOMO among traders eager for fee-free access and high-value incentives, while also reinforcing Tapbit's bullish positioning as a secure, user-centric platform poised to expand into AI-driven strategies and Web3 integrations in the coming year. For listeners, this signals that Tapbit continues to push industry standards with robust security, expansive contract offerings, including up to 150 times leverage, and advanced tools like copy trading bots, all aimed at solidifying its place as a key player in the evolving crypto futures landscape. Lbank, a Singapore-based exchange with a global user base of over 20 million, just wrapped up its 7-day stablecoin earn program. The campaign drew more than 93,000 participants and pushed locked stablecoin value to $67.4 million in under a week, signaling strong demand for the platform's high-yield products. Market reaction has been bullish. Traders view the rapid accumulation of liquidity as confidence in Lbank's secure, user-friendly yield framework, while some FOMO is evident around the one-click entry and daily settlement features that lower barriers to participation. For listeners, this event underscores how centralized exchanges are increasingly offering DeFi-style returns without compromising security, potentially reshaping expectations for stablecoin-based earning products in the broader crypto ecosystem. Bitcoin surged past $106.0 after the U.S. Congress passed a continuing resolution to end a historic government shutdown that had stalled federal operations for over 40 days. The move lifted risk on sentiment across markets. Altcoins followed with double-digit gains, and trading volume spiked as investors reassessed liquidity conditions. The announcement coincides with speculation that former President Trump may introduce $2.0 tariff-funded stimulus checks, a potential influx of cash that could further fuel speculative flows into crypto assets. For listeners, the key takeaway is that the government's return to normalcy and the possibility of new fiscal injections are tightening a bullish narrative, while uncertainty over legislative details keeps some FOMO alive amid a broader risk-on rally. Ethereum's expanding ecosystem of stablecoins and real-world assets, RWAs, is now shaping the next price cycle, a shift highlighted by Bitmain's latest $12.4 billion bet. The mining giant announced that it will allocate the proceeds to bolster Ethereum's infrastructure and token utility, signaling confidence in the network's growth trajectory. Market chatter has turned bullish as investors see this move as validation of Ethereum's role as a foundational layer for decentralized finance, while some skeptics caution that heavy investment could trigger short-term volatility. For listeners, the takeaway is clear. Bitmain's capital injection underscores a broader industry pivot toward Ethereum-based stablecoins and asset tokenization, potentially tightening demand fundamentals and influencing price dynamics in the coming months. The United States Senate's new draft proposal aims to split regulatory oversight of cryptocurrency markets between the Commodity Futures Trading Commission and the Securities and Exchange Commission, a move that could bring clearer, more specialized rules for digital assets. The bill was released by a Senate committee focused on financial regulation, signaling lawmakers' intent to address gaps left by overlapping jurisdictions and recent market volatility. Early reactions from traders are mixed. Some see the proposal as a step toward stability and reduced regulatory friction, potentially boosting confidence in institutional participation, while others warn it could introduce additional compliance layers that may dampen innovation. The context for investors is that this development comes amid growing scrutiny of crypto exchanges and token offerings, so any shift in oversight structure will likely influence market sentiment and shape the trajectory of future regulatory actions across the sector. Uniswap's core team has unveiled a bold initiative aimed at tightening the supply of its native governance token, UNI. The Uniswap Foundation and Uniswap Labs have jointly proposed burning up to 100 million UNI tokens over the coming months, targeting a significant reduction in circulating supply while rewarding long-term holders through a more attractive distribution model. The burn plan is set to be executed in phases, with quarterly allocations announced ahead of each tranche. By systematically removing liquidity from the market, the protocol seeks to create scarcity that could lift the token's intrinsic value and reinforce its role as a governance asset within the decentralized exchange ecosystem. Market reaction has been cautiously bullish. traders are watching how the burn will affect price volatility and long-term demand. Some speculate it could curb speculative dumping by tightening supply, while others warn that without complementary utility upgrades, the move might only generate short-term FOMO before stabilizing. For listeners, this development underscores Uniswap's ongoing efforts to align token economics with user incentives, positioning UNI as a more defensible asset amid growing competition in DeFi. The burn's success will hinge on execution timing and community support, factors that could shape the protocol's trajectory in the coming months. The Monad ICO has just disclosed that it has loaned a staggering 160 million tokens to 5 market maker firms through a recent Coinbase token sales filing. This move, the first of its kind to detail such large-scale liquidity provisioning publicly, shows Monad's strategy to shore up trading depth and reduce price volatility by anchoring its token in high-volume venues. For traders, the loan structure signals both opportunity and risk. On one hand, the influx of liquidity could dampen short-term swings and support a steadier price trajectory, appealing to those wary of sudden dumps. On the other, concentrating 160 million tokens with a handful of market makers may raise concerns about concentration risk and potential manipulation if any single firm shifts its position. Listeners should note that Monad's token was launched amid a crowded altcoin space, where many projects rely on market maker support to survive early liquidity gaps. This disclosure provides rare transparency into the mechanics behind those relationships, giving investors clearer insight into how Monad intends to maintain order in its secondary market. Nanyang Technological University in Singapore has teamed up with Zero Gravity to launch a $384 million research hub focused on decentralized, blockchain-based artificial intelligence. The joint venture will fund the development of transparent AI systems that run on distributed ledgers, aiming to enhance security and auditability for machine learning models. Market chatter around the partnership is largely bullish, as the collaboration signals continued institutional interest in marrying AI with Web3 infrastructure, a trend many investors view as a catalyst for broader adoption of blockchain-enabled data ecosystems. For listeners tracking crypto innovation, this move underscores that academia and startup ecosystems are aligning to push the envelope on privacy-preserving AI, potentially opening new avenues for tokenized AI services and smart contract integration in the coming years. Microsoft Research, in partnership with Arizona State University, has unveiled its latest experiment, the Magentic Marketplace, a digital arena where hundreds of AI agents engage in a simulated economy, competing, collaborating, and occasionally deceiving one another. The project was designed to probe how autonomous systems behave under pressure, testing their resilience when faced with deception and overload. Early observations show that the bots struggle to maintain optimal performance when confronted with misleading information or sudden spikes in transaction volume, leading to erratic decision-making and occasional system failures. For crypto traders, this raises a cautionary note. As AI becomes more integrated into trading algorithms and liquidity provision, the potential for cascading errors increases. While the initiative is still academic, its implications hint at heightened volatility risk if similar autonomous agents are deployed in live markets. Stakeholders should monitor how these findings influence future regulatory discussions on algorithmic trading safety and consider the broader impact on market stability. President Donald Trump has pushed a bill, known as the Genius Act, to overhaul the U.S. payments backbone with crypto-based technology by 2028. The law is already enacted, but detailed operating rules and regulatory frameworks remain unfinished. Trump's recent remarks praised the rapid growth of the crypto industry and declared that stablecoins can help preserve the dollar's dominance while modernizing settlement speeds and cutting costs. Market reaction has been mixed. bullish sentiment among technologists who see a chance for tokenized cash to replace legacy clearing systems, yet bearish caution from traditional banks wary of new capital and liquidity standards that could lag behind implementation. For listeners, this means the U.S. is moving toward a multi-rail payment stack, stablecoins and DLT handling back-end settlement, while consumer interfaces stay unchanged. Full adoption will likely extend beyond Trump's term as regulators finalize rules and acquirers test pilots. Avalanche's native token AVAX is eyeing a breakout above $20 after the U.S. Treasury and IRS issued Revenue Procedure 2025-31, creating a tax safe harbor that lets regulated crypto ETF stake assets like ETH, SOL, and potentially AVAX, while passing rewards through to investors. The guidance removes previous legal gray areas and signals that institutional capital could flow into proof-of-stake networks. Market chatter is mixed. Bulls see the regulatory clarity as a catalyst for renewed demand, but skeptics point to recent volatility and risk-off sentiment across crypto assets. For listeners, this development places AVAX among the altcoins most likely to benefit from ETF staking, positioning it at a critical psychological level, where a sustained move above $20 could ignite further upside momentum. Uniswap, the leading automated market maker on Ethereum, has rolled out a new governance initiative dubbed the UNification Proposal. The package moves the protocol from its current fee-free state into a model that activates trading fees, burns a portion of UNI tokens, and realigns incentives across its ecosystem. This shift aims to strengthen long-term sustainability by reducing token dilution while giving holders more skin in the game. Market chatter has turned bullish on the proposal's potential to increase protocol revenue and tighten UNI scarcity, sparking FOMO among liquidity providers who anticipate higher fee income. However, some analysts caution that the immediate burn could depress short-term supply dynamics, introducing a mild bearish tilt for those holding large UNI balances. The broader context is Uniswap's ongoing effort to transition from a purely permissionless DEX into a more structured governance framework. By tying fees and token economics together, the platform seeks to balance decentralization with financial viability as competition intensifies in the DeFi space. Ethereum is currently locked in a tight range, hovering around $3,580 after a period of constrained intraday swings and minimal volatility. The digital assets price has been circling within a narrow band between roughly $3,500 and $3,680, with only a modest 24-hour drift noted by major trackers. This static behavior signals that the market is in a consolidation phase, possibly setting up for a breakout or a further tightening squeeze. The muted movement has left sentiment mixed. Traders wary of a sudden pullback are watching closely, while others see an opportunity for a short-term rebound if the support levels hold. The lack of significant price action suggests caution rather than confidence, indicating that any forthcoming shift, be it bullish or bearish, will likely come from external catalysts rather than internal momentum. For listeners monitoring Ethereum's trajectory, this period underscores the importance of watching liquidity and order book depth. A sudden spike in volume could break the coil either up toward $3,680 or down near $3,500, potentially triggering a broader market reaction across the crypto ecosystem. Keep an eye on forthcoming news and on-chain metrics to gauge when the next move might materialize. Bitcoin has bounced back after chatter that a U.S. funding deal could inject roughly $150 billion from the Treasury General account into markets. The rally is tied to expectations that government shutdown fears are easing and that liquidity will surge, lifting both traditional and digital asset classes. Sentiment remains split. Some strategists view the move as evidence of a nascent bull cycle driven by rising hash rates and improving liquidity conditions, while others caution that Bitcoin must close above $110.00 to confirm sustained strength, warning that overextended commodities could trigger corrections that spill into crypto. For listeners, the key takeaway is that macro funding optimism is reshaping risk appetite, but the path ahead hinges on whether Washington's stimulus expectations hold, and if Bitcoin can navigate the current bearish sentiment without breaking critical support levels. Dogecoin has steadied after a sharp pullback, with analysts noting a solid bounce off its weekly 200 EMA near $0.16 that keeps the coin within its year-long channel. The latest chart from independent trader Kevin at Kev Capital TA shows Doge trading around $0.18, with the 200 EMA acting as a key defensive line. He flags a critical pivot at $0.202 on 3-day closes. If the price can reclaim that level, it would lift Doge above the 50% Fibonacci retracement and its own short-term EMA/SMA, potentially sparking upward momentum, provided Bitcoin stays above $106,800. The market sentiment remains cautious. Buyers are holding at lower support near $0.14, while sellers repeatedly test resistance around $0.24 to $0.305. The next hurdle is the $0.202 trigger. Failure could lead to a retreat toward deeper weekly shelves at $0.09 and $0.05. For listeners, this means Doge is currently range-bound, but poised for a breakout if it can clear the 3-day close threshold and BTC maintains strength. CleanSpark, a major Bitcoin miner, has announced a $115 billion convertible senior notes, offering to bolster its mining operations and repurchase shares. The private placement will sell notes at a conversion rate of roughly 52 shares per $1.10, setting a conversion price near $19.16. About 27% above the company's recent closing price. Investors also receive a 13-day option to buy an additional $150 million in notes, potentially raising total proceeds to $128 billion. The capital will be split, about $460 million earmarked for share repurchases at $15.3 per share, while the remainder will fund power and land acquisitions, data center development, and repayment of Bitcoin-backed credit lines. The notes carry no interest and mature in February 2032, unless converted earlier. This move comes as CleanSpark's output has slipped, 612 BTC mined in October versus 706 in March, and hash price revenue dropped to $41 per terahash, the lowest since April. With network difficulty hitting a record 155.97 trillion, miner profitability is tightening across the sector, adding bearish pressure despite CleanSpark's expansion plans. Virtual asset derivatives have become the fastest-growing segment of the crypto market, with monthly trading volume hitting a record $894 trillion in 2025, surpassing spot markets and accounting for roughly 76% of all crypto trades. This explosive growth is driven by futures, options, perpetual swaps, and CFDs that let traders bet on price swings without owning the underlying token, enabling both hedging and speculative strategies. In Brazil, regulators are scrambling to define a legal framework for these instruments. The Comissão de Valores Mobiliários, CVM, has confirmed its authority over derivatives, but omitted a clear definition of derivative contract, creating regulatory gray areas that could exclude certain crypto products from oversight. By applying the Howey test, requiring investment, expected return and third-party effort. The CVM aims to classify collective investment contracts, yet uncertainty remains about which swaps or perpetuals fall under its jurisdiction. The impact on sentiment is mixed. Investors face FUD over potential regulatory crackdowns and capital flight if foreign firms deem Brazil too risky. Meanwhile, domestic participants see a bullish opportunity to tap into the booming derivatives market once clarity arrives. For listeners, this underscores that while crypto derivatives are now the dominant trading vehicle worldwide, their future in Brazil hinges on forthcoming regulatory decisions that will shape risk exposure, market liquidity, and international competitiveness. Ethereum has slipped back into profitability after a brief dip, giving traders fresh room to push the price toward a $4.0 target. The digital asset's recent rebound followed a period of consolidation around the $3.800 level, which still acts as a key resistance zone. Market sentiment is cautiously bullish. Investors are showing renewed confidence, but many remain wary of a potential pullback if the $3.800 hurdle proves too stubborn. This development comes after several weeks of sideways movement and heightened volatility across the broader crypto market, where altcoins have struggled to find direction. For listeners monitoring Ethereum's trajectory, the current trend suggests that a breakout above $3.800 could ignite a rally toward the $4.0 mark, though traders should stay alert for any signs of renewed pressure at that resistance point. Cardano, ADA, remains a top 10 altcoin, but its price has stalled near 2024 levels, hovering below $0.60 after a 30% pullback. Yet on-chain data shows a quiet but significant shift. Over the last 4 days, whales and sharks, holders of 100,000 to 100 million ADA, purchased roughly 348 million tokens, worth about $204 million, representing almost 1% of total supply. This is the strongest buying spree since May, occurring while retail traders retreat, keeping volatility low but signaling smart money accumulation. Historically, ADA's biggest rallies followed long consolidation periods. 2023 and 2024 saw 200–300% gains after similar bases. With October's market conditions mirroring those setups and a forthcoming Cardano summit in Berlin, the stage is set for potential breakout momentum, though overall altcoin sentiment remains cautious, reflected by a low season index that could temper enthusiasm. The spotlight this week falls on a handful of DeFi tokens as the U.S. government shutdown edges toward resolution. Aster has seen a sharp whale accumulation, with large holders adding nearly 5 million tokens in just 24 hours, an 87% jump to about 61 million Aster, worth roughly $5.5 million at today's price. Pendle PENDLE follows suit. Whale activity lifted holdings by 410,000 tokens, a $1.12 million increase, as the token hovers near its $2.50 support and eyes a key resistance around $3.45. Uniswap, UNI, also attracts big money buying, despite trading in a falling wedge that could signal a reversal if the upper trendline breaks. These moves suggest growing confidence among institutional players ahead of policy clarity and a liquidity boost once federal operations resume. The market mood leans bullish for these DeFi names, with whale accumulation hinting at potential upside if key levels hold. For listeners, this signals that risk assets are re-entering the radar as the shutdown's uncertainty wanes, positioning the tokens for possible gains in the coming days. Bitania.com has emerged as a headline-grabbing privacy-first exchange in the 2025-2026 lineup of no-kick platforms. The company, still new to the market, is positioning itself as a top choice for traders who want to avoid identity verification, while maintaining access to major and niche tokens. Its zero KYC policy has sparked buzz among privacy-conscious users, generating a wave of FOMO as they seek to sidestep regulatory hurdles. In the broader crypto scene, the move fuels a bullish sentiment toward decentralized trading solutions, but it also raises FUD for regulators concerned about money laundering risks. For listeners navigating this space, Bitania's launch underscores the growing demand for privacy-centric exchanges and highlights the importance of understanding local legal frameworks before engaging with any platform that bypasses traditional KYC requirements. In a high-profile legal drama that rattled crypto circles, former Crocodile of Wall Street, Heather Razzlekin Morgan, was sentenced to 18 months in federal prison for aiding her husband Ilya Lichtenstein in laundering an estimated $13 billion of stolen Bitcoin back in 2016. The case resurfaced when Morgan publicly denied claims that President Donald Trump had commuted her sentence, a statement that was quickly debunked and labeled misinformation by authorities. The denial sparked a brief surge of FUD among investors, with some fearing regulatory crackdowns on illicit crypto flows could tighten enforcement globally. However, the market largely shrugged off the rumor, as the underlying asset, Bitcoin itself, remained on a steady upward trajectory, buoyed by broader institutional adoption. For listeners tracking compliance trends, this episode underscores that even high-profile figures cannot escape legal accountability when laundering massive digital assets, and it highlights the ongoing scrutiny regulators maintain over illicit crypto activity. BlockchainFX (BFX) has positioned itself as a revenue-sharing platform that rewards holders daily in USDT. The project recently closed its presale, raising over $10.9 million from more than 15,000 participants, and now boasts a beta with 10,000 plus active traders generating trading volume. Each transaction fee is split, sending half into a staking pool that pays stable coin dividends every day. No vesting schedules or speculative tokenomics, just real platform income. The market reaction has been cautiously bullish. Investors are drawn to BFX's tangible utility model amid a broader shift toward projects that deliver measurable value rather than hype. This contrasts with the recent pressure on Apto's apt, where a 16% supply unlock is nudging prices down, and Chainlink Link, which sees whale accumulation but ongoing volatility. For listeners, BFX represents an emerging trend in crypto. Platforms monetizing trade activity to generate passive income for token holders, potentially redefining how value is distributed within the ecosystem. SoftBank has liquidated its entire Nvidia holding, selling the stake for roughly $58 billion as it pivots to invest more heavily in OpenAI. The move signals a strategic realignment toward generative AI and suggests SoftBank is reallocating capital from semiconductor exposure to the burgeoning AI services market. Market reaction has been mixed. Nvidia shares have seen a mild pullback amid concerns that the divestiture could reduce institutional support, while investors bullish on AI growth view the shift as a positive bet on OpenAI's future upside. For those tracking the crypto-tech intersection, this development underscores how traditional tech giants are reshaping their portfolios to stay ahead of rapid AI innovation, potentially tightening competition for both Nvidia and emerging AI platforms. Exodus Movement Inc., the fintech arm of the well-known crypto wallet brand, has announced a strategic acquisition that could reshape Latin American stablecoin payments. On November 10, 2025, Exodus completed its purchase of Grateful, a Montevideo-based company that orchestrates wallet-to-wallet transactions, QR point-of-sale solutions, off-ramping, and e-commerce checkouts for merchants across Uruguay and beyond. The deal signals a bullish push into merchant services, giving Exodus an instant foothold in a region where stablecoin adoption is accelerating, but infrastructure lags behind. By integrating Grateful's payment layer, Exodus aims to slash payout costs and speed up settlement times, key pain points that have kept many Latin American merchants on the sidelines. For listeners tracking market dynamics, this move could amplify Exodus' competitive edge against other wallet providers, expanding into merchant ecosystems. The acquisition is likely to spark FOMO among developers seeking stablecoin payment APIs, while regulators may watch closely as cross-border payouts scale. Overall, the transaction injects fresh momentum into the Latin American crypto payment space, positioning Exodus as a more complete ecosystem player. Trump has leapt higher today after a sharp rebound in market liquidity that followed the recent government shutdown resolution. The surge comes on top of a $34 million whale accumulation, sending the price into new territory and pushing traders toward a $10 target that many are eyeing. Market sentiment is decidedly bullish. FOMO is building as investors see the tokens move back into the green zone, while any lingering FUD from earlier uncertainty has largely dissipated. For listeners watching the crypto scene, this rally underscores how macro policy shifts can quickly translate into on-chain activity. Whale inflows, liquidity injections, and a renewed confidence in the token's fundamentals all converging to fuel a short-term upside. The key takeaway: Trump's price action today reflects both a strategic whale play and a broader market recovery that could set the stage for further gains if the momentum holds. Solana Sol has been on a steep corrective run, losing up to 40% since mid-September as it trades inside a descending channel. Recent price action shows the token hovering near a key horizontal support at $156, with candles breaking below that level and then rebounding, an early sign of a potential base forming. Technical observers note that if the $156 zone holds, the next targets would be the 200-day moving average and the ascending trendline that began in April. Failure could push the price toward the channel's lower boundary or even a $127 support. The market sentiment remains mixed. Bulls see the current pullback as an opportunity to accumulate ahead of possible spot ETF approval, while skeptics point to repeated heavy selling from large institutional flows, often moving from Binance to Wintermute, that seem to trigger dumps just before breakout attempts. This pattern fuels FUD around whether the price is being artificially suppressed. For listeners, Solana's trajectory underscores a classic correction, then recovery scenario. A sharp dip followed by a consolidation phase that may set the stage for a rally if key support levels hold and institutional selling subsides. The next few days will be critical to gauge whether Sol can break out of the channel or continue its downward trend. Digital asset funds pulled a total of $117 billion last week, with Bitcoin and Ethereum leading the exodus. The outflows hit $932 million for Bitcoin products and $438 million for Ethereum, while Solana and Hedera drew fresh capital, adding roughly $118 million and $27 million respectively. Short-term holders on Binance are tightening their belts. Deposits from this group jumped 40% to about 8,700 BTC, pushing realized prices near $112 and amplifying sell pressure. The move signals a broader FUD-driven pullback after the October liquidity cascade and lingering uncertainty over U.S. rate policy. U.S. funds saw the bulk of the flight, $122 billion, while Europe remained relatively resilient, with Germany and Switzerland netting modest inflows. Market sentiment skews bearish. Volatility is climbing as investors weigh short-term risk against potential long-term recovery in a mid-cycle correction. Solana has reignited institutional interest after U.S.-listed spot ETFs pumped nearly $10 million into the network within a single day, with Bitwise's BSOL pulling in $75 million and Grayscale's GSOL adding $22 million. The influx pushed Solana's price back above its $150 support level, signaling renewed confidence from professional traders who are diversifying beyond Bitcoin and Ethereum. This surge mirrors the momentum building around XRP Tundra, a dual-chain DeFi platform leveraging Solana and the XRP ledger to offer cross-chain liquidity and yield infrastructure. Tundra is preparing for similar institutional engagement, featuring dynamic DAMM VTWO pools that curb early dumping, and an Arctic Spinner rewards program already dispersing over $32.0 in bonuses. Together, these developments suggest a bullish tilt for Solana, as it becomes the first non-BTC/ETH blockchain to attract significant ETF traction in the US, while positioning XRP Tundra as a compelling entry point for investors seeking exposure to Solana's expanding ecosystem. Bitcoin has settled just above the $105.0 mark after a brief dip, with traders noting a more resilient price structure that suggests the rally is holding its ground. The move comes as global risk sentiment eases and institutional buying channels remain active, providing a steady flow of capital into the crypto market. Market participants are largely bullish on Bitcoin's short-term trajectory, seeing the recent support level as a confirmation of the asset's strength rather than a temporary pause. Analysts point out that the current stability reflects a combination of macroeconomic relief, such as softer inflation data and dovish central bank cues, and continued inflows from hedge funds and family offices looking for long-term exposure. For listeners, this means Bitcoin is maintaining its position in the upper echelons of the market spectrum, while broader economic signals provide a backdrop that could keep the upward bias intact, though volatility remains a factor to monitor as the week progresses. FEMEX, the high-performance crypto exchange that serves over 6 million traders worldwide, has rolled out a fresh logo and revamped platform design as the first step in a broader rebranding effort. The new visual identity features a minimalist two-candle motif, symbolizing growth and momentum, a green to blue gradient conveying stability and innovation, and sharper geometric typography to reinforce reliability. The interface update brings 3D visuals, unified icons, and lighter layouts for cleaner desktop and mobile experiences. Market chatter is cautiously bullish. The refresh signals FEMEX's shift from pure trading venue to a full digital asset platform, potentially attracting users looking for expanded services like copy trading and wealth management. Sentiment leans toward FOMO among existing users eager to explore new features, while skeptics note that design changes alone won't alter underlying liquidity or regulatory risks. For listeners, this move underscores the ongoing trend of exchanges evolving beyond execution engines into ecosystem builders, with brand cohesion becoming a key differentiator in an increasingly crowded market. Bullzilla (BZIL) has entered its 10th pre-sale phase, Castle Bravo, with tokens priced at $24,573. The project is pushing a structured, stage-based pricing model that claims to lift early buyers into multi-100% returns as the token moves through successive rounds. Market chatter shows a bullish FOMO vibe. Investors are scrambling to lock in low entry points before the next 271% price bump and the launch of staking facilities like the HODL Furnace and Roarblood Vault. This surge comes amid a broader backdrop where institutional capital is cautiously re-entering crypto. Bitcoin ETF flows are stabilizing, and projects with clear tokenomics are regaining traction. For listeners, Bullzilla's presale offers an example of how community-driven, utility-focused coins can generate hype that aligns with genuine growth potential. But the volatility remains high, and the outcome uncertain. Bitcoin remains the headline of today's crypto market slide, with its price slipping 1% to $105,168 after a broader decline across the top 100 coins. The overall market cap fell 1%, dipping below $363 trillion as trading volume hovered around $199 billion. This pullback has cast a bearish tone. Most large-cap tokens, including Ethereum at $3,558, were down more than 1% in the past 24 hours, and 9 of the top 10 by market cap posted losses. The dip follows a sharp rise in U.S. government spending after the Senate passed a bill to reopen the federal government, which initially lifted sentiment for crypto ETFs and institutional inflows. However, renewed liquidity expectations have softened, leaving investors cautious as Bitcoin's circulating supply nears 95% of its max, signaling potential short-term volatility before any long-term trend takes hold. Ethereum has broken through its 4-month low, climbing from $3.50 on November 4 to over $3.650 this week, and surpassing its active realized price of about $3.545. The rally lifted the majority of holders out of unrealized losses, turning a previously bearish stance into one of cautious optimism. Market participants are now eyeing the critical $3.700 $3.900 resistance zone. Breaking above it could unleash momentum toward the psychological $4.0 ceiling. On-chain data show a cluster of cost bases around $3.600 $3.815 that may trigger profit-taking if the price stalls, while institutional interest, exemplified by BitMine's recent accumulation of 110.0 ETH, signals growing confidence in Ethereum's resilience amid regulatory and DeFi developments. The current environment suggests a potential bullish swing if support above $3.500 holds. Failure to do so could drag the token toward lower support levels near $2.870 or even $1.800. In a fresh geopolitical flashpoint, Chinese officials have accused the U.S. government of seizing roughly 127.0 bitcoins that were mined by the Liu Bian pool in 2020. The claim centers on a large batch of BTC that reportedly disappeared from the pool's wallets during a U.S. raid aimed at curbing illicit crypto activity. If the allegation holds, it would represent one of the largest single-event confiscations in blockchain history, and could signal a tightening of cross-border enforcement on digital assets. Market reaction has been muted but tinged with caution. Traders are monitoring the situation for potential regulatory spillover, especially as U.S. agencies continue to crack down on crypto exchanges that facilitate money laundering or sanctions evasion. The story adds another layer of uncertainty to an already volatile market, stoking FUD among holders who fear further seizure risks and prompting some to re-evaluate their exposure to large mining pools. For listeners, this development underscores how geopolitical friction can spill directly into the crypto ecosystem. It reminds investors that while blockchain offers decentralization on a technical level, it remains vulnerable to traditional state power when assets cross borders or become entangled in legal disputes. The incident also highlights the ongoing challenge regulators face, balancing enforcement against illicit activity without stifling legitimate innovation. Coinbase has launched a new public token sale platform aimed at U.S. retail investors, marking the first regulated sale in the country since the 2018 crackdown that ended the ICO boom. The debut listing will be Monad's Mon token, an Ethereum-compatible Layer 1 project, which will trade from NAV17 to NAV22 ahead of its mainnet launch on NAV24. Each Mon will sell at $0.25, with a total of 75 billion tokens, 75% of the 100 billion supply, offered. Purchase limits range from $100 to $100K. The platform incorporates fairness mechanisms. Tokens are allocated preferentially to genuine users rather than large buyers, and early sellers face reduced future allocations to curb speculative flipping. The move signals a bullish shift in U.S. retail crypto participation, as regulators have eased restrictions and the administration has shown a more supportive stance toward digital assets. Coinbase plans monthly sales with added features like limit orders and specific allocations, potentially reshaping how projects raise capital domestically. For listeners, this development means increased access to early-stage tokens for U.S. investors under a regulated framework that balances inclusivity with safeguards against abuse. Coinbase has rolled out a UK savings account, positioning itself as a hybrid neobank that blends crypto and traditional banking. The new product offers a variable 3.75% annual equivalent rate paid daily, with instant deposits and withdrawals powered by Clearbank and protected up to £80.50 under the FSCS. This move gives users bank-like security while keeping full access to Coinbase's crypto ecosystem, including its card and over 260 digital assets. Market chatter is bullish. Traders see the high rate as a competitive edge over most UK banks, and a signal that crypto firms are increasingly stepping into mainstream finance. However, some FUD lingers around recent FCA and Irish regulator fines for compliance lapses, reminding investors that regulatory scrutiny remains tight. For listeners, Coinbase's launch underscores a broader trend of crypto-native companies carving out neobank roles, potentially reshaping how consumers hold, earn, and spend money in the UK. Dubai's luxury real estate giant Serenia Residences is pushing a new wave of ultra-high net worth buyers into its under-construction penthouses on the Palm. Buyers are now paying up to 1 million dirhams as an expression of interest, with the highest bidder winning the property and others refunded. Bidding prices have surged from an initial $12 million to a peak of $24 million, matching the cost of top-tier penthouses in New York and London. This frenzy fuels a strong FOMO among global investors while signaling bullish sentiment for Dubai's high-end market. Yet it also injects volatility as allocations remain uncertain. The backdrop is a post-COVID boom where luxury apartments sell pre-construction, rents have doubled, and the city now sees 145% growth in luxury sales, making Dubai a magnet for wealth-seeking status symbols, but also widening the gap for average buyers. Transact has secured 6 additional state licenses in the United States, expanding its ability to offer stablecoin payment services across more jurisdictions. The new approvals underscore how fragmented U.S. regulatory approval remains for crypto fiat bridges, even as firms race to achieve nationwide coverage. Market chatter suggests a bullish tilt for Transact's liquidity platform. Investors view the broadened footprint as a step toward higher transaction volumes and deeper market penetration. However, some analysts warn that continued state-by-state licensing may keep regulatory uncertainty alive, tempering enthusiasm. For listeners watching the U.S. crypto landscape, this move signals both progress in operational reach and an ongoing patchwork of compliance challenges that could influence future growth trajectories.
Aura Health has announced that its projected sales for 2026 will approach $2 billion, a figure that represents nearly double the revenue it generated last year and the second consecutive year of such growth. The company's CEO, Tom Hale, explained that this surge is driven by expanding global demand for its wearable health tracking devices and an increasing number of consumers integrating Aura's data into personal wellness routines. Investors are taking note, as the forecast signals a robust market position in the growing health tech sector. For everyday listeners, stronger sales could translate into more product availability, potentially lower prices through economies of scale, and continued innovation that keeps wearable technology advancing beyond basic fitness tracking toward deeper health insights. Gamma, a new artificial intelligence platform designed to replace traditional slide creation tools, has secured $68 million in fresh capital from a group of investors led by James Fox, John Noronha, and Grant Lee. The funding round follows the company's rapid expansion and growing user base, positioning it as a potential competitor to established presentation software. For everyday consumers and small businesses, the infusion of money could accelerate Gamma's development of AI-driven design features, making it easier for non-experts to produce professional-looking slides without extensive training. On the broader market, the deal signals continued investor confidence in AI startups that offer productivity enhancements, which may lift sentiment among technology shares and encourage further venture capital flow into software innovation. The federal government's long-running shutdown is expected to end this week after a House vote clears the final hurdle. The pause began when Congress failed to approve a spending bill, leaving many agencies without operating funds and forcing workers at 800 federal sites to work without pay or to be furloughed entirely. Negotiations have now produced a short-term funding package that would keep essential services running while lawmakers work toward a longer-term budget agreement. For the average listener, the end of the shutdown means employees will soon receive their back pay, and government agencies, such as the Department of Transportation and the Centers for Disease Control, will resume normal operations. In financial markets, the news has helped calm volatility that had spiked when uncertainty about federal spending grew. Stock indices have shown modest gains, reflecting relief from the risk premium investors had charged to cover potential disruptions in public services. The resolution also signals a temporary easing of fiscal tension, which could influence interest rate expectations as the Federal Reserve watches for signs of inflationary pressure and economic stability. Paramount's guidance has announced that it expects an additional $1 billion in cost-saving benefits as part of its post-merger integration plan, with CEO David Ellison outlining further workforce reductions and efficiency measures in the company's first earnings report since the August merger. The announcement follows a broader industry trend toward consolidation, as studios look to cut overhead and streamline production pipelines amid shifting consumer habits. For investors, the extra savings signal stronger financial discipline that could improve margins over the next few quarters, while for employees, the layoffs underscore the ongoing realignment of roles within the combined entity. Market participants will likely watch how these moves affect Paramount Skydance's earnings trajectory and whether the company can maintain its growth ambitions in a competitive media landscape. Sony Group announced that its second quarter operating profit surpassed expectations, driven largely by stronger performance in its music and imaging businesses. The company's earnings beat market forecasts after the popular Sony Music Entertainment saw a surge in streaming revenue, while the imaging division reported higher sales of cameras and related accessories as consumers continue to invest in photography. This uptick reflects a broader rebound in consumer discretionary spending, with households allocating more funds toward entertainment and personal technology. For investors and everyday listeners alike, Sony's improved profitability signals resilience within its core brands and suggests that demand for media content and imaging products remains robust, potentially supporting related supply chains and encouraging confidence in the broader tech sector. The U.S. Secretary of Energy announced that federal loan programs will prioritize nuclear power projects as the administration moves toward its goal of having dozens of new reactors under construction by the end of this term. The decision follows a broader push to diversify America's energy mix and reduce carbon emissions, with nuclear seen as a stable, low-carbon source that can complement intermittent renewables. For investors and consumers alike, the move signals increased financial support for the sector, potentially lowering borrowing costs for new plants and accelerating deployment timelines. In markets, this focus may lift stocks tied to nuclear infrastructure and technology, while households could benefit from more reliable power supplies and the possibility of lower long-term energy bills as the grid modernizes. This year's market data shows that buying the dip, purchasing stocks after a decline, has yielded unusually strong returns for traders. Analysts attribute this trend to heightened volatility and widespread profit-taking, which have created frequent pullbacks in major indices. When investors sell amid short-term uncertainty, prices fall enough to provide attractive entry points, and many participants have capitalized on these opportunities. For everyday listeners, the takeaway is that market swings can generate buying chances, but the gains are not guaranteed. The pattern's persistence into late 2025 remains uncertain, as future earnings reports, inflation readings, and policy moves could shift sentiment either way. Nonetheless, the recent performance suggests that disciplined, opportunistic investing may still be viable amid a turbulent backdrop. A former paper mill in Chillicothe, Ohio, once a symbol of industrial decline, has been repurposed to manufacture sterile surgical gloves for hospitals. The change came after U.S. medical glove company acquired the plant and invested in new production lines that meet stringent health care standards. The decision was driven by rising demand for personal protective equipment amid ongoing public health challenges, as well as a national push to secure domestic supply chains for critical medical supplies. For residents of Ohio and workers across the region, the transformation means fresh jobs and a revitalized local economy where layoffs had once been widespread. For hospitals nationwide, the new facility promises a more reliable source of high-quality gloves, potentially lowering costs and reducing shortages that have strained healthcare providers. On a broader scale, this shift illustrates how repurposing legacy industrial sites can support both economic recovery and public health infrastructure, offering a model for similar communities facing deindustrialization. A group of 20-year-olds has secured a $121 million investment to launch Neros, a startup that designs and produces military drones. The founders, Soren Monroe Anderson and Olaf Hitchwa, attracted backing from venture capital firms that see growing demand for advanced unmanned aerial systems in defense contracts. Their funding round follows the U.S. Department of Defense's recent push to modernize air assets with smaller, more agile platforms, sparking interest from private investors looking to capitalize on government procurement opportunities. For the average listener, this development signals a broader trend. Private companies are increasingly entering sectors traditionally dominated by large defense contractors. While the money may not directly change everyday consumer prices, it could influence future supply chains and technological innovation that trickle down into civilian aerospace products. In markets, firms involved in drone manufacturing or related components may experience heightened investor attention as the sector expands, potentially affecting stock valuations for companies positioned to benefit from this shift. Federal Reserve Governor Stephen Murrin told CNBC that a half-point cut to the benchmark federal funds rate in December would be appropriate. But he cautioned that the central bank should consider lowering rates by at least a quarter point to keep inflation on track. Murrin's comments come as the Fed remains cautious after recent data showing modest gains in consumer spending and a cooling of manufacturing activity, yet still grapples with stubborn price pressures. The governor's stance signals that policymakers are weighing the need for further easing against the risk of stoking inflation or undermining confidence in monetary policy. For households, this could mean that borrowing costs, such as mortgage and auto loan rates, might remain elevated for longer than some markets expect, potentially slowing discretionary spending. Investors will watch closely how the Fed's next meeting interprets Murrin's remarks, as any shift toward a more aggressive rate cut could influence equity valuations and bond yields across the financial landscape.
Bitmine has pushed its Ethereum treasury to a new high, announcing that it now holds more than 35 million ETH, about 29% of total supply. The move signals a renewed focus on major assets and opens fresh risk windows across the market. Investors watching are seeing a bullish tilt as the headline grab pulls attention back toward big names and adjacent projects. In this environment, Bitcoin Hyper's BTC anchored Layer 2 offering with SVM speed and ZK security, PEPENODE's gamified mine to earn model that keeps users engaged, and Tron's deep liquidity and payments utility are highlighted as credible plays for the next leg of market activity. The narrative suggests a shift toward larger cap resilience, while still keeping an eye on innovative Layer 2 solutions and user engagement tokens. Moonbull, Polkadot, and Bitcoin Cash have landed on a rising list of projects that investors flag as potential high-reward plays in 2025. Moonbull is currently deep into its 23-stage presale, already raising over $590K with more than 900 holders, and employing a transparent stage pricing model that rewards early adopters while keeping the launch fair for newcomers. Polkadot continues to roll out infrastructure updates, asset issuance, cross-chain routing, and developer tooling that expand its builder base and reinforce its long-term utility as a multi-chain hub. Bitcoin Cash has re-entered technical charts with model-based projections pointing to a one-month target near $609, roughly 21% above current levels, supported by neutral RSI momentum and defined resistance in the mid-high $500s. Market chatter around these assets is bullish, driven by clear mechanics and verifiable catalysts rather than hype. Investors see them as structured opportunities for asymmetric upside amid a broader search for 100 times plays. Crypto wallets are no longer just digital safes. They're becoming portable identity hubs powered by zero-knowledge proofs. Recent developments show that users can now bundle verifiable credentials, such as KYC data, health records, or voting rights, directly into their wallet software without exposing the underlying information. This shift transforms the wallet from a passive asset holder to an active self-custodial identity manager, enabling seamless authentication across DeFi platforms, NFT marketplaces, and even traditional services that require proof of identity. The market reaction is cautiously bullish. Traders see this as a step toward broader adoption of Web3 infrastructure, potentially easing regulatory friction by offering privacy-preserving compliance tools. However, some investors remain wary, citing the complexity of zero-knowledge implementations and the risk of fragmented standards. The sentiment skews toward FOMO for early adopters who can leverage these new capabilities to unlock exclusive protocols, while a minority voice expresses concern over potential security gaps during this rapid evolution. For listeners, this means that future wallet interactions will likely involve more than just sending tokens. They'll include proving credentials on the fly, opening doors to decentralized finance services that require identity verification without compromising privacy. The trend underscores a broader industry push toward self-sovereign identity solutions, positioning wallets as central nodes in an increasingly interconnected crypto ecosystem. Bitensur's native token Tau has slipped 0.81% to $373.85 in the last 24 hours, but trading volume jumped nearly 25%, reaching almost $291 million. The dip follows a week-long slide of about 19%, signaling a broader market pullback after recent highs. Technical chatter points to the $355, $386 band as a key support area. Analysts note that breaking above the long descending trendline could trigger a bullish reversal, while resistance levels at $464, $561, and an upper cluster around $698, $744 remain watchpoints for potential selling pressure. Sentiment is cautiously optimistic. Investors are accumulating amid volume spikes, hinting at a possible rebound. For listeners, this means Tau is currently in a corrective phase, but may be primed for recovery if it holds above its critical support zone and navigates the identified resistance levels. XRP has stepped into a new technical chapter as recent chart patterns and on-chain activity signal a potential breakout. The digital asset's price action now shows classic bullish momentum indicators, higher highs, tightening moving average crossovers, and an uptick in active wallet counts, suggesting that traders may be positioning for a climb toward the $5 mark by year end. Market chatter is leaning bullish, with FOMO creeping into community discussions while any lingering FUD around regulatory uncertainty appears muted. For listeners watching the crypto landscape, this development positions XRP as a candidate for a significant rally, but it also underscores the importance of monitoring volume spikes and on-chain metrics that could confirm or reverse the current trajectory. Square has rolled out a new Bitcoin payment option that lets merchants accept crypto directly through its merchant platform. The feature enables sellers to add BTC as a checkout method without routing funds through third-party processors, giving them a native crypto gateway. In parallel, Solana's developer ecosystem remains active, with continued contributions and token minting activity on the network. The launch signals Square's commitment to integrating digital assets into mainstream commerce, which could drive broader merchant adoption of BTC and elevate its utility profile. Market watchers see this as a bullish cue for Bitcoin's payment use case, though the move also raises questions about regulatory scrutiny in the US. The sustained developer engagement on Solana suggests the network is holding its ground against competition, keeping investor sentiment steady for its native token. For listeners, Square's rollout reflects a growing trend of institutional players embedding crypto into everyday transactions, while Solana's resilience indicates that Layer 1 networks are still vying for developer and user traction. Both developments underscore the evolving infrastructure around digital assets and hint at possible shifts in market dynamics as more businesses explore crypto payments. The story centers on Libra, a meme coin that launched in mid-February and was thrust into the spotlight after Argentine President Javier Milei posted a selfie with its founder, Hayden Davis. Within minutes of the post, the token's market cap shot up to an eye-watering $45 billion, only to collapse by more than 94% in hours, wiping out investors in a textbook pump and dump. Federal Judge Marcelo Martinez de Giorgi has now frozen roughly $507, zero tied to Davis, and two crypto operators linked to the scheme, as prosecutors argue the assets could represent proceeds from an alleged fraud of up to $120 million. The freeze extends across all Argentine crypto platforms and compels the National Securities Commission to notify service providers, underscoring a coordinated effort to lock down potential money laundering routes. For traders, the episode has injected fresh FUD into meme coin space. Volatility spikes as investors reassess risk in projects that ride political endorsements. Meanwhile, Milei's party surprisingly secured a midterm win, showing that political fallout can coexist with electoral resilience. But public trust remains bruised as polls indicate a sharp drop in his approval rating. Zebek Network's native token, ZBCN, is back on the radar after a sharp rebound from multi-week lows. The rally kicked off when the project announced that it will be listed on Bitvavo, Europe's largest MiCA-compliant exchange. That announcement sent a bullish pulse through the market. Traders saw the listing as a liquidity boost and a sign of institutional acceptance, sparking FOMO-driven buying in the short term. While the price has gained momentum, analysts note that the move remains a catalyst rather than a long-term driver. The token's fundamentals, such as its use case in decentralized finance and recent network upgrades, will ultimately determine sustainability. For listeners following ZBCN, the key takeaway is that the Bitvavo listing is a positive signal of growing confidence, but the market will still test the token's resilience against broader crypto volatility and regulatory developments. Bitcoin itself is at the center of a new narrative. Its current flat trajectory has been likened to an IPO phase by analyst Jordi Visser in his latest Substack essay, Bitcoin's Silent IPO. The piece argues that when an asset enters a prolonged consolidation period after a sharp rally, it often signals a preparatory stage before a significant breakout, much like a company goes through a quiet listing before going public. This framing suggests that Bitcoin's sideways movement isn't just market noise, but could be setting the stage for future upside, hinting at a potential bullish shift once institutional and retail interest stabilizes. For listeners, the takeaway is that this comparison frames the present pause as a possible precursor to renewed momentum rather than a sign of weakness, positioning the current calm as a strategic buildup in an otherwise volatile crypto landscape. Uniswap's native token UNI has surged to become the top gaining asset among the top 30 cryptos, climbing roughly 20% in the past day, and trading above $8.50 after hitting a monthly peak of $10.20 on Monday. The rally followed a unification governance proposal submitted by Uniswap Labs and the Uniswap Foundation, which would activate a burn mechanism, using protocol fees and an additional 100 million UNI from the Treasury, to reduce supply and shift fee revenue toward token holders. Market sentiment is bullish, with FOMO driving demand, yet technical indicators hint at potential overbought conditions. RSI sits near 73 and MACD remains positive, suggesting a short-term retracement could bring prices back to around $7.20 before any renewed upside. Investors watching UNI should note that the proposal's approval would mark a significant structural shift in fee distribution, potentially supporting long-term value while also exposing the token to volatility as the market digests the supply contraction. TRON's native token TRX has emerged as the sole top 10 cryptocurrency moving higher in today's trading session, while the broader market remains flat or slightly bearish. Over the past 24 hours, TRX has climbed 14%, with a 68% gain on the weekly chart and an impressive 81% rally since early November, although it slipped 52% last month. The uptick appears tied to a surge in network activity. Higher transaction volumes have driven increased token burns and generated roughly $37.5 million in net revenue for holders over the past month, one of the highest figures seen across major chains. Market sentiment is cautiously bullish around TRX, but tempered by the overall consolidation of Bitcoin and other majors following the recent U.S. government shutdown resolution. Traders are watching whether this isolated rally can sustain itself without a broader market move. Economic headwinds, such as Federal Reserve warnings of sluggish growth and inflationary pressure, could pose challenges ahead, potentially leading to a correction if TRX fails to maintain its momentum. Solana's native token, SOL, has slipped below its long-term ascending channel after a sharp pullback that began on November 3. The breakout erased weeks of bullish momentum, leaving the price hovering near key resistance around $170, a level that could stall any immediate rebound. Traders are now eyeing the $170 ceiling as a potential pivot point. If SOL can break above it, the rally might resume, but failure to do so would likely extend the bearish trend and reinforce FUD surrounding the network's recent volatility. The move comes amid continued inflows into crypto ETFs, which have been supporting broader market sentiment. Yet Solana's technical breakdown tempers that optimism. Investors watching the space should note that the asset is now testing a critical support/resistance zone that could dictate whether it recovers or continues to decline in the coming weeks. Femex, a high-performance crypto exchange known for its speed and reliability, today rolled out a refreshed logo and modernized platform design as the first step of a broader rebranding effort. The new visual identity features a minimalist two-candle symbol, a fresh green to blue gradient that signals stability and innovation, and sharper geometric typography to convey precision. Platform updates include 3D visuals, a unified icon set, and lightweight layouts for desktop and mobile, aiming to streamline the trading experience. The move is largely cosmetic, but underscores Femex's shift from a pure exchange into a full digital asset ecosystem, which could boost user confidence and attract new traders. Market sentiment skews mildly bullish. The update signals intent to stay ahead of competitors, without sparking immediate volatility. For listeners, this refresh marks a strategic effort by a 6 million user platform to reinforce its brand as a future-ready, trustworthy venue in an increasingly crowded market. Ripple's chief technology officer, David Schwartz, recently clarified how Bitcoin can function as a payment medium while still offering price upside for holders. In a brief interview, Schwartz outlined that Bitcoin's settlement layer, currently in use by several merchants and financial institutions, provides fast, low-cost cross-border transfers without compromising the asset's scarcity. The implication is clear. Users can spend Bitcoin directly rather than converting to fiat, potentially boosting daily transaction volume. Market reaction has been mixed but largely neutral. Traders note that while the utility angle may strengthen demand fundamentals, it does not immediately translate into a price spike. Sentiment remains cautious. Some participants view the move as a subtle bullish signal for broader crypto adoption, whereas others see it as incremental progress amid ongoing regulatory scrutiny. For listeners, this development underscores a pivotal shift. Bitcoin's role is evolving from pure store of value to active payment instrument, a trend that could reshape on-chain activity and influence long-term network value. Stable coins are no longer just digital dollar dubs. Institutional backing is now dictating which ones survive the next wave of scrutiny and regulatory tightening. Over the past weeks, major banks and hedge funds have begun allocating capital to only a handful of projects that demonstrate robust reserves, transparent audits, and strong compliance frameworks. This shift has sent ripples through the market. Liquidity providers are pulling out of less vetted coins, while those with institutional confidence see higher trading volumes and tighter spreads. The sentiment is mixed, bullish for the few that meet regulatory standards but bearish overall as smaller stablecoins face a squeeze. For listeners tracking crypto exposure, this trend underscores the growing importance of governance and reserve transparency in maintaining stability amid tightening global oversight. Ethereum has seen a quiet but sizable build-up from its mid-tier holders, with wallets holding 10,100 ETH, adding roughly 76 million tokens since late April, a 52% jump in total holdings. Spot trading volume has spiked multiple times since the early November dip, a pattern that often signals the end of a compression phase and the start of a rally. Meanwhile, retail wallets between 110 have trimmed positions by 16%, indicating cautious sentiment among smaller holders. The accumulation trend coincides with improving macro mood. Speculation that a U.S. government shutdown will resolve has lifted risk appetite across digital assets, while Bitcoin's rebound to $106K after falling below $100K shows broader market relief. These factors suggest a bullish tilt for Ethereum if the macro tailwinds persist, but retail caution and potential OG selling could temper any rapid upside. The U.S. Treasury and the IRS have finally cleared a long-awaited path for cryptocurrency exchange-traded products, ETPs, to stake digital assets while keeping their favorable tax status. This regulatory shift means that crypto funds can now lock tokens in proof-of-stake protocols, earn rewards, and report those earnings under the same tax treatment they currently enjoy. Market chatter is bullish. Investors see a new revenue stream for tokenized funds without jeopardizing their SEC-approved structure. The move also reduces FUD around staking compliance, as fund managers no longer need to navigate a gray regulatory zone. In practical terms, this could lead to higher inflows into crypto ETFs and other investment trusts, boosting liquidity across the sector and potentially nudging spot prices upward as more capital flows in. For listeners, it signals that institutional players now have a clearer, compliant avenue to monetize staking, which may ripple through both asset price dynamics and the broader ecosystem of tokenized products. Numez token, $NNZ, has entered Stage 3 of its 28-stage presale, pushing the price to $151 per token and triggering a rush among traders looking for the next price bump. The sale structure burns any unsold tokens after each 7-day window, tightening supply as stages close faster than anticipated. This scarcity mechanism has sparked bullish sentiment, with FOMO driving volume up and a growing number of buyers eager to lock in before Stage 4 kicks in. For listeners monitoring meme coin momentum, the current stage's rapid sell-out pace signals that the next price jump could arrive soon, making $NNZ a focal point for those tracking presale dynamics and potential scarcity-driven gains. Tapbit, a fast-growing futures exchange founded in 2021, announced its 4th anniversary celebration set for November 17. The event will feature permanent zero-fee trading on select spot pairs and a $1 million rewards gala with luxury prizes and trading contests. With over 500 users across more than 200 countries, Tapbit reports daily spot volumes of $384 billion and futures volumes exceeding $53 billion, backed by a $50 million insurance fund and strict regulatory licenses from the NFA and SVGFSA. The announcement injects bullish sentiment, sparking FOMO among traders eager to benefit from fee waivers and high-value giveaways, while reinforcing Tapbit's position as a secure, user-centric platform poised for further AI and DeFi expansion. Uniswap's native token UNI has spiked about 30% after a new governance proposal, dubbed UNification, was unveiled this week. The plan would shift a portion of protocol fees into a smart contract token jar, allowing holders to burn UNI in exchange for an equivalent value of crypto, and slash fee rates on V2O and V3 pools. Market reaction has been bullish, UNI trading above $870, with CryptoQuant's CEO Kai Young-ju forecasting parabolic upside once the switch activates, citing roughly $500 million in annual token burns from current volumes. The announcement taps into a long-standing debate over Uniswap Labs' governance power and fee structure, amplified by recent regulatory shifts after former SEC chair Gary Gensler's departure. Analysts warn that the fee cut could eliminate scammy, zero-fee pools on Base, potentially reshaping liquidity dynamics. Meanwhile, insiders note a transition from treasury depletion toward possible replenishment, urging vigilance as the DAO adjusts its revenue model. For listeners, this move signals a significant restructuring of Uniswap's economics and governance, an event likely to influence token demand, fee income, and overall protocol health in the coming months. Brazil's regulatory environment faces a new challenge as virtual asset derivatives surge to dominate crypto trading volumes. In 2025, derivative contracts, futures, options, perpetual swaps, and CFDs reached an unprecedented $894 trillion in monthly turnover, eclipsing spot markets and accounting for roughly 76% of all crypto activity worldwide. Yet the Comissão de Valores Mobiliários (CVM) has not defined derivative contract, leaving a gray zone over which instruments fall under its oversight. By applying the Howey test, requiring economic investment, expected returns, and reliance on third-party efforts, the CVM signals that many crypto derivatives could be treated as securities, potentially tightening supervision. This regulatory ambiguity may dampen investor confidence and deter foreign capital, creating a bearish FUD environment for Brazil's rapidly expanding digital assets sector. The market must now navigate this uncertainty while keeping pace with global best practices, as the country seeks to balance innovation with risk mitigation in its evolving crypto ecosystem. Brazil's central bank has unveiled a sweeping regulatory package that reclassifies stablecoins as foreign exchange instruments and brings crypto wallet transfers under Forex law. The new framework, codified in Resolutions 519, 520, and 521, creates a licensed entity category called SPSAVs, requiring firms to meet banking-grade consumer protection, transparency, and AML standards. Transfers with unlicensed overseas parties will face a $100 zero cap, while reporting on capital market and cross-border activity begins May 4, 2026. Full enforcement starts February 2, 2026. Market sentiment is cautiously bullish. The move promises greater legal certainty and data visibility for regulators, but it also imposes heavier compliance burdens that could pressure smaller crypto operators. For listeners, this signals a significant tightening of Brazil's crypto landscape, aligning digital assets with existing fiat currency rules, and potentially reshaping how stablecoin activity is tracked and taxed in Latin America's second-largest market. Bitcoin is under new scrutiny as analyst Willy Woo released a quantum-safe guide urging holders to move funds into SegWit or legacy addresses, BC1Q13, rather than Taproot BC1P wallets. The move follows accelerating quantum computing progress that could eventually crack public keys and compromise private ones. Wu estimates the transition to quantum-resistant protocols may take roughly 7 years, while critics like Charles Edwards argue SegWit offers no real protection and push for immediate network upgrades. Market chatter is mixed. Some traders see this as FUD, fearing a looming security risk that could pressure prices, while others view it as a prudent precaution that may reinforce confidence in Bitcoin's long-term resilience. For listeners, the key takeaway is that quantum threats are projected to materialize sometime between 2028 and 2030. So preparing now by shifting assets into safer address types could mitigate potential future vulnerabilities. Uniswap's native token UNI has surged sharply after its CEO, Hayden Adams, unveiled a governance proposal that would make the token deflationary by activating protocol fees, burning UNI, and introducing Unichain fees. The announcement triggered a near 50% jump in price within hours, sending UNI to a new 24-hour high of about $888 and lifting its market cap above $56 billion. Traders are reacting with bullish FOMO as the move tightens supply and promises higher protocol revenue, while some analysts note that acceptance of the proposal remains key. For listeners, this development signals a potential shift in UNI's value dynamics. A tighter supply curve paired with increased fee streams could set the stage for future upside if market sentiment stays positive. XRP has ignited renewed bullish chatter after a confluence of technical and on-chain signals pointed toward a potential breakout. Analysts noted that the digital assets price has broken key resistance levels, while on-chain metrics such as active addresses and transaction volume have trended upward, suggesting growing network participation. This development is fueling FOMO among traders who see an opportunity to push XRP toward the $5 mark by year-end, a target that would represent a substantial rally from its current range. The market's reaction has been largely optimistic, with trading volume spiking and sentiment shifting away from earlier caution. For listeners, this signals a possible inflection point for XRP as it moves beyond short-term consolidation into a broader upside trajectory, though volatility remains high and the outcome is still uncertain. Xebec Network's native token, ZBCN, has started a modest bounce after slipping to multi-week lows, thanks largely to the announcement that it will soon list on Bitvavo, Europe's largest MiCA-compliant exchange. The listing news injected fresh optimism into an otherwise bearish backdrop for mid-cap altcoins, with traders quickly turning FOMO into buying pressure. On the technical side, ZBCN has broken out of its recent consolidation range and is testing support levels that could propel it toward a $0.50 target if momentum holds. Market participants are watching closely. Any sustained lift could signal a broader rally for other European-listed tokens, while a pullback would reinforce the prevailing caution across the sector. For listeners tracking mid-cap dynamics, ZBCN's move underscores how exchange listings can act as catalysts even in a market still grappling with volatility and regulatory headlines. Bitcoin's rally this year has largely been powered by institutional inflows into exchange-traded funds and large-scale purchases by investment strategies. In recent weeks, those buying channels have slowed, leaving the price rangeless as traders wait for a catalyst that never materialized. The lack of new ETF capital has dampened bullish momentum, sparking mild FUD among holders who had counted on fresh inflows to lift prices further. Market participants are now weighing whether the pause signals a temporary lull or a broader shift in institutional appetite. With no clear upside driver on the horizon, sentiment remains cautious, and traders are keeping a close eye on upcoming regulatory announcements that could reignite demand for Bitcoin-linked products. Bitcoin has hit a pivotal crossroads as CryptoQuant founder Kai Young-ju released a sharp bullish outlook that has traders on edge. The analyst highlighted the digital currency's recent consolidation around key resistance levels, noting that a breakout could trigger renewed buying momentum, while a failure would push prices into a broader retracement zone. Market chatter is currently split. Some participants are buzzing with FOMO over potential upside, whereas others warn of lingering FUD if volatility spikes again. For listeners watching the crypto space, this development underscores the importance of monitoring price action near those critical thresholds. A move above or below them could set the tone for Bitcoin's next phase and ripple across the broader market. Shiba Inu has hit a critical juncture as its latest rally stalls against a stubborn resistance level near the 26-day exponential moving average. After a brief surge that lifted the meme coin above $0.06, traders saw the price fail to sustain momentum beyond this technical threshold, leading to a pullback that reasserted the EMA's hold. Market sentiment has turned noticeably bearish. Liquidity providers are tightening positions, and many on-chain indicators show declining buying pressure. The pause at the 26 EMA signals a potential consolidation phase or even a short-term reversal if sellers dominate. For listeners watching Shiba Inu, this development underscores the importance of technical cues. The coin's ability to break through the EMA will dictate whether it can resume an upward trajectory or face further downward pressure. Keep an eye on volume spikes and order book depth. Those will be decisive in determining the next move for SHIB. Crypto wallets are shifting from simple asset vaults to portable identity hubs powered by zero-knowledge proofs, a move that could reshape how users prove credentials on decentralized platforms. The technology lets holders authenticate themselves without exposing personal data, effectively turning every wallet into a self-custodial passport for the Web3 ecosystem. Market reaction is cautiously bullish. Developers are already integrating these identity layers into dApps and NFT marketplaces, while regulators watch for privacy compliance. For traders and builders alike, this trend signals a tightening of user authentication standards and a potential boost in adoption as frictionless identity reduces onboarding barriers. In short, wallets are evolving from storage lockers to keycards that unlock the next generation of decentralized services. Coinbase has rolled out a new public token sale platform aimed at retail investors, marking the first U.S. launch since the 2018 ICO crackdown. The inaugural offering will be Monad's Mon token, an Ethereum-compatible Layer 1 project, with sales running from Nav 17 to 22 ahead of its mainnet debut on the 24th. Coinbase's mechanism caps purchase amounts between $100 and $100, limits large holders, and tracks early resales. Those who sell within 30 days receive lower future allocations to encourage long-term holding. The move signals a shift toward regulated, inclusive token offerings in the U.S., potentially easing FUD around past ICO scams, while sparking FOMO among retail participants eager for a new entry point. This development comes amid a broader policy pivot that favors innovation under regulatory oversight, positioning Coinbase as a gatekeeper for future public sales and reshaping how U.S. investors access early-stage crypto projects. Finassets.io, a crypto payment processor focused on iGaming, recently enabled an online casino to accept cryptocurrency deposits and withdrawals through its transparent total cost of ownership model. Within just 2 weeks of launch, the casino saw a sharp uptick in users choosing crypto as their primary funding method, translating into higher gross gaming revenue. The move reflects a broader industry shift. 17% of all gambling bets in Q3 2024 were placed with crypto, and 58% of iGaming professionals view digital currencies as the key driver for future growth. Operators that ignore crypto risk losing market share, especially in high-adoption regions like Curaçao, Canada, Germany, Japan, and India. Finassets' low, fixed fees, cutting TRON gas costs by over half, and rapid integration via sandbox testing and real-time support have made the switch smoother than competitors, boosting sentiment among operators toward a more cost-efficient, player-centric payment ecosystem. Brazil's central bank has just rolled out a comprehensive regulatory framework targeting virtual asset service providers, VASPs, and stablecoin transactions. The new rules mandate stricter licensing, enhanced anti-money laundering controls, and tighter reporting requirements for all VASPs operating within the country. Stablecoins must now register with the regulator, provide real-time transaction data, and adhere to reserve backing standards designed to curb illicit use while preserving financial stability. The announcement has stirred a mix of caution and opportunity in markets. Traders note that the tighter oversight could dampen short-term liquidity for certain stablecoin issuers, generating bearish sentiment among those concerned about compliance costs. Conversely, firms already compliant may see a boost as they position themselves ahead of global regulatory trends, sparking mild FOMO around Brazil's emerging crypto ecosystem. For listeners, this move signals Brazil's intent to balance innovation with risk management, aligning the nation with international best practices while potentially reshaping the regional crypto landscape and influencing cross-border flows in the coming months. Transact has added 6 new state licenses to its roster, extending its stable coin payment reach across a broader slice of the United States. The move underscores how fragmented the regulatory landscape remains, with each state still carving out its own rules for crypto fiat bridges. For market watchers, the news signals a bullish tilt in the stable coin infrastructure space. More licenses mean tighter compliance and potentially smoother onboarding for users and merchants alike. Yet the patchwork nature of approvals also keeps a bearish undertone alive. Any single jurisdiction could tighten standards or clamp down on cross-border flows, creating FUD for operators. In context, this development comes as demand for instant fiat to crypto conversion spikes amid volatile spot markets. Firms like Transact are positioning themselves to capture that liquidity by proving they can operate legally in multiple states. The expansion may also pressure competitors to accelerate their own licensing campaigns, tightening the race for nationwide coverage in a still fragmented regulatory arena. Dogecoin's latest buzz centers on DogeOS, the company-grade app layer that aims to bring smart contract functionality to the meme coins ecosystem. In a recent episode of the Crypto Beat podcast, Size Chad and MyDoge CEO Jordan Jefferson took the mic to unpack what DogeOS actually delivers, how it plans to integrate with existing Dogecoin infrastructure, and the roadmap for developer tools and incentives. The announcement signals a shift toward utility for Dogecoin beyond its current status as a tipping currency. While early reactions are mixed, some traders see the move as a bullish catalyst that could unlock new revenue streams. Others caution that the layer's adoption hinges on developer traction and market demand. Overall sentiment skews cautiously optimistic. The broader crypto community is watching to see if DogeOS can overcome past scaling critiques and position Dogecoin alongside more established smart contract platforms. For listeners following the space, this development underscores a growing trend. Legacy coins are now investing in modular infrastructure to stay competitive. The next few months will be critical to gauge whether DogeOS can translate technical promise into tangible market upside. Bitcoin has bounced after headlines that a U.S. funding deal could unlock roughly $150 billion from the Treasury General account, potentially flooding markets with liquidity. The rally sparked mixed reactions. Some strategists view the move as a signal that Bitcoin's growing correlation with macro funding is solidifying a bullish trend, while others remain cautious, noting that the coin still needs to close above $110.0 to confirm momentum and warning that overextended commodities could drag crypto down. Rising hash rates add a layer of confidence for long-term holders, suggesting network health and demand are steady even as sentiment stays bearish on social metrics. For listeners, this means Bitcoin's next few weeks will be pivotal. New liquidity could lift risk appetite, but any softening economic data or fading stimulus hopes might push the price back toward support levels, keeping volatility in play as the year draws to a close. CleanSpark, a major Bitcoin mining operator, has launched a $115 billion convertible senior notes offering to shore up its balance sheet and fund expansion amid tightening miner margins. The private placement will sell notes that convert at roughly 52 shares per $1.0, about a 27.5% premium over the company's recent closing price, while giving early buyers a 13-day option to add another $150 million. CleanSpark plans to use about $460 million of the proceeds for a share repurchase, and the rest to grow its power, land, and data center portfolio, and pay down Bitcoin-backed credit lines. The move comes as network difficulty hit a record $155.97 trillion in late October, pushing hash price revenue to its lowest since April and squeezing profitability across the sector. CleanSpark's output fell from 706 BTC in March to 612 BTC in October, echoing similar declines at peers like Riot and Kango. Market sentiment skews bearish. Miners are under pressure, yet the capital raise signals confidence that scaling will eventually offset the current squeeze. For listeners, This highlights how even top-tier miners are navigating a high-difficulty environment by securing long-term financing to sustain growth. In a high-profile legal twist, former cryptocurrency fraudster Heather Razzlekin Morgan, known for laundering an estimated $13 billion in stolen Bitcoin with her husband Ilya Lichtenstein, has been sentenced to 18 months behind bars. The case underscores the growing scrutiny of crypto money laundering schemes and the tightening regulatory net over illicit digital assets. Morgan's brief, unverified claim that former President Donald Trump had commuted her sentence sparked a flurry of speculation online. The correction came just weeks after she was convicted for orchestrating large-scale Bitcoin laundering in 2016. While the statement did not influence any legal outcome, it fueled temporary FUD among investors watching how high-profile crypto figures navigate the justice system. For market watchers, the ruling reaffirms that regulators are cracking down on sophisticated laundering operations, and that even prominent names cannot escape accountability. This sentiment may reinforce a cautious stance toward unverified claims in the space, reinforcing a broader narrative of increased compliance pressure, rather than any bullish surge tied to individual personalities. Zcash, ZEC, has dropped more than 20% in the last 24 hours, sparking concerns that its recent rally could be cooling. Yet the broader picture tells a different story. The coin is still up about 14% this week, and over 200% in the past 3 months, ranking among the strongest performers of the cycle. Analysts see the dip as a consolidation within a bull flag pattern, an upper trend line forming after the late October surge that could break to the upside once resistance is breached. Hidden bullish divergence on the daily chart adds weight. ZEC made higher lows while RSI fell, suggesting selling pressure easing. Derivatives data points to a short heavy zone between $529 and $651. If the price nudges up, forced liquidations could trigger a squeeze that fuels further gains. Current levels hover around $526, with breakout targets near $612, $688, potentially setting off runs towards $749, $898, or even $110, while a full flagpole projection hints at upside close to $230. The key caveat is maintaining support above $488. A break below could invalidate the pattern and open the door to deeper retracements toward $371. For now, ZEC looks more like a recharge than a retreat. Its 20% pullback may have simply primed the market for the next leg higher. Coinbase has rolled out a UK savings account that pays a variable 3.75% annual equivalent rate, with interest credited daily and backed by the Financial Services Compensation Scheme up to £80.50. The product is powered through ClearBank, allowing instant deposits and withdrawals without lockups or minimum balances, effectively giving users bank-like liquidity while earning crypto-style yields. Market chatter leans bullish. Traders note that the rate eclipses most traditional UK banks and rivals many fintech savers, sparking FOMO among investors looking for higher passive income streams. Yet some caution that regulatory fines, recent FCA penalties, and an Irish anti-money laundering fine highlight ongoing compliance risks for Coinbase's expansion strategy. For listeners, this move signals a growing trend of crypto exchanges positioning themselves as full-stack neobanks, blending fiat protection with digital asset flexibility, and could reshape how UK consumers approach savings and spending in the near term. NFT markets are showing a modest rebound after last month's slump, with the biggest gains coming from established blue-chip projects such as CryptoPunks and Bored Ape Yacht Club. Across the broader space, secondary market sales have ticked up by roughly 12%, signaling renewed buyer confidence. Meanwhile, meme coins, particularly those that dominated the January rally, have surged again, with Dogecoin Shiba Inu, and SafeMoon each posting double-digit gains in a wave of FOMO-driven buying. The overall sentiment is bullish. Traders are returning to the market after a period of uncertainty, and liquidity appears stronger than it was during the dip. For listeners, this suggests that while volatility remains high, the fundamentals for both NFTs and meme coins are stabilizing, and positions may be looking more attractive as momentum builds. Bitcoin's price has settled near $105,300 after a brief slide toward the $100 mark, keeping its weekly trend largely intact despite a dramatic surge in selling pressure. On-chain data shows short-term holders moved 695 BTC to exchanges from just 470 on November 8, a jump of over 300%, while midterm investors added another 857 BTC, nearly tripling their outflows. Such inflows usually signal a bearish tilt, yet the market has held steady, hinting that fresh buying is offsetting these exits. Technical chatter points to an emerging bullish crossover. The 20-period EMA is edging above the 50-period EMA, a pattern that previously spurred a 5% rally in late October. If this cross completes, it could confirm underlying momentum recovery and lift Bitcoin toward key resistance levels at $105,500, with potential upside to $109,700, $112,600, or even $116,400. Whale activity adds another layer of support. Entities holding over 10 BTC increased by 26 units between November 6 and 10, adding roughly 26 BTC, about $27 billion, to large wallets. This accumulation could absorb short-term selling and sustain the current rebound. However, a daily close below $102,900 would weaken the structure, exposing $98,800 and potentially reversing the bullish setup. Cardano, ADA, remains a top 10 altcoin, but its price is still stuck near 2024 levels, hovering below $0.60 after a 30% pullback. Despite the flat chart, on-chain data shows that whales and sharks, holders of 100 to 100 million ADA, have been quietly buying hard, accumulating roughly 348 million tokens in the last 4 days, worth about $204 million or 0.94% of total supply. This is the strongest accumulation since May and signals smart money's confidence that the dip offers a better entry point. The market reaction so far has been muted. Retail sellers have stepped back while large holders fill the void, keeping volatility low but setting the stage for a potential bullish swing. Historically, ADA has launched sharp rallies after long consolidation periods of about 10 months, with 2023 and 2024 seeing gains of 200–300%. Current conditions mirror those setups, and the upcoming Cardano Summit in Berlin could inject further optimism. Yet overall sentiment remains cautious, as the altcoin season index sits at a low 39 points, indicating lingering fear that may temper an immediate breakout. Coinbase has relaunched U.S. token sales after a 7-year pause, unveiling a new platform that pairs community fundraising with regulatory guardrails. The first offering will feature Monad, a Layer 1 chain, selling 75% of its supply from NAV 1722 in USDC bids. An algorithm favors smaller orders to broaden participation. To curb quick flips, Coinbase will penalize holders who sell within 30 days and lock sold tokens for 6 months, with private or secondary sales requiring approval. Projects must clear team, token structure, and vesting checks, while buyers pay no fee but issuers shoulder a percentage of proceeds. The launch follows Coinbase's $375 million acquisition of Echo, the crypto fundraising platform that powers transparent community deals. The move signals a bullish shift toward regulated public offerings, echoing recent high-profile sales like Megaeth's rapid raise via Echo's sonar. Institutional interest is growing, and the new rules aim to restore confidence after past ICO volatility. For listeners, this marks a structured entry point into token launches, with potential FOMO on early monad access, but tempered by anti-pump safeguards. Femex, a high-performance crypto exchange with over 6 million users, has unveiled a refreshed logo and upgraded platform design as the first step in a broader rebranding effort. The new visual identity features a minimalist two-candle motif, symbolizing growth and momentum, a deep green to bright blue gradient that conveys stability and innovation, and sharper geometric typography to reinforce reliability. The interface now boasts 3D visuals, unified icons, and lightweight layouts for cleaner desktop and mobile trading experiences. The update signals Femex's shift from a niche spot and derivatives venue toward a comprehensive digital asset platform, aiming to strengthen brand cohesion while maintaining its core emphasis on speed and precision. Market reaction has been cautiously optimistic. Traders view the refresh as a confidence booster rather than a disruptive change, with sentiment leaning bullish for user engagement but neutral on price impact. For listeners, this move underscores how established exchanges are evolving their identities to stay relevant in an increasingly crowded crypto ecosystem, blending performance with a clearer brand narrative. Brazil's central bank is tightening its grip on the crypto market, with a sweeping regulatory overhaul set to take effect in February 2026. All exchanges, custodians, and brokers will need explicit licensing, meeting bank-grade standards for compliance, risk management, and cybersecurity. Stablecoins, currently driving about 90% of Brazil's crypto flows, will now fall under foreign exchange rules, and any unlicensed cross-border transfer faces a $100 zero cap. The move signals a shift from the Wild West era to a regulated ecosystem, aiming to curb money laundering risks while preserving innovation. For traders, this introduces more paperwork but also clearer legitimacy for platforms that can comply. Market sentiment skews cautiously bullish. The framework may reduce scams and volatility, yet the stricter rules could dampen rapid growth in the near term. Brazil's stance positions it as a regional model. Latin America's largest economy is setting the tone for how emerging markets might balance openness with oversight. Ripple's flagship token XRP has surged nearly 10% this week, trading around $2.45 on Coinbase after a recent uptick that fuels bullish sentiment among institutional players, eyeing spot ETF launches slated for mid-November. The rally, however, sits on fragile footing. Technical analysts flag the $2.41 Fibonacci support as a critical backtest. A failure to hold could trigger a slide toward the 0.5 retracement near $2, aligning with broader correction patterns observed across the market. Meanwhile, Bitcoin's stalled resistance at $107K keeps the ecosystem in a state of tension. Any pullback there would ripple through altcoins like XRP. Ripple's CEO Alexis Surkia highlights long-term catalysts such as SEC filings for multiple ETF tickers and significant capital injections from Citadel and Fortress, suggesting that while short-term price action remains volatile, structural fundamentals are solidifying. For listeners, the takeaway is clear. Monitor the $2.41 zone. A bounce could sustain the rally, but a break may prompt a retracement to macro support before any decisive move forward. Libra's shadow saga expands as Argentina cracks down on Hayden Davis in a fresh move that adds to the $250 million fraud probe now stretching across Buenos Aires and New York courts. The Argentine court ordered a sweeping freeze of Davis's assets, tightening the net around alleged misappropriations tied to the failed Libra initiative. Market chatter has turned bearish, with FUD swirling as regulators tighten scrutiny over former Libra players. Investors are bracing for further legal rattles that could ripple through the broader stablecoin ecosystem, while some view this crackdown as a sign that regulators are finally closing loopholes. For listeners tracking digital currency compliance, this development underscores how jurisdictional pressure can amplify risk and shift sentiment in an already volatile space. CleanSpark, Nasdaq-listed, and the world's second largest Bitcoin miner, with a 46.6A/s hash rate, has announced a $115 billion senior convertible note offering to fund its expansion into both Bitcoin mining capacity and artificial intelligence infrastructure. The deal is slated to close on November 13, with net proceeds expected around $113 billion, up to $128 billion if underwriters exercise all options. CleanSpark plans to allocate $460 million for a private share buyback at roughly the current trading price, and will deploy the remainder to grow its power land portfolio, build data center capacity, repay Bitcoin secured debt, and cover operating costs. The move comes amid a broader industry pivot toward AI and high-performance computing, as miners seek higher margin workloads after the April having trimmed block rewards. CleanSpark's announcement has injected bullish sentiment into its shares, which surged 13% in late October following the AI strategy reveal. For listeners, this signals that even established mining players are diversifying to hedge against falling Bitcoin profitability and rising power costs, positioning themselves for the next wave of tech demand. The X402 protocol, an internet payment layer that lets autonomous AI agents execute verifiable on-chain payouts, has seen a sharp contraction in activity. Over the last 30 days, its trading volume collapsed by nearly 90%, falling from $28 million to just 329,000, while transaction counts dropped 56% from about 3 million to 13 million. Coinbase remains the dominant player, handling the majority of requests and volume in a single day. Google Trends data echo this slide, with global search interest plummeting from a peak of 100 to only 10, signaling waning public attention. Despite these bearish numbers, institutional momentum is still building. Chainlink's recent integration of an X402 endpoint into its runtime environment enables AI agents to discover workflows, verify outcomes, and settle directly on-chain, opening the door to programmatic payouts and a reusable marketplace. Bioprotocol's adoption of X402 for instant USDC micropayments on Base further demonstrates real-world use in decentralized science. Overall, while retail sentiment looks bearish, the ecosystem's market cap has surged 300% in 2 weeks, from $800 million to over $12 billion, highlighting a dichotomy between short-term activity drops and long-term institutional uptake. Bitcoin has surged past $106 after the U.S. government lifted its shutdown and moved back into office space, sparking a risk-on rally across the crypto spectrum. The Senate's approval of a continuing resolution to fund federal operations through January 2026 removed a major drag on economic sentiment, easing uncertainty and encouraging speculative capital flow. As a result, Bitcoin and key altcoins have posted double-digit gains, while traders are bracing for potential $2.0 stimulus checks that could inject further liquidity into the market. The move signals a bullish turn, with FOMO driving demand as investors anticipate a rebound in discretionary spending. However, the stimulus proposal remains contingent on legislative approval, leaving some caution in the air. In short, the government's return to normalcy is acting as a catalyst for renewed confidence in crypto assets, positioning the market for another upward trajectory while observers watch the stimulus bill's fate closely. Gemini, the Winklevoss-backed crypto exchange, reported a 52% jump in Q3 revenue to roughly $50 million, driven by higher transaction fees and a surge in services such as credit card usage. staking, and custody. Despite the top-line growth, the company posted a net loss of $159, $5,667 per share, highlighting ongoing cost pressure after its IPO debut. The news sent shares down about 12%, dropping below $15 and marking the lowest post-IPO price. Investors are weighing Gemini's expanding ecosystem against its continued profitability gap. Sentiment skews cautious, with some FOMO around new product launches like a self-custody wallet and planned prediction markets, but bearish concerns persist over high operating expenses and market volatility. For listeners, this underscores that while revenue momentum exists, the exchange remains in an adjustment phase, balancing growth initiatives with financial discipline as it navigates the broader crypto landscape. Bitcoin's headline has turned into a courtroom drama as the U.S. 11th Circuit Court of Appeals dismissed a $364 million claim against the federal government. The suit, filed by convicted fraudster Michael Prime, sought compensation in Bitcoin for alleged losses tied to his illegal schemes. The judge ruled the demand was filed too late and lacked credible evidence, effectively crushing one of the largest Bitcoin-related claims ever seen. For market watchers, this ruling sends a clear signal. Regulatory bodies remain resilient against large-scale crypto lawsuits, reinforcing confidence that U.S. institutions can withstand legal challenges without destabilizing the broader ecosystem. The decision may dampen short-term FUD surrounding governmental exposure to volatile assets, but does not alter Bitcoin's long-term trajectory. In context, this outcome underscores that while individual litigants can pursue claims, the courts are tightening scrutiny on evidence and timing, reminding traders that legal risks exist but are not a systemic threat to the market at large. Paysten, a BitWo billion payments platform that moves $20 billion in transactions each year, has acquired Bitwidge, a crypto payroll engine that has dispersed more than $400 million in digital wages across 200 countries since 2014. The deal injects USDC and USDT salary payment capabilities directly into Paysten's enterprise workflows, allowing companies to send stablecoins on weekends, bypass ACH delays, and cut cross-border FX costs. With Bitwidge's 90+ user base already converting fiat salaries via Circle and Tether, the combined service positions itself as a plug-in for payroll automation, while prioritizing Layer 2 solutions and Solana for faster settlement. The acquisition comes amid a boom in stablecoin traffic, $9 trillion of transfers in 2025, nearly half of Visa's annual throughput, and growing institutional adoption through BlackRock's BUIDL fund and MasterCard's USDC settlements. Market sentiment skews bullish. Firms view stablecoins as a competitive edge, with 87% of CFOs acknowledging this advantage, up from 61% last year. For listeners, the move signals that payroll can now be streamlined through on-chain dollars, reducing costs for global talent while aligning with regulatory clarity in the U.S., where SEC guidance on custody is tightening, and high-profile acquisitions like Visa's bridge purchase underline mainstream acceptance. The spotlight has shifted back to meme coins after political-themed tokens Trump and MELANIA sparked a wave of buying. In the past week, Trump surged 14%, while MELANIA leapt 35% in one day and 66% over 7 days, igniting FOMO among traders who chase reflexive momentum rather than fundamentals. This rally has spilled into related projects. Bitcoin Hyper, Dollar Hyper, a Bitcoin-settled Layer 2 presale that has already raised over $26 million with significant whale activity. Maxi Doge, Dollar Maxi, a brand-centric meme token emphasizing staking and community engagement. And Useless Coin, Dollar Useless, a Solana listing with a $185 million cap that offers immediate liquidity on major exchanges. The current sentiment is bullish, driven by macro optimism and concentrated on chain purchases, but the space remains volatile. Listeners should note that these tokens are speculative vehicles riding cultural hype rather than core utility, and market moves may be swift and short-lived. Uniswap's native token UNI has surged to a new high, becoming the strongest performer among the top 30 cryptocurrencies by market cap, after rallying 20% in the last 24 hours and topping $8.50 per coin. The spike followed the launch of the UNification governance proposal submitted by Uniswap Labs and the Uniswap Foundation on Monday. If approved, the plan would activate a burn mechanism that uses protocol fees from the DEX and Unichain sequencer to destroy tokens, while also permanently burning 100 million UNI already held in the treasury and stopping Uniswap Labs from collecting interface, wallet, and API fees. The move is designed to shift fee revenue toward the protocol's treasury or token holders, a long-awaited fee switch. Market sentiment has tilted bullish as traders react to the potential supply contraction, but technical indicators hint at an overbought condition with RSI near 73 and MACD still in positive territory. Should the rally cool, UNI could retrace to around $7.20 for a new support level. A further dip would force defense of $6.60. If momentum resumes, the token may reclaim Monday's $10.20 peak within days. Ethereum is currently tightening its range around $3,580 after a period of restrained intraday swings and low volatility. The coin's price has been circling between roughly $3,500 and $3,680. With only a modest 24-hour drift observed by major tracking platforms. This consolidation suggests that traders are waiting for a clear directional move before committing capital. Market sentiment leans neutral to slightly bearish. The lack of significant price action fuels caution among holders wary of a potential pullback. For listeners on the edge of the market, this tight coil indicates that any breakout, whether upward or downward, will likely trigger sharp reactions. Until volatility picks up again, Ethereum remains in a holding pattern, keeping the broader crypto ecosystem on standby for the next decisive shift. Bitcoin has steadied above the $105.0 mark as global risk sentiment eases and institutional inflows continue to reinforce its price structure. Market participants note that the recent pullback from a higher peak has been capped by a resilient support zone around 104,000, with on-chain activity showing steady buying pressure. This backdrop fuels a cautiously bullish tone. Traders are less rattled by macro uncertainty, while FOMO remains subdued compared to the last rally cycle. For listeners navigating today's market, the key takeaway is that Bitcoin's recent consolidation reflects both an improving risk environment and growing institutional confidence, positioning it for potential upside if the current support holds. ConsenSys's legal team has fired a warning shot at the Senate's proposed crypto market structure bill, after a draft provision was released that could leave decentralized finance operators without clear protection. The firm argues that the so-called safe harbor language is too vague and would fail to shield DeFi projects from potential regulatory crackdowns, citing precedent cases where ambiguous statutes have led to enforcement actions. This critique arrives just as lawmakers are still wrestling with how to define and regulate non-custodial platforms, a debate that has stalled progress on the bill for months. The backlash is already echoing across crypto circles. Traders and developers are voicing concerns that an ill-defined safe harbor could trigger a wave of compliance costs or sudden shutdowns, fueling a bearish mood in DeFi-centric tokens. At the same time, some market watchers see this as a wake-up call for clearer regulations, potentially opening the door to more institutional interest if the framework is tightened. For listeners, the key takeaway is that the Senate's crypto bill remains on hold until 2026 at the earliest, and the lack of definitive guidance could keep DeFi projects in a regulatory gray zone. This uncertainty may dampen short-term enthusiasm, while investors weigh the risks of operating without solid legal footing. Shiba Inu, SHIB, has been rattling the markets again after a sharp shift in its trend that could signal another slide toward lower levels. In the past 24 hours, the token logged a staggering outflow of roughly 15.5 billion SHIB from exchanges, indicating that holders are pulling back rather than dumping into centralized venues. This lack of exchange inflow is a double-edged sword. On one hand, it suggests liquidity pressure could worsen if the price continues to fall. On the other, it may keep large sell orders off the books, potentially softening an immediate dump. The overall sentiment around SHIB has turned noticeably bearish as traders weigh the risk of a deeper pullback against the token's ongoing meme coin hype cycle. FUD is building among more cautious participants who fear that a sustained downturn could erode confidence in the project's long-term viability, especially after recent regulatory scrutiny over its marketing claims. Conversely, some FOMO remains tied to the low price levels and the potential for a quick rebound if the market sentiment shifts. For listeners tracking meme coins or looking for short-term trading opportunities, the current environment underscores the importance of monitoring exchange flows as a proxy for market pressure. A continued outflow trend could presage further downward momentum, while any sudden reversal in exchange deposits might signal a potential stabilization or even a modest bounce. Stay tuned for how SHIB's liquidity dynamics evolve and whether the bearish narrative holds or gives way to renewed buying interest. Internet Computer, ICP, is on the brink of a breakout that could push its price toward the $10 mark and beyond. Recent technical analysis shows ICP's chart forming a falling wedge pattern, a classic signal for a bullish reversal once the support level holds. The catalyst comes from a steady rise in stablecoin supply circulating on the network, indicating increased liquidity and broader adoption of the platform's infrastructure. Market sentiment is leaning bullish. Traders are watching closely for a breakout that could trigger FOMO buying, while some remain cautious about potential short-term volatility. For listeners, this development signals that ICP may be positioning itself as a key player in the decentralized internet space, with growing on-chain activity and institutional interest potentially driving demand. Keep an eye on the next price action. If the wedge holds, it could set the stage for a significant rally. NFTs and memecoins are pulling back from a steep slide, with the global NFT market cap climbing roughly 12% to $39 billion in just 1 week, while memecoin valuations jumped about 11% from $47 billion to $52 billion. This rebound signals that traders are cautiously reallocating capital into higher-risk digital assets, despite lingering macro uncertainty and U.S. fiscal debates. The uptick is driven by a handful of high-momentum collections: CryptoPunks up 22.8%, Mutant Ape Yacht Club 36.5%, and Milady Maker 80%, and strong performance on BNB Chain, Polygon, and Flow, which outpaced other ecosystems. Blue-chip titles such as Bored Ape Yacht Club and Pudgy Penguin still see declines, indicating a segmented recovery. Across the board, the top 10 memecoins posted gains: Dogecoin plus 8.7%, Shiba Inu plus 10.4%, and Pepe plus 7%. Solana-based tokens like Bonk and Dogwifhat also surged over 11%. The overall sentiment is bullish for speculative players, but liquidity remains concentrated in select collections, leaving the broader market wary of sustaining this momentum amid ongoing volatility and regulatory scrutiny. Sway's native token, Sway, has just secured a major institutional-grade custody partnership with Crypto.com, the global crypto exchange. The deal gives high-net-worth investors and enterprises a regulated cold storage solution backed by transparent audits and seamless liquidity access on Crypto.com's platform. Market reaction is bullish. Sway surged almost 5% over the past week, And while it dipped about 3% today amid a broader pullback, traders view the partnership as a confidence boost for institutional demand. For listeners, this move signals that Sway is tightening its compliance framework and expanding its appeal to traditional finance players, an essential step as the network pushes new ETFs, ETNs, and trusts into regulated markets. The alliance underscores a growing trend of mainstream exchanges offering custodial services for emerging Layer 1 projects, positioning Sway as a more credible entry point for institutional capital. Bitcoin is hovering near $105.00 after slipping past its April 2025 support at $107.00, which has flipped into a hard resistance zone as the price pulls back. The drop coincided with renewed optimism that the U.S. government avoided a shutdown, giving risk assets a lift, but the crypto market remains wary. Technical analysis shows BTC has shed both the 200-day MA and EMA, now converging near $107,000. If it can break and hold above that level, downward pressure may ease. Otherwise, the trend stays bearish. On higher timeframes, the 50-week EMA still provides a solid support anchor, having held since 2023, while an unfilled fair value gap around $90.00 could attract liquidity if the price retraces. Traders are watching key zones below $105,000 for potential pullbacks and short-term moves, with institutional outflows hinting at cautious sentiment. The current scene is one of cautious optimism, FOMO from recent gains tempered by a clear resistance barrier that will dictate Bitcoin's next major swing. Femex, a leading crypto exchange known for low-latency spot and derivatives trading, has unveiled a fresh visual identity and a revamped platform interface. The new logo, a minimalist two-candle motif, signals growth and balance, while the updated gradient shifts from deep green to bright blue to convey stability and innovation. Typography moves to sharper geometric shapes, reinforcing reliability, and the UI now features 3D visuals, unified icons, and lighter layouts for a cleaner desktop and mobile experience. The rebrand is part of Femex's broader strategy to transition from a high-performance trading venue into a comprehensive digital asset ecosystem. This signals bullish sentiment among users who value speed and clarity. The redesign aims to boost confidence and attract traders seeking an intuitive, trustworthy platform. For listeners, it underscores that Femex is investing in brand cohesion and user experience as it scales its services beyond spot and futures, positioning itself for future growth in the competitive crypto exchange landscape. Cardano's native token ADA has rebounded sharply after slipping below $0.50 earlier this week. Following a dip to roughly $0.48 on November 5, the coin surged over 20% and topped $0.60 by November 10, before easing about 2% to around $0.58 in the last 24 hours. The rally is underpinned by significant on-chain buying. Whales and large holders have added nearly 1% of the circulating supply, about 348 million ADA worth roughly $204 million, in just 4 days, signaling renewed confidence from major investors amid broader market volatility. Analysts note that while short-term momentum has improved, ADA remains testing the lower edge of its trend band. A sustained break above $0.70 would be needed to confirm a full bullish turnaround. Beyond price action, Cardano's ecosystem is strengthening. DeFi TVL rose 28.7% in Q3 to $423.5 million. NFT trading volume surged 561%, and the privacy-focused sidechain Midnight secured a partnership with Google Cloud. Governance has also progressed, moving from an interim constitutional committee to a fully elected body, reinforcing community control. These developments paint a cautiously optimistic picture for ADA as it seeks higher ground. Exodus Movement Inc., listed on NYSE American under ticker EXOD, has just announced a strategic acquisition that will reshape its merchant services footprint in Latin America. The company is buying Montevideo-based Grateful, a stablecoin payments orchestrator that powers wallet-to-wallet transfers, QR code point-of-sale terminals, off-ramping options, and e-commerce checkouts for merchants across Uruguay. This deal signals a bullish push by Exodus to deepen its stablecoin infrastructure and offer faster, lower-cost payouts in the region. The move comes amid growing demand for seamless crypto merchant solutions as retailers seek to capture the expanding digital currency user base. By integrating Grateful's technology, Exodus positions itself to capitalize on the surge of wallet-to-wallet commerce, potentially boosting adoption rates and strengthening its competitive edge against other payment platforms in the fast-evolving stablecoin ecosystem. Tether, once a straightforward stablecoin provider, is now operating with the complexity of a central bank. The company has begun to manage its reserves in a way that mirrors monetary policy, adjusting holdings, reporting profits, and making strategic decisions that resemble those of sovereign institutions. This shift signals a move away from the simplicity that originally attracted users seeking a stable digital asset. Market reaction is mixed. Some traders view the new structure as a sign of institutional maturity, while others fear increased regulatory scrutiny could dampen confidence, creating FUD around Tether's future stability. For listeners, this development underscores how dominant stablecoins are evolving beyond mere price anchors into entities that could be subject to policy-like oversight, potentially reshaping their role in the broader crypto ecosystem. Solana's two newly launched spot ETFs have posted a stunning run of inflows, pulling in roughly $342 million over just 10 days since their debut last month. The cumulative net capital added underscores growing confidence among institutional and retail investors looking to gain direct exposure to Solana without the volatility of crypto wallets. Market chatter has tilted bullish, with many traders citing the steady money flow as a sign that Solana's ecosystem is regaining traction after earlier sell-off periods. For listeners, this momentum could signal an easing of bearish sentiment around Layer 1 blockchains and may influence how other emerging chain ETFs are priced moving forward. Uniswap's flagship token, UNI, has taken a sharp turn toward a new governance architecture under founder Hayden Adams' latest proposal, dubbed UNification. The initiative would overhaul the platform's tokenomics by allocating roughly $38 million each month to buyback and burn UNI tokens, a move designed to tighten supply and potentially lift the price. Market reaction is mixed. On one side, traders see the buyback program as a bullish signal that could curb inflationary pressure. On the other, skeptics warn it may trigger a short-term sell-off if liquidity dries up or if users perceive the change as a dilution of voting power. The broader context is clear. Uniswap has been under scrutiny for its governance model and token distribution, and this proposal arrives amid growing competition from Layer 2 DEXs and evolving regulatory pressures. As votes are cast over the coming weeks, the crypto community will be watching closely to see whether the UNification plan can deliver on its promise of a more resilient UNI ecosystem, or simply add another chapter to the platform's ongoing governance saga. Bitcoin faces a new quantum era risk as on-chain analyst Willy Woo has urged holders to migrate funds out of Taproot addresses. Woo's X thread outlined a 6-step plan to move coins from BC1P addresses, where public keys are exposed, to older SegWit BC1Q or legacy 1/3 formats that hide keys behind hashes until transaction broadcast. The push follows growing chatter that quantum computers could eventually crack ECDSA signatures, exposing Taproot holdings. Market sentiment has turned cautious. Traders see the move as a warning sign and some are tightening risk management, while others dismiss the urgency, citing a 10-20-year horizon for practical quantum threats. For listeners, this debate underscores how protocol upgrades can trigger technical friction. Bitcoin's flexible UTXO model allows phased migration, whereas smart contract chains like Ethereum face permanent exposure once contracts lock in current signatures. The conversation highlights that even as the crypto ecosystem evolves, new security paradigms may force rapid shifts in wallet and address strategies. CleanSpark, a top-tier Bitcoin miner, has announced plans to raise $115 billion to scale its mining operations and launch an AI-focused data center division. The capital will be used to add new hash rate capacity, while diversifying revenue streams as the market braces for post-halving pressure on BTC prices. Investors see the move as a bullish signal that CleanSpark is positioning itself against the tightening supply curve. Yet some analysts caution that the hefty funding could dilute earnings if AI demand stalls. The company's pivot reflects a broader industry trend, where miners seek alternative income sources to offset declining mining margins, underscoring the sector's ongoing shift toward hybrid infrastructure models. Ethereum's next major upgrade, Fusaka, is set to go live on December 3, 2025 at 21:49, 11 UTC. The lone hard fork brings a suite of EIPs that overhaul data availability, proposer scheduling, and the EVM itself. Key changes include erasure-coded blobs distributed across subnets, a new peer-does protocol limiting blocks to 10 blobs initially, with future increases to 14 and then 48, and security tweaks such as storing 2 epoch-ahead proposer schedules for Merkle-proof validation. Cryptographic upgrades allow SEC-256 Roan curves alongside the current SEC-256 cone, boosting hardware wallet compatibility. Gas cost adjustments. EIP 7883 hikes precompile fees, while EIP 7934 caps execution blocks at 8 MB to prevent oversized block attacks, aimed to tighten DUS defenses. Validator gas limits rise to 60 million, and ancillary optimizations strip legacy data from P2P messages, EIP 7642, and add a new ETH config RPC for client tracking, EIP 7910. Market chatter is mixed. Analysts note that the enhanced data layer could improve scalability, sparking bullish sentiment among developers and infrastructure firms. However, some traders warn of potential short-term congestion as nodes adapt to blob handling, injecting mild FUD around immediate performance. For listeners, Fusaka represents Ethereum's most ambitious loan push yet, promising stronger security, better data availability, and a more efficient gas model, key factors that could shape the network's trajectory in the coming months. Japan's Stardoll has rolled out a new super app designed to integrate directly with Sony's emerging Sonium blockchain ecosystem. The platform will let users tap into upcoming token generation events, claim airdrops, and earn rewards native to the Sonium network. By bundling these features in a single interface, Stardoll aims to streamline user participation across multiple token launches, potentially driving higher engagement rates for Sonium's offerings. Market observers see this as bullish momentum for both brands. Stardoll expands its digital footprint while Sony boosts activity on its blockchain layer, feeding FOMO among early adopters and reinforcing confidence in the ecosystem's growth trajectory. For listeners following crypto infrastructure trends, this move signals a consolidation of services that could accelerate mainstream adoption of Sonium's native assets. XRP has swung sharply against the bulls after a sudden surge of bearish sentiment took hold across major exchanges. The digital assets price fell back toward the $240 level, snapping the brief rally that had lifted it above that threshold earlier in the week. Traders and short-term holders have taken profits, while long positions are tightening around key support zones, creating a net sell pressure that keeps the market tone decidedly bearish. This dip comes amid growing FUD over regulatory scrutiny and liquidity concerns, which has prompted many participants to exit or reduce exposure. For listeners monitoring XRP's trajectory, the current pullback signals a cautious period ahead. The asset is now testing critical resistance levels before any potential rebound can materialize. Dogecoin remains the only meme coin that has stayed in the top 20 for almost a decade. In 2025, its largest custodial holders are still exchanges. Robinhood's wallet holds 2716 billion Doge, about 18% of total supply, worth roughly $48 billion at current rates. Binance follows with 15.7 billion Doge, approximately 7%, valued near $277 billion. And South Korean exchange Upbit owns 1056 billion Doge, approximately 7%, worth about $186 billion. The concentration of Doge in these platforms underscores the coin's institutional footprint. Despite this backing, Doge's price has slumped nearly 76% from its all-time high of $0.7316, fueling bearish sentiment and FUD among holders. Yet recent macro cues, interest rate cuts, and the end of a U.S. government shutdown, plus pending ETF approvals could ignite a bullish rally. For listeners, this means Doge's future trajectory hinges on regulatory moves and broader market cycles, rather than any single holder's activity. A new disclosure from Coinbase has spotlighted Monad, the cryptocurrency behind a recent ICO that raised significant capital through token sales. In the filing, Coinbase revealed that Monad's launch involved allocating roughly $160 million worth of tokens to 5 distinct market maker firms. Each firm received a specific tranche, with detailed breakdowns of amounts and timing, marking one of the first public instances where an ICO's liquidity provision is so transparently disclosed. The move signals a shift toward greater operational transparency for projects that rely on institutional makers to maintain price stability. For traders, this could reduce uncertainty around supply manipulation, potentially easing FUD surrounding early-stage token volatility. Conversely, some market watchers note that the sizable loan volumes might still create short-term liquidity pressure if any maker exits abruptly, injecting a mild bearish undertone. Listeners should view this development as part of a broader trend, where exchanges are increasingly demanding clearer disclosures on token allocation and market-making arrangements. As more projects follow suit, investors can expect tighter scrutiny of how early-stage tokens are distributed, which may influence both short-term price swings and long-term confidence in ICO ecosystems. DeFi tokens are stepping into the spotlight as the U.S. government shutdown edges toward a resolution this week. Crypto whales have begun piling into projects like Aster, Pendle, PENDLE, and Uniswap, UNI, signaling renewed confidence in risk assets ahead of the expected policy clarity. In the last 24 hours, whale holdings of Aster jumped by almost 5 million tokens, an 87% increase that translates to roughly $55 million at current prices. Pendle saw a modest inflow of 410 tokens, adding about $12 million in value, while UNI's large holder activity continues despite the token trading within a narrowing wedge and an RSI divergence hinting at a potential pullback. The market reaction is bullish. Whale accumulation suggests that big money anticipates a rebound once federal operations resume, reducing FUD around the shutdown uncertainty. Traders are watching key support levels: Aster's descending channel, Pendle's $250 floor, UNI's $953 threshold, and resistance points that could trigger short-term upside if broken. For listeners, this signals that DeFi and DEX tokens may experience a surge in demand as the political stalemate lifts, positioning these assets for potential gains while cautioning on possible retracements before momentum solidifies. Bitcoin has slipped into a prolonged sideways shuffle, hovering in the low $100 zone despite a bullish backdrop in equities and an upcoming U.S. government reopening. On shorter time frames, the price has broken its prior downtrend, but is now trading in a corrective impulse, with a modest uptrend line suggesting potential upside to roughly $107,500 if the bulls maintain the current stance. Daily charts show BTC still below the 200-day moving average. Only a sustained rally above that level would signal a clear shift back into bullish territory. Fibonacci retracements from the all-time high place the current price at the first key level around $105.0, and traders are watching whether it can breach successive supports toward the 0,618 target near $115,750. Weekly indicators remain favorable for bulls. Stochastic RSI sits near its bottom with a possible cross-up next week, while the Relative Strength Index hovers just above the critical 4040 line that has acted as both support and resistance in recent cycles. For listeners, this means Bitcoin is currently caught between consolidation and a potential breakout. Momentum remains fragile, and any break below key averages could trigger renewed FUD, whereas a sustained push above them may rekindle bullish sentiment. Microsoft Research, in partnership with Arizona State University, has unveiled its Magentic Marketplace, a high-stakes digital sandbox where hundreds of AI agents trade, collaborate, and even deceive each other within a simulated economy. The experiment aimed to stress-test autonomous agents under complex market conditions, revealing that many bots falter when faced with deceptive tactics or sudden overloads, leading to abrupt liquidity drains and price swings in the virtual market. This demonstrates the fragility of current AI-driven trading models and underscores the risk of deploying such systems without robust fail-safe mechanisms. For crypto traders and technologists, the findings signal a cautionary tale. While AI can enhance efficiency, its susceptibility to manipulation and stress can trigger cascading failures, prompting a more measured approach to integrating machine learning into live markets. Tapbit, a rapidly expanding futures exchange that launched in 2021, has announced its 4th anniversary celebration slated for November 17th. The company will roll out permanent zero-fee spot trading on select pairs and host a $1 million rewards gala featuring trading contests, referral challenges, and lucky draws. Prizes include high-end cars and luxury goods. Tapbit's event, themed Number Tapbitan S4, blends online and offline activities to engage its global user base of over 500, across more than 200 countries. The move signals a bullish push by the platform to deepen community loyalty and attract new traders amid fierce competition for market share. By offering fee-free spot trades and high-value incentives, Tapbit aims to generate FOMO among active users while reinforcing its reputation as a low-barrier, secure venue with zero security incidents, and robust regulatory licensing from the NFA and SVGFSA. Listeners should view this as part of Tapbit's broader strategy to cement itself as a leader in futures trading, leveraging user-first innovations, such as 150x leverage, copy trading, and AI-driven bots, to stay ahead in an increasingly crowded crypto landscape. U.S. lawmakers are tightening the regulatory net over crypto by proposing a split watch system that would hand oversight of digital assets to both the CFTC and SEC. The Senate committee released a draft bill outlining clearer rules for market conduct, enforcement procedures, and licensing requirements. The move has sparked mixed reactions. Some traders see it as a step toward greater legal certainty, while others warn it could increase compliance costs and slow innovation. Analysts note that the proposal's dual agency approach may reduce regulatory overlap, but also create jurisdictional friction, adding uncertainty to market sentiment. For investors, the key takeaway is that this draft signals a shift toward more structured governance in the crypto space, potentially affecting trading volumes and exchange operations as regulators work to define their respective scopes. Bitania.com has emerged as a headline-making entrant in the no-kick exchange space, positioning itself at the forefront of privacy-centric trading for 2025-26. The platform launched with a zero verification policy, allowing users to trade without submitting IDs or selfies, while still offering a full suite of spot and futures pairs. This move has sparked a wave of interest among traders who value anonymity, pushing sentiment toward bullish foam as the market watches how Bitania navigates regulatory scrutiny. In a landscape where most exchanges tighten KYC to appease regulators, Bitania's stance offers an alternative for those wary of data collection. However, listeners should note that while the platform remains legally permissible in many jurisdictions, its status can vary by country, and users must verify local compliance before opening an account. BlockDAG has stepped into the spotlight this year as a hybrid proof-of-work/DAG network that claims to combine Bitcoin-level security with the speed of directed acyclic graphs. The project's Awakening testnet is live, handling over 400 transactions per second and fully compatible with the Ethereum virtual machine, so developers can already deploy smart contracts on BDAG. Market chatter is bullish. Investors are eyeing the potential to scale high-throughput DeFi without sacrificing decentralization. This move comes amid a broader push for faster Layer 1 solutions that can support growing user demand and complex financial products. For listeners, BlockDAG represents the next step in blockchain scalability, a technology-driven upgrade that could reshape how quickly transactions settle while keeping the network open to developers and users alike. Signum's Future Finance 2025 survey, polling over 1,000 institutional and professional crypto investors across 43 countries, shows that diversification is now the headline strategy for market players. The data reveal that 61% of respondents intend to boost their digital asset allocations, while only 4% plan to pull back. Despite this forward-leaning stance, sentiment is expected to shift toward neutrality or bearishness within a year, reflecting short-term caution amid broader macro uncertainty. The findings underscore a gradual pivot from speculative pump playbooks to more balanced portfolios that include crypto as a strategic allocation. This trend signals growing institutional confidence in digital assets as a diversification tool, even as the market remains wary of near-term volatility and regulatory tightening. For traders and portfolio managers, the takeaway is clear. Crypto is increasingly being treated as an asset class rather than a hype bubble, but expectations of a softer cycle remain high. Hyperliquid, a next-generation decentralized derivatives platform, has announced that it will remain entirely independent of venture capital funding. Founder Jeff revealed in an October interview with TBPN that the firm's core strategy is to forego external capital to preserve neutrality and avoid early investor influence, an approach he likens to Bitcoin's original ethos. The decision signals a deliberate slowdown in development timelines, as the team prioritizes long-term trust over rapid scaling. Market sentiment has leaned cautious. Traders wary of missing out on faster growth see this move as potentially bearish for short-term momentum, while supporters applaud the commitment to decentralization and view it as a bullish statement on integrity. For listeners, the takeaway is that Hyperliquid's path may mean slower feature rollouts, but aims to build a more resilient, community-driven protocol in an era where many projects chase quick valuations at the expense of true decentralization. DYDX has just dropped maker and taker fees on its Bitcoin and Solana perpetual markets after a community vote, unleashing zero-fee trading for all users with no conditions or limits. The move comes alongside the V94 protocol upgrade that introduces a sliding affiliate fee system, letting partners earn up to 50% of taker revenue based on monthly volume, while traders still enjoy a 50% rebate on any positive fees until year-end. In addition, DYDX is running a $1 million prize pool for November and a 4-week trading league with weekly payouts tied to volume. Market chatter skews bullish. Traders see fresh liquidity and lower costs as a catalyst for higher turnover, while affiliates are encouraged by the performance-based commission model. For listeners, this shift underscores DYDX's commitment to community governance and reward incentives, potentially boosting user activity and platform adoption in the competitive derivatives space. Dogecoin has steadied after a sharp pullback, with analysts noting a solid rebound from its weekly 200 EMA at roughly $0.16 that brought the meme coin back into its year-long trading channel. The latest chart shows Doge hovering near $0.18, while the moving average remains just below the price, acting as the bull's last line of defense. The key pivot identified by independent trader Kevin at Kev Capital TA is a 3-day close at $0.202. If that level is reclaimed, Doge would lift above the 0.5 Fibonacci retracement and its short-term EMA/SMA, potentially sparking upward momentum, provided Bitcoin holds its ground above $106,800. Market sentiment remains cautious, but not overtly bearish. Buyers are defending the lower rail of the channel, while sellers keep pressure on the upper levels near $0.24, $0.30. The next hurdle is the $0.21, $0.24 supply zone. Beyond that, higher timeframe targets at $0.285 and $0.305 loom. For listeners, Doge's current stance is range-bound with a clear technical framework, a rising 200 EMA, a tight channel, and defined support at $0.014, $0.09, and $0.05. A move above $0.202 on 3-day closes would signal potential bullish continuation. But the coin remains vulnerable to any dip below its short-term moving average or a Bitcoin pullback. Alora's native token, ALLO, has just landed on MEXC's innovation zone, launching spot pairs with USDT and USDC starting November 11, 2025. The exchange is rolling out a zero-fee window for the ALLO/USDT pair until mid-November, while the ALLO/USDC pair will stay fee-free indefinitely. To sweeten the debut, MEXC is running an Airdrop Plus event that rewards traders with $60K worth of ALLO and offers up to $25K in USDT futures bonuses for participants who hit 25 lucky draws. The promotion spans from November 10 to 17, 2025. Alora positions itself as a self-learning AI network where ALLO powers inference tasks, staking, and reward distribution across its decentralized model marketplace. For market players, the listing injects fresh liquidity into the AI token space and fuels FOMO around the zero-fee window, while the airdrop incentives could temporarily boost trading volumes. This move aligns with MEXC's strategy to spotlight emerging tech tokens and keep users engaged through promotional events. Bitcoin sits at a crossroads as CryptoQuant founder Kai Young-ju warns that the market could tilt towards sellers if the recent surge in strategy and spot ETF buying wanes. The analyst points out that the influx of capital from these investment vehicles has been a key driver of the current rally, but notes that once that momentum subsides, supply may outpace demand, putting downward pressure on prices. Traders are already feeling a shift. Liquidity flows that were fueling the recent uptick could reverse, sparking tighter spreads and increased volatility. For investors watching the crypto landscape, this signals a potential pivot from bullish sentiment to a more cautious stance, as the ETF-driven boom may cool sooner than expected. Avalanche's native token AVAX is eyeing a breakout above $20 after U.S. Treasury and IRS released Revenue Procedure 2025-31, creating a tax safe harbor for crypto ETFs to stake digital assets. The guidance clears the legal gray area that has kept institutional funds hesitant, allowing regulated vehicles to hold a single asset with a qualified custodian and distribute staking rewards directly to investors. With ETH and SOL already positioned to benefit, AVAX could see a surge in capital inflows as ETF managers tap its high-throughput POS network. Market sentiment is cautiously bullish. The price sits at roughly $17.75, approaching the key psychological resistance of $20 that has stymied bulls on multiple attempts. If the token sustains a rally past this threshold, it would signal renewed institutional interest and could trigger a broader altcoin rally across POS projects. For listeners, the move represents a tangible regulatory win that may unlock significant staking revenue for AVAX, potentially reshaping its investment profile amid ongoing risk asset jitters in global markets. Uniswap's flagship governance token UNI has set its sights on a massive supply-cutting initiative that could reshape the protocol's economics. The Uniswap Foundation and Uniswap Labs unveiled a plan to burn up to 100 million UNI tokens, a move aimed at increasing scarcity and rewarding long-term holders. The proposal, if approved by the community, would trigger a scheduled burn schedule over the next few years, shaving roughly one-third of the current circulating supply. Market chatter is already leaning bullish. Traders see the burn as a confidence booster that could tighten demand and lift UNI's price trajectory, while some FUD remains around whether the burn will be executed swiftly enough to prevent dilution from staking rewards. For listeners following DeFi dynamics, this development underscores how protocol-owned tokenomics can become a lever for value creation, an important signal for anyone tracking Uniswap's competitive edge in the AMM space. Dubai's luxury real estate market is heating up with under-construction penthouses sparking a new wave of bidding wars. Investors from around the globe are locking in hefty deposits, up to 1 million dirhams, to signal interest, while only the highest bidder secures the property. Others receive refunds. The top bids have surged to roughly $24 million, doubling the initial $12 million launch price and matching the cost of premium penthouses in New York and London. This frenzy signals strong FOMO among ultra-wealthy buyers seeking status symbols, while the broader market watches a potential shift toward higher-end assets. For listeners tracking global investment flows, the Dubai boom illustrates how pre-construction demand can inflate prices rapidly, offering a glimpse into emerging luxury property trends that could ripple through related sectors such as high-yield rentals and real estate tokenization. BlockchainFX (BFX) has positioned itself as a revenue-sharing platform that pays daily USDT to holders from half of every trade fee. In its presale, the token raised over $10.9 million from more than 15.0 participants and now enjoys a working beta with 10.0+ daily users generating trading volume. The model delivers tangible income rather than speculative hype, which is resonating in a market that has grown wary of empty promises. Investors are watching BFX as a potential source of steady yield amid broader uncertainty, especially after token unlocks on projects like Aptos and Chainlink have added pressure to supply-driven prices. For listeners, BFX represents an example of how utility-first projects can generate real value, offering a contrast to the volatility seen in more speculative assets. Bullzilla (BZIL) has pushed its presale into the spotlight as investors chase the next high-growth opportunity. The project is currently in Stage 10, Castle Bravo, with tokens priced at $24,573 and a 271% price hike on the horizon. Early participants could see returns north of 100%, while a typical $3.0 stake would translate into roughly 12.2 million BZIL, and potentially over $64.0 if the token reaches $527, more than a 20% gain. The market reaction is bullish, fueled by FOMO around Bullzilla's structured pricing model, transparent ROI projections, and community-centric staking rewards such as the HODL Furnace and Roarblood Vault. The hype is tempered by the project's clear tokenomics and vesting schedule, which mitigate typical meme token volatility. This surge comes amid a broader crypto backdrop where institutional interest is cautiously returning. Bitcoin ETF liquidity deepens, and platforms like Hyperliquid assert anti-VC stances while Stellar shows resilience. For listeners tracking potential 1.0 times plays, Bullzilla's underscores the continued appetite for projects that blend DeFi utility with disciplined growth paths. Bitcoin has been jolted higher amid a looming end to the 41-day U.S. government shutdown and President Trump's announcement of a tariff dividend, a proposed $2.0 benefit for every citizen that could inject massive liquidity into the economy. The Senate already passed the continuing resolution with a 60-40 vote, sending optimism through equities, gold, silver, and BTC, which is hovering near $105,300. Historically, Bitcoin rallied 96% and 157% after similar shutdowns in 2018 and 2019, though those moves often lagged weeks behind broader market recoveries. Today's sentiment skews bullish. Investors are looking for a risk-on wave as fiscal stimulus looms, but caution remains. Delays or scaling back of the dividend could trigger a short-term correction before any long-term upside materializes. Banking giants DBS and JP Morgan have announced a joint initiative to build an interoperability framework that would allow tokenized deposits to move seamlessly across both public and permissioned blockchains around the clock. The new system aims to bridge disparate ledger ecosystems, enabling instant settlement of digital asset-backed deposits without manual intervention or custodial delays. Market watchers see this as a bullish development for institutional crypto adoption, signaling confidence that banks are ready to integrate blockchain liquidity into their core operations. If the framework gains traction, it could reduce friction in cross-border payments and lower counterparty risk, potentially nudging more traditional finance players toward tokenized assets. For listeners, this move underscores the growing convergence of legacy banking infrastructure with emerging digital asset platforms, hinting at a future where deposits can be swapped instantly across multiple chains without compromising regulatory compliance. Argentina's federal court has frozen more than $507 linked to the Libra meme coin, a token that surged after President Javier Milei posted a selfie with its founder, Hayden Davis. The freeze targets Davis and two crypto operators, Colombian Fabio Camilo Rodriguez Blanco and Argentine Orlando Rodolfo Melino, as part of an investigation into what prosecutors allege is a multi-million-dollar pump and dump scheme that could have siphoned $100 million to $120 million from investors. The move comes amid mounting evidence that Libra's rapid 94% collapse was orchestrated through insider wallets and cross-chain transfers, with proceeds funneled into other meme coins like Pope. Market sentiment has turned sharply bearish. FUD dominates as traders reassess the risk of high-profile political ties in crypto ventures. For listeners, this case underscores how regulatory crackdowns can ripple through token valuations and erode confidence in projects that ride on celebrity endorsements or government associations. TRX, has become the sole top 10 crypto to trade in positive territory today, a rare divergence as Bitcoin and most other majors sit flat or slide. In the last 24 hours, TRX is up 1.4%. Its weekly gain stands at 6.8%, while the 14-day trend shows a modest 0.2% rally. Since November, it has surged 81%. Despite this, the coin remains down 5.2% over the past month. The upside appears linked to heightened on-chain activity and burn volume. TRX's network generated roughly $37.4 million in net revenue for holders over the last month, a figure that ranks among the highest in the market. Stablecoin adoption has also spiked, feeding more transactions and burns. Market sentiment is cautiously bullish around TRX alone, but the broader scene remains consolidation heavy with FOMO muted after the U.S. government shutdown was lifted and no clear rally followed. Investors are watching whether TRX can sustain its gain without a larger market move, especially as economic headlines, Fed warnings of slow growth and rising inflation, add pressure to crypto valuations. Bittencer's native token TAO is currently hovering near $374 after a 0.81% dip in the last 24 hours, yet trading volume has surged almost 25%, climbing to roughly $291 million. The spike in liquidity suggests that investors are still piling on despite the recent pullback, indicating accumulation rather than panic selling. Technical analysts note that TAO has just broken a long-standing descending trendline and is now retesting its key support zone between $355 and $386, a critical area where a sustained move higher could confirm a bullish reversal. If the price holds above this band, traders anticipate a climb toward resistance levels at $464, then $561, with higher swing targets near $698, $744. Market sentiment remains cautiously optimistic. FOMO is brewing around the potential upside, while some FUD lingers from the token's 19% week-long slide. For listeners, this means TAO is in a delicate phase where volume and support levels will dictate whether it can regain momentum toward its projected 2025 targets, ranging from $845 to over $150, before any significant market shift occurs. Bitcoin's price has been grinding sideways this week, a pattern that analyst Jordi Visser likens to an IPO phase. He calls it Bitcoin's silent IPO. The idea is simple. Just as a company's shares can hover after going public while investors digest fundamentals, Bitcoin may be in a similar consolidation period. Visser notes the market mood remains cautious. Sentiment swings between mild FOMO and lingering FUD, but overall stays neutral. For traders watching the daily charts, this suggests a pause rather than a breakout. No clear bullish surge or bearish dump yet. The broader context is that institutional interest has plateaued, and regulatory chatter continues to weigh on short-term volatility, making the current flat range less of a panic sell-off and more of an equilibrium recalibration before any next move. JP Morgan and DBS are testing tokenized deposit solutions as a cross-bank alternative to traditional stablecoins, signaling a shift in how major financial institutions could handle liquidity and settlement. According to a recent BIS survey, at least one-third of commercial banks worldwide are either exploring or piloting these digital deposits, indicating growing institutional appetite for blockchain-based cash equivalents. The move injects bullish sentiment into the tokenized asset space, as banks look to reduce counterparty risk and improve efficiency. Yet some market participants caution that regulatory clarity remains uneven, which could temper rapid adoption. For listeners, this development underscores a broader trend of mainstream finance embracing crypto infrastructure, not for speculative gains, but for robust, interoperable payment channels, potentially reshaping the landscape of cross-border settlements in the coming years. Bitcoin has steadied near the $105.00 mark after a 13% dip in the last 24 hours, trading around $104,978 as it consolidates within a tight range. The move comes amid a surge of stablecoin liquidity flowing into the market, suggesting that institutional and retail players may be quietly accumulating positions in anticipation of a breakout. Market sentiment remains cautiously bullish. Traders are watching for a clear reversal signal before committing larger bets. For listeners, this phase signals a potential pause before the next significant rally, an opportunity to gauge market depth and prepare for the upcoming move while avoiding the typical FUD that often follows sudden price swings. Bitcoin has settled into a tight trading band just below its $108.00 resistance level, hovering near $104.500 in recent sessions. After weeks of choppy swings driven by macroeconomic headlines, the digital gold's price action now shows a notable pause rather than outright volatility. Traders are weighing whether this newfound stability could signal an impending breakout, or simply a consolidation phase before another pullback. The market sentiment remains mixed. Some investors view the tight range as bullish groundwork for a surge, while others caution that any break below $104.00 could trigger a FUD-driven dump. For listeners monitoring BTC's trajectory, the key takeaway is that the coin is currently in a narrow corridor. How it reacts to the next macro shock or technical move will likely set the tone for the coming weeks. Institutional investors are stepping up their crypto bets amid a market dip. A Swiss survey of 10 global firms shows that more than 61% plan to boost digital asset allocations, while 73% cite higher future returns as the main driver. The sentiment remains bullish in the short term. 55% expect gains, but is tempered by regulatory delays, notably the market structure bill and pending ETF approvals. The backdrop is a sharp October correction that wiped out roughly $20 billion in market cap, yet confidence stays strong. With 16 ETF applications stalled by a U.S. government shutdown, investors are eyeing new products like staking ETFs beyond Bitcoin and Ethereum as potential catalysts for inflows once regulatory decisions clear. This mix of optimism and cautious waiting underscores the current crypto landscape. Volatility persists, but institutional appetite endures, poised to surge when approvals arrive. Best Wallet, a non-custodial crypto app built on MPC key management, has launched its $Best token presale amid a year of record-high thefts. 2025's mid-year losses already surpassed last year's $22 billion total, with the largest single hit being a $15 billion Bybit breach linked to Lazarus Group. This surge in attacks has pushed venues to re-evaluate key handling and operational security, creating demand for hardened wallets like Best Wallet that split secrets across encrypted shards and add biometric two-factor access. The presale, priced at roughly $0.26 per token, with a November 28 close, is targeting a $20 million raise, an indicator of growing investor interest in security-first infrastructure. Market chatter skews cautiously bullish. The narrative focuses on tangible defenses rather than speculative gains, yet FUD lingers around broader hack momentum. For listeners, this signals that while hot wallet risk remains high, solutions leveraging MPC and certified connectivity are gaining traction, potentially reshaping user behavior and token utility in 2025's volatile landscape. Bitcoin faces a fresh quantum computing scare that has rattled investors and developers alike. Analysts point out that while current cryptography remains safe, a future quantum machine could crack the public key math underpinning Bitcoin's security. The headline claim is that storing coins in SegWit addresses, whose public keys are hidden until transaction time, offers a temporary shield for up to 7 years. This tactic has sparked debate. Some see it as a prudent stopgap, others dismiss it as a false sense of security that could lull the community into complacency and delay real quantum-resistant upgrades. The sentiment is mixed. FUD looms over long-term safety, yet traders remain cautious because SegWit wallets lock funds in place, limiting liquidity. For listeners, the takeaway is that while Bitcoin's core protocol may hold today, the industry must keep pace with emerging threats and avoid relying on temporary fixes as a permanent solution. Gemini has announced a 52% jump in Q3 revenue, driven by a sharp uptick in trading volume and the rollout of several new financial products. Despite the earnings surge, the exchange's shares have slipped further, as investors weigh higher operating costs and regulatory headwinds that could temper future growth. Market sentiment remains mixed. On one hand, the revenue lift signals healthy demand for crypto services. On the other, ongoing scrutiny over compliance and competition from larger exchanges fuels caution. For listeners, this highlights how even strong quarterly figures can be overridden by broader market concerns, underscoring the importance of monitoring both financial performance and regulatory developments when assessing a crypto exchange's trajectory. Bitcoin has surged past $105.0 as Washington edges toward reopening its longest U.S. government shutdown on record. The rally echoes the 2019 post-shutdown spike that lifted BTC from roughly $3,500 to nearly $14,000 in 5 months, a pattern now used by traders to forecast further upside. However, unlike 2019, where a sharp Fed pivot, an 80% bear market bottom, and limited spot ETF exposure created a perfect storm, today's environment is far more professionalized. Spot ETFs dominate flows, derivatives volumes dwarf spot trading, and institutional liquidity has expanded, dampening the explosive volatility that once fueled Bitcoin's gains. Market sentiment remains bullish but tempered. FOMO drives current price action while FUD lingers around lingering regulatory uncertainty and elevated inflation. Analysts suggest that if reopening delivers half of 2019's relative move, BTC could approach $260.0. A one-third impact would still push it above $200.0. The key question for investors is whether the end of the shutdown will act as a local macro low, resetting sentiment and unlocking demand, or simply remove a negative impulse without sparking a new surge. In short, Bitcoin's next leg hinges on supply constraints, institutional behavior, and the broader monetary backdrop, rather than any single political event. Zcash, ZEC, has surged almost ninefold from its October low of $76 to a peak near $686, igniting FOMO among holders and traders alike. Yet the chart now spells a potential reversal. A clear bearish double top pattern has formed, with resistance levels collapsing at roughly $256. Market sentiment is shifting toward caution as the asset's momentum stalls. Liquidity providers and institutional players are tightening risk limits. For listeners, this means Zcash's recent rally may have reached its apex, and a pullback could test support around the mid-$200s before any new breakout can be confirmed. The broader crypto environment remains volatile, so positions in ZEC should be monitored closely as the technical signals point to possible downside pressure. Bybit, the world's second-largest crypto exchange, has moved to acquire Korbit, South Korea's fourth biggest platform. The deal is still in early talks, but Bybit appears to target SK Planet's 31.5% stake first before pursuing full ownership of Korbit, whose remaining shares are held by Nexon's parent company NXC. The move gives Bybit a regulated foothold in Korea, the second-largest virtual asset market after the U.S., and signals a broader trend of foreign exchanges entering through M&A rather than building new operations from scratch. Market sentiment is cautiously bullish. Investors see potential for increased liquidity and cross-border trading, while regulators watch closely for compliance with local, gold price separation, rules that limit banks' direct crypto exposure. This acquisition could accelerate other international players into Korea's mature market and heighten competition across the region. Bitcoin takes a major commercial leap as Block, Jack Dorsey's payments arm, rolls out its first-time Bitcoin checkout for roughly 4 million Square merchants across the United States, starting November 10. The new feature lets sellers accept BTC directly at point of sale and settle via the Lightning Network, offering instant confirmation and no processing fees until January 1, 2027. Thereafter, a 1% fee will apply. Merchants can choose automatic conversion, BTC to fiat, fiat to BTC, or keep holdings, and may convert up to 50% of daily card sales into crypto, giving small businesses an easy path to build a Bitcoin position. Market sentiment skews bullish for mainstream adoption. The move signals confidence in lightning speed and the absence of chargebacks, potentially nudging both consumers and retailers toward routine BTC payments. However, uptake remains uncertain. Success hinges on shopper willingness, merchant settings, and regulatory constraints that currently exclude certain states like New York. For listeners, this development marks a tangible push toward everyday crypto commerce, but real-world impact will unfold over months as merchants test the new checkout flow and customers decide whether to pay in Bitcoin or fiat. In today's Crypto Roundup, we're spotlighting 3 assets that are drawing attention for their structured upside potential. The presale token Moonbull, the established multi-chain network Polkadot, and the long-time market participant Bitcoin Cash. Moonbull is in its 6th stage of a 23-step presale, already raising over $590K from more than 900 holders. Its tiered pricing model turns early conviction into a quantifiable edge, while keeping new entrants fair. The project emphasizes stability and community ownership, sparking FOMO among those hunting high beta plays, but also generating caution about the typical hype cycle. Polkadot continues to roll out developer tools, cross-chain routing upgrades, and asset issuance features that reinforce its role as a backbone for decentralized apps. Each update adds utility and depth, feeding bullish sentiment from allocators who prefer long-term infrastructure exposure, alongside more speculative positions. Bitcoin Cash has re-entered technical screens, with model-based projections pointing to a 1-month target near $609, about 21% above current levels, and resistance in the mid to high $500s. Its neutral 14-day RSI suggests momentum could pivot quickly on volume spikes, offering traders a clear framework for short-term play while still reflecting broader market direction. Together, these signals illustrate a trend toward clarity over noise. Structured economics, tangible development milestones, and defined price targets are driving investor focus as the market looks for asymmetric returns. Ethereum has become the hotbed of tokenized fund growth this year, with on-chain assets surging nearly 2.0% since January as BlackRock and Fidelity roll their investment vehicles onto the network. The influx signals a strong institutional shift toward blockchain for transparency, liquidity, and lower costs, especially after Ethereum's recent upgrades, proof of stake, EIP 4844, and Layer 2 scaling, have slashed fees to near zero. Market sentiment remains bullish. While ETH is currently trading below its 20-week moving average and showing cooling momentum, it still holds solid support around $350, $400, with a potential rebound toward the $800 mark if that level stays intact. For listeners, this trend underscores Ethereum's dominance as the go-to platform for tokenized finance, bolstered by regulatory clarity in hubs like Singapore and Switzerland, and a mature ecosystem that makes institutional adoption increasingly seamless. BitMine has announced a fresh tranche of Ethereum purchases that pushed its holdings past 35 million ETH, roughly 29% of the total supply. The move signals a treasury-scale confidence in the flagship coin and is reigniting interest in major assets and their adjacent ecosystems. Market chatter leans bullish, with FOMO creeping around projects like Bitcoin Hyper, which promises a high-speed Layer 2 built on Bitcoin's security, and PEPENODE, whose gamified mine-to-earn model is already drawing attention after raising over $2 million in its presale. Tron also benefits from the renewed focus on large-cap liquidity. Its payment infrastructure remains robust as flows broaden beyond ETH. For listeners, This development underscores a pivot back to core protocols while keeping an eye on innovative Layer 2 and utility projects that could ride the next market upturn. Blockchain FX, ticker BFX, has just closed a presale that raised $11 million and secured a regulated trading license, positioning the project as a unified multi-market platform that will let users trade crypto, stocks, forex, commodities, and ETFs from one interface. The launch price of $0.29 per token, coupled with a bonus tier, signals strong early demand and a clear path to liquidity once the mainnet goes live. Market chatter is bullish. Traders are spotting the convenience factor and the regulatory backing as differentiators that could drive volume once BFX starts listing its 500-plus assets. For listeners, this development highlights how a single platform can reduce fragmentation in finance, potentially reshaping trading habits for both retail and institutional participants looking for a consolidated gateway to global markets. TeraWulf Inc., a US-based Bitcoin miner, reported Q3 revenue that leapt 87% to $56 million, driven by a surge in BTC prices and new income from high-performance computing leases. The company mined 377 Bitcoins, down from 555 last year, but the average price of $114,390 per coin more than offset the lower output, pushing digital asset revenue to $43.4 million. TeraWulf is also expanding into AI infrastructure, securing multi-billion-dollar lease agreements with FluidStack and Google at its Lake Mariner site in New York, and an additional joint venture in the Southwest Power Pool. Market reaction was modestly bullish. Shares climbed up to 6% before settling near $14.30, a 0.5% gain for the day. This performance illustrates how miners are pivoting from pure crypto mining toward diversified data center operations amid a recovering BTC market and tightening profitability metrics across the industry. Bitcoin closed the week near $107.0 after a brief rally tied to speculation that the U.S. government shutdown could end soon. The digital gold surged past the $107K mark only to be rejected and fall back by about $20, leaving its market cap just under $21 trillion, and dominance slipping below 58%. While BTC's movement was muted, a wave of correction swept through the altcoin space. Zcash slid 25% to roughly $485, ICP fell 12.5%, and Monero dropped about 10%. Uniswap's token bucked the trend, jumping 20% to above $8. Ethereum eased back to $3,550 after a 2% dip, and XRP slipped over 3% to $245. The broader market cap dipped by more than $50 billion, settling at around $363 trillion. Traders are left weighing short-term volatility against the backdrop of political uncertainty, with FOMO driving brief spikes but overall sentiment leaning bearish as corrections roll out across the ecosystem. SoftBank has liquidated its entire Nvidia position, selling all shares for roughly $58 billion as it pivots to back OpenAI more heavily. The move signals a strategic realignment toward generative AI, with the venture fund redirecting capital from hardware to software-centric innovation. Market reaction is mixed. Nvidia's stock has faced a slight pullback after the divestiture, while investors eyeing OpenAI's growth prospects are spurred by a bullish sentiment in AI-focused tokens and projects. This shift underscores SoftBank's intent to stay ahead of a rapidly evolving competitive landscape, potentially accelerating funding flows into AI startups and influencing token valuations tied to AI infrastructure. For listeners tracking the intersection of corporate capital moves and crypto-enabled AI ventures, this development highlights how traditional tech giants are reshaping their portfolios to capitalize on next-generation AI breakthroughs. Uniswap, the leading decentralized exchange built on Ethereum, has just rolled out a comprehensive governance package dubbed the UNification Proposal. The initiative, announced by founder Hayden Adams, seeks to activate protocol fees for the first time, introduce scheduled UNI token burns, and restructure incentive mechanisms across its ecosystem. The move is intended to align user and developer interests, while providing a sustainable revenue stream for platform upgrades. Market chatter skews bullish on the proposal's long-term value proposition, though some traders are cautious about the immediate impact of fee activation on trading volume. Early sentiment suggests a mix of optimism, seeing this as a maturation step, and FUD around potential short-term liquidity dips as users adjust to new fee structures. For listeners tracking Uniswap's evolution, this proposal marks a pivotal shift from its earlier free trade model toward a more balanced fee and governance framework. The outcome will hinge on community voting outcomes and how quickly the platform can integrate the new mechanisms without disrupting existing liquidity pools. Ethereum has broken back above its 4-month low, rallying roughly 20% from $3.50 on November 4 to trade north of $3.650 this week. The surge pushed the coin past its active realized price, around $3.545, meaning most holders are no longer underwater and sentiment is turning bullish. Analysts note that sustaining support above $3.500 is critical for a push toward the psychological $4.0 resistance. Failure could pull ETH back toward historic support levels near $2.870 or lower. The current $3.700 $3.900 zone remains a key barrier. If it turns into support, momentum may carry Ethereum to new highs above $4.0. Institutional activity is also climbing, with firms like BitMine adding over 110.0 ETH last week, signaling growing confidence amid broader market volatility and regulatory chatter. Bitcoin has taken center stage as financial author Robert Kiyosaki, best known for Rich Dad Poor Dad, unveiled a bullish stance on the crypto and precious metal markets. In a recent X-post, Kiyosaki declared he is buying, not selling, projecting Bitcoin to hit $250, gold $27.0, and silver $100 by 2026, citing macro insights from Jim Rickards and Tom Lee. His narrative hinges on the anticipated collapse of fiat, fake money, and Gresham's law, suggesting a mass shift toward hard assets. The market reaction has been largely FOMO-driven. Bitcoin traders note that BTC is consolidating within a rising wedge around $104,700, with key support near $104.0 and resistance at $107,500, $113,500. The RSI sits near 51, indicating neutral to bullish momentum if buyers hold the ascending trend line. A breakout above $107,500 could unlock further upside toward $110,500 and beyond. Listeners should understand that while Kiyosaki's optimism fuels short-term excitement, it also underscores broader concerns about U.S. debt levels and fiat stability. The technical picture suggests a potential rally, but the overall sentiment remains cautious. Investors are watching for higher lows before committing to larger positions. Abu Dhabi-based Phoenix Group has just kicked off a new 30-megawatt hydropower-backed mining hub in Addis Ababa, partnering with the state-owned Ethiopian Electric Power. The activation marks the firm's first large-scale African deployment and signals its intent to tap the continent's growing renewable energy potential for crypto mining. Market chatter is already picking up. Traders view the move as a bullish cue for sustainable mining ventures, while some skeptics warn that Ethiopia's regulatory framework remains uncertain, adding a mild FUD overlay. For listeners, this development underscores how major miners are diversifying geographically and energetically, positioning themselves ahead of tightening carbon regulations in traditional crypto hubs. Bitcoin has just nudged its way back into the spotlight after a quiet stretch of sideways trading. Spot activity and apparent demand for BTC have climbed to levels last seen 4 months ago, signaling that institutional and retail buyers are once again stepping onto the floor. The key threshold now is $110. Zero analysts say a break above that mark could trigger renewed bullish momentum, as on-chain metrics suggest growing confidence in the network's fundamentals. Traders watching this space are already picking up FOMO cues. Volume surges and longer holding periods point to a potential rally rather than a sustained dump. For listeners, the takeaway is clear. Bitcoin's recent uptick in demand is a concrete indicator that market sentiment is shifting back toward optimism. But the next critical move will hinge on whether it can close the gap above $110,000 without stalling. Ethereum's co-founder Vitalik Buterin has called for a hybrid approach that fuses zero-knowledge proofs with other cryptographic primitives to tighten blockchain security. In a recent statement, he argued that layering ZK technology, known for privacy and tamper resistance, with complementary protocols could harden networks against sophisticated attacks and enhance user confidentiality. The proposal is sparking debate among developers and investors. Some see it as a bullish sign of continued innovation in the Ethereum ecosystem, while others warn it may complicate consensus layers and slow adoption. For listeners tracking protocol upgrades, this move underscores a broader trend toward modular security solutions, suggesting that next-generation smart contracts might increasingly rely on multi-layer cryptography to defend against both external hacks and internal coercion attempts. Aptos Apt is heading into a critical week as it unlocks about 11.3 million tokens, roughly $38 million at current levels, on November 12. The release, which adds almost 1% of total supply to circulation, could press the price toward its recent support band around $280-$30 after a brief fakeout below that zone earlier in the week. Traders are watching closely. If the new coins flood the market aggressively, Apt may dip past key support, but existing demand could absorb the supply and let it rebound quickly, as seen in prior unlocks. The broader backdrop shows Aptos still driving ecosystem growth, with Chainlink data streams and partnerships that fuel adoption. Yet competition from Solana and Sway keeps sentiment cautious. Market participants are split. Some anticipate a temporary correction. Others see potential upside if liquidity holds. The coming days will test whether Apt can maintain its structural support amid the added supply pressure. WEISS-Bet, a Curaçao-licensed crypto casino, has launched its second WEF token sale, offering a $1 million cap and a 15% discount to new buyers. The native utility token, already in circulation with over 10,000 holders, powers both Play to Earn and Hold to Earn staking on the platform. Since its private sale in 2024, WEF has distributed more than 39 million tokens, allocating a portion for crypto rewards and revenue sharing, while a community-reported pool of roughly 77 million tokens remains staked. Market chatter is bullish. Traders see the new sale as a chance to deepen engagement with an ecosystem that blends instant no-kick access, extensive game libraries, and active rakeback incentives. For listeners, this move signals WEISS-Bet's intent to capture growing GambleFi interest by expanding its token utility and staking appeal amid a competitive iGaming landscape. The rally centers on World Liberty Financial, WLFI, a token that has surged more than 30% after U.S. Senate talks reportedly moved to end the government shutdown and President Trump hinted a deal is near. WLFI, closely tied to Trump's brand, jumped from around $0.13 to over $0.16 in a single day, igniting FOMO among speculators who view it as a political play rather than a utility asset. In contrast, Digitap Dollar Tap continues its presale momentum, having raised over $16 million and sold 110 million tokens through a buy back and burn model that cuts circulating supply while rewarding stakers. Tap's Omnibank platform, combining fiat, crypto, and DeFi with instant swaps, staking, and non-kick Visa cards, offers tangible use cases for freelancers and remote workers, positioning it as a more sustainable alternative amid the short-term WLFI pump. For listeners navigating today's volatile altcoin landscape, WLFI's spike is a cautionary tale of hype-driven gains, while TAP's progress underscores the value of real utility in driving long-term adoption. Kalshi Inc., a US-based prediction market platform that lets traders bet on sports outcomes, has just survived a legal hurdle when 3 California tribes sought a preliminary injunction to block its contracts. The court denied the tribe's request, allowing Kalshi to keep offering sports event betting products without interruption. This decision dampens immediate regulatory FUD and signals a short-term bullish stance for the company's token and trading volume, as users can continue to engage in sports-related wagers. For listeners, it means that Kalshi's market position remains intact amid ongoing debates over betting legality across states, while investors should note the court's ruling as a modest boost to confidence, but not a guarantee of long-term regulatory certainty. Ethereum's price has nudged back into a profit zone after months of losses, sparking renewed bullish chatter among holders who now see a realistic path toward the $4.0 mark. The digital asset is trading near its 50-day moving average, and recent on-chain metrics show increased buying pressure from institutional wallets, suggesting a shift in sentiment from cautious to cautiously optimistic. However, resistance around $3.800 remains stubborn. Traders are watching that level closely for a potential pause or even a brief pullback before the next push higher. For listeners tracking the market, this development signals that the long-term rally could be gaining momentum, but short-term volatility is still likely as price hovers near key technical thresholds. The broader crypto landscape continues to weigh on sentiment, with regulatory headlines adding an undercurrent of FUD. Yet Ethereum's recent recovery hints at a growing confidence among investors in its network upgrades and DeFi ecosystem growth. Madeira Invest Club Mike has fallen under Spanish law enforcement after authorities arrested crypto influencer Alvaro Remillo on charges of running a €260 million Ponzi scheme that duped more than 3.0 investors with promises of up to 20% annual returns. The arrest followed the discovery of a Singapore bank account holding roughly €9 million linked to Remillo's network, prompting a bail-denied detention and the seizure of high-end vehicles and other assets. Court documents suggest he faces 9 years in prison, potentially extending to 18 if classified as a mass offense. The case has amplified FUD across European crypto circles, underscoring the risk of unregulated investment platforms and the importance of due diligence. For listeners, this serves as a stark reminder that even prominent influencers can orchestrate large-scale frauds, reinforcing caution when evaluating high-yield promises in the digital asset space. Gold has become the headline of today's BRICS spotlight, with India and South Africa taking the lead in central bank holdings this October. By early October, India's reserves hit roughly $102.4 billion, holding about 880 tons, a jump driven mainly by price gains rather than new purchases. South Africa's combined gold and foreign exchange reserve value rose from $67.9 billion to $69.4 billion, with its gold stash hovering near 125 tons in Q3 and steady growth in total reserves despite limited tonnage disclosure. The market reaction is cautiously bullish. The data signals a strategic diversification away from dollar exposure, feeding FOMO among investors who see gold's record highs at over $4.0 an ounce. Yet the lack of transparency from other BRICS members tempers enthusiasm, keeping some bearish sentiment alive around potential future purchases. For listeners, this trend underscores that while India and South Africa are solidifying their positions as gold leaders within the bloc, broader BRICS activity remains opaque. So keep an eye on upcoming releases for a clearer picture. The United Kingdom's financial watchdog has floated a new cap on the value of systemic stablecoins that can be used by retail customers, setting a ceiling at £20 per user. This move follows earlier proposals to tighten oversight of stablecoins and is part of the UK's push to roll out definitive rules by 2026. The cap aims to limit exposure to potential liquidity shocks from large-scale redemptions, while still allowing consumers to use stablecoins for everyday payments and investment purposes. Market chatter has been mixed. Some analysts view the £20 threshold as a prudent risk management tool that could bolster confidence in digital assets, potentially encouraging broader adoption. Others warn it may dampen enthusiasm among traders who rely on higher value positions for arbitrage and liquidity provision, injecting a degree of caution into the market. The policy shift signals the UK's commitment to regulating stablecoins more tightly, aligning with global trends toward stricter consumer protection in the crypto space. For investors and users alike, the new cap underscores that while stablecoins remain attractive for their low volatility, regulatory frameworks are tightening around how much exposure is deemed acceptable. Bitcoin has steadied around $105,400 today, adding just under 1% over the last 24 hours while trading volume hovered near $70 billion. The price hold comes amid a surge in Uniswap's native token UNI, which jumped more than 44% after founder Hayden Adams rolled out a governance proposal that retools the protocol's fee structure to burn UNI and redirect revenue into liquidity pools. This upgrade has injected bullish sentiment for the platform, sparking FOMO among holders who see an opportunity to benefit from the new economics. Across the market, attention is shifting toward Monad, an EVM-compatible layer one slated to launch its mainnet on November 24. The project will open a public token sale on Coinbase from November 17 to 22 at $0.25 per MON, offering 75% of its $100 billion supply. Backed by $240 million in venture capital, Monad promises 0 transactions per second and sub-second finality, while maintaining full Ethereum developer tool support, direct competition for Solana. However, critics point to a heavy insider lockup, 64%, and modest airdrop size as potential dump risks at the token generation event. For listeners, the day signals a mixed market. Bitcoin's resilience underpins a broader bullish stance. UNI's governance-driven rally fuels optimism in DeFi, and Monad presents an early entry point for those tracking next-gen Layer 1 projects. The coming week will test whether these catalysts can sustain momentum, or if market volatility reasserts itself. Uniswap's native token UNI has surged nearly a third in just 24 hours, catapulting it to the top of both daily and weekly charts, a rare feat for an AMM protocol. The rally follows founder Hayden Adams' announcement on X that he will submit his first governance proposal, which seeks to redirect network and Unichain sequencer fees into a large-scale token burn, targeting 100 million UNI from the Treasury, and introduce protocol fee discount auctions to improve liquidity pool outcomes and internalize MEV. The move has ignited FOMO among holders, as burning can tighten supply and potentially lift price, while market watchers note that the broader crypto environment remains bearish. If Bitcoin's anticipated bullish turn materializes, spurred by recent Fed rate cuts and an ended government shutdown, the upside for UNI could persist. Otherwise, a correction looms amid consolidation across the sector. Oak Mining has unveiled a new mobile-first mining platform that claims users can earn Bitcoin and Dogecoin directly from their phones, without any physical hardware or technical setup. The service positions itself as an effortless cloud mining solution, letting anyone tap into the network's hash power via a simple app interface. This move comes amid growing interest in accessible crypto mining tools, especially after several high-profile hardware providers faced supply chain constraints and rising costs. Market reaction has been mixed. On one hand, early adopters and FOMO-driven users are intrigued by the promise of passive mining without capital outlay. On the other, skeptics point to regulatory scrutiny over cloud mining schemes and potential dilution of mining returns. Sentiment skews slightly bullish among those looking for low-barrier entry points, but caution remains as the industry watches for compliance signals and real throughput data. For listeners, Oak Mining's launch highlights a broader trend toward democratizing crypto infrastructure. While the platform could lower barriers for casual participants, its long-term viability will hinge on transparent operation metrics, cost efficiency, and adherence to evolving regulatory frameworks, key factors that will shape whether this mobile mining model gains traction or stalls in a crowded market. Ethereum's expanding ecosystem of stablecoins and real-world asset (RWA) integrations is becoming a pivotal factor in shaping its next price trajectory, a trend highlighted by Bitmain's recent $12.4 billion bet on the network. The company's sizable investment signals confidence that Ethereum's Layer 2 rollups and DeFi protocols are maturing into robust platforms for both synthetic stablecoins and tokenized real-world assets. From commodities to securities, market sentiment has shifted toward a cautiously bullish stance. Traders note that a broader adoption of RWAs could unlock new liquidity pools, potentially driving demand for ETH as collateral and governance tokens. However, some investors remain wary of regulatory scrutiny over asset tokenization and the risk of a sudden shift in supply dynamics if stablecoin issuance falters. For listeners, this development underscores how Ethereum's pivot from purely digital assets to incorporating tangible real-world value could redefine its utility and price momentum, positioning it as a central hub for future decentralized finance infrastructure. Uniswap's governance token UNI has surged more than 35% in a single day after founder Hayden Adams announced a sweeping fee switch proposal on November 11. The plan, dubbed UNification, would activate protocol fees to buy and permanently burn UNI, adding deflationary pressure while also sending Unichain fees to the same burn mechanism and immediately destroying 100 million tokens from the treasury. Market reaction was immediate. Price leapt from roughly $6.70 to nearly $10. Volume spiked over $3 billion, and UNI gained about 74% in the past week, outpacing the broader crypto market's modest gains. Analysts see a bullish tilt, with projections of up to $500 million in annual burns and monthly buybacks around $38 million, suggesting a potential supply shock as many UNI remain on exchanges. The move comes after regulatory hurdles stalled similar proposals and follows concerns over governance centralization. The new contract aims to align Uniswap Labs' actions with community interests. Sygnum Bank's latest global survey reveals that a majority of institutional investors, 61% to be exact, are gearing up to increase their crypto holdings in the fourth quarter, signaling sustained bullishness amid a still volatile market. However, the same poll shows a shift toward caution as 2026 approaches, with respondents flagging regulatory tightening and macroeconomic headwinds as potential drag factors. This dual stance reflects a classic pump-and-pause scenario. Firms are riding current upside while preparing for a possible pullback. For listeners tracking institutional flow, the data underscores that while short-term sentiment remains positive, long-term positioning is becoming more risk-averse. The market will likely see continued inflows into crypto assets this year, but traders should monitor how the 2026 outlook influences capital allocation and liquidity in key token classes. Ripple's Chief Technology Officer, David Schwartz, recently stepped into the spotlight to clarify how Bitcoin can be leveraged in payment scenarios, while still maintaining its appeal as a store of value asset. In a concise interview, Schwartz outlined that Bitcoin's on-chain settlement speed and low transaction costs make it viable for micropayments, especially when paired with Layer 2 solutions like Lightning Network. He emphasized that this utility does not dilute Bitcoin's scarcity factor. Instead, it positions the network as both a digital gold and an efficient payment conduit. The commentary arrived amid a market swing where BTC has been consolidating after a brief rally, and investors are debating whether the asset's dual role could spur renewed demand. The tone of the discussion leans cautiously bullish. Schwartz acknowledges that while Bitcoin's payment use can drive broader adoption, volatility remains a hurdle for mainstream merchants. Consequently, traders are watching for any uptick in merchant adoption metrics as a potential catalyst. For listeners following the crypto landscape, this insight ties directly into the ongoing narrative about Bitcoin's evolution from purely speculative asset to functional currency. The implication is clear. If payment use cases gain traction without compromising scarcity, it could reinforce confidence among both retail and institutional participants, potentially nudging prices higher in the medium term, while keeping an eye on regulatory developments that may affect cross-border settlement flows. The U.S. Internal Revenue Service has issued new guidance that clarifies how cryptocurrency investment funds can collect staking rewards while staying within regulated limits. The IRS now treats staking income earned by pooled crypto vehicles, such as hedge funds, venture capital funds, and family offices, as taxable property, subject to the same reporting requirements applied to other crypto holdings. This change removes a gray area that previously left many fund managers uncertain about how to handle blockchain incentives. For market participants, the announcement is largely bullish in tone. It signals greater regulatory certainty for institutional players looking to add staking exposure without risking compliance headaches. Funds can now structure their staking strategies more confidently, potentially boosting inflows into crypto asset classes that generate passive yield. However, some analysts warn of a short-term dip as managers adjust accounting systems and disclose new revenue streams in their financial statements. Listeners should note that the ruling does not alter the underlying economics of staking rewards. It simply codifies how those gains are treated for tax purposes. As institutional adoption continues to rise, this clarity could accelerate the integration of blockchain assets into mainstream portfolios, reinforcing a trend toward more mature, regulated crypto investment products. Sentiment's latest analysis uncovers a hidden driver behind price swings in XRP, Bitcoin, and Ethereum: the clash between whale activity and micro-wallet flows. The study charts how large holders quietly add to positions while retail wallets offload, an action that historically precedes sharp upticks. Conversely, when whales unload and smaller wallets keep buying, markets tend to dip. In XRP's case, despite a weak second half of 2025, FOMO-driven micro-wallet purchases persisted, yet the most pronounced rallies came from silent whale accumulation. Bitcoin mirrored this pattern. Major bull runs followed quiet whale buying amid retail sell-offs, while bearish moves appeared when whales dumped and retail kept buying. Ethereum's June-August surge, an 87% jump driven by stakeholder accumulation against a backdrop of retail selling, highlights the same dynamic. These opposing flows appear to forecast volatility more reliably than traditional indicators, offering traders a clearer lens on who truly steers market momentum. The U.S. government's Genius Act, signed into law this year, aims to overhaul America's payment infrastructure by 2028 without a central bank digital currency. President Trump has championed the bill, praising crypto's rapid rise and pledging that stablecoins will underpin a 21st-century settlement layer, boosting treasury demand, lowering rates, and protecting dollar dominance. The legislation is already on the books, but detailed operating rules, capital and liquidity standards for payment service providers, and bank supervision frameworks remain pending, with implementation slated for 2026. Market reaction is mixed. Some view the move as a bullish catalyst for stablecoins and tokenized deposits, while others warn that without full acquirer adoption and regulatory clarity, the shift will be gradual rather than an overnight overhaul. For listeners, this means that while policy momentum exists, the realignment of U.S. payments toward crypto rails will likely unfold over several years, with legacy card networks and instant transfers still serving consumers on the front end. Bitcoin and Ethereum lead a broad sell-off that has knocked the crypto market cap down 1% to $363 trillion, with 77 of the top 100 coins falling today. BTC slid 1% to $105,168, while ETH dropped 13% to $3,558, and Binance Coin hit a 27% decline at $977. Trading volume remains robust at roughly $199 billion. The dip comes amid mixed macro signals. The U.S. Senate's reopening bill has lifted some institutional optimism, and Nasdaq and Cboe are preparing to launch crypto futures. Yet Bitcoin's circulating supply is approaching 95% of its maximum, tightening supply dynamics. Market sentiment sits in the fear zone but shows slight relief as spot ETF flows stay modest. $115 million into BTC ETFs and none for ETH. For listeners, this means a temporary bearish tilt across major assets, tempered by institutional interest that could reignite liquidity if regulatory approvals accelerate post-shutdown. Ripple's flagship token XRP has surged to $2,500 value for everyone. Zero coins as market eyes SEC approval of XRP-focused ETFs slated for late 2025. The filing process is already underway with several major managers: Bitwise, Franklin Templeton, 21 Shares, Canary and CoinShares, registering pre-launch listings through the DTCC. If the regulator greenlights these products, institutional inflows comparable to Ethereum's post-ETF boom could flood the market, driving demand sharply higher. Analysts project that a successful ETF launch could lift XRP into a $20–$30 price range by 2026, translating 0 coins into $20, $30. This potential upside fuels bullish sentiment and FOMO among investors, while some remain cautious, noting the still unsettled regulatory timeline and the impact of RLUSD supply burn mechanics on scarcity. For listeners, the key takeaway is that XRP's price trajectory will hinge largely on SEC decisions in the coming months. A favorable ruling could trigger significant institutional capital inflows, reshaping the token's valuation landscape. Lbank, a Singapore-based crypto exchange with over 20 million users and daily volumes topping $10 billion, just wrapped its 7-day stablecoin earn campaign that launched on November 6. The promotion drew more than 93,000 participants and saw locked value climb to an impressive $67.4 million within a week, an indicator of strong demand for high-yield stablecoin products. The platform's one-click entry, automatic daily settlements, and real-time income tracking lowered barriers for both newcomers and seasoned traders, positioning Lbank as a bridge between centralized infrastructure and DeFi-style earnings. Market reaction has been noticeably bullish. The rapid accumulation of locked capital signals growing confidence in Lbank's secure ecosystem. Investors watching yield products are likely to view this as a positive cue that stablecoin lending can still deliver competitive returns without compromising safety. For listeners, the key takeaway is that L-Bank's Earn program demonstrates how exchanges can monetize liquidity while maintaining user trust, an approach that could shape future yield offerings across the crypto landscape. Solana's ecosystem has just hit a new milestone as US-listed spot ETFs poured in nearly $10 million within 24 hours, $75 million into Bitwise's BSOL, and $22 million into Grayscale's GSOL, bringing the pair's combined assets over $294 million. The influx signals that institutional players are once again eyeing Solana beyond Bitcoin and Ethereum, a move that has pushed the token back above its $150 support level and sparked bullish chatter across trading desks. At the same time, XRP Tundra is lining up for a comparable swell of capital. The dual-chain DeFi platform, operating on both Solana and the XRP ledger, is preparing to launch its Phase 10 presale with cross-chain liquidity built on Meteor's DAMM VTWO pools and an incentive engine called Arctic Spinner. Early fee structures capped at 50% are designed to curb dump pressure, while tiered spin rewards have already distributed over $32.0 in bonuses. For listeners, this confluence of ETF inflows and a well-structured DeFi launch underscores growing confidence in Solana's scalability and the broader appetite for alternative Layer 1 exposure. The market is leaning toward optimism. Professional traders are reasserting Solana as a viable base layer choice, while retail participants can now tap into its momentum through XRP Tundra's audited presale mechanism. Digital asset funds pulled a total of $117 billion last week, with Bitcoin and Ethereum leading the outflows, while Solana and HBAR drew steady inflows. The sell-off is most pronounced in U.S. markets, where investors drained $122 billion from crypto products, contrasting sharply with European pockets that added capital, Germany netting $41.3 million and Switzerland $49.7 million. Binance remains the hub for short-term holders, whose deposits jumped 40% to 8,700 BTC in a month, signaling mounting stress and potential volatility spikes. Weekly ETP trading volume hit $43 billion, yet optimism dimmed after brief gains tied to U.S. government shutdown talks. The data underscores a widening sentiment divide. American investors are pulling back amid liquidity concerns and uncertain Fed policy, while European players show resilience. This pattern suggests short-term bearish pressure, but also hints at the possibility of a mid-cycle correction that could set the stage for longer-term recovery. Cardano's investment arm Emergo has teamed up with Wirex to roll out a new multi-chain crypto card that will be embedded in the Wirex app and instantly available to its 6 million users worldwide. The partnership, unveiled at the Cardano Summit in Berlin, lets holders of ADA and other supported tokens convert balances on the fly for everyday purchases without leaving the platform. Market chatter is bullish. Traders see this as a step toward mainstream adoption, boosting confidence that Cardano can compete with established payment providers. For listeners, the move signals that the ecosystem is tightening its bridge between blockchain assets and real-world spend, potentially expanding ADA's utility beyond staking and smart contracts. The launch could drive higher transaction volumes on the Cardano network and attract new users to both brands as they chase broader retail penetration. NVIDIA has eclipsed entire industry sectors, now commanding a market cap of roughly $51 trillion and accounting for 85% of the S&P 500, a share larger than any single sector except the top 5 global markets. The chipmaker's valuation now surpasses the combined value of real estate, materials, and utilities, as well as the bottom 240 S&P 500 stocks. Market sentiment is sharply bullish. Investors are snapping up exposure amid a surge in AI demand, while analysts project a 12-month price target near $350. The story underscores NVIDIA's growing dominance in the GPU arena and its outsized influence on broader equity indices, signaling continued upside momentum for tech-heavy portfolios. Dogecoin has stalled in a tight sideways range, trading between roughly $0.118 and $0.1763, with no decisive move. Analysts point to persistent lower highs and lows, signaling a bearish bias that could push the meme coin toward further declines. The price may temporarily rally to absorb liquidity near $0.188, but that level is likely to act as resistance. A quick pullback to around $0.165 is expected if the uptrend fails to sustain. Support at $0.1763 remains critical. Any break below could confirm a false breakout and trigger a sharper drop. In the current market climate, sentiment skews negative, with FUD outweighing any FOMO, leaving investors cautious as Dogecoin hovers on the edge of potential decline. SoftBank has shed its entire $58 billion stake in Nvidia to redirect capital toward a massive $40 billion bet on OpenAI's profitability prospects, signaling a strategic pivot amid growing scrutiny of AI spend returns. The move underscores the Japanese conglomerate's confidence that generative AI will unlock long-term value, even as Wall Street questions whether AI investments are sustainable at current price levels. Market reaction has been mixed. Nvidia shares dipped briefly on the news, reflecting a short-term bearish tilt from investors wary of dilution, while OpenAI-related sentiment remains bullish, fueled by FOMO around next-gen AI tech. For listeners, this shift highlights how institutional players recalibrate exposure between established GPU giants and emerging AI platforms, illustrating the broader trend of capital reallocation in the evolving crypto tech ecosystem. The Central Bank of Brazil has just finalized a comprehensive regulatory framework targeting virtual asset service providers, VASPs, and stablecoin transactions. The new rules aim to shore up financial stability, tighten anti-money laundering controls, and curb the use of digital assets for illicit activities. Market chatter is already picking up. Many traders see the move as a bearish signal for Brazilian crypto exchanges that will face higher compliance costs and tighter reporting obligations. On the flip side, some view it as a positive step toward legitimizing the sector, potentially attracting institutional interest once regulatory clarity improves. For listeners in Latin America and beyond, this development underscores how emerging market regulators are tightening their grip on digital finance, forcing operators to adapt quickly or risk penalties, while signaling that stability concerns will shape the next wave of crypto adoption. Ripple's flagship token XRP has stepped into the spotlight this week, as speculation mounts over a wave of new exchange-traded funds set to hit the market. Canary Capital is slated to launch its own XRP ETF later this week, adding to an already crowded field of potential products that could bring institutional capital straight to the digital asset. The announcement has sparked a surge in trading volume and a sharp uptick in price action, with XRP hovering near the $270 level, its strongest rally in months. Market chatter leans bullish. Traders are echoing FOMO as liquidity prospects widen, while some remain cautious, citing regulatory uncertainty that could temper enthusiasm. For listeners tracking crypto flows, the key takeaway is that the ETF buzz is injecting fresh demand into XRP's ecosystem, potentially propelling the price higher if the momentum sustains and institutional interest materializes. BNB Chain, the powerhouse behind the world's most active smart contract blockchain, has announced a two-day event lineup in Buenos Aires that should stir the Latin American dev scene. On November 15-16, the network will kick off its first local hackathon, BNB Hack, Buenos Aires, in partnership with Izzy Labs as part of a new city-to-city series backed by a $1 billion builder fund. 8 tracks, from trading and RWA to AI, DeFi, payments, and wallets, will compete for a $160 zero prize pool, up to $50 zero in ecosystem support, and fast-track interviews into the most valuable builder program and easy residency, opening doors to potential investment. The following day, BNB Chain Demo Night will host live demos, keynotes, and panels, offering founders an audience of investors, mentors, and ecosystem leaders. The events aim to fuel local innovation, tap into global resources, and showcase emerging Web3 projects, amplifying FOMO among builders while reinforcing BNB Chain's bullish stance on expanding its developer ecosystem across the globe. A new decentralized finance token priced at just 35 cents is drawing attention as the market gears up for its next bullish wave. The project, built on a Layer 2 rollup that claims near-zero gas fees and instant finality, announced a strategic partnership with a major liquidity aggregator to boost on-chain trading volume. This move has sparked FOMO among traders, pushing the token's price up 12% in the past 24 hours despite overall market softness. Analysts note the partnership could unlock deeper market depth and attract institutional liquidity, positioning the token as a potential outlier against larger-cap cryptos by 2026. For listeners, this development signals that niche DeFi projects with strong infrastructure and liquidity hooks can still create significant upside even in a crowded ecosystem. But volatility remains high until broader adoption materializes. Lido DAO has unveiled a new automated buyback plan for its native LDO token, aiming to strengthen the protocol's financial footing and signal confidence in its long-term strategy. Under the proposal, the DAO will trigger systematic purchases of LDO when market conditions turn favorable, such as dips in price or increased liquidity demand, using reserves from staking rewards. The move is positioned as a defensive tactic that could curb volatility while rewarding holders, potentially nudging sentiment toward bullish expectations. Market watchers note that the initiative signals Lido's intent to add fiscal resilience amid tightening crypto regulations and competitive staking options. For listeners, this development underscores how major DeFi platforms are turning internal governance tools into market impact mechanisms, a trend likely to influence token pricing dynamics in the coming weeks. China has accused a U.S. government agency of seizing roughly 127 bitcoins that were mined by the Chinese-based pool Lu Bian in 2020, alleging that the assets were transferred to American custody without proper authorization. The claim adds another layer to the already tense geopolitical frictions surrounding cross-border crypto asset control and regulatory enforcement. Market reaction has been muted but tinged with caution. Investors are wary of potential legal entanglements that could affect liquidity in large mining pools, while some see it as a warning sign for future jurisdictional disputes over digital assets. For listeners, this incident underscores the fragility of international cooperation in cryptocurrency governance and highlights how geopolitical tensions can spill into the market, prompting heightened scrutiny of cross-border asset movements and regulatory compliance. Bitcoin has just missed a critical psychological barrier at $107.0, snapping its recent rally before it could regain full bullish momentum. The digital currency tested that level twice but failed to hold, sliding back into the lower $104.0, $105.0 zone. Market participants are now wary of fresh, OG selling pressure, as older holders look to unload positions, adding bearish weight to an already cautious sentiment. This setback follows a brief surge that had many traders FOMOing toward a potential topside rebound. The failure to secure support has dampened optimism and stoked fears of a broader pullback. For listeners tracking the market's pulse, this development signals a pause in upward movement and suggests that any recovery will need to overcome significant resistance before new gains can materialize. Trump, the meme token that mirrors former President Donald Trump's name, experienced a sharp rally today as market liquidity steadied following the resolution of the recent U.S. government shutdown. The surge was propelled by a sizable $34 million whale move, which injected fresh buying pressure and nudged the price toward a technical 10-level target that traders have been eyeing for weeks. Market sentiment has tilted bullish. On-chain data shows increased open interest and a rise in trading volume across major exchanges, signaling renewed confidence among holders. The backdrop is a broader recovery of liquidity after the shutdown's market freeze, which had dampened activity across many altcoins. For listeners, this uptick suggests that Trump may be regaining momentum as the macro environment normalizes, but volatility remains high, and traders should monitor price action around key support levels for potential reversals. Bitcoin has entered a decisive do-or-die phase after sliding nearly 20% from its early October peak of $123,500 to a low of $99,900 on November 4, then rebounding to roughly $106,350. The rally now stalls between the 200-day moving average at about $110.00 and the $100.00 floor, a tight band that traders view as a critical pivot point. Analysts warn that failure to breach $110.00 could trigger further selling pressure, pushing prices deeper below the current range, while a bounce past that level would signal renewed upside and restore buying confidence. Institutional activity remains steady. Michael Saylor's firm added 487 BTC, approximately $50 million, to its holdings. Yet ETF outflows hit $122 billion last week, adding volatility. Market sentiment is cautiously upbeat. The Fear and Greed Index nudged up to 29, and Bitcoin gained about 36% in the past day after U.S. lawmakers advanced a shutdown deal. Traders are pricing a 28% chance of hitting $130.00 this year, and only a 9% probability of breaking $150.00. Near-term catalysts include potential tariff adjustments and fiscal clarity, but risks such as continued ETF outflows and rising leverage could dampen the recovery. Bitcoin's next move around the $100,000–$110,000 corridor will determine whether this pause is a brief hiccup or a turning point for the market. Standard Chartered has teamed up with DCS Card Center to launch Card, a credit card that lets users spend stablecoins in everyday retail environments across Singapore. The partnership means the bank will provide the underlying banking infrastructure, while DCS supplies the card and merchant acquisition network, enabling holders of USDC, BUSD, or other pegged assets to tap into their crypto balances without converting to fiat first. Market chatter is largely bullish on this move. Liquidity providers and stablecoin holders see it as a step toward mainstream adoption, while some skeptics worry about regulatory scrutiny over card-linked crypto transactions. In the broader context, the announcement comes amid growing institutional interest in integrating digital assets into traditional payment systems, positioning Singapore as a potential hub for fintech innovation that bridges the gap between fiat banking and decentralized finance. Ethereum has reclaimed the $3,500 area after a weekend rally that pushed it to $3,650 before settling back into the $3,550 band. The altcoin's recent dip to a 4-month low of $3,57 was quickly reversed as buyers stepped in at the $3,400 resistance, turning the level into short-term support for the first time in 7 days. This rebound comes amid a broader market recovery that has seen Bitcoin and other majors climb modestly. The move has injected mild bullish sentiment among traders, but caution remains high. Analysts point to a significant resistance wall around $3,700, where nearly $870 ETH were amassed, alongside a recent exodus of 23 mega whales who sold or redistributed holdings between November 4 and 8. Despite this, institutional interest is steady. BitMine's CEO confirmed a $400 million purchase last week, boosting the firm's stake to roughly 29% of total supply. Contextually, Ethereum's current range sits above the critical $3,100 support but below the psychological $4,0 threshold. If the $3,500 level holds, the coin could build a base for a higher low around $3,400, $3,500, and potentially target new all-time highs in December. However, failure to defend these levels may signal a broader consolidation or even a bear phase, echoing patterns seen in previous quarters, where a brief break below consolidation ranges was followed by a rapid rally. The market is watching closely for any shift toward the $3,700, $3,800 resistance that could trigger a significant year-end surge. Bitcoin and Ethereum remain in a consolidation phase despite fresh institutional inflows. Bitcoin sits at $105,368 after a 0.72% rise, while ETH trades near $3,581, nudging above its $3,500 support. Market cap dropped 19% to $354 trillion, and the Fear-Greed Index reads 31, signaling lingering fear. Institutional buying, $137 billion in ETH, and continued BTC ETF inflows, has kept prices steady. But whale selling since the $100,000 peak threatens a reversal if key levels break. Tech stocks have drawn attention, leaving crypto on hold as traders await a decisive move from the neutral RSI zone. The market watches for a breakout that could shift sentiment from cautious to bullish. Nanyang Technological University in Singapore has teamed up with Zero Gravity to launch a $384 million research hub focused on decentralized, blockchain-based artificial intelligence. The partnership injects fresh capital into the emerging intersection of AI and distributed ledger technology, signaling that academic institutions are increasingly backing projects that aim to make AI more transparent and tamper-proof. Market sentiment skews bullish. Developers and investors watching the space view this as a validation of decentralized AI's potential, sparking FOMO among token holders linked to Zero Gravity's ecosystem. The move also underscores a broader trend of universities collaborating with crypto firms to push forward cutting-edge tech that could disrupt traditional AI models. For listeners, it means more institutional confidence in blockchain-enabled AI, which may drive future funding rounds and partnerships across the sector. Square's payment arm has rolled out a new Bitcoin feature aimed at merchants, allowing sellers to accept BTC directly through its platform. The move follows recent regulatory chatter in Washington and the growing push for institutional crypto integration. Market reaction is mixed. Bulls see it as a step toward mainstream adoption, while skeptics flag potential volatility risks for small business users. In parallel, Solana's developer ecosystem remains robust, with consistent activity on its network despite earlier network hiccups. This sustained engagement signals resilience and could buoy investor confidence in the platform's long-term viability. For listeners, the takeaway is that major payment providers are tightening their crypto offerings amid regulatory shifts, while Layer 1 projects like Solana continue to demonstrate developer momentum, factors that shape sentiment across the broader market today. Zcash, ZEC, has seen a sharp slide, falling more than 25% in the last 24 hours and dipping below the $500 psychological barrier after peaking near $744 earlier this month. The tumble erased over $3 billion from its market cap as daily volume surged by roughly 150%, driven by heavy liquidations and profit-taking, including a notable whale deleveraging of a $12 million position on November 9. Market sentiment has turned bearish. The 4-hour chart now shows a double-top pattern. The price sits below its 50-day EMA, and the RSI is trending toward 39, signaling further downside potential. This sharp pullback comes amid a broader altcoin rally that saw privacy coins like Dash mirroring ZEC's movements. Yet the sector faces renewed FUD, as Bitcoin's recent gains may trigger additional outflows from privacy tokens. In the near term, traders will watch for support around $470 and key resistance near the EMA at $531. A break below the $400-$300 zone could deepen the correction. Ethereum is currently testing a critical $3,607 resistance after a month-long downtrend that has kept its price range tight. The second largest crypto by market cap sits at roughly $3,604, just below the key breakout point. Recent data shows long-term holders are dialing back their selling pressure. Hodler net position change is shifting from decline to incline, and the lowest monthly sell volume indicates growing confidence among big players. Meanwhile, weighted sentiment has spiked to a 2.5-month high, suggesting retail and institutional optimism is returning. If ETH can flip $3,607 into support, short-term targets could lift it toward $3,802 and then $3,950. But a pullback past $3,489 would trigger further selling and re-establish the bearish trend. For listeners, this snapshot signals that while bullish momentum is building, the market remains vulnerable to profit-taking. The next move will hinge on whether long-term holders maintain their reduced selling and sentiment stays elevated. Solana SOL has been on a steep correction, sliding nearly 40% since mid-September and now trading inside a descending channel that's pushed the price below key support levels. Recent candles show the asset hovering around $156, a robust horizontal floor that has held through multiple pullbacks. If it fails, the next refuge would be the channel bottom or the $127 mark. Technicals also point to a potential rebound. The 200-day SMA and an ascending trendline remain below the current price, offering upside targets, while weekly charts reveal bullish signals from stochastic RSI crossings that previously preceded a 167% rally. The market sentiment is mixed. On one hand, bearish streaks, long bodies opening below the trendline, fuel FUD about continued downside pressure. On the other, the repeated retests of the channel's base and supportive oscillator readings inject FOMO-driven optimism among traders eyeing a recovery before any forthcoming spot ETF approvals. For listeners, Solana is currently in a consolidation phase that could either break out to new highs or continue its slide toward deeper support. The next price action will be critical. A bounce above $156 would reset the channel and potentially ignite a bullish rally. A collapse below it would confirm bearish momentum and extend the corrective trend. Ethereum has swung hard in the last quarter, sliding from a peak of $4,960 down to around $3,000 before rebounding toward $3,500. The dip mirrors the 2020 correction when ETH fell from roughly $490 to $308 before rallying sharply. Analysts note that key support now sits between $3,000 and $3,100. Holding above this zone could trigger a recovery similar to the previous cycle. Technical chatter points to a 20-day EMA at about $3,695 acting as resistance, while MACD is nearing a bullish crossover, suggesting momentum may shift soon. Whale activity adds weight. Large holders began buying near $3,200, and institutional holdings remain robust, with BitMine reporting 3.5 million ETH at roughly $3,639 each. However, some of the biggest whales have sold or redistributed recently, and trading volume plus open interest hit record highs, hinting that speculation is tightening the market. For listeners, the takeaway is clear. Ethereum's current move echoes a past pattern, and whether it breaks above short-term resistance or falls back into support will dictate the next phase of its trajectory. Silver has stepped into the spotlight as a potential next Bitcoin in the eyes of high-profile commentator Robert Kiyosaki. In a recent tweet, Kiyosaki highlighted that while Bitcoin's price now tops $105K, making it out of reach for many, the precious metal remains affordable and is poised for significant upside. He cited current levels near $50 per ounce and projected a jump to $70, with some analysts even eyeing $200 in the coming year. The sentiment around silver has shifted from cautious to bullish among those looking for an accessible asset that could mirror Bitcoin's meteoric rise. For listeners, this signals that interest in alternative inflation hedges is growing. Investors are watching silver's price action closely as a potential entry point into high-growth commodities, without the massive capital required for crypto giants. Femex, a high-performance crypto exchange with over 6 million traders, has rolled out a refreshed logo and upgraded platform design as part of a broader rebranding push. The new visual identity features a minimalist two-candle motif symbolizing growth and momentum, a fresh green to blue gradient that conveys stability and innovation, and sharper geometric typography to reinforce reliability. The interface now boasts 3D visuals, unified icons, and lighter layouts for a cleaner trading experience across desktop and mobile. The move signals Femex's shift from a pure trading venue toward a full digital asset ecosystem, positioning the brand as both efficient and user-centric. Market sentiment is cautiously bullish. Traders view the redesign as a confidence boost without overt hype, suggesting steady interest rather than a sharp FOMO surge. For listeners, this update underscores how exchanges are evolving their identities to match expanding product lines, while maintaining core strengths in speed, precision, and security. Bitcoin has hit a critical juncture as CryptoQuant founder Kai-Young Ju released a bullish forecast that could reshape trader expectations. The analyst highlighted the digital gold's current price level, suggesting it sits at a pivotal support zone that, if breached, may trigger a significant rally or a sharp pullback. Market chatter is already splashing FOMO on social feeds, while some risk-averse participants voice cautious FUD, citing macro uncertainty and potential regulatory tightening. For listeners navigating the volatility maze, this projection underscores the importance of monitoring liquidity flows and order book depth around key resistance levels. Whether Bitcoin will continue its upward trajectory or encounter a corrective dip hinges on how swiftly institutional capital responds to these signals in the coming trading sessions. FUN token Dollar Fun has just launched a $5 million giveaway, a calculated play that could send its price into motion. The token's team distributed free coins to thousands of holders and new users as part of an incentive program aimed at boosting liquidity and network activity. Market chatter is already picking up the signal. Traders are watching for a surge in on-chain volume, while skeptics warn that such giveaways can create temporary FOMO spikes followed by a correction if fundamentals don't support the rally. The move comes amid a broader trend of projects using airdrops to generate buzz, and investors will be keen to see whether Dollar Fun's community engagement translates into sustained demand or merely a short-term price bump. In short, the giveaway is a catalyst that could tilt sentiment bullishly today, but its long-term impact hinges on how the token's ecosystem evolves beyond the initial hype. Bitcoin has steadied above the $105.0 mark as global risk sentiment eases and institutional buying continues to support the digital gold structure. The rally shows a healthier market footing after last week's volatility, with on-chain metrics indicating sustained inflows from large holders. This steadiness injects bullish confidence into an environment that had seen sporadic FUD over regulatory uncertainty. Investors are seeing clearer price consolidation rather than panic selling. For listeners navigating the crypto landscape, the current phase suggests a momentary pause before potential next-level moves, as macro tailwinds and institutional traction keep the asset's trajectory on an upward tilt, while caution remains around short-term pullbacks. Gemini, the Winklevoss-founded crypto exchange, now trading under GEMI, reported a 52% jump in Q3 revenue to roughly $50 million, driven by surging transaction fees and a sharp rise in services income, particularly from its credit card and staking products. Despite the top-line growth, the company posted a net loss of $159.5 million, or $6.67 per share, as it continues to navigate post-IPO operating costs and market volatility. The earnings release sent shares tumbling 12% in after-hours trading, pushing the stock below its $15 IPO floor and fueling a bearish sentiment among investors wary of Gemini's expanding loss base. For listeners, this highlights how even a high-growth exchange can face liquidity pressure once it shifts from venture to public markets, underscoring the importance of monitoring both revenue momentum and profitability when assessing crypto platform stability. Matter Labs CEO has spotlighted privacy tech as a game-changer for institutional blockchain use. The company reports that zero-knowledge proofs are now being woven into core Layer 2 solutions like zk-Sync, enabling banks and asset managers to move settlement traffic onto public chains while keeping transaction details confidential. This shift comes amid a broader regulatory pivot. U.S. sanctions on privacy coins such as Tornado Cash have eased, signaling that regulators view privacy as a technical necessity rather than a crime tool. The result is a bullish sentiment among enterprise players. Confidence in private layers is rising even as retail speculation cools, and fee activity on zk-Sync has surged thanks to new tokenomics and staking programs. For listeners, the takeaway is clear. Privacy infrastructure is moving from niche to mainstream, positioning itself as essential for compliant, scalable institutional DeFi deployments. Cardano's native token ADA has rebounded sharply after sliding below $0.50 earlier this week. After hitting a low of roughly $0.48 on November 5, the coin surged over 20% to about $0.60 by November 10, only to trim around 2% in the last 24 hours to near $0.58. On-chain data shows that large holders have piled up nearly 1% of the circulating supply, about 348 million ADA worth $204 million, in just 4 days, signaling renewed confidence from institutional investors amid broader market volatility. The price is currently testing its trend band's lower boundary. Analysts say a move above $0.70 would confirm a bullish reversal, while consolidation could keep the trend neutral to bearish. Beyond price action, Q3 saw Cardano's DeFi TVL jump 28.7% to $423 million and NFT volume surge 562%, underscoring strengthening network fundamentals as the platform shifts toward community-led governance and partners with enterprise cloud providers for privacy solutions. XRP has swung sharply into a bearish zone after a rapid shift in investor sentiment. The digital assets price has dipped toward the $240 level as traders who were previously optimistic now tighten their positions, signaling growing FUD around the cryptocurrency's regulatory outlook and recent market volatility. This pullback is part of a broader trend where XRP has struggled to maintain upward momentum against a backdrop of tightening liquidity and heightened scrutiny from regulators. For listeners monitoring the crypto space, this move underscores the importance of watching key support levels. A break below $240 could trigger further selling pressure and widen the gap between bulls and bears in the XRP market. Bitcoin's rally this year has largely been powered by inflows into spot ETFs and large-scale purchases by institutional strategies. But that engine is now sputtering. Recent data shows ETF buying has slowed sharply, and the big strategy firms are holding steady rather than adding fresh BTC positions. The result is a cooling of bullish momentum. Prices have stalled near key resistance levels, and market chatter leans toward caution, with FUD creeping in over potential regulatory setbacks. For listeners watching the crypto landscape, this pause signals that the previously robust inflow cycle may be shifting. Traders should note the reduced buying pressure and keep an eye on any policy updates that could revive or further dampen investor enthusiasm. 8lens, a rising player in on-chain lending, has rolled out its native utility token, 8LNDS, on the base Layer 2 network. The launch marks a shift from speculative issuance to a usage-driven model. New tokens are minted only when users actively engage with the platform's lending and borrowing services. By anchoring supply to real activity, 8lens aims to curb inflationary pressure that often plagues emerging DeFi projects. The move has generated mixed buzz in the market. Early adopters see a bullish signal. Rewards now reflect genuine demand rather than hype, potentially boosting long-term token value and platform credibility. However, some traders caution that Base's competitive landscape could dilute 8lens' share of the liquidity pie, casting a bearish undertone for short-term price swings. For listeners following DeFi trends, this development underscores a broader industry pivot toward sustainability. Projects are increasingly tying incentives to actual use cases instead of speculative mechanisms, which may help stabilize tokenomics and attract more institutional interest in the coming months. Domino's Pizza has teamed up with payments pioneer Xmoney to launch a hybrid fiat and crypto checkout in Cyprus, marking the first step toward a broader European rollout. The partnership will enable Domino's franchise outlets to accept digital wallets, Apple Pay and Google Pay, as well as crypto assets via Xmoney's embedded checkout stack, promising instant, secure transactions without redirect hops. For the market, the move signals growing institutional interest in integrating blockchain-based payments into mainstream retail, likely boosting demand for Xmoney's native token XMN and reinforcing its regulatory compliance credentials. Listeners should note that while this collaboration is still limited to a single location, it sets a precedent for large consumer brands adopting crypto payment options, potentially accelerating mass adoption across the continent. Meme tokens tied to political headlines are back in focus as Trump-themed coins surged last week. Dollar Trump up 14% and dollar MELANIA jumping 35% in a single day, 66% over the past 7 days. This rally has fed liquidity into related projects, sparking a wave of presale interest and exchange listings. Bitcoin Hyper, Dollar Hyper, is positioning itself as a BTC-settled Layer 2 that can host meme activity. Its presale already raised $26.8 million, with whale purchases topping $300K in the last 24 hours. Maxi Doge, Dollar Maxi, capitalizes on brand strength and staking incentives, aiming to keep holders engaged during early phases. Useless Coin, Dollar Useless, a Solana meme listed on Binance with a $185 million cap, offers instant liquidity for traders looking to capture short-term swings. The market reaction is bullish FOMO-driven. Momentum traders are chasing reflexivity rather than fundamentals, and the spillover from political memecoins is driving speculative inflows into these three distinct playbooks: BTC-aligned throughput, staking-centric branding, and liquid-listed satire. The NFT and memecoin sectors have pulled back from a month-long slide, with high-profile digital collectibles showing modest gains, while meme tokens across the board rallied on renewed sentiment, leading non-fungible assets, such as those from top marketplaces and branded collections, offered selective upside, lifting overall market cap by a few percentage points. Meanwhile, a wave of memecoins, from the familiar to newer entrants, surged collectively, reflecting a FOMO-driven rebound after a period of bearish pressure. This shift signals that liquidity is re-entering the space, and traders are reassessing risk-reward profiles after the slump. For listeners tracking market dynamics, the recovery indicates that while volatility remains, confidence in both NFTs and meme assets is returning, setting the stage for potential upside if sentiment stays positive. Threshold Network has unveiled a sweeping upgrade to its TBTC protocol, streamlining on-chain Bitcoin access by enabling direct, gas-free minting of the wrapped token. The move removes the traditional multi-step process that required users to lock BTC in custodial contracts before receiving TBTC, cutting fees and latency for every transaction. Market chatter is bullish. Institutional players who have been ramping up Bitcoin exposure through regulated products see TBTC as a cleaner bridge into DeFi ecosystems, while retail traders welcome the lower gas costs. The upgrade comes amid a surge of corporate treasury allocations to crypto assets, positioning TBTC as a more efficient conduit for Bitcoin-centric liquidity. For listeners following on-chain innovation, this development signals a tightening integration between Bitcoin and Ethereum-based protocols, potentially accelerating broader adoption of wrapped BTC in decentralized finance. Dogecoin remains the only meme coin that has stayed in the top 20 over its 12-year run. In 2025, the biggest custodial holdings are now controlled by exchanges. Robinhood leads with 27.16 billion Doge, about 18% of total supply and roughly $48 billion at current prices. Binance follows with 15.7 billion Doge, approximately 7%, worth $277 billion, while South Korea's Upbit holds 1056 billion Doge, approximately 7%. These institutional vaults underscore the market's continued concentration of liquidity in exchange wallets. Despite this heavy exchange presence, Dogecoin's price has slumped nearly 76% from its all-time high of $0.7316, fueling a bearish mood and FUD among holders. Yet recent macro developments, an interest rate cut, and the lifting of the U.S. government shutdown, alongside pending ETF filings, could spark renewed FOMO if approved. For listeners tracking meme coin dynamics, the next weeks will be pivotal. Institutional weight remains high, but market sentiment hinges on regulatory moves that could lift Dogecoin toward a new peak. In a high-profile case that rattled the crypto community, former Crocodile of Wall Street Heather Morgan, known online as Razzlekin, has confirmed that her 18-month prison term will run to completion. Morgan was convicted for aiding her husband, Ilya Lichtenstein, in laundering roughly $13 billion worth of stolen Bitcoin back in 2016. A week ago, she falsely claimed President Trump had granted a commutation, but court documents now show no executive intervention occurred. The correction has dampened the brief FOMO that surged around potential presidential leniency and reinforced a bearish tone for illicit asset prosecutions. For traders watching regulatory crackdowns, this serves as a stark reminder. High-stakes crypto crimes still face strict judicial follow-through, underscoring the risks of relying on political favor in an increasingly law-driven market. XRP remains a focal point for traders as the digital asset hovers near the $250 threshold, sparking speculation about whether it can break that level before week's end. Yesterday's close left XRP just shy of the mark, trailing slightly behind the broader market's modest rally. The price action has ignited a mixed sentiment. Some investors see the resistance as a bullish test, while others interpret the near miss as a sign of continued volatility and potential pullback. Market chatter is thick with FOMO on short-term gains, but also cautionary FUD about regulatory developments that could weigh on liquidity. For listeners, This scenario underscores how a single price target can catalyze both optimism and apprehension in a space where momentum shifts quickly and every tick counts. Dogecoin is holding a fragile pause after a steep pullback, with traders watching a key level that could signal a shift in momentum. The meme coin recently rebounded off its weekly 200 EMA near $0.16 and slipped back into the year-long channel it has traded within for most of the season. Analysts point to a three-day close at $0.202 as the pivot that would lift Doge above both the macro 50% Fibonacci retracement and the short-term moving average confluence, potentially sparking bullish activity if Bitcoin stays above its $106,800 threshold. Current price sits around $0.18, while support lies near $0.14 with deeper shelves at $0.09 and $0.05. The market remains range-bound. Buyers are defending the lower rail while sellers keep pressure on the upper levels. This setup injects a cautious FOMO vibe among holders, but the coin will need to break the $0.202 mark to move beyond its defensive stance. In a high-stakes showdown between regulators and cybercriminals, the United States announced its largest-ever forfeiture action against the Liu Bian mining pool, which had been hit by a massive theft of more than 127,000 Bitcoin. The DOJ claims it recovered the stolen coins through a combination of blockchain tracing and cooperation with international partners, but questions have surfaced about how U.S. authorities accessed such a sizable digital asset that was reportedly moved across multiple wallets before being seized. The move has sent ripples through the market. While some traders view the forfeiture as a win for law enforcement, reinforcing the notion that illicit gains can be reclaimed, others see it as a warning sign of increased scrutiny on mining operations and large-scale storage solutions. Sentiment is mixed. FUD lingers around the vulnerability of high-value pools, yet there's also a cautious optimism that regulatory clarity could eventually stabilize the sector. For listeners keeping an eye on crypto's evolving legal landscape, this episode underscores the importance of robust security practices for mining entities and highlights how enforcement actions can shift investor confidence, especially when they involve one of the most valuable digital assets in circulation. FEMEX, the high-performance crypto exchange that serves over 6 million traders worldwide, has rolled out a refreshed logo and a redesigned platform interface as the first step in a broader rebranding push. The new visual identity features a minimalist two-candle motif symbolizing upward momentum, a fresh green to blue gradient that conveys stability and innovation, and sharper geometric typography to reinforce reliability. The upgraded UI introduces 3D visuals, a unified icon set and lightweight layouts for both desktop and mobile, aiming to streamline user experience. The update signals FEMEX's shift from a pure trading venue toward a comprehensive digital asset platform, positioning itself as a future-oriented, trust-centric brand. Market sentiment is cautiously bullish. Traders view the redesign as an effort to enhance usability and differentiate amid intense competition, but some FOMO may be muted until further brand rollouts materialize. For listeners, this move underscores how exchanges are investing in brand equity to retain momentum in a crowded, rapidly evolving crypto landscape. BlockchainFX (BFX) has secured an official trading license from the Anjuan Offshore Finance Authority, marking a major regulatory milestone for the project. The new AOFA approval instantly elevates BFX above unlicensed competitors such as Hyperliquid and BitGet, signaling stronger compliance and governance. Market sentiment is sharply bullish. Traders are spurred by the credibility boost and a limited-time License F50 bonus that offers 50% more tokens until NAV20, driving short-term buying pressure. For listeners, this development positions BFX as a notable contender in today's presale landscape. While Solana and XRP remain stuck near resistance levels, highlighting the contrast between a regulated entrant's momentum and the cautious stance of established assets. Zcash (ZEC) has plunged 26% in a single day, slashing its price from a recent peak above $700 to roughly $485. The drop comes amid a broader slide across privacy coins, Monero down 9%, Dash off 16%, and a sector-wide market cap contraction of about 34%. Market sentiment is decidedly bearish. Traders are debating whether the rally has stalled, or if this is merely a mid-trend pullback. Influential voices echo divergent views. Arthur Hayes forecasts a rebound to $1.10, while others warn that failure to hold near $487 could trigger deeper lows toward $235. The dip fuels FUD as ZEC's liquidity position remains strong within major funds, yet the immediate outlook skews cautious. For listeners, this sharp correction signals a potential pause in the privacy coin surge and underscores the volatility inherent in speculative altcoins during market swings. Lighter, a rising DeFi platform aimed at simplifying decentralized finance for enterprises, just closed a $68 million funding round that drew heavyweight backers, including Peter Thiel's Founders Fund and the brokerage crypto hybrid Robinhood. The capital injection signals a growing confidence from corporate investors in DeFi infrastructure, suggesting that mainstream adoption could accelerate as more traditional players eye blockchain solutions. Market sentiment is noticeably bullish. Traders view the deal as validation of Lighter's technology stack and its potential to capture institutional demand. For listeners, this move underscores how high-profile venture capital and fintech firms are increasingly allocating resources toward decentralized finance, reshaping expectations for the sector's trajectory in the coming months. Lighter XYZ, an Ethereum-based Layer 2 exchange focused on perpetual futures, just closed a $68 million round that values it at $15 billion ahead of its token generation event. The funding, led by Founders Fund and Ribbit Capital with participation from Hawn Ventures and Robinhood, signals strong investor confidence in Lighter's zero-knowledge trading engine and ultra-low latency, approximately 5 ms. The valuation boost comes as Lighter's volume has surged to $738 billion over the past week, topping peers like Aster and Hyperliquid, while its 24-hour trade hit $101 billion, higher than competitors EdgeX and Hyperliquid. The exchange still trails rivals in open interest, $500 M, raising questions about long-term liquidity once incentive campaigns wind down. Lighter plans a Q4 token airdrop that could allocate up to 30% of supply to the community, sparking betting on its post-launch fully diluted valuation. With spot markets slated for launch soon, analysts warn the order book model, offering zero fees and no MEV, could pressure Uniswap's AMM dominance and attract high-frequency traders from centralized venues. For listeners, this development positions Lighter as a potential disruptor in DeFi, blending speed, scalability, and low cost. The market reaction is mixed. Bullish sentiment surrounds the funding and volume gains, yet caution remains over sustainability and competition. Keep an eye on the upcoming TGE, as it could redefine on-chain trading standards for Layer S. Bitcoin's price has slipped back below $104,300 after a failed attempt to breach the $107,000 resistance earlier this week. The dip comes despite a modest inflow of about $115 million into U.S.-listed spot Bitcoin ETFs, ending a 6-day withdrawal streak that totaled over $122 billion. Trading volume surged from $11.5 BN last week to $14.1 BN on Monday, indicating heightened liquidity and investor participation. Technical indicators paint a mixed picture. The 4-hour chart shows bearish momentum with support at the 50% Fibonacci retracement near $100,353, while the RSI sits at 58 and MACD lines have converged into bullish territory, signals that could trigger a rebound if the daily candle closes above the 38.2% Fibonacci level at $106,453, potentially nudging BTC toward its 50-day EMA around $110,000. However, a close below that level would push the price back toward the key support near $100,353. For listeners, this means Bitcoin is in a consolidation phase with upside potential still tethered to key resistance levels, but downside risk remains if bullish momentum stalls. The market sentiment skews cautiously bearish today, as traders weigh institutional inflows against lingering volatility and technical retracements. XRP staking platform Firelight is set to go live on Flare this month, expanding DeFi options for holders of the XRP token. The launch will see Firelight's mainnet deployed on Flare's EVM-compatible Layer 1 chain, allowing users to stake their XRP and receive the liquid staking token XRP, which can be used across Flare's growing protocol suite. Market sentiment leans bullish as the move promises tighter integration between XRP liquidity and DeFi infrastructure, potentially driving more institutional interest. Ethereum has already filed for a Flare ETF, and boosting TVL toward its current all-time high of roughly $180 million. For listeners, this development signals that XRP holders can now keep custody of their assets while accessing a broader array of on-chain opportunities without leaving the XRPL ecosystem, thanks to upcoming smart accounts that will enable direct cross-chain transactions by December. In 2025, a new roundup of crypto-friendly online casinos has hit the market, spotlighting 16 platforms that pair well with VPN usage for players seeking anonymity and secure deposits in digital assets. The list ranks sites by their compatibility with common VPN providers, the breadth of supported cryptocurrencies, and overall user experience when routing traffic through encrypted tunnels. For traders monitoring the betting niche, this update signals a steady demand for privacy-oriented gambling options amid tightening regulatory scrutiny on crypto gaming. While some operators have already adopted robust KYC procedures, the highlighted venues maintain minimal friction for users who prefer to keep their activity off the public ledger. The move reflects broader sentiment in the ecosystem. Investors and enthusiasts are increasingly prioritizing security and discretion, fueling growth in niche markets that blend gambling with privacy tech. As the industry adapts, these VPN-compatible casinos could become key players for those navigating the intersection of crypto assets and online betting. Libra, a high-profile memecoin that promised quick gains through crypto to fiat swaps, has hit a legal wall in Argentina. A federal judge froze the project's assets after prosecutors traced roughly $500 transferred via BitGet to President Javier Milei, linking the token's collapse to alleged bribery and political abuse. The move follows evidence that investors lost over $100 million as the platform sold off its inflated holdings. Market sentiment has turned sharply bearish. FUD is spreading as regulators clamp down on the project's operators, including U.S. promoter Hayden Davis and Argentine figures Orlando Melino and Favio Rodriguez. For traders, this signals a tightening of scrutiny around meme tokens tied to political entities, warning that similar schemes could face swift legal intervention and asset freezes before they reach the exchange floor. Bitcoin is trading near $104,547 today, with a market cap hovering around $28 trillion and 24-hour volume at roughly $79 billion. The intraday swing from $104,382 up to $107,465 shows the price circling key resistance near $107,000 before pulling back. Daily charts still display a bearish bias. Momentum lines are flat, and short-term indicators lag bullish signals. Traders appear cautious, testing that ceiling without breaking through, which feeds a mild FUD atmosphere among risk-averse participants. For listeners, this means the market remains in a consolidation phase. Bitcoin is holding near the $107,000 mark, but hasn't yet shown decisive upside momentum. The broader implication is that any break above resistance would likely spark renewed bullish sentiment, whereas failure to do so could prolong the current sideways trend. As U.S. government shutdown gears toward a close this week, crypto whales are piling into DeFi tokens, signaling renewed risk appetite. In the last 24 hours, Aster holders have added roughly 49 million tokens, an 87% jump to 61.5 million, worth about $55 million at current pricing. Pendle has seen a similar surge. Whale balances rose from 195.9 million to 196.3 million tokens, adding around $12 million in value. Uniswap is also on the radar, with large wallet activity continuing as the coin trades within a falling wedge that could break above its upper trendline for a short-term rally. The accumulation pattern across these DeFi projects reflects bullish sentiment among institutional players, who appear to be positioning ahead of expected liquidity injections once federal operations resume. Market watchers note that while Aster is still navigating a descending channel, and UNI shows bearish RSI divergence, the overall whale buying suggests confidence in a rebound as policy clarity returns. For listeners, this underscores a potential shift back toward risk assets amid the end of shutdown uncertainty, with DeFi tokens emerging as likely targets for early week gains. Shiba Inu has logged a staggering outflow of roughly 15.5 billion tokens over the past day, a move that underscores the meme coin's recent trend reversal. While traders see this exodus as a potential trigger for further downside, the lack of fresh inflows into major exchanges tempers the immediate risk of a sharp dump. Market sentiment skews bearish. FUD is mounting as holders pull back and liquidity drains, yet some participants view the reduced exchange presence as a short-term protective bubble that could stall panic selling. For listeners watching the broader crypto landscape, this episode highlights how massive token outflows can signal momentum shifts while simultaneously creating temporary liquidity constraints. An important nuance for anyone tracking Shiba Inu's trajectory amid wider market volatility. Dogecoin's ecosystem expands as DogeOS, an application layer built to streamline smart contract functionality on the Dogecoin network, gets a spotlight in a recent podcast interview with key figures from the project. Size Chad, a prominent developer behind the platform, and Jordan Jefferson, CEO of MyDoge, shared insights into the architecture, roadmap, and integration plans that aim to attract DApp developers seeking lower gas costs and faster transaction times. The discussion signals a bullish pulse among users who see DogeOS as a catalyst for broader adoption. While skeptics question whether the layer can compete with established chains, the narrative is leaning toward FOMO, with community members excited about potential new use cases and increased liquidity. For listeners, this development underscores a growing push to position Dogecoin beyond its meme coin origins, offering a more robust infrastructure that could reshape on-chain activity and market sentiment moving forward. Tether Inc., the issuer behind the world's most widely used stablecoin, has shifted from a straightforward asset-backed model to one that resembles central bank operations. The company now publishes detailed reserve reports, tracks profit margins, and implements policy-style decisions on liquidity and issuance rates. This structural change signals higher regulatory scrutiny and suggests Tether is positioning itself as a quasi-central bank within the crypto ecosystem. Market reaction has been mixed. Some traders view the transparency boost as bullish for confidence, while others see it as a warning that Tether's stability may be more fragile than previously thought, sparking FUD around potential liquidity constraints. For listeners, This evolution underscores how dominant stablecoins are evolving beyond simple price anchors into complex financial institutions, reshaping risk profiles and regulatory expectations across the broader digital asset market. ZK-Sync's lead developer has flagged a critical hurdle for institutional players eyeing blockchain settlement: system-level privacy. While banks and asset managers are increasingly testing Layer 2 solutions to reduce clearing times and counterparty risk, they find that current privacy layers fall short of regulatory compliance and internal security standards. The announcement signals that without robust zero-knowledge rollups or similar tech, large-scale deployment will stall, tempering the bullish narrative around rapid institutional adoption. For listeners, this means that the pace at which major financial firms can move to on-chain settlements may slow, prompting a recalibration of expectations for liquidity and integration timelines across crypto exchanges and custodial services. Binance, the world's largest crypto exchange, has upgraded its crypto analysis bot on Telegram, adding AI-driven insights and expanding language support to 8 new tongues. The bot now pulls real-time data for over 300 tokens, offering market sentiment, ETF flows, sector trends, price ticks, daily token summaries, technical charts with indicators, event updates, perpetual futures metrics, DEX activity, fear and greed index, funding rates and open interest, all in one interface. A user can ask the bot to analyze Bitcoin. It delivers a concise volatility overview, macro drivers such as U.S. fiscal resolution and Fed easing, short-term technical signals, MACD bearish, RSI near oversold, Bollinger lower band, and current sell pressure from ETF withdrawals. The free tool aims to give traders rapid, consolidated information, potentially boosting confidence amid a volatile market environment. Bitensor's native token TAO is currently hovering near $374 after a 0.81% dip in the last 24 hours. Yet trading volume has surged by almost 25%, hitting roughly $291 million. The price slide follows a broader week-long decline of about 19%, indicating a market correction from recent highs. Analysts point to the sharp volume uptick as a sign that investors are still piling in, suggesting a potential rebound once TAO holds its key support band between $355 and $386. Technical chatter highlights a breakout above a long-running descending trend line, which many view as a bullish reversal cue. If the token can sustain a rally from today's levels, it could unlock higher resistance zones at $464, $561, and eventually the $698, $744 cluster, where selling pressure may re-emerge. In 2025, some forecasts project TAO reaching between $745 and $150, implying a sizable upside for those tracking long-term momentum. For listeners, the current scene blends cautious optimism with evidence of ongoing accumulation, an environment ripe for a potential upside play if support holds. Turbo Energy, a Spanish renewable energy firm, has announced that it will launch tokenized debt financing for its solar and battery projects using the Stellar blockchain. In partnership with Taurus and the Stellar Development Foundation, the company plans to issue digital tokens backed by future cash flows from these installations, allowing investors to gain exposure to green infrastructure without traditional banking intermediaries. The move signals a growing trend of utility tokenized finance in the clean tech sector, sparking bullish sentiment among token enthusiasts who see it as a way to deepen liquidity and accelerate project deployment. However, some market watchers caution that tokenizing debt adds regulatory complexity and could introduce counterparty risk if the underlying projects underperform. For listeners following the intersection of blockchain innovation and sustainable energy, this development underscores how decentralized finance is being leveraged to fund real-world assets, potentially reshaping both the renewable energy financing landscape and the broader crypto asset ecosystem. CleanSpark, a prominent Bitcoin miner, has unveiled a $115 billion convertible senior notes, offering to shore up its operations amid tightening margins. The private placement will raise roughly $113 billion, up to $128 billion, if the optional $150 million tranche is taken, and includes a 27.5% premium conversion price of about $19.16 per share, above the recent $15.3 closing. Management plans to allocate $460 million for a share repurchase at that price, while the remainder will fund power and land expansion, data center development, and repayment of Bitcoin-backed credit lines. The move comes as CleanSpark's mining output has slipped from 706 BTC in March to 612 BTC in October, with daily production falling from 2095 to 1975 BTC. Simultaneously, network difficulty hit a record 155.97 trillion, pushing hash price revenue down to around $41 per unit of computational power, the lowest since April. This confluence of higher difficulty and lower revenue is squeezing miner profitability across the sector. For listeners, CleanSpark's capital raise signals a strategic pivot to consolidate cash flow and scale infrastructure in a bearish mining environment, while its share repurchase indicates confidence in its long-term valuation despite short-term headwinds. Crypto wallets are stepping beyond simple vaults and becoming portable identity hubs powered by zero-knowledge proofs. The shift means users can prove ownership or credentials without exposing personal data, turning every wallet into a self-custodial passport for decentralized services. This evolution fuels optimism among developers and users alike, as it promises stronger privacy, easier KYC integration, and reduced reliance on centralized intermediaries. For the market, the move is bullish. Increased functionality drives higher demand for wallets that support identity features, while also tightening security standards that could mitigate regulatory scrutiny. Listeners should note that this trend signals a broader push toward Web3 infrastructure where ownership and identity are inseparable, setting the stage for new dApps to leverage seamless authentication without compromising user privacy. In today's market rally, Fetch AI (FET) has taken center stage among AI-focused tokens, posting a sharp daily surge that nudges the price toward the $0.50 mark. The move follows a broader uptick across crypto markets, with several altcoins rebounding after a week of consolidation. Traders are flagging FET's breakout as a bullish signal. Its on-chain activity has spiked, and liquidity pools have seen increased volume, suggesting growing confidence among holders. While the overall sentiment remains cautiously optimistic, FOMO is palpable around AI assets. The rally also underscores lingering volatility. Any sudden market shift could trigger a quick correction. For listeners tracking the AI sector, FET's performance indicates that demand for decentralized machine learning infrastructure is gaining traction, positioning it as a potential catalyst in the current recovery phase. Microsoft Research, in partnership with Arizona State University, unveiled its Magnetic Marketplace, a high-stakes simulation where hundreds of AI agents trade, cooperate, and occasionally deceive each other in a virtual economy. The experiment revealed that the bots struggled under pressure, overloaded by complex interactions, and susceptible to manipulation, leading to crashes and erratic behavior within the system. For crypto traders, this underscores a broader caution. As more projects integrate sophisticated AI into decentralized finance, volatility can spike when algorithms fail or are exploited. Market chatter is mixed. Some view the findings as a warning that over-reliance on autonomous agents could amplify risk, while others see it as an opportunity to refine AI governance protocols. In short, the study serves as a reminder that even cutting-edge tech is not immune to systemic stress, and participants should remain vigilant as AI adoption accelerates across the ecosystem. Bitcoin, the flagship crypto asset, has been at the center of a high-profile dispute involving alleged state-level hacking and subsequent U.S. law enforcement action. In late December 2020, roughly 127 BTC were swept from wallets linked to the Lu Bian mining pool through coordinated withdrawals across hundreds of addresses. A drain traced back to weak random number generation that left the seed space limited to about 43 billion possibilities. The coins remained largely dormant for 4 years before U.S. authorities seized them, and are now pursuing forfeiture of around 127,300 BTC as proceeds from alleged fraud tied to a Chinese individual. The incident has stirred mixed market sentiment. Some traders view the seizure as a regulatory win that may dampen confidence in custodial services, while others see it as evidence that weak wallet practices can still be exploited by sophisticated actors. The broader context underscores how technical vulnerabilities can create opportunities for both criminal and law enforcement actors, reminding participants to prioritize robust security measures and stay alert to the evolving risk landscape. Coinbase has jumped back into the ICO arena with a launch that's already generating buzz across the crypto community. The exchange is rolling out its first token of the year, a new project that promises to tap into the platform's massive user base and liquidity pool. As the biggest initial coin offering on Coinbase this season, the move signals a bullish shift for the broader market, suggesting that institutional players are once again looking to capitalize on early-stage digital assets. Traders are watching closely. FOMO is evident among speculators who see potential upside from the platform's built-in exposure, while some analysts caution that the hype could mask volatility typical of fresh token launches. In context, this rollout follows a period where many exchanges have been cautious about listing new coins, so Coinbase's decision marks a notable pivot toward fostering innovation and driving on-chain activity for its community. Tapbit Exchange, a fast-growing futures platform founded in 2021, is marking its 4th anniversary with a global celebration slated for November 17. The event will feature permanent zero-fee trading on select spot pairs and a $1 million rewards gala that includes luxury prizes such as Mercedes-Benz vehicles. The launch comes amid the exchange's impressive growth. Over 500 users across more than 200 countries, daily spot volume of $384 billion and futures volume exceeding $53 billion, all backed by a $50 million insurance fund and stringent security measures. Market sentiment is largely bullish. Traders view the fee waiver and high-value giveaways as incentives that could boost user activity and liquidity. For listeners, this move signals Tapbit's strategy to deepen engagement, while reinforcing its position as a compliant, tech-driven player in the competitive crypto exchange landscape. A federal appeals court has dismissed a massive Bitcoin claim that would have seen $364 million in compensation awarded to a convicted fraudster against the U.S. government. The 11th Circuit upheld an earlier ruling, citing the plaintiff's delayed filing and lack of credible evidence as grounds for rejection. The decision sends a clear signal to the market. Large-scale Bitcoin lawsuits face significant legal hurdles, tightening the regulatory environment for crypto litigation. Investors may interpret this outcome as a modest bearish cue, reinforcing caution around high-risk claims that could destabilize institutional confidence. For those watching the intersection of blockchain and U.S. law, it underscores the importance of timely, well-documented evidence in any court battle involving digital assets. U.S. regulators have cleared a new path for crypto exchange-traded products to stake digital assets while keeping their favorable tax status. The Treasury Department and the Internal Revenue Service announced that investment trusts can now participate in staking under a protected federal framework, ensuring rewards are taxed consistently with existing classifications. This development removes a major regulatory hurdle that had kept many funds from engaging in staking, which has become a key source of yield for holders of proof-of-stake coins. Market sentiment is noticeably bullish. Institutional players see this as a green light to expand staking portfolios without jeopardizing tax efficiency, while retail investors may view the move as an endorsement of staking's legitimacy. The announcement comes amid growing pressure from both regulators and industry groups to standardize crypto taxation, signaling that the U.S. could soon offer clearer rules for other digital asset investment vehicles. As staking gains traction, this regulatory clarity is likely to boost confidence across the ecosystem and drive higher participation in proof-of-stake networks. Brazil's central bank is tightening its grip on crypto as it moves from a permissive sandbox to a fully regulated ecosystem. Beginning February 2026, every exchange, custodian, or broker must secure an explicit license and meet bank-grade standards for compliance, risk management, and cybersecurity. The most urgent trigger was stablecoins. They now account for roughly 90% of domestic crypto flows, so any purchase or cross-border transfer will fall under foreign exchange rules with a $100 zero cap on unlicensed activity. This shift signals a bullish move toward legitimacy, but introduces FUD as firms scramble to meet the new criteria and users brace for tighter controls. Brazil, Latin America's largest crypto market that handled about $319 billion last year, has become a regional model, showing that growth can coexist with stringent oversight. The U.S. government's new Genius Act is poised to overhaul America's payment infrastructure with crypto-backed technology, bypassing a central bank digital currency. The bill, already signed into law, calls for a multi-rail settlement system that would let banks and payment processors net transactions in stablecoins such as USDC or EURC before routing funds through traditional channels. Market reaction is mixed. Some traders see the move as bullish for stablecoin liquidity and a boost to treasury demand, while others warn of regulatory lag and uncertainty over capital and liquidity standards that could delay full adoption. The rollout hinges on final rules expected in 2026, with early pilots underway but no decisive shift yet toward crypto settlement at point of sale. For listeners, this means the U.S. payment landscape may evolve gradually rather than overnight, potentially reshaping how merchants and consumers settle payments while keeping the dollar's reserve status intact. The story centers on Libra, a meme coin that surged to a $45 billion market cap after Argentine President Javier Milei posted a selfie with its founder, Hayden Davis. Within hours, the token collapsed, wiping out investors in a textbook pump and dump. Argentina's federal court has now frozen over $507 zero of assets linked to Davis and two crypto operators, citing potential proceeds from an alleged fraud estimated at $120 million. The freeze, imposed by Judge Marcelo Martinez de Giorgi, also compels the national securities regulator to block any movement of these funds across all local exchanges until the investigation ends. Market sentiment has turned sharply bearish. FUD surrounds Libra's viability and the political fallout from Milei's association. For listeners, this case underscores how rapid social media hype can trigger massive price swings, while regulatory crackdowns reveal the legal risks behind high-volatility meme tokens in emerging markets. BlockDAG has emerged as a standout in 2025's crypto landscape, announcing that its hybrid proof-of-work/DAG network can now handle up to 15.0 transactions per second, while remaining fully EVM compatible. The live Awakening testnet already processes over 400 TPS, attracting developers eager to deploy smart contracts on a high-speed platform that retains Bitcoin-level security. This technical leap has sparked bullish sentiment among the community, with FOMO driving early interest as users test the network's scalability and decentralization. For listeners, BlockDAG represents the next step in solving the throughput security trade-off that has long plagued blockchains, an advancement that could position it as a backbone for future dApps and enterprise solutions if adoption continues to grow. Banking giants DBS and JP Morgan have unveiled plans to build a cross-chain interoperability framework that would allow tokenized deposits to move seamlessly between public and permissioned blockchains around the clock. The initiative targets real-time settlement of digital assets, potentially slashing liquidity gaps and reducing custodial friction for institutional players. Market chatter leans bullish. Traders see this as a step toward mainstream adoption, with reduced counterparty risk and faster settlement times. Yet some skeptics caution that regulatory hurdles and technical complexity could delay rollout, injecting mild FUD into the space. For listeners, the move signals a tightening of the bridge between traditional finance and decentralized ecosystems, an evolution that could reshape how banks manage digital collateral and streamline cross-border payments in the coming years. Singapore's largest bank, DBS, has teamed up with JP Morgan to launch a real-time tokenized transfer platform that will bridge multiple blockchain networks. The partnership means digital assets can move instantly across chains using tokenized representations of traditional securities, cutting settlement times from days to seconds. Market eyes this as a bullish signal for institutional crypto adoption. The collaboration demonstrates confidence from two major financial houses in cross-border digital payments, potentially easing regulatory concerns and driving further integration of blockchain into mainstream finance. For listeners, this move highlights how legacy banks are now actively deploying on-chain infrastructure to stay competitive, signaling that the next wave of fintech innovation will likely focus on speed, interoperability, and regulatory compliance rather than hype alone. Bitcoin has hit a new milestone as Block, the payments company founded by Jack Dorsey, rolled out its first-time Bitcoin payment option for roughly 4 million Square merchants across the United States. Starting November 10, retailers can accept BTC directly at checkout and settle transactions over the Lightning Network, giving near-instant confirmation speeds. The feature also lets sellers choose automatic conversion to fiat or hold crypto, with no processing fees until January 1, 2027, after which a 1% fee is expected. The rollout signals a bullish push toward everyday commerce adoption. If even a fraction of those merchants enable the option, Bitcoin's real-world payment volume could rise. However, uptake will hinge on consumer demand, ease of checkout flow, and regulatory constraints in certain states like New York. For listeners, this move represents a significant step in integrating crypto into point-of-sale systems, potentially reshaping how small businesses manage revenue and exposure to volatility. Bitcoin faces a new regulatory hurdle in Germany, as two major political parties move to scrap the tax-free holding exemption that has long protected investors from capital gains taxes on crypto assets held longer than 1 year. The proposed change would reclassify Bitcoin and other cryptocurrencies as taxable securities, meaning any profit from a sale after a year would be subject to ordinary income tax rates. Market sentiment is currently leaning bearish for the digital asset. Traders are worried that the shift could trigger a sell-off in European crypto funds and dampen institutional inflows. The policy debate reflects broader concerns about outdated tax frameworks catching up with fast-evolving blockchain technology, and it underscores how fiscal policy can ripple through liquidity, valuation models, and global trading volumes. For investors watching the European market, this move signals that regulatory tightening may become more common as governments seek to modernize tax codes for digital assets. Consensus legal team has fired back at a Senate draft bill that aims to regulate decentralized finance, arguing it falls short of providing the safe harbor many DeFi projects need to operate legally. The draft, part of a broader crypto market structure proposal, would still leave developers exposed to potential regulatory crackdowns if they fail to meet stringent compliance criteria. This backlash has injected a wave of bearish sentiment into the sector, as traders fear that without clear protections the bill could stifle innovation and push projects underground. Market watchers note that the debate may delay the bill's passage until 2026, widening uncertainty for DeFi platforms seeking stability. For listeners, this development underscores the tension between lawmakers' desire to curb illicit activity and the need to preserve the open-source ethos that drives blockchain growth. The outcome will shape how quickly DeFi can scale while staying within evolving regulatory boundaries. A new Senate committee has unveiled a draft proposal that would split regulatory authority over cryptocurrency markets between the Commodity Futures Trading Commission and the Securities and Exchange Commission. The plan aims to clarify which agency handles what aspects of crypto trading, custody, and derivatives, addressing long-standing jurisdictional overlap. Early reactions from traders suggest a mix of cautious optimism and concern. Some see clearer rules as a potential catalyst for institutional confidence, while others worry that dual oversight could introduce compliance friction. In the broader context, the proposal arrives amid heightened scrutiny of digital asset exchanges and a push to tighten anti-money laundering standards. So market participants are watching closely for how this split might reshape the regulatory landscape and influence liquidity in the sector. Nasdaq-listed Bitcoin miner CleanSpark has announced a $115 billion senior convertible note offering to fund its next phase of growth. The company will net roughly $113 billion in proceeds, rising to about $128 billion if underwriters exercise their options, with the deal set to close on November 13. CleanSpark plans to allocate $460 million for a private stock buyback at around $15 per share, and use the remaining capital to expand its power and land portfolio, build out data center infrastructure, repay Bitcoin-backed loans, and cover general corporate costs. The move comes amid a broader industry pivot toward artificial intelligence and high-performance computing, as miners look to repurpose excess energy following the April halving that cut block rewards in half. CleanSpark's announcement has injected bullish sentiment into its shares, which surged 13% after revealing its AI expansion strategy, and highlighted Georgia as a strategic region for future growth. The funding push signals CleanSpark's intent to stay competitive at the intersection of mining and AI workloads, while navigating tightening margins across the sector. Exodus Movement Inc., the parent of the popular Exodus wallet, has announced a strategic acquisition that could reshape Latin America's stablecoin landscape. On November 10, 2025, the company closed its purchase of Uruguay-based Grateful, a Montevideo-founded payments orchestrator that powers wallet-to-wallet transfers, QR POS solutions, off-ramping and e-commerce checkouts for merchants. The deal is designed to bolster Exodus's merchant services arm, delivering faster, lower-cost payouts across the region. Market eyes are watching closely. The move signals a bullish push into emerging markets where stablecoin adoption remains fragmented. If Grateful's infrastructure integrates smoothly with Exodus's existing wallet ecosystem, it could create a seamless bridge for merchants and consumers alike, potentially increasing transaction volume and liquidity in local currencies. Meanwhile, competitors may feel pressured to accelerate their own Latin American expansion plans. For listeners, this acquisition underscores how wallet providers are evolving beyond simple custody into full payment ecosystems, aiming to capture the growing demand for stablecoin commerce in high-growth markets. The spotlight turns on the Libra fraud saga that has already rattled investors worldwide. Argentina's judiciary has issued a fresh order targeting former executive Hayden Davis, adding another layer to the $250 million probe that now spans courts in Buenos Aires and New York. This legal move signals that regulators are tightening their net around those linked to the collapsed stablecoin venture, reinforcing concerns about governance lapses in digital asset projects. Market sentiment is noticeably bearish. Traders are tightening risk controls, pulling liquidity from related tokens, and FUD has surged as more evidence of mismanagement surfaces. For listeners following the broader crypto landscape, this development underscores that even high-profile entities cannot escape scrutiny, and it serves as a cautionary reminder that regulatory compliance remains a critical factor in sustaining investor confidence. TD Cowen has announced that its strategy arm will deploy €608 million in net proceeds from a new STRE token raised to buy Bitcoin. The firm expects to use substantially all of the capital for direct BTC purchases, signaling a bullish stance on the digital asset as it seeks to lock in long-term value. This move comes amid a broader trend of institutional allocation toward crypto, reinforcing market confidence and potentially supporting price stability. For listeners, the key takeaway is that a sizable institutional player is committing significant funds to Bitcoin, which could add buying pressure and enhance liquidity during an otherwise volatile cycle. The strategy underscores the growing acceptance of BTC as a core asset class in diversified portfolios, while also highlighting the importance of monitoring how these large inflows impact market dynamics moving forward. Uniswap's founder Hayden Adams has pushed a sweeping governance overhaul dubbed UNification, aimed at reshaping UNI tokenomics. The proposal would activate monthly buybacks potentially worth up to $38 million, injecting liquidity into the ecosystem and tightening supply dynamics. Market reaction is mixed. Some traders view the move as bullish, seeing it as a long-term value driver that could support price stability. Others remain cautious, citing uncertainty over how the buyback mechanism will be funded and its immediate impact on liquidity pools. For listeners following DeFi developments, this initiative underscores Uniswap's continued effort to align token economics with platform growth, while highlighting the ongoing debate around governance-driven supply management in the broader crypto landscape. Silver takes center stage as India jumps to second-ranked global buyer, matching U.S. demand. Recent data from the Silver Institute shows that nearly 70% of Indian silver purchases are in bars and ETFs, underscoring a shift toward physical and structured assets. The surge comes amid U.S. market volatility, government shutdowns, and anticipated Fed rate cuts, fueling safe haven flows into precious metals. Analysts note that silver is poised to retrace an inverse head and shoulders neckline, with short-term targets near $53 and a bullish run toward $64 as gold prices hover around $600. The narrative signals growing FOMO among investors eyeing silver's defensive role, while some caution that the market could still swing if U.S. economic data falters. For listeners tracking metal cycles, India's robust buying pressure adds a new layer to the current bullish backdrop, suggesting that silver may continue its upward trajectory as global risk sentiment shifts. Cardano's latest headline isn't about on-chain upgrades or staking rewards. It's a partnership that could reshape everyday crypto use. The ADA ecosystem has teamed up with Wirex to launch a global crypto card, slated for rollout ahead of Cardano's namesake summit in Germany. Despite the network's 32% YTD decline, this move signals confidence that fiat crypto friction can be eased through a branded payment solution. Market chatter is mixed. Some traders see the card as a bullish catalyst that could drive broader adoption and increase transaction volume, while skeptics argue that a partnership alone won't lift ADA's price, especially amid lingering bearish sentiment across the market. The announcement fuels FOMO among holders hoping for a utility boost, yet it also invites scrutiny over whether the card will deliver real value or merely add noise. For listeners following Cardano's trajectory, this development is a reminder that token performance and product innovation can diverge. While ADA continues to struggle against broader crypto downturns, the Wirex collaboration could position the platform as a practical entry point for consumers, potentially setting the stage for future momentum once the card goes live. Coinbase has rolled out a new public token sale platform aimed at retail investors, marking the first U.S. retail offering since the 2018 ICO crackdown. The launch will feature Monad's Mon token, an Ethereum-compatible Layer 1 project, with sales running from NAV 17 to 22 ahead of its mainnet debut on NAV 24. Coinbase's model caps individual purchases between $100 and $100, limits large buyer influence, and ties future allocations to early sale activity. Tokens sold within the first month earn smaller future allotments to curb flipping. The move signals a bullish shift in U.S. regulatory sentiment toward retail token access, potentially rekindling FOMO among casual holders while reassuring regulators that the platform enforces fair distribution and post-listing controls. For listeners, this represents a significant policy reset. Coinbase will host one sale per month, introduce lock-up periods, and require detailed project disclosures, aiming to blend innovation with compliance in a market still wary of past ICO excesses. Cardano's DeFi ecosystem has surged in Q3 2025, with total value locked climbing 28.7% quarter-over-quarter to $423.5 million, its highest level since early 2022. The lift is driven by a wave of liquidity flowing into lending platforms, stablecoin protocols, and newer decentralized exchanges. Liquid Finance has overtaken MinSwap as the network's top protocol, its TVL jumping 58% to $101.6 million thanks to expanding lending markets and the adoption of Q tokens that let users earn yield while keeping collateral exposure. Stablecoins on Cardano grew 21.5% co-Q to a market cap of $38.1 million, led by USDM and USDA, signaling a shift toward utility-driven activity rather than speculative hype. For listeners, this momentum suggests Cardano is maturing into a more resilient liquidity hub, with diversified protocols and stablecoin adoption bolstering confidence as the network heads into Q4 2025. JP Morgan and Singapore's DBS are reportedly moving beyond traditional stablecoins to test tokenized deposit products, an emerging alternative that could streamline cross-bank settlements. The move follows a Bank for International Settlements survey showing that at least one-third of commercial banks worldwide are already exploring or piloting such digital deposits. Market observers view the trend as bullish, signaling growing confidence in blockchain-based liquidity solutions and a potential shift toward more efficient interbank payments. For traders and institutional players, this development underscores the expanding role of tokenization in core banking infrastructure, hinting at tighter integration between fiat reserves and crypto-enabled settlement layers in the coming months. Bitcoin, the flagship cryptocurrency, has been trading in a tight range for weeks, a pattern that analyst Jordi Visser likens to an IPO phase in traditional markets. In his latest Substack piece, Bitcoin's Silent IPO, Visser argues that this sideways consolidation mirrors the period companies often experience after going public. Price volatility subsides, while institutional interest builds quietly beneath the surface. The implication is that Bitcoin may be preparing for a new growth cycle rather than a sudden rally or crash. Market sentiment remains cautiously bullish. Traders are watching liquidity levels and on-chain activity for signs of an upcoming breakout, yet fear of missing out FOMO has not translated into aggressive buying. The narrative around a silent IPO keeps the conversation focused on structural fundamentals, like increased institutional adoption and regulatory clarity, rather than hype. For listeners navigating the current crypto landscape, this perspective suggests that patience could pay off. As Bitcoin continues to consolidate, stakeholders should monitor key metrics such as active addresses, exchange inflows, and ETF developments, which may signal when the market finally exits its IPO-style plateau and resumes a clear directional move. Domino's Pizza has teamed up with European payments firm Xmoney to launch a new checkout stack that supports both fiat and crypto payments. The first rollout will hit Domino's Cyprus outlets, integrating Apple Pay, Google Pay, and an embeddable wallet-less checkout that bypasses redirects for faster order flow. Xmoney's backend will handle all sensitive data, while the platform also offers Web3 readiness through USDC on Sway for instant confirmations. This move signals a broader push by a global fast food brand toward hybrid payment models, potentially easing the path to mass adoption of blockchain-enabled commerce. For market watchers, the partnership is bullish on Xmoney's token XMN and its growing regulatory footprint, while also underscoring consumer demand for frictionless crypto spend in everyday retail. The collaboration could spur other franchise chains to follow suit, expanding crypto acceptance across Europe and beyond. Bitcoin remains in a tight sideways consolidation around the low $100 zero zone, with traders eyeing a potential breakout. The price has just snapped past its recent downtrend line and is now trading within a narrow channel, hinting at a possible lift toward the $107,500 resistance if the short-term uptrend holds. On daily charts, Bitcoin sits below its 200-day moving average, an indicator that bullish momentum hasn't fully returned yet. But it has touched the first Fibonacci level near $105.00 and could push through successive levels to target the key 0,618 point at roughly $115,750. Weekly data still favors bulls. A rebound could reinforce the major trendline rather than break it. Momentum oscillators like stochastic RSI sit at their lowest, with a potential cross-up early next week, while the RSI hovers just above the critical 4040 support that has guided markets in prior cycles. Overall sentiment is cautiously bullish. FOMO may rise if price clears these pivots, but FUD lingers until clear confirmation of a new upward wave. This context helps listeners gauge whether Bitcoin's current pause signals an impending rally or a prolonged consolidation amid broader market volatility. Bitcoin's chief architect Adam Back, CEO of Blockstream, has just framed the digital asset as a living embodiment of the cypherpunk vision for bearer Ekesh. In a recent interview, he underscored that Bitcoin operates as permissionless bearer money, meaning ownership transfers simply by handing over the private key, without intermediaries or regulatory gatekeepers. This statement reinforces Bitcoin's core proposition as a decentralized, trust-less medium of exchange and positions it against fiat and traditional payment systems. The remark comes at a time when market sentiment is oscillating between cautious optimism and lingering FUD about regulatory crackdowns. Back's affirmation could buoy bullish narratives that highlight Bitcoin's resilience to censorship. Yet some traders remain wary of potential policy shifts that might curb its utility as truly permissionless bearer cash. For listeners tracking the macro environment, this comment reminds investors that Bitcoin's foundational design still aligns with its original mission: a frictionless, private store of value and payment system. It also signals to market participants that any regulatory developments will need to confront this deeply entrenched principle if they are to alter Bitcoin's role in global finance. Uniswap's native token UNI has spiked roughly 30%, trading above $870 after the unveiling of a new governance proposal dubbed UNification. The plan, jointly filed by Uniswap Labs and the Foundation, would redirect a quarter to a sixth of protocol fees into a smart contract, token jar, enabling holders to burn UNI in exchange for an equivalent amount of crypto. CryptoQuant's CEO Kai Young-ju flagged the switch as potentially parabolic, projecting annual token burns near $500 million based on current volumes. The move has lit up bullish sentiment across markets. Traders are lining up for a fee structure that trims LP fees from 0.3% to 0.25% on VTWO pools, while capping protocol earnings at 0.5%. At the same time, analysts warn of market distortion. Roughly half of recent base chain volume stems from zero-fee, scammy pools that would evaporate once the switch activates, potentially reshaping liquidity dynamics. Contextually, this proposal arrives amid a shifting regulatory backdrop, post-Gensler SEC climate, an internal restructuring that sees the foundation winding down while Labs absorbs most staff. The DAO's focus shifts to a $20 million annual UNI growth budget and fee discount auctions aimed at internalizing MEV. For listeners, the UNification move signals a decisive pivot in Uniswap's revenue model and governance power, likely amplifying both upside potential for holders and volatility as the protocol readjusts its fee architecture. NVIDIA is the headline driver of today's AI trade buzz. The chipmaker surged 5.8% on Monday, adding roughly $500 billion to its market cap in just 2 trading days, a record-high daily gain since April, and a $43 billion per hour climb from mid-Friday to close. This rally has reignited bullish sentiment across the sector, with investors chasing NVIDIA's role as the backbone of OpenAI workloads. Yet the euphoria is tempered by growing FUD. SoftBank's CFO disclosed that its recent sales were aimed at preserving financial strength, while it prepares a $30 billion investment push this quarter, hinting at cautious capital deployment. Meanwhile, famed contrarian Michael Burry has warned that hyperscalers may be inflating earnings by extending the useful life of compute assets, potentially understating depreciation on NVIDIA-supplied chips. For listeners, this underscores a market in flux, robust upside potential from NVIDIA's dominance, but shadowed by liquidity concerns and accounting scrutiny that could dampen momentum if not addressed. Cryptography researchers are sounding a warning bell as quantum computers edge closer to practical reality. Gianluca Di Bella, known for his work on zero-knowledge proofs, has argued that the harvest now, decrypt later threat is already active. Attackers can record encrypted traffic today and unlock it tomorrow when quantum capabilities mature. This claim rattles the crypto community, which relies heavily on asymmetric schemes like RSA and elliptic curve cryptography for wallet security and smart contract integrity. Market chatter has turned cautious. Institutional investors are re-examining their risk models, while some projects accelerate post-quantum research. For listeners, this means that while current protocols remain functional, the window of vulnerability is narrowing, prompting a shift toward quantum-resistant algorithms before the next generation of qubits arrives. Zcash, ZEC, has surged almost ninefold from its October trough, climbing to around $76 before spiking to a peak near $256, a rally that rattled the market. Yet charts now reveal a textbook bearish double-top pattern forming as the price retraces, suggesting a potential reversal. Traders watching the daily candles see resistance at the recent highs and support fading below the 200-day moving average, tightening the window for a pullback. The signal is clear. Volatility could spike and prices may trim back toward the $200 level if the top fails to hold. For investors, this signals caution. FUD is mounting as market sentiment shifts from FOMO-driven gains to risk-off scrutiny. Historically, Zcash's rapid ascent has been followed by sharp corrections. The current pattern aligns with that trend, hinting at a possible correction cycle before any new upside emerges. Finassets.io, a crypto payment processor focused on iGaming, recently helped an online casino lift its gross gaming revenue within just 2 weeks of adding cryptocurrency deposits and withdrawals. The casino, which had only accepted USD, EUR, and RUB until 2025, chose Finasets for its transparent total cost of ownership model and low TRON network fees, cutting operational costs by more than half through direct energy purchases. Integration was rapid. A sandbox environment, clear API docs, and under 10-minute Telegram support allowed the casino to go live in days without downtime. After launch, users overwhelmingly switched to crypto as their primary funding method, driving a noticeable spike in revenue and reinforcing the industry trend that 17% of online gambling bets were placed with crypto in Q3 2024. Market sentiment remains bullish for operators adopting crypto. Players prize speed, anonymity, and flexibility, while firms risk losing market share if they stay offline. This case underscores how a strategic payment upgrade can quickly boost turnover and align an operator with the growing digital transaction ecosystem. Digital asset allocation has moved from hype to a strategic pillar for institutional investors. According to a new survey by Signum's Future Finance 2025 report, the study canvassed over 1,000 professional crypto participants in 43 countries and found that 61% plan to boost their digital asset exposure, while only 4% intend to cut back. Despite this bullish stance on allocation, the sentiment is expected to shift toward neutral or bearish within the next year as markets face near-term caution. The data underscores a broader trend of diversification over speculation among hedge funds, family offices, and sovereign wealth managers. Investors are now treating crypto not just as a speculative play, but as a risk management tool in their portfolios. The survey's findings suggest that while allocation levels will rise, volatility expectations remain high, keeping the market in a delicate balance between FOMO-driven inflows and FUD-triggered caution. For listeners, this means that institutional momentum is solidifying crypto's place in mainstream asset classes, but short-term price swings are likely to persist as risk appetite fluctuates. Uniswap's governance body and its core development team have unveiled a bold plan to make the UNI token more attractive for holders by targeting a 100 million token burn. The proposal, which will be put to a community vote, aims to reduce supply and potentially lift per unit value, while rewarding long-term participants with higher staking yields. Market chatter is already split. Some traders view the burn as bullish, seeing it as a supply squeeze that could tighten liquidity and drive price action upward. Others caution that the move might trigger short-term volatility if holders rush to sell before the burn completes. For listeners, this development comes at a time when DeFi protocols are increasingly experimenting with tokenomics tweaks to sustain user engagement. So keeping an eye on UNI's vote outcome and subsequent burn execution will be key to assessing its impact on the broader ecosystem. Uniswap Labs has unveiled a sweeping UNification proposal that could reshape the flagship decentralized exchange's governance and revenue model. The plan introduces protocol fees to fund an aggressive UNI token burn, retrospectively slashing 100 million tokens from the treasury to tighten supply and reward long-term holders. It also launches protocol fee discount auctions, letting traders bid for lower costs while boosting burns. Structurally, the proposal merges Uniswap Labs with the Foundation's core teams under a 5-member board led by Hayden Adams, Devin Walsh, and Ken Ng, streamlining decision-making. Version 4 will act as an on-chain aggregator, harvesting fees from external liquidity sources via new hooks for added revenue. The company is slated to drop monetization of its interface, wallet, and API, redirecting future income toward aligning with UNI holders. A 20 million UNI annual budget earmarked for governance will commence in 2026. Market reaction has been mixed. Bullish sentiment from supply contraction advocates, yet bearish caution among those wary of centralizing leadership. For listeners, This move signals Uniswap's push toward tighter tokenomics and unified operations, potentially setting a new standard for DeFi governance while altering the fee landscape for traders. Transact, a leading stablecoin payment platform, has just secured licenses in 6 additional U.S. states, bringing its total to 17 jurisdictions. The move comes amid ongoing regulatory fragmentation across the country, as firms scramble for broader access while state regulators maintain distinct requirements. Market chatter shows a bullish tone. Traders view the expansion as a sign that Transact's infrastructure is scaling and may strengthen its competitive edge against rivals like MoonPay and Simplex. At the same time, some analysts caution that the patchwork of approvals could still pose compliance hurdles, keeping a degree of uncertainty in the air. For listeners following the crypto payments landscape, this development signals that stablecoin adoption is gaining traction at the state level, but also highlights how uneven regulation continues to shape the sector's growth trajectory. Cardano's investment arm Emergo has struck a deal with Wirex to roll out a new Cardano card, a multi-chain crypto payment solution that will sit inside the Wirex app and be instantly available to its 6 million users worldwide. The partnership was unveiled at the Cardano Summit in Berlin, positioning the card as a bridge between Cardano's ecosystem and everyday spendable fiat. For market watchers, this move injects bullish momentum into Cardano's token by expanding real-world utility and potentially driving usage spikes. It also signals that major crypto payment platforms are tightening ties with Layer 1 projects to capture the growing demand for seamless crypto to fiat spending. Investors and traders should note the partnership as a step toward broader adoption, while keeping an eye on how the card's rollout might influence ADA's liquidity and price dynamics in the coming weeks. Tether has quietly bolstered its asset base by hiring a senior metals trader from HSBC and announcing plans to increase its gold holdings. The move signals the stablecoin issuer's intent to diversify beyond cash and crypto assets, aiming for greater resilience amid market volatility. Investors are watching closely. The announcement has sparked mild FOMO among those who see gold as a hedge against fiat inflation, while some skeptics question whether adding physical bullion will materially shift Tether's risk profile. Historically, Tether's liquidity has hinged on its reserves, so any tangible increase in hard assets could reinforce confidence in the platform's backing. In the broader context, this development comes as regulatory scrutiny tightens and market participants seek more transparent reserve disclosures, positioning Tether to potentially strengthen its standing in a crowded stablecoin arena. BitMine has just pushed its Ethereum treasury to over 35 million ETH, roughly 29% of total supply, after a 110K ETH purchase that sent the market into a bullish reverberation. The move signals renewed confidence in major assets and opens new risk windows across the crypto landscape, stoking FOMO among investors eyeing large-cap plays. In this backdrop, Bitcoin Hyper's upcoming Layer 2 solution promises SVM speed with ZK security, appealing to those who want BTC safety without its throughput limits. Meanwhile, PEPENODE introduces a gamified mine-to-earn model that keeps users actively engaged, and Tron remains a liquid payments engine poised to benefit when global retail flows back into the system. Together, these projects illustrate how BitMine's treasury expansion is reshaping sentiment toward both established and emerging tokens. Zcash (ZEC) has pulled more than 20% in the last day, sparking concerns that its recent rally might be fading. However, a broader view shows the coin still up 14% this week and over 200% in the past 3 months, ranking it among the cycle's strongest performers. The dip appears to be a consolidation within a classic bull flag pattern. A sharp rise from late October to early November created the flagpole, while sideways trading has built the flag itself. A hidden bullish divergence, higher lows on price against lower lows on RSI between NAV 8 and 10, suggests selling pressure is easing even as the price holds steady. Derivatives data adds another layer. Short heavy zones between $529 and $651, with Binance shorts outpacing longs by roughly 60%. This imbalance could trigger a short squeeze if ZEC nudges higher, feeding momentum toward the flag's resistance near $612, $688. A breakout above that range would validate the pattern and set the stage for targets around $749, $898, and beyond, potentially pushing the coin close to $2.30 on the full flagpole projection. The key caveat: ZEC must stay above $488. A break below could invalidate the flag and force a deeper pullback toward $371. For now, the market views the 20% slide more as a recharge than a retreat, an opportunity to ignite the next leg higher if the pattern holds. Bitcoin and the broader crypto market experienced a muted day as traders digested a mix of regulatory updates and institutional signals. The world's flagship digital asset settled near $29,400 after a brief dip to $28,900 earlier in the session, reflecting a cautious stance amid fresh U.S. Treasury guidance on stablecoin oversight. Meanwhile, Ethereum's price hovered around $1,850, with its recent upgrade rollout drawing mixed reactions: optimism from developers but uncertainty among liquidity providers. DeFi platforms reported steady TVL growth, though some protocols faced minor security patches that triggered temporary FUD. NFT marketplaces saw a dip in daily sales volume, suggesting a pullback after last week's speculative rally. Overall sentiment remains neutral. Investors await clearer regulatory direction before committing to larger positions. Tapbit, a rapidly growing futures exchange founded in 2021, has announced its 4th anniversary celebration slated for November 17th. The company will roll out zero-fee spot trading on selected pairs permanently and host a $1 million rewards gala featuring trading contests, referral drives, and lucky draws that could net users luxury prizes such as a Mercedes-Benz. Over the past 4 years, Tapbit has expanded to more than 200 countries, amassed 500 zero-plus users, and generated daily spot volumes of nearly $4 billion, with futures turnover topping $53 billion, all while maintaining a spotless security record backed by a $50 million insurance fund. The announcement injects FOMO into the market. Traders are eyeing the fee waiver as an incentive to increase volume, while the reward pool adds short-term bullish momentum. For listeners, this move underscores Tapbit's strategy of blending low-cost trading with high-visibility incentives to solidify its position in a crowded exchange landscape and drive user engagement ahead of planned AI and Web3 integrations. Virtual asset derivatives have surged to dominate crypto trading, with monthly volumes hitting $894 trillion in 2025, outpacing spot markets and accounting for roughly 76% of all activity. This explosive growth has drawn international regulatory attention, yet Brazil's market remains in a gray zone because the CVM has not defined what constitutes a derivative contract. The omission leaves investors uncertain whether instruments like futures, options, perpetual swaps, or CFDs fall under supervisory purview, potentially stalling foreign capital inflows and dampening local innovation. In response, the regulator has adopted the Howey test to classify certain contracts as securities, but without clear definitions, market participants face heightened compliance risk and reduced transparency. For traders and firms operating in Brazil, this regulatory ambiguity means navigating a rapidly expanding, yet poorly governed derivatives landscape, where FOMO around high-volume products could be offset by mounting FUD over legal uncertainty. Ripple's flagship token XRP has attracted renewed bullish attention after recent technical and on-chain indicators suggest a potential breakout trajectory toward $5 by year-end. Analysts note that the price has broken above key resistance levels, while volume patterns reveal an uptick in institutional activity, signaling stronger demand momentum. The market reaction has been mixed. Traders are riding FOMO as charts hint at upside, yet some remain cautious due to lingering regulatory uncertainty and past volatility spikes. For listeners, this development underscores how short-term technical cues can spark rapid sentiment shifts, but it also reminds us that XRP's broader ecosystem, particularly its settlement network and legal status, continues to shape long-term value. The next few weeks will be critical to see if the breakout holds, or if the rally stalls amid macroeconomic headwinds. Bitcoin is back on a rebound after a week of sharp swings, with U.S. listed ETF inflows picking up again. The digital gold has traded between $98.0 and $110.0, edging toward the $116.0 resistance that could set it on a run to roughly $128,500. Market sentiment is cautiously bullish. Traders are watching macro data and risk appetite while FOMO drives short-term buying, but lingering FUD around ETF approvals keeps volatility alive. This recovery comes as crypto firms sharpen their narrative tools. Data-driven PR agencies like Outset PR are aligning messaging with market mood to shape investor perception. For listeners, the takeaway is that Bitcoin's near-future price hinges on sustained ETF inflows and broader macro conditions. Effective communication will play an increasingly decisive role in how the asset is valued by the market. The latest IMF data shows a seismic shift in global GDP dynamics. BRICS economies, China, India, Brazil, Russia, and South Africa, are now projected to dominate purchasing power parity output, while the G7's share is set to decline past 30% by 2028. China and India alone account for roughly two-thirds of that rise, driven by massive demographic expansion and productivity gains. Their PPP shares have jumped from about 5% in 1990 to nearly 19% today, with India climbing from 3% to 8%. For crypto traders, this macro pivot signals a potential bullish tilt toward assets linked to emerging markets. Think stablecoins pegged to local currencies or tokens tied to infrastructure projects in BRICS regions. Conversely, it could dampen sentiment around Western-centric financial instruments as traditional growth engines face demographic headwinds and slower output. In short, the balance of economic power is realigning. Watch how this may shift capital flows toward high growth, emerging market crypto opportunities, while tempering exposure to legacy G7 assets. Idiosphere has announced a new venture that aims to channel cryptocurrency speculation into scientific research by creating prediction markets for upcoming study outcomes. The platform will let token holders bet on whether experiments reach certain milestones, with the proceeds earmarked to fund the very projects being wagered upon. This move positions Idiosphere as a hybrid of DeFi and academic funding, potentially opening a novel revenue stream for researchers, while offering traders a fresh asset class tied to real-world data. Market chatter is mixed. Some participants see bullish potential, viewing it as an innovative use of blockchain that could legitimize crypto's value proposition beyond hype. Others warn of regulatory uncertainty and the risk of FUD if the markets fail to attract sufficient liquidity or if research results are delayed. For listeners, this initiative signals a broader trend where decentralized finance seeks purpose-driven applications, but its success will hinge on building trust among scientists, investors, and regulators alike. Exodus, the crypto wallet giant, has announced a strategic acquisition of Uruguay-based payments orchestrator Grateful to deploy stablecoin-powered merchant tools across Latin America. The move delivers instant payment rails for gig workers and small businesses, slashing settlement times and costs while positioning Exodus as a full-stack wallet provider rather than just a vault. The deal fuels bullish sentiment around stablecoins in the region, where adoption surged through 2025 and volumes hit record highs, suggesting a growing appetite for crypto-enabled commerce. The acquisition is expected to lift daily wallet activity, more payouts, swaps, and on-chain claims, which will benefit Exodus's new best wallet token, $Best. $Best has already raised $16.9 million in presale, with 77% of tokens staked and priced at roughly $0.26 each, offering structured exposure to a payment-driven growth cycle. For listeners, the narrative is clear. As stablecoins become everyday money for LATAM merchants, wallets will be the first touchpoint, and Best aims to capture that utility loop through fee reductions, rewards, and access perks, turning routine usage into a potential long-term value driver. Kalshi Inc., the US-based prediction market platform that trades contracts on sporting outcomes, has just survived a legal showdown with 3 California tribes. The court denied the preliminary injunction the tribes sought, allowing Kalshi to keep offering its sports event contracts without interruption. This ruling removes a key regulatory hurdle for the company and signals that its business model can withstand tribal opposition, an encouraging sign for investors watching the niche of event-based derivatives. In the broader crypto landscape, where litigation often dampens sentiment, Kalshi's win injects a dose of bullish clarity. It reduces FUD around compliance risks and may lift confidence among traders who rely on the platform's unique market. For listeners following the evolving intersection of betting law and blockchain, this outcome underscores that regulatory battles can be navigated successfully, potentially paving the way for further expansion and attracting additional venture capital as Kalshi positions itself amid growing interest in sports betting derivatives. Bitcoin BTC sits near $105.0 after slipping past its April 2025 support at $107.0, a level that has flipped into resistance as the price fell. The move comes amid renewed optimism that the U.S. government avoided a shutdown, which has buoyed risk assets and spurred short-term buying interest. Technical analysis shows BTC has shed both the 200-day MA and EMA, now converging around $107,000, a key barrier. If the spot stays below this zone, bearish pressure persists. A break above would signal a potential reversal. On higher timeframes, structural support remains intact. The weekly candle closed above the 50-week EMA, a level that has held since 2023 and still attracts liquidity. An unfilled fair value gap near $90,000 suggests additional buying pressure could surface if BTC drops below that floor. Market participants note active liquidity pockets around $104,950 and an open CME gap at $104,000, hinting at possible short-term pullbacks. Overall sentiment is cautiously bullish, FOMO from risk on rally, but FUD lingers as the market watches whether BTC can reclaim the $107,000 resistance before a renewed downtrend. The next critical move will hinge on breaking that barrier and holding above it to reset the cycle. Bitcoin faces a new quantum era risk as on-chain analyst Willy Woo has urged holders to migrate their coins out of Taproot, BC1P, addresses, and back into older SegWit or legacy formats that hide public keys behind hash functions. Woo's 6-step guide, posted on X, warns that once quantum computers reach sufficient power, they could derive private keys from the exposed public data in Taproot scripts. The move has sparked a technical debate. Some developers argue a comprehensive migration plan is already underway, while others see Woo's call as premature hype. Market sentiment skews mixed. FUD looms over the 10-20-year quantum timeline projected by figures like Michael Saylor, Yet bullish eyes point to Bitcoin's adaptable UTXO model that could absorb upgrades without breaking the chain. For listeners, this highlights an emerging security layer in the crypto ecosystem. While today's Bitcoin remains robust, the community is already planning preemptive steps to safeguard assets against a future where quantum attacks could undermine current cryptographic primitives. Standard Chartered has teamed up with DCS Card Center to roll out Decard, a credit card solution that lets users spend stablecoins directly at merchants worldwide. The launch marks the bank's first foray into consumer crypto payments and positions Singapore as a hub where digital assets meet traditional finance infrastructure. Market chatter is leaning bullish. Traders see the move as evidence of growing institutional acceptance and a potential uptick in stablecoin liquidity outside exchanges. For listeners, this development underscores how banks are testing new payment channels that promise faster settlement, lower fees, and broader merchant adoption. Key factors that could accelerate mainstream crypto spending if the pilot proves successful. Zebec Network's native token, ZBCN, is pulling back from a multi-week trough after being listed on Bitvavo, Europe's largest MiCA-compliant exchange. The announcement triggered an immediate uptick as traders seized the first trading window on the new venue, pushing the price toward the $0.50 mark that many analysts had flagged as a potential short-term support level. Market sentiment has swung decisively bullish. FOMO is evident in the surge of order flow and the volume spike seen across major exchanges, while any lingering FUD from previous liquidity concerns appears to be receding. For listeners watching the scene, this move signals that Zebec Network's listing strategy is paying off, giving the token a fresh influx of capital and visibility. The next phase will hinge on whether ZBCN can sustain momentum beyond the initial listing buzz. Traders should monitor price action against key resistance levels and keep an eye on any subsequent partnership announcements that could further validate the project's growth trajectory. Numez token, $NNZ, has entered Stage 3 of its 28-stage presale on Binance, pushing the price to $0.151 and accelerating buying pressure as each stage's limit is approached. The structured burn schedule, unsold tokens are destroyed every 7 days or upon sell out, tightens supply while a live Noom gauge visually tracks progress, creating tangible urgency for participants. Market chatter leans bullish. Traders note the rapid close of Stage 3 and anticipate a price spike once the next checkpoint opens, fueling FOMO among meme coin hunters. For listeners navigating the crowded altcoin space, this development signals that $NNZ is positioning itself as an early-stage play with built-in scarcity mechanics and a referral program that rewards both referrers and buyers, potentially amplifying demand ahead of the upcoming Stage 4 launch. Ethereum's price has settled into a tight coil around $3,580, with intraday swings now largely constrained and volatility at an all-time low. The digital asset is trading within a narrow $3,500 band, reflecting muted range-bound action that has persisted across major trackers. Over the past 24 hours, the drift has been slight, leaving the market in a holding pattern rather than a clear breakout or breakdown. The lack of volatility signals a potential squeeze. Traders may be awaiting a decisive move before committing more capital. Sentiment remains neutral to mildly bearish. Without fresh catalysts, investors are waiting for confirmation. For listeners watching Ethereum's trajectory, this period underscores the importance of monitoring the next pivot point. Whether the price will break above $3,680 or dip below $3,500 to gauge the market's direction moving forward. Lbank, a Singapore-based crypto exchange with 20 million users and $10.5 billion daily volume, just wrapped its 7-day stablecoin earn program. The campaign drew more than 93,000 participants and locked $67.4M in stablecoins, signaling strong demand for high-yield products. Market reaction skews bullish. The surge in locked value boosts confidence in Lbank's secure, user-friendly platform, while FOMO may drive further sign-ups. For listeners, this move showcases how centralized exchanges are blending DeFi-style returns with institutional reliability, potentially setting a new benchmark for yield offerings and encouraging broader adoption of stablecoin earning tools. The Bank of England has unveiled a new regulatory framework for GBP-backed stablecoins, aiming to tighten oversight before final rules go live in late 2026. The paper sets out that issuers must fully collateralize tokens with high-quality liquid assets, at least 40% in central bank deposits, and the remainder in short-dated gilts, with a temporary 95% gilt window for firms scaling toward systemic status. Individual holders face a £20 £0 cap, while non-financial entities are limited to £10 million. Banks are exempt. The Treasury will label which coins qualify as systemic in payment chains, triggering BOE supervision on capital, liquidity, and operational resilience, while the FCA retains consumer protection duties. Market reaction has been mixed. Some traders see London's principles-based approach as a pull factor for institutional issuance, sparking FOMO among issuers. Others warn of potential FUD if the caps dampen adoption. For listeners, this move signals a tightening of the stablecoin ecosystem in the UK and could reshape where institutions choose to issue GBP-backed tokens. Ethereum has broken through a key psychological level, trading above $3,650 after a 4-month low of $350. The move lifted the token past its active realized price, around $3,545, meaning most holders are no longer underwater and sentiment is shifting bullish. Analysts point to the $3,700 $3,900 resistance zone as the next hurdle. Breaking it could pave the way toward a $4.0 rally, while failure might pull the price back toward support levels near $2,870 or lower. Institutional buying is on the rise, with firms like BitMine adding 110.0 ETH last week, signaling growing confidence amid ongoing regulatory and DeFi developments. The market is watching closely for whether Ethereum can maintain pressure above $3,500 to test higher resistance, a move that could trigger renewed FOMO-driven momentum, or, if stalled, a retreat toward lower support zones. Stardo Group has rolled out a new super app aimed at consolidating the Sonium ecosystem into one unified platform. The application will enable token generation events, airdrops, and reward distributions directly within its interface, streamlining user access to Sonium's utilities. Market chatter around the launch is cautiously bullish. Investors see potential for higher engagement if the app drives volume, but some remain skeptical about execution risk and regulatory scrutiny of token sales. For listeners, this move positions Sonium alongside other projects that are betting on integrated ecosystems to boost adoption, while also highlighting the growing trend of all-in-one crypto utilities that could reshape how users interact with blockchains in the coming months. Litecoin has broken through the $100 mark, with its price climbing steadily this week as network activity picks up, and a new staking product launches from Poen Block Energy Inc. Poen unveiled an AI-powered smart staking contract that automatically delivers daily rewards to LTC holders, claiming eco-efficient yields and real-time visibility via a dashboard. The move has sparked bullish sentiment among the community, with FOMO driving trading volume higher as investors eye consistent passive income without active management. In the broader market, total capitalization surpassed $235 trillion, and institutional ETF inflows kept Bitcoin hovering near $103.0, while Ethereum remains in a $3,250 range amid DeFi recovery. For listeners, this development signals that Litecoin's recent rally is not just price momentum, but also supported by innovative yield generation tools, potentially adding new layers of demand as the crypto ecosystem looks for sustainable income streams. Ethereum is the headline today as whale wallets have quietly added roughly 76 million ETH, an increase of 52% since late April, while retail holdings dipped by about 16%. The bulk of this accumulation comes from large addresses holding between 10.0 and 100.0 ETH, indicating that institutional players are positioning themselves at the current $3.0 level. Spot trading volume has surged multiple times since early November, signaling a rebound in market activity and a potential compression phase that often precedes upward moves. The buildup suggests growing confidence among big investors, even as smaller holders pull back. This divergence creates a mixed sentiment. Whales hint at bullish fundamentals, whereas retail retreat fuels mild FUD. For listeners, the key takeaway is that Ethereum's price has stabilized near $3.0. Whale activity and higher volumes may foreshadow a short-term rally if macro conditions stay steady. BZ Hash has rolled out a new suite of cloud mining contracts that promise investors straightforward, hardware-free crypto earnings. The platform now lets users stake funds into automated mining pools managed entirely in the cloud, eliminating the need for on-prem rigs or technical setup. Market chatter is mixed. Early adopters applaud the convenience and low barrier to entry, sparking a mild FOMO buzz among casual traders, while skeptics caution that the profitability of such contracts hinges on volatile hash rates and fee structures. For listeners, this development sits at the intersection of yield-seeking strategies and the broader debate over cloud mining's sustainability and regulatory scrutiny, an option worth watching as miner economics continue to shift in a post-Bitcoin halving landscape. Jack Dorsey's Square has activated Bitcoin payments for its merchant network, enabling thousands of sellers to accept BTC directly or convert it on the fly through its dashboard. The rollout is part of a staged plan that began with Lightning pilots in May and will extend through 2026, signaling a long-term commitment rather than a one-off marketing stunt. This move shifts Bitcoin from a speculative asset into a usable checkout option, tightening sentiment across the stack. Traders see bullish cues as adoption curves accelerate, while any misstep could trigger FOMO-driven volatility. The announcement dovetails with the launch of Best Wallet token BEST, an app-first wallet that rewards users with reduced fees and perks tied to BTC usage at point of sale. With nearly $17 million already raised in its presale, BEST positions itself as the natural gateway for new users entering the ecosystem as Square's merchant base, roughly 4 million businesses, grows. For listeners, this development underscores a broader trend toward mainstream crypto payments and the rise of utility-centric tokens that capture spillover from everyday adoption. Zcash, ZEC, has slammed into a sharp correction, sliding more than 25% in the last 24 hours to dip below the $500 psychological threshold and touch lows near $476. The drop erased roughly $3 billion of market cap amid a surge in daily volume, up about 150%, as large holders liquidated positions and profit-taking accelerated. Market sentiment has swung decidedly bearish. On-chain data show reduced shielded pool activity, while technical indicators flag a double-top pattern on the 4-hour chart, an RSI hovering near 39 and a breach of the 50-day EMA, all pointing to further downside risk. This slide follows ZEC's meteoric rally from $40 in early September to nearly $750 by early November, fueled by having hype, capital rotation, and a privacy token surge. With Bitcoin holding above $105K and broader altcoin enthusiasm waning, the next critical zone for ZEC lies between $400 and $300, while a rebound would likely target the $470 support level, before testing the EMA at roughly $531. Femex, a leading crypto exchange known for speed and reliability, has rolled out a fresh brand identity that signals its shift toward becoming a full-stack digital asset platform. The company unveiled a new logo featuring a minimalist two-candle motif, an updated platform UI with 3D visuals, unified icons, and lighter layouts across desktop and mobile. This visual refresh is the first step in a broader rebranding effort that will introduce a house of brands and a cohesive identity system over the coming weeks. The move comes as Femex seeks to emphasize precision, performance, and progress, while maintaining its core promise of efficiency. Market sentiment remains mixed. Some traders view the overhaul as a bullish sign of growth ambitions, while others see it as purely cosmetic amid ongoing competition for user acquisition. For listeners, the key takeaway is that Femex is actively evolving its brand and product experience to stay ahead in a crowded exchange landscape, potentially affecting user perception and retention in the near term. Shiba Inu's community is abuzz after commentator James Wynn floated a $0.10 price target for SHIB, a level that would catapult long-term holders into millionaire status and ignite fresh FOMO among fans. The claim rests on the token's historic 2021 rally, yet analysts caution that with roughly 589 trillion coins in circulation, reaching $0.10 would demand a market cap of about $589 trillion, nearly twice the U.S. GDP, and is unlikely without drastic supply changes or widespread burns. Despite a recent 2–3% dip amid broader crypto sell-offs and year-to-date losses near 53%, SHIB's core base remains bullish, driven by nostalgia for past gains and an active community ready to chase sentiment-driven surges in future rallies. Bitcoin is once again at the center of headline chatter after Eric Trump publicly claimed the cryptocurrency will break $1 million and that this year's fourth quarter will be unbelievable. The statement, posted on Twitter in early November, follows a string of high-profile predictions, from Binance founder CZ to ARK Invest's Cathie Wood, each betting on BTC reaching seven-figure territory. Market reaction has been mixed. Bullish sentiment from FOMO-driven traders and cautious skepticism among risk-averse participants, as the asset's recent peak of $126.00 in 2025 still falls short of Trump's target. Contextually, October's historic single-day liquidation event underscored volatility, while the approval of 11 spot Bitcoin ETFs last year has fueled institutional inflows and broadened mainstream adoption. As BTC continues its ascent, analysts weigh whether the current trajectory can sustain a move toward $1 million before the decade ends, or if regulatory headwinds and market corrections will temper expectations. Stablecoins are no longer a quiet corner of the crypto ecosystem. They're now front-line assets in institutional strategy wars. Recent filings show several major banks and payment firms rolling out new stablecoin infrastructure, committing capital and regulatory compliance resources to projects that can demonstrate robust reserves and transparent custody. The move signals a shift. Only platforms with proven liquidity frameworks and audited backing will attract the heavy hitters. Market chatter is split. Some traders fear a consolidation wave that could squeeze smaller issuers into oblivion, while others see an opportunity for those that survive to gain dominance in cross-border payments and DeFi lending. For listeners, this means stablecoins are becoming pivotal pillars of institutional crypto exposure. Watch how reserve transparency and regulatory alignment will dictate which names rise above the noise. Argentina's courts have moved to freeze assets tied to the Libra token debacle, targeting U.S. promoter Hayden Davis and his Argentine and Colombian associates. Judge Marcelo Martinez de Giorgi ordered that bank accounts, real estate holdings and crypto wallets, over $100 million in alleged proceeds, be sealed, with the National Securities Commission instructed to extend the hold across local exchanges. The action follows a New York freeze of $57 million in USDC, linked to Davis's former Meteora exchange, underscoring a cross-border crackdown on what prosecutors label a sophisticated memecoin pump and dump scheme that wiped out roughly $250 million for investors worldwide. Market reaction is steeply bearish. FUD has surged as traders grapple with the risk of regulatory sweeps and potential collateral damage to related projects. The move comes amid political headlines, dubbed Cryptogate, after Davis's meetings with President Milei, though no direct link to the president has been established. For listeners, this signals that even high-profile crypto actors are not immune to aggressive judicial action, reinforcing the need for vigilance in token investments and highlighting how swiftly legal developments can ripple through global markets. Bitcoin is currently hovering near the $105.0 mark after a brief bounce off a steep demand downtrend. The rally has hit strong overhead resistance at $114.0 and faces a key supply zone between $106.0 and $110.0, where both the 100-day and 200-day moving averages now act as dynamic resistance. On the 4-hour chart, the price is trapped in a falling wedge. A clean breakout above $110.0 would signal continuation, but a rejection would likely send it back to the $100.0 support level. On-chain data shows a steady decline in unique daily addresses since early 2025, indicating that rising prices are not matched by increased network activity or retail participation. This divergence fuels bearish sentiment and adds FUD around the sustainability of the current price levels. For listeners, the takeaway is that Bitcoin's near-term outlook remains uncertain. Without a surge in buying volume to reclaim the $110.0 order block, the asset could retreat below $100.0, reinforcing caution among market participants. Dubai's luxury real estate giant Serenia Residences on the Palm is sparking a new wave of bidding wars for unbuilt penthouses. Buyers are locking in 1 million dirhams just to signal interest, with the highest offer now reaching $24 million, double the initial $12 million floor. This surge has pushed Dubai's penthouse prices into parity with New York and London, turning these units into the ultimate status symbol for ultra-high net worth investors. The frenzy fuels a FOMO-driven market sentiment. Overseas buyers are racing to secure a stake before construction completes, while local home buyers feel squeezed by soaring entry costs. Rental yields remain high, and developers anticipate quick flips once the projects finish, adding bullish pressure on property values. For listeners, this trend highlights how Dubai's post-COVID real estate boom continues to attract global capital, reshaping the luxury housing landscape and intensifying competition among the ultra-wealthy. Shiba Inu, SHIB, has stepped back into the spotlight as its derivatives market heats up again. Open interest on futures spiked about 15% on November 8, pushing the token just above the $0.10 psychological level and shifting the long-short ratio toward bullish bets at roughly 0.9. The move comes after a broader crypto rebound that lifted Bitcoin back over $100,000 and saw SHIB climb more than 8% in the past week. Institutional buzz, highlighted by an ETF filing, and a likely end to the U.S. government shutdown add further upside sentiment, while whale activity remains subdued with low-value transfers dominating recent days. Technical chatter points to a potential breakout from a consolidation zone, and analysts eye a rally toward $0.03 if momentum sustains. A dramatic 146% surge in token burns last 24 hours cut supply sharply, tightening demand dynamics. At the moment, SHIB trades near $0.1005, reflecting the current bullish pulse amid growing speculative interest. Bitcoin has steadied near $104, 5K after a period of choppy swings that kept it below the $108K resistance line. Over the past weeks, macroeconomic data and regulatory chatter have pushed the price back and forth, but recent candlestick patterns show tighter consolidation. Traders are now weighing whether this newfound stability could signal an impending breakout or simply a pause before another pullback. Market sentiment skews cautiously bullish. Some analysts see the narrowing range as a potential setup for a short-term rally, while others caution that without a clear directional move, the coin may remain trapped in a sideways trap. For listeners following Bitcoin's trajectory, the key takeaway is that the asset has moved from a volatile swing phase into a tighter band, an environment where momentum could either surge or stall, depending on upcoming macro cues and market psychology. 8lens, a decentralized crowdlending platform built on Base, has launched its native utility token, 8LNDS. The token is not sold but earned through platform activity, investments, retro drops, and airdrops, with an initial fixed supply of 100 million and liquidity locked at 100% USDC. Minting is strictly matched to real-world rewards. Before each mint, the equivalent amount is bought and burned on the open market, keeping circulation stable. Investors receive 6% in 8LNDS, vested over 10 months, while community members qualify for a 5 million token retro drop or a future airdrop based on engagement. The rollout is staged. First, reward activation with free DEX trading. Second, broader ecosystem expansion. This structured approach aims to avoid speculative spikes and instead fuel long-term participation, generating bullish sentiment among users who value tangible DeFi impact over hype cycles. Cardano, ADA, remains a top 10 altcoin, but its price has stalled near 2024 levels, hovering below $0.60 after a 30% pullback. In the past 4 days, whale and shark holders, those owning between 100K and 100M ADA, have quietly accumulated roughly 348 million tokens, worth about $204 million or 0.94% of total supply. This marks the strongest buying surge since May, indicating that smart money sees the dip as a prime entry point while retail traders retreat, keeping volatility low. The accumulation trend coincides with a historical pattern. ADA has delivered 200–300% rallies after roughly 10 months of consolidation in 2023 and 2024. October's price range of $0.50–130 mirrors those setups, suggesting a potential breakout as the Cardano summit in Berlin approaches. Despite this bullish backdrop, overall altcoin sentiment remains cautious, with the season index near 39 points, reflecting lingering FUD that could temper an immediate rally. Maestro, a leading infrastructure firm behind Bitcoin-native capital markets, has unveiled Mezzanine, a new on-chain credit platform that lets idle BTC flow directly into mining operations via secured loans collateralized by hash rate, energy assets, and the BTC itself. The service aims to unlock roughly $150 billion of liquidity for miners, while providing institutional holders with a sustainable yield source tied to proof of work. Analysts see the move as bullish for decentralization. By easing capital constraints that currently favor large, publicly traded miners, Mezzanine could spread hash rate more evenly across the network and reduce reliance on USD-denominated debt. For investors watching the mining sector, the announcement signals a shift toward native BTC financing and may lift sentiment around institutional BTC yield products. The platform's launch comes at a time when over $2 trillion of BTC sits idle, so the market is primed to absorb a new mechanism that promises low risk, on-chain returns without exposing holders to fiat volatility. Canary Capital's newly approved XRP ETF, ticker XRPC, has cleared SEC hurdles and is set to launch on Nasdaq this week, marking the first spot XRP fund under the 1933 Act. The automatic approval came after Canary filed Form 8A, confirming Nasdaq listing eligibility, while a prior S1 filing detailed its structure. A 0.50% management fee, spot tracking via the XRP USD CCI XBER Reference Rate Index, and custody handled by Gemini Trust and BitGo with U.S. Bancorp as transfer agent. The announcement has sparked bullish sentiment. XRP's price climbed nearly 10% to $248 in the past week. Trading volume surged 40% in a single day, and futures open interest on CME and Binance is rising. Market participants view the ETF launch as a potential catalyst for further upside, though some technical concerns, like a looming death cross, persist. For listeners, this development signals growing institutional acceptance of XRP and could reshape liquidity dynamics for the token moving forward. Avalanche's native token AVAX is eyeing a critical $20 breakout after the U.S. Treasury and IRS issued Revenue Procedure 2025-31, creating a tax safe harbor that allows regulated ETFs to stake crypto assets like ETH, SOL, and AVAX while passing through rewards to investors. This regulatory clarity removes a major legal hurdle for institutional participation in proof-of-stake networks. Market sentiment has shifted from recent bearish pressure, spurred by global risk asset jitters, to cautious optimism, as the guidance signals potential capital inflows and a new mainstream investment channel for staking. For listeners, this means AVAX is positioned at a psychological resistance level with growing institutional interest. Its price hovers near $17.75, having tested $20 before. If the token clears that threshold and sustains upward momentum, it could trigger renewed buying activity tied to the broader POS ecosystem's regulatory lift. Square has rolled out a new Bitcoin payment option that lets merchants accept crypto directly through its platform. The move positions Square alongside other fintech players expanding their crypto services and could push more small business owners into the ecosystem, adding fresh demand for BTC as a settlement currency. In the broader market, the announcement is seen as bullish for Bitcoin, with traders noting that increased merchant adoption often translates into higher price support. Meanwhile, Solana continues to show strong developer activity, indicating resilience in its ecosystem and keeping investor sentiment positive despite recent network hiccups. For listeners, this dual update underscores how institutional fintech moves and on-chain developer momentum can jointly influence market dynamics, highlighting a trend where traditional payment infrastructure increasingly embraces digital assets, while blockchain projects maintain robust community engagement. China has accused a U.S. government agency of seizing roughly 127 bitcoins from the Liu Bian mining pool back in 2020, sparking fresh geopolitical friction over digital asset control. The claim centers on an alleged confiscation that would have wiped out a sizable portion of the pool's holdings, though no independent audit has confirmed the loss. Market reaction so far is muted. Crypto traders largely ignore the story, as it sits amid broader U.S.-China regulatory standoffs. Still, the narrative feeds existing FUD around cross-border seizure risks for large mining operations, and could prompt tighter compliance checks by pools operating in contested jurisdictions. For listeners, this underscores that even high-value digital assets can become pawns in international power plays, reminding stakeholders to stay vigilant about jurisdictional exposure when managing or transferring crypto holdings. Uniswap's native token UNI has become the top performer among the world's largest 30 cryptocurrencies, posting a 20% surge in the past day and trading above $8.50. The rally followed the launch of the UNification governance proposal from Uniswap Labs and the Uniswap Foundation, which would activate a burn mechanism that consumes protocol fees and directly destroys 100 million UNI held in the treasury. If approved, The move could shift fee revenue from liquidity providers to the protocol's treasury or token holders, tightening supply and potentially supporting price. The market reaction has been strongly bullish, with FOMO-driven buying pushing UNI past its recent monthly high of $10.20 before a retracement began. Technical indicators, RSI at 73 and positive MACD lines, still signal overbought conditions but hint at a possible pullback to around $7.20 for efficiency, while a deeper dip could force support near $6.60. Should the bullish bias resume, traders expect UNI to reclaim its Monday high within hours or days. For listeners, this development underscores how governance-driven supply dynamics can spark rapid price action in DeFi tokens, and highlights the importance of monitoring both on-chain metrics and market sentiment when assessing short-term movements. Ripple's XRP ledger has just hit a new milestone by unlocking smart contract functionality, a move that has stirred debate over the platform's next development phase. A RippleX engineer stepped into the spotlight to address widespread misconceptions, clarifying how the new capability fits into XRPL's broader roadmap and what it means for developers and users alike. The announcement has injected bullish sentiment among the community, with many pointing out the potential for increased DApp activity and cross-border payment integrations. At the same time, some traders remain cautious, noting that early adoption will hinge on how quickly third-party solutions can leverage the feature. For listeners following XRPL's trajectory, this update signals a tangible step toward broader decentralization, while underscoring the importance of distinguishing hype from genuine technical progress. Brazil's Bitcoin exchanges are facing a new legal showdown as Federal Deputy Rodrigo Valadares, UNIOSC, has tabled a Proyecto de Decreto Legislativo to halt the central bank's latest regulatory moves on crypto firms. The bill targets resolutions 519, 520, and 521 of November 10, 2025, which reclassify foreign currency-backed digital assets, stablecoins, as part of the country's exchange market. Valadares argues that the central bank overstepped its mandate by equating stablecoins with foreign currency, a step not authorized under Brazil's 2022 crypto law, and one that would expose traders to additional taxes like IOF exchange fees. The proposed suspension could slow the rollout of these rules, creating uncertainty for fintechs, exchanges, and users who might be pushed toward unregulated overseas platforms. While the move is framed as a call for legislative debate rather than outright opposition to regulation, market sentiment has tilted bearish. Investors worry that the standoff may delay clarity on compliance costs and operational requirements, potentially dampening crypto activity in Brazil's growing but still fragile ecosystem. Uniswap's native token UNI has entered a new phase of supply control after the protocol's governance team approved a sweeping burning program. The proposal will permanently remove a sizable portion of circulating UNI, targeting an estimated burn volume that could shave off several million tokens from the market over the coming months. Early calculations suggest the burn could reduce total supply by roughly 15–20%, tightening liquidity and potentially raising per-token scarcity. The announcement has sparked a mix of bullish chatter and cautious FUD among traders. Some analysts point to reduced dilution as a catalyst for price support, while others warn that the immediate impact may be muted if market sentiment remains indecisive or if competing protocols continue to innovate. The burn also signals Uniswap's commitment to long-term token economics, which could bolster confidence in the platform's governance model. For listeners tracking DeFi dynamics, this move underscores a broader industry trend toward deflationary mechanisms as projects seek to align incentives between liquidity providers and protocol holders. While the exact price reaction remains uncertain, UNI's burning initiative is likely to be watched closely for its potential to reshape supply-demand fundamentals in the coming quarter. The U.S. Treasury's new Genius Act is the headline driver of this story. In a recent address, former President Donald Trump reiterated his pledge to overhaul America's antiquated payments infrastructure without deploying a central bank digital currency. He framed stablecoins as a shield for the dollar and highlighted how the bill could boost demand for U.S. Treasuries, lower borrowing costs, and cement the dollar's reserve currency status. Market chatter is mixed. Some traders view the legislation as bullish for crypto-enabled settlement rails, while others warn that the rollout hinges on pending rulemaking and bank acquirer adoption, keeping sentiment cautiously optimistic. For listeners, this means a potential shift toward a multi-rail payment stack where stablecoins handle back-end settlements. But the transition will likely unfold over several years rather than a single flag day. So keep an eye on regulatory milestones through 2026 before expecting widespread retail impact. Bitcoin remains the headline asset in this update. The Internal Revenue Service has clarified that transferring Bitcoin as a gift does not trigger an immediate tax event for the donor, but it still falls under specific IRS rules that can affect future liabilities. While the gift itself is exempt from capital gains at the moment of transfer, the recipient inherits the original cost basis and holding period, meaning any subsequent sale will be taxed based on the donor's original purchase price. This regulatory nuance keeps market sentiment cautiously bullish. Investors see an opportunity to structure holdings without immediate tax drag, yet they must avoid inadvertent compliance pitfalls that could spark future audits or penalties. For traders and holders navigating 2025's tax landscape, staying compliant means documenting every gift transaction accurately, reporting the inherited basis on Form 8949, and monitoring any changes in IRS guidance that might shift the treatment of crypto gifts. Transact, the fintech bridge that links fiat to crypto wallets, has just secured regulatory clearance in 5 additional U.S. states: California, New York, Texas, Illinois, and Ohio. The expansion means the company can now offer its stable coin payment platform under full state oversight, tightening compliance for users who convert dollars into digital assets. Market observers see the move as a bullish sign for regulated crypto adoption. It expands the user base that can safely transact through Transact's API while potentially easing friction for institutional partners. The announcement comes amid growing pressure on U.S. exchanges to tighten KYC and AML protocols. So Transact's broadened license set positions it as a preferred gateway for compliant fiat to crypto flows. Listeners, this development signals that stablecoin infrastructure is gaining traction across key jurisdictions, reinforcing the trend toward mainstream, regulated crypto payments. Threshold Network has rolled out a suite of upgrades that make minting and redeeming its TBTC token faster, cheaper, and entirely gasless across major chains. The protocol now lets users move Bitcoin to Ethereum, Layer 2s, and non-EVM networks with a single transaction, eliminating the usual bridging fees and approvals. This streamlining is aimed at institutional treasuries that want to deploy BTC liquidity in DeFi without relying on custodians or incurring high gas costs. The update comes amid a surge of institutional Bitcoin holdings, over $400 billion in corporate reserves, and nearly 170 listed companies holding more than 1 million BTC, fueled by U.S. spot ETF approvals. By offering a permissionless 51 of 100 threshold signer model, TBTC positions itself as the most secure bridge for large-scale capital flow into DeFi. Market sentiment leans bullish for TBTC's utility. The new features reduce friction and operational overhead, potentially accelerating institutional adoption. Listeners should note that while the upgrades improve on-chain access, they do not alter BTC's underlying value or introduce new risks beyond standard protocol exposure. Bullzilla $BZIL has launched a high-stakes presale that is already stirring the market. The project's launch event ties token price to every $100 K raised and a 48-hour countdown, creating a built-in scarcity engine that rewards quick action and penalizes hesitation. As XRP headlines swirl around potential ETF approval and Monero posts a privacy-driven breakout, Bullzilla's structured roadmap, 24-chapter burns, live staking incentives, and a referral bonus system offers traders a clear milestone schedule to chase. The sentiment is decidedly bullish. Investors are drawn by the tangible scarcity mechanics and the promise of early price hikes, generating FOMO among those looking for next-wave projects that blend narrative with measurable supply cuts. For listeners, this presale represents a timely opportunity to engage in a project that pairs storytelling with concrete scarcity triggers, aligning with the current market appetite for projects that deliver visible progress on a set timeline. Lido DAO has unveiled a new automated buyback strategy for its native LDO token, aiming to strengthen the protocol's financial footing and market stance. The plan will trigger systematic repurchases when market conditions favor LDO, using liquidity pool reserves and on-chain signals to time purchases efficiently. Early indications suggest the move could help smooth price volatility, potentially cushioning LDO against sharp sell-offs while supporting long-term supply management. Market chatter is cautiously bullish. Participants see a disciplined buyback as a signal of confidence in Lido's governance model, yet some users are wary of added centralization risks if large holders drive the mechanism. The initiative comes amid broader DAO efforts to embed automated treasury functions, offering listeners insight into how decentralized projects are evolving their economic engines for resilience and stakeholder alignment. Ripple's flagship token XRP retreated on November 11 after a brief rally that had been building toward the anticipated approval of exchange-traded funds, ETFs. The dip came as traders paused, waiting for confirmation from regulators and market makers before committing further capital to the asset. Market sentiment skewed cautious. The pullback injected a touch of bearishness into an otherwise bullish narrative around XRP's potential institutional adoption. Investors, wary of a possible regulatory setback or delayed ETF launch, tightened their positions, amplifying FUD in the short term. However, the broader context remains that XRP's price movement is largely tied to the evolving ETF landscape, an environment where any sign of approval could reignite FOMO and lift the token back into upward momentum. For listeners, this pause underscores how regulatory milestones can temporarily stall even strong technical trends. The character brand Nobody Sausage is pushing its Nobody token into mainstream social media audiences by leveraging its massive TikTok, X, and Instagram followings. The strategy centers on making crypto invisible, meaning the team is embedding the token's utility into viral content and short-form videos, so that fans can acquire or stake tokens without navigating traditional exchanges. Early engagement metrics show a spike in Nobody wallet creations and an uptick in on-chain activity, suggesting a bullish micro moment driven by FOMO among its youthful base. However, analysts caution that the hype is largely platform-driven. If the content loses traction, token demand could stall, creating bearish pressure. For listeners, this move illustrates how meme brands are now orchestrating direct fan-to-token flows, bypassing conventional onboarding and potentially reshaping liquidity dynamics for niche altcoins in the Web3 ecosystem. Bitcoin remains the headline of 2025's crypto landscape, riding a wave of institutional support that has kept its price above $100 despite market swings. The surge is largely driven by the rollout of U.S. spot Bitcoin ETFs, which have attracted fresh capital and reinforced confidence in BTC as a store of value. Market sentiment stays bullish for the digital gold, with FOMO keeping inflows steady, while occasional corrections trigger short-term bearish patches that are quickly absorbed. For listeners, This means Bitcoin's resilience is now underpinned by regulated products rather than speculative hype, signaling a maturation phase where institutional adoption and regulatory clarity are the new drivers of price momentum. Bitcoin remains the headline of today's market slide, with its price slipping 1% to $105,168 after a broader downturn that saw the crypto cap tumble by 1% to $363 trillion. The dip is driven by a wave of declines across the top 100 coins. 77 are down, and 9 of the top 10 have lost ground in the last 24 hours. Ethereum follows suit at $3,558, dropping 13%, while Binance Coin records the sharpest drop at 27%. Trading volume stays hefty at roughly $199 billion. Market sentiment is cautiously bearish. Investors are wary as Bitcoin's circulating supply edges toward 95% of its hard cap, tightening the supply side. The backdrop includes a fresh U.S. Senate bill reopening the government, which has lifted optimism for regulatory clarity and potential ETF approvals, signals that could eventually bring more institutional capital into play. For listeners, the takeaway is clear. Crypto's recent pullback reflects both macro market pressure and evolving regulatory dynamics, setting the stage for a possible rebound if liquidity and sentiment recover. Rise, a high-performance Ethereum Layer 2 focused on programmable markets, has announced the acquisition of BSX Labs, the team behind the Base Network Perpetuals exchange BSX. The deal brings over $15 billion in cumulative order book trading volume and a proven hybrid engine into Rise's ecosystem, enabling the rapid rollout of synchronous, composable spot and perp order books on its platform. This move is bullish for the on-chain market, as it positions Rise to deliver CEX-grade liquidity and speed while opening bridges to traditional finance, attracting both retail brokers and institutional issuers. The integration will also trigger a one-week sunset of the BSX DEX, with users advised to close positions before November 11th at 15:00 UTC. Holders of the BSX token will receive an airdrop from Rise's upcoming native token, allocating 15% of its supply. For listeners, this development signals a consolidation trend in decentralized trading infrastructure, and a push toward fully on-chain order books that could redefine execution quality across DeFi and legacy markets. Zcash, ZEC, has found itself in the crosshairs of former U.S. Treasury advisor and crypto commentator Arthur Hayes after a recent price surge that pushed the coin to a $744 peak, its highest level since January 2018. Hayes publicly criticized the move, labeling it a trade rather than genuine market demand, and urged caution amid what he described as an overinflated hype cycle. The backlash has sparked a noticeable pullback in ZEC's price, with traders re-evaluating their positions after weeks of bullish momentum. Market sentiment is turning cautious. Liquidity providers are tightening spreads, and institutional investors appear to be reassessing risk exposure in the privacy coin space. For listeners tracking Zcash's trajectory, this episode underscores how high-profile commentary can quickly shift market dynamics, reminding everyone that even a brief spike can be followed by a swift correction when sentiment pivots from FOMO to FUD. Grayscale has expanded its Solana exposure by adding options trading to its newly launched GSOL ETF, a regulated vehicle that bundles on-chain staking rewards with traditional market access. The move gives investors a way to hedge or speculate on Solana's price action without holding the native token directly, potentially lowering friction for institutional players wary of custody and compliance hurdles. Early data suggests the announcement has injected mild bullish sentiment into the Solana ecosystem, as traders now see more structured ways to bet on volatility while still reaping staking yield, an attractive combo that could mitigate some of the FOMO-driven dumps seen in the past. For listeners following the crypto market, This development underscores a broader trend. Fund houses are increasingly offering derivative products tied to high-growth chains, signaling confidence in Solana's infrastructure and its ability to support sophisticated investment strategies. XRP has ignited a sharp on-chain rally that's catching traders' eyes. Over the past 24 hours, transaction volume and wallet activity spiked by roughly fivefold, suggesting renewed institutional interest or a coordinated move from large holders. The surge injected bullish momentum into the token's price chart, lifting it toward recent highs and sparking FOMO among retail participants who see an opportunity for short-term gains. Market sentiment is mixed. Some analysts point to the volume spike as a sign of healthy liquidity, while others caution that such rapid inflows can trigger volatility or a pullback if the underlying fundamentals remain unchanged. For listeners watching the market, this development underscores the importance of monitoring on-chain metrics alongside price action, as they often foreshadow short-term directional shifts in the crypto landscape. In the fast-moving world of crypto betting, a new roundup has surfaced spotlighting the top 17 instant withdrawal platforms for 2025. These venues claim to deliver lightning-quick payouts, generous sign-up bonuses, and streamlined financial flows that appeal to both seasoned traders and casual gamblers alike. The listing signals a broader industry push toward frictionless user experience, as operators scramble to differentiate themselves in an increasingly crowded market. For listeners, the headline underscores a bullish trend. More providers are investing in instant liquidity infrastructure, which could dampen volatility in withdrawal times and attract higher volume players. However, the rapid rollout also fuels FOMO among users eager to exploit new bonus offers, while regulators watch for potential money laundering risks associated with fast crypto transfers. Overall, the surge of instant withdrawal casinos reflects both a market demand for speed and an ongoing debate over security versus convenience in the evolving crypto gaming ecosystem. Ethereum faces a new recovery proposal after years of lost wallet incidents. The Locked Ether Collective, LEC, a group of users hit by the 2017 parity wallet freeze that immobilized over 500,000 ETH, has drafted an Ethereum Fund Recovery Protocol, EFRP. This smart contract-based framework would let legitimate owners reclaim inaccessible funds without hard forks or core protocol changes, governed by a technical council DAO to ensure fairness and accountability. Market chatter is mixed. Some traders see the EFRP as a bullish sign of community resilience, while others worry it could introduce FUD around governance risks. Contextually, Ethereum has endured multiple security gaps, from SCLF-DSTRUCT misuse to upgrade bugs, leaving thousands without access to their assets. The LEC's call for a structured, decentralized recovery mechanism highlights ongoing concerns over early safety standards and the need for robust, user-centric solutions in the crypto ecosystem. Binance, the world's largest crypto exchange, has upgraded its crypto analysis bot on Telegram to include AI-powered market insights and expanded language support to 9 languages, including Portuguese. The bot now delivers real-time data for over 300 tokens, covering price feeds, sentiment, ETF flows, sector trends, technical charts, perpetual futures metrics, DEX activity, and Web3 events, all in a single interface. Users can also pull the Fear and Greed Index, funding rates, open interest, and upcoming listings or airdrops at no cost. The update signals Binance's push to streamline decision-making for traders amid heightened volatility. By automating technical analysis, highlighting short-term negative momentum via MACD, potential upside when RSI approaches oversold levels, and Bollinger Band lows, the bot offers a data-driven counterpoint to market FUD. For listeners navigating the fast-paced crypto scene, this tool represents an efficient way to stay ahead of institutional flows and macroeconomic shifts without leaving Telegram. In 2025, the crypto arena shifted from hype to real utility, spotlighting 8 projects that delivered tangible on-chain value instead of fleeting buzz. These coins, ranging from Layer 1 infrastructures bolstering decentralized finance protocols to niche tokens powering emerging NFT ecosystems, showed sustained adoption metrics and active developer communities. Market sentiment skewed bullish for the majority. Investors noted growing confidence as transaction volumes rose and network effects strengthened, while a few lagging projects faced bearish pressure amid stagnant user growth. For listeners, the takeaway is clear. 2025 reinforced that longevity in crypto hinges on functional utility and ecosystem integration, not just marketing hype, an insight crucial for anyone tracking long-term asset performance. Shiba Inu's core team has issued a definitive statement to quell growing chatter that the project might be winding down. In a concise announcement, the developers clarified that SHIB remains fully operational and under active development, dismissing rumors of an impending shutdown. The clarification came amid a broader market pause where many altcoins saw muted activity. However, Shiba Inu's price slipped roughly 4% in the last 24 hours following the initial speculation. Market sentiment skews bearish as traders digest the FUD surrounding the token's future, but the team's reassurance injects a modicum of confidence that could temper panic selling. For listeners tracking SHIB's trajectory, this update underscores the importance of distinguishing between genuine project milestones and speculative noise, especially in an environment where hype can quickly swing price action. Spain-based Turbo Energy has announced a new tokenized debt financing model for its solar and battery projects, partnering with Taurus and the Stellar Development Foundation to issue blockchain-backed bonds on the Stellar network. The move means investors can purchase fractional stakes in renewable energy assets through digital tokens, streamlining capital flow and improving liquidity compared to traditional green bonds. Market reaction is cautiously bullish. Analysts note that tokenization could lower entry barriers for smaller investors and attract institutional interest, while skeptics point to regulatory uncertainty around debt token compliance. In the broader context, this development follows a surge of renewable projects seeking alternative funding channels amid tightening capital markets, positioning Turbo Energy as an early mover in the green finance space, and potentially setting a precedent for other utilities looking to leverage Stellar's low-cost settlement layer. Binance's co-founder Changpeng Zhao has stepped into the spotlight after a fraudulent autobiography surfaced on an online marketplace. The book, marketed as a personal memoir of the cryptocurrency giant's founder, is actually an AI-generated fabrication that purports to reveal insider insights and future plans for Binance. CZ publicly denounced the scam, urging users to verify authenticity before purchasing or sharing any such material. The incident injects a wave of FUD into the crypto ecosystem, as traders and collectors question the reliability of digital content linked to high-profile projects. While Binance's market position remains robust, the episode underscores the growing threat of AI-driven misinformation that can erode trust in established brands. Investors are advised to stay vigilant, especially when encountering unexpected, exclusive releases tied to major exchanges. For listeners following the broader crypto landscape, this serves as a reminder that even industry leaders are not immune to sophisticated phishing and deepfake tactics. As digital assets continue to attract scrutiny from both regulators and users, the community must maintain rigorous due diligence, particularly in an era where AI can convincingly mimic personal narratives. Dogecoin has rebounded from a recent sharp pullback, with price hovering near $0.18 after snapping back off its weekly 200 EMA at roughly $0.16. The move has kept the coin inside its year-long upward tilting channel and preserved higher lows, signaling that the downtrend may be paused rather than broken. Analysts point to a critical pivot at $0.0202 on 3-day closes. If Doge can reclaim that level while Bitcoin stays above $106,800, bullish momentum could resume. For now, the market remains range-bound, with buyers anchoring support near $0.14 and sellers pushing back toward resistance around $0.24 to $0.30. The stance is cautiously optimistic. FOMO is muted until the key $0.0202 test clears, after which a surge in demand could follow. Libra, the Argentine memecoin that promised a new era of crypto fiat integration, has hit a major legal snag. A federal judge in Buenos Aires ordered the seizure of funds linked to the project, citing evidence that roughly $500 was routed through BitGet into President Javier Milei's accounts, a move prosecutors say amounts to bribery and political abuse. The freeze follows claims that investors lost more than $100 million as Libra's price collapsed after a coordinated sell-off by its promoters. The ruling has rattled sentiment across Latin American markets, injecting sharp FUD into the region's crypto space. Traders are wary of similar regulatory crackdowns, while some view the case as a cautionary tale about hype-driven tokens that lack robust governance. For investors, the story underscores the risks of projects tied to high-profile political figures and highlights how quickly a once bullish asset can turn bearish when legal scrutiny intensifies. The assets remain frozen until the judicial process concludes or all illicit proceeds are recovered, leaving Libra's future uncertain and setting a precedent for Argentina's approach to crypto fraud. Bakkt Holdings has pushed its quarterly top line higher, reporting third-quarter revenue of $402.2 million, up 27% year-over-year, as it completes a sweeping corporate overhaul and finalizes the sale of its loyalty arm in early October. The deal cleared the company's balance sheet, leaving Bakkt debt-free with $64.4 million in cash on hand. For market watchers, the numbers signal a strengthening foothold for one of the largest digital asset infrastructure players amid a broader shift toward institutional adoption. While the revenue lift injects bullish momentum into Bakkt's valuation narrative, investors will be watching how the newly freed capital is deployed, whether to deepen product offerings or to weather regulatory headwinds that could dampen sentiment. In the wider crypto ecosystem, this move underscores the sector's growing focus on operational efficiency and financial resilience as it scales toward mainstream acceptance. Ripple's flagship token XRP is currently trading around $2.45, roughly a third below its July peak, and dropping an additional 15% this month, sending many charts into a bearish spiral. The slide has been largely attributed to regulatory delays linked to the U.S. government shutdown, which stalled decisions on several spot ETF filings for the asset. Despite the gloom, institutional interest is quietly building. Large wallets have added roughly $600 million in XRP, and long-term holders have increased their positions by 8% since August. If the SEC clears an ETF this month, several funds have already triggered a 20-day automatic approval window under Section 8A. The market could experience a significant liquidity injection. Analysts point to Ripple's recent $4 billion expansion into traditional finance, including acquisitions of Hidden Road and G-Treasury, as evidence that the company is positioning itself for broader institutional adoption. For listeners, this means XRP's current downside may be setting up a potential rebound. Once an ETF launches, the influx of U.S. capital could push the price past $5, mirroring Bitcoin's post-ETF surge, and potentially double again by 2026 if the momentum continues. The sentiment is a mix of FOMO around the upcoming ETF and cautious bearishness due to recent regulatory setbacks, an environment where institutional players are quietly loading in while retail traders watch closely. SharpLink has confirmed a sizable boost to its Ethereum strategy, with a reported reward haul of 767 ETH from staking operations. The digital asset platform, known for its focus on DeFi infrastructure and cross-chain solutions, has reiterated that it remains bullish on Ethereum's long-term viability, citing the recent payout as evidence of the protocol's continued profitability for stakers. The influx of over 7,000 Ether adds fresh liquidity to Sharplink's treasury, reinforcing its position in a market where staking yields are under constant scrutiny. While some investors view high rewards as a sign of healthy network activity, others caution that such payouts could also signal a temporary surge rather than sustainable growth. Overall sentiment leans toward cautious optimism. The reward underscores Ethereum's resilience amid volatile altcoin cycles, but it does not eliminate underlying FUD around potential regulatory shifts or competition from other proof-of-stake chains. For listeners tracking crypto momentum, this development highlights how institutional players are leveraging staking to generate passive income while maintaining exposure to Ethereum's ecosystem. It also serves as a reminder that reward fluctuations can influence market perception, boosting confidence when yields rise, yet prompting scrutiny if payouts appear unsustainably high or inconsistent with broader network performance. Polymarket, the on-chain prediction market platform, has inked a partnership with PrizePicks, a fantasy sports app that is poised to relaunch in the United States. The deal will allow PrizePicks to launch CFTC-approved derivatives contracts by leveraging Polymarket's established infrastructure and regulatory compliance. This move signals a shift toward more regulated, exchange-backed betting products within the crypto space, potentially broadening the user base for both firms. Market sentiment is cautiously bullish. Investors see an opportunity to tap into the growing sports betting market while satisfying U.S. regulators, but they also note that the partnership hinges on future approval from the CFTC and other oversight bodies. For listeners, this development underscores how crypto platforms are increasingly seeking legitimate pathways to expand their offerings beyond speculative trading, blending traditional sports wagering with blockchain-based derivatives in a regulated framework. Standard Chartered has launched a stablecoin pilot in Singapore by partnering with DCS Card Center to roll out Decard, a credit card that lets users spend stablecoins like cash for everyday purchases. The bank will supply transaction banking and financial market services, settling both fiat and crypto, managing treasury, liquidity, and FX hedging, to support the card's user base in Singapore's advanced regulatory sandbox. This move comes as MAS expands licenses for digital asset firms, signaling a supportive environment for stablecoin payments. Market sentiment skews bullish on the initiative. The pilot could accelerate mainstream adoption of stablecoins, reduce friction between TradFi and DeFi, and enhance payment efficiency across the region. For listeners, this partnership illustrates how traditional banks are actively bridging conventional banking infrastructure with emerging digital asset ecosystems, potentially setting a new standard for everyday crypto spending. Bitcoin faces new regulatory pressure as two major German political parties move to scrap a tax exemption that has allowed holders to keep their gains untaxed for up to a year. The proposed change would treat all crypto-related income like traditional capital gains, forcing investors to report and pay taxes on every sale or transfer. Market reaction is already showing signs of caution. Traders are tightening risk parameters, and some institutional portfolios are re-evaluating exposure in Germany's largest economy. In the broader context, this shift could ripple across EU member states that have adopted similar tax-friendly frameworks for digital assets, potentially accelerating a wave of tighter scrutiny across Europe. For investors, the key takeaway is that the regulatory environment around crypto is tightening. Compliance costs may rise and short-term liquidity could be affected as firms adjust to the new reporting requirements. Bitcoin at the center of a high-stakes drama that has rattled markets and regulators alike. In late 2020, roughly 127.0 BTC were swept from wallets linked to China's Liu Bian mining pool over 2 hours, exploiting a weak MT19,937 seed that reduced the key space to just 32 bits. The drain was traced by independent forensics teams, Arkham, Milksad, and Blockscope, to coordinated withdrawals across hundreds of addresses, with a distinctive fixed-fee pattern confirming the attack vector. The coins sat largely dormant until U.S. authorities seized them in 2024-25, filing forfeiture actions tied to alleged fraud and money laundering involving Chen Zhai. Chinese officials have accused the United States of orchestrating the original hack, but independent blockchain analysis finds no evidence of a state actor. Instead, it points to a criminal entity exploiting the weak key flaw and later handing assets over to law enforcement. This saga has injected palpable FUD into crypto sentiment. Traders are wary that similar vulnerabilities could surface in other mining pools or wallet providers, while regulators emphasize the need for robust seed entropy. The broader market remains cautious. Bitcoin's price has hovered near resistance levels since the incident, with investors scrutinizing security practices more closely than ever. For listeners, this episode underscores how technical oversights can trigger geopolitical fallout and regulatory crackdowns, reminding all stakeholders that even a single weak link can ripple through the entire ecosystem. FET, the token behind the Fetch AI platform, has surged ahead of its peers in a market that's finally finding footing after a prolonged slump. Yesterday, FET jumped nearly 15%, outpacing other AI-focused coins and pushing close to the $0.50 mark, a level many traders had flagged as a key psychological support. The rally comes amid broader index gains, suggesting that investors are gradually re-engaging with niche projects once the market's volatility has eased. The price action signals a bullish tilt for FET. Momentum is building, on-chain activity is up, and liquidity pools have deepened. Yet the move remains cautious. Traders are watching whether the breakout can sustain itself beyond the $0.50 threshold before pulling back into a consolidation phase. In the wider crypto scene, this uptick reinforces a narrative that AI projects are regaining credibility after a period of skepticism. But FOMO is still tempered by lingering concerns over regulatory scrutiny and competition from other machine learning platforms. For listeners tracking token performance, FET's breakout offers a case study in how niche ecosystems can ride macro recoveries when fundamentals align. The next key test will be whether the asset maintains its upward trajectory or stalls as broader market sentiment fluctuates. Pi Network's native token, Pi, has slipped back into a green zone on the monthly chart after a brief rally that pushed it close to $0.30 in late October. But the price is now hovering near $0.23, a 14% month-to-date gain. The drop follows the release of Pi Node v054, which adds improved bonus calculations, better node tracking, and bug fixes. An upgrade that has sparked cautious optimism even among previously skeptical holders. Meanwhile, the market faces potential short-term pressure. Nearly 143 million Pi coins will unlock in the next month, and exchange holdings have jumped by almost 2 million tokens to over 426 million, signaling a shift from self-custody to centralized platforms. For listeners, this means Pi is currently under a mixed sentiment. Some bullish chatter about future upside, but tangible supply dynamics suggest a possible pullback ahead. Ethereum, the flagship Layer 1 platform powering countless decentralized applications, has found itself at the center of a courtroom drama that highlighted how complex blockchain mechanics can trip up traditional legal frameworks. In a recent mistrial, a jury was unable to reach a verdict on a case involving smart contract disputes, because jurors lacked sufficient background on how Ethereum's consensus rules and transaction validation actually work. The judge cited this gap as the reason for declaring a mistrial, underscoring that even seasoned legal professionals can struggle with the intricacies of distributed ledger technology. The incident has injected a wave of FUD into the broader DeFi ecosystem. Traders are bracing for potential regulatory scrutiny that could tighten oversight on smart contract litigation and force platforms to provide clearer disclosures. While the market reaction has been predominantly bearish, with ETH trading sideways amid uncertainty, some analysts point out that the event also signals a maturation of legal standards around crypto assets, an eventual boost once frameworks solidify. For listeners, this serves as a reminder that blockchain's technical depth can ripple into real-world consequences. As regulators and courts grapple with how to apply existing laws to code-based agreements, investors should monitor upcoming policy developments. The current climate suggests caution. Until judicial processes adapt to the nuances of DeFi, volatility may persist while the industry pushes for clearer legal definitions and better juror education. FUN token, $Fun, has ignited a new wave of speculation after unveiling a $5 million giveaway that will distribute tokens to holders and newcomers alike. The move was orchestrated by the project's core team, who positioned the airdrop as a reward for early adopters while simultaneously creating fresh demand from potential buyers eager to claim free coins. Early trading data shows an immediate spike in volume, with $Fun settling above its 24-hour high shortly after the announcement, signaling strong bullish sentiment and a surge of FOMO among traders. Market watchers note that the giveaway's limited supply, only a fraction of the total circulating tokens, could tighten liquidity, amplifying price swings if the influx of new holders turns into selling pressure once the initial hype fades. For listeners following the crypto landscape, this episode underscores how strategic incentive campaigns can quickly reshape market dynamics, turning scarcity into an opportunity for rapid upside while also raising caution about potential short-term volatility as the airdrop cycle completes. In 2025, a new wave of crypto lottery platforms has surged into the spotlight, with BC Game, 7-Bit Casino, and BitStars topping the list of favorites for players chasing daily jackpots and hefty bonuses. These sites have rolled out enhanced smart contract-based games that promise provably fair outcomes, while also expanding their token incentives to attract a broader audience. The influx has sparked bullish chatter among enthusiasts, who see this as another avenue for on-chain gambling diversification. Yet regulators remain cautious, raising concerns about AML compliance and player protection. For listeners, the key takeaway is that the lottery niche is maturing, offering more transparent mechanics and larger rewards, but it also brings heightened scrutiny and the need to verify each platform's licensing status before diving in. Bitcoin faces a new frontier of risk as leading on-chain analyst Willy Woo unveiled a 7-year roadmap to shield the network from potential quantum computing attacks. Woo's proposal centers on incremental protocol upgrades that would harden key cryptographic primitives without compromising decentralization or speed, aiming for a seamless transition by 2030. The announcement has sparked a mixed market reaction. Many holders view it as proactive risk management, boosting confidence in Bitcoin's long-term resilience. Others warn that the effort could delay other necessary scalability work, adding short-term uncertainty. For listeners, this development underscores how quantum threats are moving from theoretical concerns to actionable planning within the ecosystem, prompting investors and developers alike to monitor upcoming consensus upgrades and the broader discourse on post-quantum security in crypto. Transact, the cross-border payment facilitator that bridges fiat and crypto wallets, has just secured 6 additional state licenses across the United States. This move lets the company launch direct fiat to stablecoin services in each of those jurisdictions, without relying on third-party intermediaries. The expansion is a clear signal that Transact is tightening its regulatory footing, potentially easing compliance headaches for both merchants and users who prefer stablecoins like USDC or DAI. Market chatter is cautiously bullish. Traders see the new licenses as a step toward broader institutional adoption of stablecoin payments, which could boost transaction volumes on Transact's platform. However, some analysts warn that state-by-state licensing still leaves gaps in federal coverage, so the rollout may face further hurdles before it fully scales. For listeners tracking crypto infrastructure, this development underscores how regulatory clarity can accelerate the integration of traditional banking flows with digital assets. It also highlights the ongoing tug-of-war between rapid fintech innovation and the layered U.S. compliance framework, an environment where every new license is a small but significant win for the ecosystem. Bitcoin has hit a sharp sell-off this week as new entrants, those who entered the market in the last 12 to 18 months, began liquidating positions after modest gains of 20% to 30%. The dip was compounded by long-time holders taking profits, amplifying downward pressure. Sentiment is decidedly bearish. The Fear and Greed Index sits at 24, signaling extreme anxiety and a muted FOMO response despite recent 14 days of growth. Analysts now see a potential rebound, projecting a 24.8% rally that could lift prices into a $106,600, $125,700 range by midweek. This scenario would restore some confidence after last year's volatility, but traders should stay cautious as the market remains highly sensitive to on-chain selling activity and macro headlines. Bitcoin has slipped below its recent highs, prompting traders to question whether the digital gold will soon test the $100 zero support line. The dip came after a sharp pullback from a brief rally that had pushed prices into the upper $60,000s, leaving the market in a cautious stance. Market sentiment skews bearish as volatility spikes, and some holders tighten risk limits, while others view the drop as a buying window amid heightened FOMO pressure. Contextually, this move follows the latest macroeconomic data and regulatory chatter that have rattled investor confidence. With liquidity tightening and institutional positions under scrutiny, the next price action will likely hinge on whether Bitcoin can regain its upward momentum or settle into a consolidation phase below the key psychological barrier. CleanSpark, one of the world's largest Bitcoin miners, has raised $115 billion through a senior convertible note to fuel expansion into AI data centers, while bolstering its mining footprint. The capital will be split between a $460 million stock buyback and investments in land, power infrastructure, AI compute capacity, and debt repayment. After the announcement, CleanSpark's shares surged roughly 13%, reflecting bullish sentiment as investors see the move as a hedge against Bitcoin volatility and a pivot toward high-performance computing demand. The deal fits a broader trend of miners diversifying into AI services, mirroring contracts between firms like IREN and Microsoft to tap growing enterprise GPU needs. For market watchers, CleanSpark's dual focus on mining and AI signals a strategic shift that could reshape revenue streams in the crypto infrastructure sector. Spot Solana ETFs have pushed through a record streak of 10 straight days of net inflows since their late October launch, pulling in roughly $342 million to date. The latest Monday saw the pair, Bitwise's BSOL and Grayscale's GSOL, collect a combined $678 million, with BSOL alone topping $59 million. This sustained demand signals growing confidence in Solana's expanding ecosystem, amid a broader environment of heavy crypto product withdrawals that last week hit $117 billion. While Bitcoin and Ethereum ETFs remained largely flat or saw modest outflows, Solana's inflows have outpaced other altcoins, fueling FOMO among institutional players. The trend underscores a bullish sentiment for Solana, suggesting that despite market volatility, the network's infrastructure upgrades, such as Alchemy's recent RPC overhaul, are resonating with investors seeking high-throughput, low-latency solutions. Bitcoin has steadied its climb after a period of volatility, nudging the market toward a fresh bullish wave, while the cloud mining firm Moonhash announces expanded services aimed at boosting investor returns. The digital gold's price slipped past key support levels last week, but recently pulled back, trading above the 200-day moving average and signaling renewed buying pressure. This rebound feeds sentiment that the broader crypto cycle is turning green again, sparking FOMO among traders who had been on the sidelines. Moonhash, positioning itself as a reliable cloud mining platform, now leverages advanced cloud computing infrastructure to offer more efficient hashing power for users. The move comes amid growing demand for low-cost, scalable mining solutions as energy costs and hardware shortages weigh on traditional rigs. By streamlining access to hash rate and reducing upfront capital outlays, the company aims to attract both retail investors and institutional participants looking to diversify their crypto exposure without owning physical equipment. For listeners watching the market, Bitcoin's rebound and Moonhash's expansion suggest that infrastructure innovation is dovetailing with price momentum. The combination of a healthier price trajectory for BTC and new cloud mining options could signal a more resilient ecosystem, though volatility remains on the horizon as regulators tighten scrutiny and global macro conditions evolve. Ethereum's price has slipped below its recent resistance levels, prompting traders to watch a potential test of the $3,400 support zone. The dip follows a broader market pullback that has seen major cryptos retreat from their highs, tightening the risk-reward profile for holders and speculators alike. Analysts note that while the move could signal a short-term consolidation, the depth of the decline may also trigger further selling pressure if the $3,400 floor fails to hold. Market sentiment is mixed. Some participants view the drop as an opportunity to re-enter at lower valuations, whereas others warn of increased volatility and FUD surrounding regulatory scrutiny and network upgrades. For listeners, this development underscores the importance of monitoring key technical levels on Ethereum's chart, particularly the $3,400 zone, as it could dictate short-term direction and influence broader market dynamics across the crypto ecosystem. Bitcoin has become the headline of today's market buzz after author Robert Kiyosaki, best known for Rich Dad Poor Dad, pushed a bullish stance on BTC, gold, and silver. In a recent X post, he confirmed he is buying, not selling, projecting Bitcoin to hit $250 by 2026, while calling gold $27 and silver $100. Kiyosaki cited macro strategist Jim Rickards and Fundstrat's Tom Lee, framing the move as a hedge against an impending fake money collapse that would push investors into hard assets under Gresham's law. The announcement has injected FOMO-driven optimism among traders. Bitcoin's technical picture is equally supportive. The coin sits in a rising wedge near $104,700 with its 20 EMA above the 200 EMA, suggesting solid support around $104. Zero and potential breakout targets at $107,500, $110,500 and $113,500 if buyers hold the trend line. A dip below $104 could trigger a short-term pullback to $101,400, but the broader bullish bias remains as long as higher lows persist. For listeners, Kiyosaki's forecast adds another layer of confidence for those eyeing BTC and other stores of value amid soaring U.S. debt and weakening fiat credibility. The narrative that digital gold could reach six-figure levels is gaining traction, while new Layer 2 projects like Bitcoin Hyper on Solana are already raising significant capital, hinting at future scalability gains for the network. Monad's upcoming liquid staking platform A Priori, backed by a $30 million raise and slated to go live as day one on the Monad network, has been hit by an airdrop controversy. Data leaked that newly created wallets captured roughly 60% of the total supply of the $APR token, only to liquidate their holdings immediately after claiming them. The rapid dump has rattled investors, sparking bearish sentiment and widespread FUD around the project's distribution model. In the broader market context, A Priori was positioned as a key player in Monad's ecosystem, expected to drive liquidity and staking rewards. This incident undermines confidence and could delay or dampen adoption of the protocol's launch. Stakeholders are now scrutinizing the token allocation mechanics, while the community debates whether the airdrop design was intentionally exploitative or a flaw exposed by bad actors. Say, a Layer 1 blockchain built for high-frequency trading has announced that its time to finality now eclipses Ethereum by more than 4,000 times, slashing confirmation latency to almost instant levels. The network also remains the cheapest major chain, with transaction fees staying exceptionally low while cumulative on-chain volume tops $138 billion, a clear sign of growing DeFi activity. Technical analysis shows a double bottom pattern forming around $0.13, $0.15, with a neckline near $0.38. If SAY closes above that level under strong buying pressure, the price could rally toward $0.63, $0.70, implying roughly 400% upside from today's levels. Market sentiment is leaning bullish as speed and cost advantages fuel developer interest, but traders remain cautious until key support at $0.16 holds. JP Morgan and DBS are moving beyond traditional stablecoins to explore tokenized deposits as a cross-bank payment bridge. In 2024, the Bank for International Settlements reported that at least one-third of commercial banks have begun pilot programs or are actively researching how digital tokens can represent fiat deposits on distributed ledgers. The move signals a shift toward more interoperable, low-friction settlement layers that could reduce correspondent banking costs and speed up cross-border flows. Market chatter is bullish for the tokenized deposit niche. Institutions see a clear regulatory path, while investors note that early adopters may capture first-mover advantage in a space still dominated by legacy payment networks. For listeners, this development highlights how traditional banks are embracing blockchain infrastructure to stay competitive, potentially reshaping the future of global payments and liquidity management. Bitcoin slid into its latest futures gap at the Wall Street Open, snapping a brief $104K rally that had been brewing overnight. The dip was driven by massive whale-level sell orders that surfaced just as spot traders tried to push the price back up. With liquidity draining from the top of the order book, the market retreated further into the gap zone, reinforcing a bearish bias for the day. This move has added fuel to FUD among short-term holders who are wary of another sharp pullback after last week's volatility spike. For traders watching the daily charts, the episode underscores how quickly institutional selling can override momentum, tightening the range around the gap and setting the stage for a potential consolidation before any new breakout. A shift in U.S. policy could soon ripple across the crypto market as lawmakers edge toward a deal to lift the federal shutdown. Once the government reopens, key agencies, namely the Treasury's Financial Crimes Enforcement Network, FinCEN, the Securities and Exchange Commission, SEC, and the Department of Justice, will resume full regulatory oversight of digital assets. The return of these bodies signals that enforcement will tighten on illicit activity and that compliance frameworks for exchanges and token issuers will be reapplied, potentially stifling speculative flurries while encouraging long-term institutional participation. For traders, this development injects a mix of caution and opportunity. Short-term volatility may spike as firms adjust to renewed scrutiny, yet the broader market could view the move as a sign that crypto is becoming a regulated asset class, laying groundwork for deeper integration into mainstream finance. Cardano's team has rolled out a new global crypto debit card in partnership with Wirex, positioning it as a key feature ahead of the upcoming Cardano Summit in Germany. The announcement comes even though ADA's price has slumped more than 32% year-to-date, underscoring that the project is still pushing forward on product expansion rather than waiting for market rallies. Market chatter around the card is mixed. Some traders view it as a bullish move that could broaden adoption and drive wallet activity, while others caution that the broader crypto card space remains crowded and regulatory uncertainty may dampen uptake. For listeners, this development signals Cardano's continued focus on real-world utility, offering holders an everyday payment tool, while the price volatility reminds us to keep a close eye on how new services translate into tangible demand in the near term. SoFi Bank has launched a new crypto trading feature inside its federally regulated banking app, allowing customers to buy, sell, and hold Bitcoin, Ethereum, and other tokens alongside traditional accounts. The move marks the first time a U.S. bank is offering integrated digital asset services directly within its core mobile platform. Market reaction skews bullish among users who see this as a sign that mainstream financial institutions are embracing crypto, potentially driving wider adoption. The announcement comes amid growing regulatory clarity for banks handling digital assets, and follows similar steps by other fintechs looking to capture the growing segment of customers seeking seamless fiat to crypto flows. For listeners, it signals that the line between traditional banking and crypto investing is blurring, offering a new avenue for portfolio diversification while raising questions about security, custody, and compliance standards within regulated banks. Argentina's federal court has frozen more than $507K in assets linked to the Libra meme coin, a project that surged after President Javier Milei shared a promotional selfie with its founder, Hayden Davis. The judge ordered the seizure of Davis's holdings and those of two crypto operators, Favio Rodriguez Blanco and Orlando Melino, as part of an investigation into a suspected multi-million-dollar pump and dump scheme that could have siphoned up to $120 from investors. Libra's market cap briefly hit $45 billion before collapsing 94% within hours, wiping out retail funds and sparking widespread FUD across the crypto community. The freeze signals a tightening regulatory stance in Argentina and underscores how political endorsements can amplify volatility. For traders, the move highlights the risk of meme coins tied to high-profile figures and the importance of monitoring legal developments that may trigger asset seizures or market swings. Aster token, a relatively niche asset on the crypto fringe, has hit a critical price floor as buying interest dwindles. After a brief rally that pushed it near the $1 mark, volume collapsed, stalling any further upside and leaving traders with a flat-line chart. Technical analysis points to a potential pullback. Moving averages are sloping downward, RSI hovers in neutral territory, and the 50-day EMA is now below the price level, signaling weak momentum. The market reaction has been noticeably bearish. Early adopters and day traders have pulled back, wary of a sustained decline, while social chatter reflects growing FUD around Aster's liquidity profile and recent partnership announcements that failed to deliver on expectations. In contrast, any remaining bullish voices are muted, citing the lack of volume as a key risk factor. For listeners following the broader crypto landscape, Aster's wobble is a reminder that even near $1 tokens can suffer sharp corrections when market depth evaporates. The current environment, High volatility across major coins and tightening regulatory scrutiny amplifies the impact of thin liquidity. Traders should watch for any sign of renewed volume or a break above key support before considering repositioning, as the asset remains exposed to a swift bearish turn if sentiment shifts further negative. U.S. lawmakers are pushing a bipartisan crypto market structure bill that would hand sweeping oversight of digital commodities to the Commodity Futures Trading Commission, CFTC. The draft, unveiled by Senator John Boozman and Senator Cory Booker, extends the House's Clarity Act by granting the CFTC exclusive authority over spot crypto exchanges and requiring centralized platforms to register as digital commodity exchanges with new operational standards. The proposal also tightens coordination between the CFTC and the Securities and Exchange Commission, SEC, while setting safeguards for fund segregation and disclosure. Market sentiment is mixed. Industry insiders see a bullish chance of clearer rules, citing recent optimism from Coinbase's Brian Armstrong and a 25% probability that the Clarity Act will pass this year per Polymarket traders. Yet FUD lingers over unresolved DeFi regulations, anti-money laundering gaps, and the CFTC's current staffing crisis. Only one commissioner is active, with a looming government shutdown deadline and an election year window tightening. Lawmakers must act quickly to avoid regulatory arbitrage and ensure enforcement readiness before the bill reaches the president's desk by year's end. Swiss crypto bank Signum has released its Future Finance 2025 report, revealing that a striking 61% of institutional investors plan to boost their digital asset exposure by year-end, with 38% adding positions in Q4 alone. The data signals a shift from speculative trading toward strategic diversification as institutions view crypto as a long-term portfolio component, rather than a defensive play. Market sentiment remains bullish short-term. Roughly half of respondents expect further upside driven by ETF approvals and clearer policy frameworks. However, optimism wanes beyond 2025. Analysts project a cooling in 2026 as liquidity tightens, rate cuts plateau, and regulatory progress stalls, turning sentiment toward neutral or bearish territory. The report also highlights growing institutional concentration in Bitcoin, now over 7 million BTC held by regulated wallets, and a surge in tokenized real-world assets, rising from 6% to 26% of investment interest year over year. For listeners, this underscores that while crypto's institutional foothold is deepening, the next cycle may test discipline more than exuberance, with potential headwinds from delayed U.S. ETF approvals and a prolonged government shutdown, dampening short-term momentum. Bitcoin remains the headline, with 10T Holdings founder Dan Tapiro asserting that the digital gold's fundamentals are still solid, despite a looming bear phase that could trim prices by up to 70%. Tapiro highlighted Bitcoin's capped supply, growing institutional adoption, and its role as a hedge against inflation as key pillars that keep the asset on a bullish trajectory. Yet he warned that a significant pullback is likely if market sentiment turns sharply bearish, suggesting traders should brace for volatility rather than panic. For listeners, this means keeping an eye on liquidity levels, on-chain activity and macroeconomic signals, especially interest rate moves, that could accelerate a dip. In short, Bitcoin's long-term value proposition stays intact, but the next correction may be steep, prompting cautious positioning amid the current FOMO-driven rally. Strive Capital has announced a bold move that could position it as the next major Bitcoin holder after MicroStrategy. The firm plans to pour $162 million into BTC, signaling confidence in the asset's long-term upside. Market reaction has been mixed. Bulls see this as a validation of institutional demand and anticipate a price lift, while skeptics warn that such a sizable purchase could backfire if volatility spikes, potentially dragging prices lower before the strategy takes hold. The trade comes amid a broader trend of corporate treasury managers reallocating reserves to digital assets, reflecting shifting attitudes toward inflation hedging. For listeners tracking on-chain dynamics, Strive's bet underscores how large-scale accumulation can shift market sentiment and may influence short-term liquidity conditions as the crypto ecosystem continues to mature. Matter Labs CEO has spotlighted privacy as a linchpin for institutional blockchain uptake. The firm's zk-Sync Layer 2 platform is now integrating zero-knowledge proofs to enable confidential, scalable transactions on Ethereum, positioning it as essential infrastructure for banks and asset managers seeking private settlement flows without sacrificing public liquidity. This shift comes amid a broader regulatory pivot that has eased sanctions on privacy tools like Tornado Cash, turning what was once taboo into a strategic necessity. The move signals bullish sentiment among institutional players. Fee activity on zk-Sync is surging as new tokenomics and staking models attract enterprise interest rather than retail hype. For listeners, the takeaway is clear. Privacy layers are no longer niche perks, but core components driving mainstream DeFi adoption in regulated sectors. MicroStrategy, led by Michael Saylor, is once again buying Bitcoin, this time adding 487 BTC between NAV3 and NAV9 for about $499 million, averaging $102,557 per coin. The purchase came right after a brief slide past the $100 zero floor, meaning the firm bought near a recent high rather than at a trough. Investors have mixed reactions. Some see this as buy the top risk and worry about short-term volatility, while others view it as evidence of institutional confidence that Bitcoin is a long-term store of value. In context, MicroStrategy's strategy has delivered more than $12 billion in gains year to date despite a slower buying pace, showing that even top price entries can turn profitable over time. The firm's regular disclosures continue to signal steady demand and help anchor market sentiment amid ongoing price swings. Rise, the high-performance Ethereum Layer 2 platform, has announced it will acquire BSX Labs, the team behind the Base Network Perpetuals exchange that processed more than $15 billion in trading volume since its 2023 launch. The deal brings BSX's hybrid order book expertise and a skilled engineering crew into Rise's ecosystem, enabling the company to roll out fully on-chain, EVM composable spot and perp order books at scale. Market reaction is cautiously bullish. Traders are eyeing the promise of deeper liquidity and tighter spreads, while some skeptics question whether the integration will deliver the promised speed gains. For listeners, this move signals a push toward bridging traditional finance with DeFi, potentially opening new avenues for institutional brokers, asset issuers, and retail users to access on-chain order books that rival CEX performance. Ripple's flagship token XRP has surged past $250 after a wave of ETF listings appeared on the DTCC website. With 11 new products from firms such as Bitwise, 21 shares and ProShares now registered. The announcement sparked a 12% rally in the last 24 hours, pushing the price to a fresh high of $256. Market sentiment is decidedly bullish. Traders are reacting to the prospect that a spot XRP ETF could launch this week, fueling FOMO among holders and investors looking for institutional exposure. The move comes amid broader optimism as the U.S. government shutdown nears its end, suggesting a rebound in risk-taking across asset classes. Analysts remain upbeat, with some projecting long-term targets ranging from $6 to even $30 if momentum continues. Meanwhile, a few traders caution that sideways price action could temper enthusiasm. But overall, the narrative is one of renewed confidence and potential upside for XRP as it positions itself at the center of the upcoming ETF wave. Tether has bolstered its balance sheet by hiring senior metals traders from HSBC as it ramps up a new gold reserve program. The stablecoin issuer is moving beyond its traditional fiat and crypto holdings to include physical gold, aiming to diversify assets and shore up perceived stability for users. Market chatter skews cautiously bullish. Investors see the addition of tangible collateral as a confidence-building step, while skeptics question whether the move will materially affect liquidity or pricing dynamics. Contextually, this shift comes amid heightened scrutiny over stablecoin reserves and growing demand for transparency from institutional players. By anchoring part of its backing in gold, Tether positions itself to weather volatility better than peers that rely solely on digital assets, potentially easing FUD around reserve adequacy without triggering a major market ripple. A Chinese cybersecurity agency has accused the United States of appropriating roughly $13.2 billion worth of Bitcoin that was allegedly stolen in a 2020 mining pool breach. Beijing's claim states that the U.S. seized the coins and reclassified them as proceeds from criminal activity, effectively labeling legitimate digital assets as illicit. The allegation has sparked immediate FUD among crypto holders and traders, as it questions the integrity of cross-border seizure procedures and could trigger regulatory scrutiny in both jurisdictions. Market sentiment is cautiously bearish. Institutional investors are monitoring for potential legal challenges that might force a reevaluation of seized assets status, while retail participants remain wary of possible liquidity constraints. For listeners, this development underscores the growing geopolitical friction over digital asset control and highlights how governmental actions can ripple through price dynamics and confidence in the broader crypto ecosystem. BlockDAG has pulled in more than $435 million during its presale, pricing each token at just $0.05 and leaving under 42 billion coins on the market. The project is already rallying developers with a global buildathon that offers 50 USDT in grants and an extra 5 USDT in bounties before the token even hits exchanges. This builder-first approach is generating early-stage FOMO among crypto enthusiasts, while skeptics point to the typical volatility of launch-phase assets. Compared with the more mature ecosystems of Polygon Pol and Internet Computer, ICP, BlockDAG's low entry price and compressed supply create a sharper risk-reward profile. Pol has shown steady growth but limited upside due to its already reflected valuation. ICP remains below its all-time highs, with recovery prospects tied mainly to tech adoption rather than scarcity. In contrast, BDAG's presale momentum and developer incentives suggest a potential for rapid upside once the token lists. For listeners tracking high return opportunities, BlockDAG represents a launch stage play that could outpace Pol or ICP if its ecosystem expands quickly. The market sentiment skews bullish around the presale, yet caution remains warranted given the inherent risks of early-stage projects. Crypto giants opened the session on a bearish note as the market cooled overnight. Bitcoin slipped 1% to $104,800. Ethereum followed at $3,550. Binance Coin dropped 2% to $978, and Solana fell 3% to $163. Amid the red tide, Uniswap's UNI surged 20%, powered by a bold governance package that flips the fee switch, burns an initial 100 million tokens, and rolls out further protocol tweaks. Aerodrome Aero also rallied 16%, while Zcash saw a steep 25% plunge to $474, yet remains up 16% on the week. Regulatory chatter added layers of optimism. The Treasury and IRS rolled out guidance easing ETF access to stake crypto and distribute rewards, signaling smoother institutional entry. Concurrently, the Senate released its first draft of a comprehensive crypto market structure bill, marking progress toward clearer rules. In corporate news, Jack Dorsey's Square announced Bitcoin payment support across 4 million merchants, hinting at broader merchant adoption. Conversely, Gemini's shares fell 12% after reporting a $159.5 million net loss for Q3, underscoring continued volatility in crypto-focused equities. Overall, the market feels a mix of FUD and cautious optimism. Institutional pathways are tightening while retail sentiment remains jittery, setting the stage for potential midterm upside if regulatory momentum sustains. Bitcoin's core vision has been reaffirmed by Blockstream CEO Adam Back, who highlighted that the network embodies the cypherpunk concept of bearer electronic cash. Back underscored that Bitcoin's design, decentralized, permissionless, and resistant to censorship, realizes the idea of a truly portable, trustless medium of exchange originally championed by early cryptography pioneers. This statement comes as the market watches for signals from key industry leaders. Back's remarks reinforce a bullish narrative around Bitcoin's foundational role in digital finance, suggesting continued confidence among institutional adopters. For listeners, it means that Bitcoin remains at the center of discussions about sovereign monetary sovereignty and financial privacy, positioning itself as a reliable store of value amid broader regulatory uncertainty. Threshold Network has upgraded its TBTC protocol and relaunched its website streamlining Bitcoin on-chain access for DeFi users. The update introduces a one-click minting and redemption flow that is gasless on supported chains, Ethereum, Layer 2s, and non-EVM networks, while keeping self-custody intact. Users can now move BTC to TBTC and back without extra approvals or Layer 2 signing, cutting operational overhead for institutional treasuries and simplifying onboarding for individuals. The rollout comes amid a surge in institutional Bitcoin holdings after U.S. spot ETF approvals. Corporate reserves hit $117 billion last quarter, and 172 listed firms hold over 1 million BTC collectively. TBTC's expanded integrations, Arbitrum, Base, Polygon, Sway, Starknet, Bob, Optimism, position it as the most permissionless bridge for Bitcoin liquidity into DeFi. Market sentiment leans bullish on the upgrade. Institutions seek efficient, trust-minimized pathways to deploy BTC across ecosystems, and retail users gain a friction-free gateway. The move underscores a broader trend of institutional adoption, reshaping on-chain capital flows, while maintaining decentralized integrity. Dogecoin, the original memecoin that has stayed in the top 20 for over a decade, remains dominated by institutional custodians this year. In 2025, Robinhood's custodial wallet holds a staggering 2716 billion Doge, about 18% of total supply, worth roughly $48 billion at current prices. Binance follows with 15.7 billion Doge, approximately 7%, and Upbit adds another 1056 billion, approximately 7%. These concentrations underscore the market's reliance on major exchanges for liquidity and storage, reinforcing a bullish narrative that institutional confidence can buffer volatility. Yet Doge's price has slumped nearly 76% from its all-time high of $0.73, reflecting ongoing bearish sentiment amid broader crypto corrections. The recent Fed rate cut and the resolution of the U.S. government shutdown have injected some FOMO, while pending SEC approvals for Doge ETFs could spark a rally. For listeners tracking market dynamics, the key takeaway is that large custodial holdings provide stability, but price momentum remains fragile until regulatory clarity materializes. Canton Network, a blockchain platform that recently secured $540 million in private funding and landed on several major exchanges, saw its token tumble more than 30% just days after trading opened. The sharp dip came despite the headline-grabbing listings, sparking a wave of bearish sentiment across the market. Investors reacted with caution, fearing overvaluation and potential liquidity strain once the new exchange venues went live. For traders monitoring the space, this slide serves as a reminder that even high-profile deals can trigger volatility. Early movers may need to reassess their positions amid the current uncertainty. The broader crypto ecosystem remains on edge, watching how Canton's performance will influence confidence in similar projects launching on top-tier exchanges. Silver takes center stage as India emerges as the world's second-largest silver consumer after the United States. A recent Silver Institute survey shows that nearly 70% of Indian purchases are in bars, with ETFs gaining traction, underscoring a shift toward tangible holdings. This surge comes amid U.S. market turbulence, an extended government shutdown, and expectations of Fed rate cuts that has bolstered demand for silver as a safe haven asset. Analysts note the metal is poised to establish a new base before a potential breakout, citing support levels near the 72-74 gold to silver ratio band and projections that could lift prices toward $62-64 in the next cycle. For listeners, the takeaway is clear. Silver's dual role as an industrial driver and hedge is strengthening, fueling bullish sentiment among investors who view the metal as a resilient store of value amid global economic uncertainty. Domino's Pizza has teamed up with payments firm Xmoney to launch a hybrid fiat and crypto checkout in Cyprus, marking the first rollout of the company's embedded payment stack for a global fast food brand. The partnership equips Domino's franchises with instant digital wallet support, Apple Pay, Google Pay, and opens the door to crypto payments via USDC on the Sway blockchain, aiming to cut checkout times and boost security. Market chatter is cautiously bullish. Analysts note that the move could accelerate mainstream adoption of token-backed payment flows, while skeptics warn about regulatory hurdles in cross-border consumer transactions. For listeners, this collaboration signals a broader trend of legacy retailers integrating regulated crypto infrastructure, potentially reshaping everyday commerce as blockchain tech slips into the background of routine purchases. Bitcoin is at the center of a new geopolitical spat. China's cybersecurity agency has accused the United States of secretly seizing 127.0 BTC, worth roughly $13 billion, stolen in a 2020 hack of the Liu Bian mining pool. Washington denies any illicit involvement, saying the coins were lawfully confiscated as part of a fraud and money laundering case. Blockchain analysis shows the assets began moving through U.S. tagged wallets in mid-2024, raising doubts about the timing and legality of the seizure. The dispute is already fueling FUD among traders. Any sudden transfer or court ruling could trigger sharp price swings as markets react to the uncertainty over state control. This episode underscores how digital asset disputes can quickly morph into broader power plays between superpowers, reminding listeners that crypto remains deeply intertwined with global politics and legal frameworks. Zebek Network's native token, ZBCN, has begun a modest rally after slipping to multi-week lows earlier this month. The lift came on the back of an official listing announcement on Bitvavo, Europe's largest MiCA-compliant exchange, which has immediately injected liquidity and visibility into the project. Market chatter is leaning bullish. Traders note that the new venue opens a wider European investor base and could reduce volatility once trading volume stabilizes. Analysts point out that while the current uptick is encouraging, it remains cautious to treat the move as a long-term signal until price consolidates above key support levels. For listeners following Zebek's trajectory, this development marks a potential turning point. A platform-wide listing can act as a catalyst for broader adoption, yet the token still faces the typical post-listing volatility that defines the crypto cycle. Cardano's native token ADA has rebounded sharply after sliding below $0.50 earlier this week. The price dipped to about $0.48 on November 5, before surging over 20% to roughly $0.60 by the 10th. then easing a touch lower to around $0.58 in the last 24 hours. Behind the move, large holders, wallets with 10 million ADA, have added almost 1% of the circulating supply, amassing 348 million tokens worth about $204 million. This accumulation signals renewed confidence from major investors, feeding a bullish narrative despite short-term volatility. Technical chatter notes that ADA is testing the lower edge of its trend band. Traders say a breakout above $0.70 would cement a reversal into solid upside territory. Beyond price, Q3 data show Cardano's DeFi TVL up 28.7% to $423 million and NFT volume spiking over 560%. While governance shifts toward a fully elected body reinforce its community-driven trajectory. Overall, the market is watching for a sustained rally as institutional buying mounts and network fundamentals strengthen. SoFi, the nationally chartered bank known for its fintech-first approach, has just opened a new door for retail investors: direct crypto trading within its platform. Beginning with a phased rollout, members can now buy, sell, and hold major tokens such as Bitcoin BTC, Ethereum ETH, and Solana SOL. The move signals SoFi's intent to deepen its position in the growing institutional-grade crypto space, offering users an integrated banking and digital asset experience. The announcement has sparked a mix of bullish sentiment. Traders see it as another mainstream entry point that could lift demand for the listed coins, while skeptics note the regulatory scrutiny still looming over consumer crypto offerings. The phased launch suggests caution on SoFi's part, likely testing liquidity, compliance frameworks, and user uptake before full scale. For listeners, this development underscores how traditional financial institutions are steadily blending with digital asset services, potentially reshaping how everyday investors access cryptocurrencies without leaving their familiar banking ecosystem. Whales are once again turning a dip into a buying opportunity, this time with Bitcoin and Ethereum. Within 48 hours of a sharp slide, large wallets began scooping discounted BTC and ETH, signaling a classic risk rotation cue that often precedes a rebound. The move has stoked FOMO among retail traders, who are looking beyond the majors for convex payoffs. One presale riding this wave is PEPENODA, an ERC20 token that couples live staking during its raise with a browser-based mining game post-TGE, already raising over $2 million at a price of roughly $0.114 per token. The project offers progressive tranches and a 611% APY for early stakers, an attractive yield in a market where dips are being quickly absorbed. For listeners, this illustrates how institutional accumulation can shift sentiment, pushing retail into utility-heavy presales that promise both engagement and upside, while the broader crypto landscape stays in flux. Ethereum-based Layer 2 DexLighter has secured a $68 million round that values it at $15 billion before its token generation event, marking one of 2025's biggest DeFi raises. The funding led by Founders Fund and Ribbit Capital underscores confidence in Lighter's zero-knowledge, high-speed infrastructure, which currently powers perpetual futures with record volumes. $73.8 BN over 7 days, topping rivals like Hyperliquid and Aster. As the exchange gears up to launch spot markets, it aims to undercut Uniswap's AMM model by offering a 5 ms latency order book, 0 MEV and no fees, potentially attracting high-frequency traders from centralized venues. The market buzz is bullish. Investors are eyeing the upcoming TGE, while speculation on Polymarket about Lighter's fully diluted valuation fuels FOMO among traders. With a planned Q4 airdrop allocating 25–30% of supply to community holders, the project could reshape on-chain trading standards if its performance delivers on speed and scalability promises. Threshold Network has upgraded its TBTC protocol and rebranded to streamline Bitcoin on-chain access through a direct, gasless minting process. The update removes the need for intermediate custodial steps, letting users lock BTC in a single transaction and receive wrapped tokens instantly without paying Ethereum gas fees. Market reaction skews bullish. Institutional players eye the simplification as it lowers friction for large-scale treasury exposure and aligns with the surge of regulated Bitcoin products. Analysts note that the move could accelerate on-chain liquidity and attract corporate treasuries looking for efficient BTC tokenization, while skeptics warn that any technical hiccup could trigger a temporary dip. For listeners, this development signals a tightening link between institutional demand and decentralized infrastructure, potentially boosting TBTC's role as a bridge asset in the broader crypto ecosystem. Ripple's flagship token XRP has been under scrutiny as traders eye a potential break above the $250 threshold before week-end trading closes. The latest price action shows a tight consolidation around the $230–240 range, with on-chain metrics indicating modest liquidity inflows, but no significant surge in exchange volume that would support a decisive rally. Market sentiment remains cautiously bearish. While some FOMO-driven chatter circulates on social platforms, the broader consensus points to continued resistance near the $250 mark, especially as institutional holders maintain sizable positions. For listeners tracking crypto momentum, this pause suggests a waiting game. XRP's trajectory will hinge on forthcoming regulatory developments and any upcoming partnership announcements that could inject fresh demand. Until then, traders should monitor the price corridor closely, recognizing that a breakout would likely require both technical support and a shift in market confidence. Lighter, a DeFi infrastructure startup, has closed a $68 million funding round that drew heavyweight backers, including Peter Thiel's Founders Fund and the brokerage platform Robinhood. The injection of capital underscores a sharpening corporate focus on decentralized finance, suggesting that institutional appetite for crypto-based services is gaining momentum. Market chatter is leaning bullish. Investors see this as a signal that DeFi solutions are moving closer to mainstream adoption, potentially lifting demand for Lighter's API and liquidity tools. For listeners tracking the space, this round signals that major venture players and retail broker giants are aligning behind scalable DeFi platforms, which could accelerate integration of crypto products into everyday financial workflows. Bitcoin faces a new class of threat, as on-chain analyst Willy Woo outlines how quantum computers could one day crack the elliptic curve cryptography that secures BTC. Woo's latest analysis, focused on holding Bitcoin in a SegWit wallet for roughly 7 years, explains that while current quantum hardware lacks the stable qubits needed to mount and attack future breakthroughs, particularly those employing Shor's algorithm, could expose private keys and even public addresses. The market reaction is mixed. Some traders see the warning as a reminder of long-term risk, sparking mild FUD about the eventual need for post-quantum upgrades. Others view it as a call to action rather than panic, noting that quantum-resistant solutions are already under discussion within Bitcoin's developer community. Woo presents a 3-step mitigation plan. Continuously monitor progress from leaders like IBM and Google, push for adoption of lattice or hash-based post-quantum schemes in new transactions, and coordinate a network-wide upgrade, soft or hard fork, once quantum threats become tangible. For holders, the takeaway is that Bitcoin's current security remains intact, but vigilance will be key as the quantum frontier advances. Bitcoin's momentum gets a new catalyst as Block, Jack Dorsey's payments arm, launches a Bitcoin checkout option for roughly 4 million Square merchants in the United States. The rollout began on November 10, enabling point-of-sale acceptance that can settle via the Lightning Network and offers automatic conversion between BTC and fiat at the seller's discretion. No processing fees will apply until January 2027. Afterward, a 1% fee is expected. Merchants may also auto-convert up to half of daily card sales into Bitcoin, giving small businesses an easy path to build crypto exposure. The move injects bullish sentiment among crypto adopters who see a major retail platform embracing BTC, while skeptics note that real-world uptake depends on consumer demand and the ease of checkout. Regulatory hurdles, AML checks, state restrictions, e.g. New York and Lightning routing limits, remain concerns for merchants weighing volatility and tax implications. In short, if even a fraction of those 4 million sellers activate the feature, Bitcoin could see a measurable uptick in everyday payment use, signaling broader commercial acceptance beyond speculative trading. A UK court has handed an 11-year prison term to a fraudster behind the country's largest ever Bitcoin seizure, wiping out roughly 61.0 BTC, worth about $63 billion at current prices, from his control. The forfeiture represents a significant blow to illicit crypto activity, underscoring regulators' growing resolve to clamp down on money laundering schemes that use digital assets. For market participants, the move sends a bearish tone for dark market and wash trade sentiment, reinforcing FUD around unregulated exchanges while reassuring institutional players that law enforcement is tightening its net. The case highlights how swift legal action can remove massive amounts of supply from circulation, potentially supporting price stability in the short term, as the broader ecosystem watches to see whether similar crackdowns will ripple through other jurisdictions. KuCoin has rolled out a new platform called KuCoin Institutional, aimed squarely at professional traders, institutional investors, and strategic partners. The launch introduces a 3-pillar service model: enhanced VIP products, expanded asset management tools, and upgraded compliance infrastructure to deliver ultra-low latency trading, customizable environments, and flexible collateral systems that boost capital efficiency. Key features include off-exchange settlement options, third-party custody integration, 24/7 support, and a crypto-as-a-service API for external platforms. The move signals KuCoin's intent to deepen ties with traditional finance, bolster market confidence, and position itself as a bridge between regulated institutions and the digital asset economy. Market sentiment is cautiously bullish. Investors see potential liquidity gains and regulatory alignment, while some FOMO may drive short-term interest in the new offerings. For listeners, this development underscores how major exchanges are evolving to meet institutional demands, potentially reshaping trading dynamics and capital flows within the broader crypto ecosystem. Firelight, the XRP staking platform, is set to launch its mainnet on Flare this month, expanding DeFi access for XRP holders. The move lets users keep custody of their XRP while converting it into the liquid staking token XRP, which unlocks opportunities across Flare's EVM-compatible ecosystem. With Firelight on Flare, protocols can issue tokenized insurance coverage, a feature that could boost confidence and liquidity in the network. Market sentiment skews bullish as Flare itself reports a surge in total value locked to an all-time high of about $180 million and has bridged over 50 million XRP from the XRPL. The upcoming launch dovetails with plans for smart accounts, enabling direct Flare transactions from XRPL addresses by December, further tightening the liquidity bridge between the two chains. Institutional interest is also rising. Ethereum's pending FLR ETF filing signals growing confidence in Flare's infrastructure. For listeners, this development underscores a broader trend of XRP liquidity feeding into DeFi ecosystems, potentially increasing demand for XRP and strengthening Flare's position as an interoperable Layer 1 platform. The Canary XRP ETF has crossed its last regulatory checkpoint, positioning itself to launch this week. This milestone means that the exchange-traded product, backed by Ripple's digital asset XRP, is now cleared for market debut, a first for any XRP-based fund. The move is likely to lift confidence among institutional players and signal growing mainstream acceptance of crypto assets. Market chatter has shifted from uncertainty to cautious optimism. Traders are watching closely as the ETF could inject liquidity and broaden exposure to XRP, potentially nudging prices higher. For listeners, this development underscores a pivotal moment in the evolving bridge between traditional finance and digital currencies, highlighting how regulatory green lights can accelerate adoption and reshape market dynamics. Bitcoin has slipped below $105.00 after a brief rally tied to hopes of a U.S. government shutdown resolution, signaling a shift in its risk-reward profile. Analysts note that both the Sharpe ratio and normalized risk metric are trending lower, reflecting a muted performance over the past year and dampening institutional enthusiasm. While the asset still has upside potential, experts suggest the most bullish phase of this cycle may be behind it, with volatility likely to persist into December before a possible cooling period next year. Swissblock highlights that Bitcoin is now in a consolidation stage after holding a key support zone. The next test will be the $108.00, $110.00 pivot range, which could ignite renewed bullish momentum if it holds. Concurrently, miner selling pressure has eased, with outflows dropping since late October, a pattern historically preceding accumulation phases and recovery rallies. Together, these signals paint a picture of short-term neutral to mildly bullish sentiment amid ongoing market uncertainty. Bitcoin has become the center of a geopolitical spat after China's National Computer Virus Emergency Response Center released an analysis accusing the United States of seizing 127.0 BTC, worth roughly $13.2 billion, in what it calls a state-level hack. The U.S. seized the coins in mid-October, citing ties to Chen Zhai, leader of a major Asian crime syndicate, and linked them to the mining pool Liu Bian. Chinese investigators argue that the same 127.0 BTC were stolen in 2020 from Liu Bian via a private key generation flaw known as milk SAD, and that U.S. authorities may have orchestrated or benefited from the original theft. The claim adds fresh FUD to an already volatile market, prompting traders to question the integrity of seizure procedures and raising concerns about cross-border enforcement. For listeners, this drama underscores how regulatory actions can spill over into geopolitical narratives, potentially influencing Bitcoin's short-term sentiment and long-term perception as a global asset. Today's crypto pulse centers on Bitcoin, which slid slightly after a brief rally earlier in the week, nudging its price back toward the $30.00 support zone. The dip follows a mix of regulatory chatter, particularly U.S. Treasury officials hinting at stricter AML scrutiny, and a surge in institutional selling that has pushed short interest higher. Market sentiment skews bearish as traders weigh the potential impact of tighter compliance rules on liquidity and transaction volumes. This backdrop comes amid ongoing discussions about the EU's MiCA framework, which could reshape how digital assets are classified and traded across Europe. For listeners, the key takeaway is that Bitcoin remains in a consolidation phase, with volatility likely to persist as regulators tighten their grip and institutional players recalibrate exposure. Stablecoins USDT and USDC have surged, with a fresh $11.7 billion minted in just 1 month, pushing the combined market cap over $305 billion. This rapid expansion signals growing institutional appetite for dollar-pegged assets as traders seek liquidity amid volatile spot markets. The influx has sparked mixed sentiment. Some view it as a defensive hedge that could dampen crypto volatility, while others worry that the sheer volume may pressure reserve adequacy and prompt regulatory scrutiny. For listeners, This means stablecoins are solidifying their role as the backbone of DeFi and cross-chain liquidity. But the sector must remain vigilant about transparency and compliance to maintain confidence in a market still grappling with high-profile failures. Bitcoin slipped back into red territory after a brief rally, hovering around $105.80 and falling nearly 1%. The drop follows a broader market pullback that has muted bullish sentiment across major coins, with Ethereum trailing at roughly $3,560 and Ripple under $250. Uniswap's recent proposal to introduce protocol fees sparked a near 40% surge in UNI, offering a rare bright spot amid the downturn. Meanwhile, Solana, Dogecoin, Chainlink, Cardano, Stellar, Hedera, Litecoin, Tonkin, and Polkadot all posted double-digit percentage declines, signaling widespread selling pressure. The slide comes as U.S. political developments ease. Senate approval of a funding bill to end the government shutdown has lifted broader market optimism, nudging gold up nearly 3% and temporarily supporting crypto prices. For listeners, the key takeaway is that while individual projects like UNI can rally on structural changes, the overall sentiment remains bearish, with traders cautioning against renewed FOMO after recent gains. Ethereum has seen its Binance Reserve holdings tumble by a staggering 83% in recent weeks. The drop indicates that traders are pulling out of the exchange's vaults, likely shifting funds into other venues or wallets, an early signal of accumulating demand on the broader market. Market chatter is leaning bullish. Analysts point to the rapid depletion as evidence that institutional and retail investors are building positions ahead of a potential price rally. For listeners, this move underscores how reserve balances can act as a barometer for sentiment. A sharp decline often precedes a rebound in liquidity and price action. While no guarantees exist, the current trend suggests traders are preparing for an upside play on Ethereum's next leg. XRP is poised to hit a critical milestone this week, as regulators green light the launch of the first spot exchange-traded fund dedicated to the digital asset. The ETF's approval signals that XRP can now be held in traditional brokerage accounts, potentially opening the token to a broader retail and institutional base. Market chatter has shifted from speculative hype to cautious optimism. Traders are weighing how increased liquidity could pressure the price upward, while some remain wary of regulatory scrutiny lingering around Ripple's legal battles. For listeners, this development means a tangible shift in XRP's accessibility. If the ETF performs as expected, it could normalize trading volumes and reduce volatility spikes that have historically plagued the token. The broader crypto market watches closely. Any uptick could ripple through altcoin sentiment, reinforcing bullish momentum for assets seeking institutional adoption. In Spain's latest crypto crackdown, influencer-turned-fraudster Alvaro Remillo has been detained without bail after authorities uncovered a €9 million Singapore bank account linked to his network of companies. The case centers on the Madeira Invest Club, a scheme that lured more than 30 investors with promises of up to 20% annual returns and guaranteed buybacks for luxury assets such as yachts and Ferraris. Offers now proven to be fabricated. Investigators seized dozens of high-value vehicles and other assets. Prosecutors warn Remillo could flee, potentially facing up to 18 years in prison if the crimes are deemed a mass offense. The arrest fuels growing FUD around unregulated crypto investment platforms across Europe, as regulators tighten scrutiny following several large-scale frauds. While Remillo claims he has already repaid roughly 700 victims in cash, no evidence has been presented, leaving investors wary and markets jittery. This episode underscores the heightened risk of Ponzi schemes masquerading as legitimate crypto ventures, reminding participants that due diligence is paramount amid a climate where law enforcement moves decisively against deceptive operators. Ripple's digital token XRP has stepped into the spotlight after analyst Pompeius warned that a fresh liquidity surge, driven by upcoming U.S. stimulus and massive corporate AI investment, is poised to hit global markets. He points to a planned $400 billion cash infusion, the first major round since 2021, alongside quarterly tech outlays exceeding $100 billion, as catalysts for a capital influx reminiscent of the pandemic-era boom. The narrative suggests XRP's real-time settlement network could become the preferred bridge for these rapid cross-border flows, positioning it at the heart of institutional activity. Market reaction has been mixed. Traders are watching closely, with a slight 1.4% dip in the past day, reflecting cautious FOMO against potential upside as liquidity expectations rise. For listeners, this underscores how macro policy shifts and corporate spend can reshape crypto demand dynamics, especially for assets touted as payment rails, in an era of accelerated capital movement. Domino's Pizza has teamed up with European payments platform Xmoney to roll out a new checkout system that accepts both fiat and crypto payments. The partnership will launch first in Cyprus, where Domino's franchises can now process credit cards, Apple Pay, Google Pay, and select cryptocurrencies, starting with USDC on the Sway blockchain, through an embeddable Xmoney checkout widget that keeps users on site and speeds transaction times. The move signals a broader push toward Web3-ready consumer brands. As more Domino's locations adopt the technology, the acceptance of digital assets in everyday retail will expand. Market chatter is bullish. Traders see the collaboration as proof that mainstream merchants are willing to integrate regulated crypto infrastructure, potentially boosting demand for Xmoney's native token XMN and reinforcing confidence in cross-border payment solutions. For listeners, this partnership illustrates how traditional fast food chains are experimenting with hybrid payment models to improve checkout friction and tap into a growing segment of consumers who prefer instant, low-fee digital transactions. Shiba Inu, SHIB, has slumped roughly 60% over the past year, eroding confidence among its core holders. The dip comes amid a broader market pullback that has dampened sentiment for many meme coins. Yet the community remains defiant, holding out for a rebound while analysts point to technical signals suggesting a potential upside. Recent chart action shows SHIB breaking out of a consolidation zone with bullish divergences, hinting at a possible 200% rally toward resistance levels near $0.32. Forecasts from on-chain analysts project that the token could reach highs around $0.67 by 2026, though lower bounds remain near $0.04-$0.09. In short, SHIB is in a steep correction phase but may be primed for a recovery as traders watch key technical thresholds and community sentiment evolve. Bitcoin's trajectory remains the headline driver of today's crypto chatter. Wintermute analyst Jasper Demare signals that the market has slipped into a period of consolidation, with altcoins poised for a lift once Bitcoin breaks through its current resistance. Demare stresses that sentiment is still muted, no clear bullish surge yet, and pockets of FUD linger around whether Bitcoin can hit a new all-time high before broader rallies materialize. For listeners, the takeaway is straightforward. Bitcoin's performance will dictate altcoin momentum. If BTC climbs, we'll likely see a coordinated uptick across the sector, but until that pivot occurs, the market stays on the sidelines, waiting for a decisive move. The Bank of England has released a discussion paper outlining a new regulatory framework for systemic GBP-backed stablecoins, with final rules expected later in 2026. The BOE will require issuers to back every token with high-quality liquid assets. At least 40% must sit as unremunerated deposits at the central bank, and the remaining 60% can be held in short-dated UK gilts, with a temporary window allowing up to 95% in gilts for entities scaling towards systemic status. To curb concentration risk, individual holders face a £20, £0 cap and companies a £10 million limit, while financial institutions are exempt. The Treasury will designate which stablecoins qualify as systemic in payment chains, imposing capital, liquidity, operational resilience, and recovery standards similar to those for major payment systems. Redemption at par within one business day will be mandatory. This move signals a bullish stance on London's potential as a preferred hub for institutional GBP stablecoin issuance, contrasting with the EU's MiCA rulebook and US proposals, while aiming to mitigate FUD around systemic risk. Bitcoin has settled near $104, 5K after a week of choppy swings, tightening into a tight corridor just below the critical $108K resistance level. The rally pullback pattern suggests the price is consolidating, with traders watching closely for a potential breakout that could confirm a new upward trend. Market sentiment remains cautiously bullish. Volatility has eased, but uncertainty over macroeconomic data keeps many investors on edge. For listeners monitoring the digital gold, this pause offers a clear benchmark. If BTC can breach $108K, it may signal renewed momentum and trigger further buying pressure. Failure to do so could reinforce a bearish stance or prompt a pullback into lower support zones. The next few days will be decisive as supply-demand dynamics play out around that key threshold. Ripple's flagship token XRP has stepped back into the spotlight after a leading research firm released an upbeat outlook, calling it the fastest horse in the next bull cycle. The report highlighted upcoming regulatory milestones, potential banking charter approval, the Clarity Act, and possible XRP ETFs that could cement Ripple's role in global finance. Technical analysts note that XRP recently broke out of a symmetrical triangle around $250. With support near $235 and resistance projected at $270, implying a short pullback before a new rally. Market sentiment skews bullish. Traders are firing on all cylinders as the token's price edges higher after weeks of volatility. For listeners, this signals that XRP is gaining traction amid clearer regulatory footing and could see renewed momentum if key support holds, positioning it as a top contender in the current market cycle. Ethereum dominates the latest defined narrative as stablecoin issuance on its network jumps by roughly $48 billion this year, eclipsing Tron's $15.8 billion growth. The surge is matched by U.S. regulatory momentum. The Genius Act has become law and the market structure bill is advancing, creating a clearer framework for crypto operations. Together, these developments signal that capital is quietly piling into Ethereum-based stablecoins while prices remain flat. A classic early cycle accumulation pattern rather than a speculative climax. For listeners, this means a structural build-up is underway. Institutional appetite is rising, regulatory certainty is tightening, and the market may be shifting toward a more mature DeFi phase with deeper participation and broader protocol adoption once the groundwork solidifies. Coinbase has launched a new token sale platform that brings early-stage crypto deals back into retail hands. The exchange will feature one curated sale per month, using USDC settlement and algorithmic allocations to keep the process orderly. Its first offering is Monad, followed by high-profile projects such as Bitcoin Hyper, Maxi Doge Maxi, and Remitix RTX. Hyper has already attracted over $26M in commitments at a price of $13,255, positioning it to benefit from renewed Bitcoin-linked activity and ETF flows. Maxi's meme branding and live staking have raised nearly $4M at $0.2675, while Remitix has pulled more than $28M through its crypto to fiat remittance network. Market chatter is bullish for infrastructure and payments narratives, though the usual presale risk remains. For listeners, This development signals a shift back toward retail participation in vetted token launches, potentially reshaping how new projects raise capital and gain early traction. Pi Network's native token, Pi, has stayed firmly anchored in a narrow consolidation zone this week, trading around $0.23 as market participants sit on the sidelines. Despite the sideways action, a prominent whale continues to accumulate positions, adding a bullish signal that could hint at future upside if the trend breaks out of the range. The lack of volatility has dampened FOMO momentum, leaving traders cautious. Yet the steady buying pressure from large holders suggests underlying confidence in Pi's long-term prospects. For listeners watching the broader crypto landscape, this pattern underscores how institutional interest can quietly shape price dynamics even when headline movements are muted, and it highlights the importance of monitoring whale activity as a barometer for potential breakout points. Ripple's native token XRP has proven resilient amid a broader altcoin pullback this week. After hovering near $2.50 in early November, the price dipped modestly to about $2.48, marking an overall 6% decline over the month and 8% last week, still less than many peers that fell double digits. The steadiness is attributed to its holder base. A sizable portion of XRP sits in long-term wallets rather than speculative traders, giving the token a firmer support floor. Market chatter links this stability to recent catalysts, a favorable court ruling for Ripple, ongoing banking sector stress, and the launch of spot Bitcoin ETFs, all of which have bolstered confidence. With a market cap around $148 billion, XRP remains in the top 4 cryptocurrencies, keeping it under close institutional scrutiny, while retail traders weigh the muted volatility as a potential sign of underlying strength. Standard Chartered has teamed up with DCS Card Center to roll out Decard, a credit card solution that lets users spend stablecoins in everyday retail environments. The launch signals the bank's push to embed digital assets into traditional finance and positions Singapore as a hub for crypto-enabled payments. Market chatter is bullish on the move. Analysts point to increased liquidity for stablecoins and a broader acceptance of crypto cash, while some caution that regulatory scrutiny could temper enthusiasm. For listeners, this development underscores how institutional players are moving beyond custody and trading into real-world spendability, potentially accelerating mainstream adoption of digital currencies in everyday transactions. Robert Kiyosaki, the Rich Dad Poor Dad author, has ramped up his crypto exposure, piling on Bitcoin, Ethereum, gold, and silver while projecting a $250K price target for BTC by 2026. His bullish stance comes amid broader market volatility, sparking FOMO among traders who view Bitcoin as a hedge against inflation. Meanwhile, 3 altcoins have posted sharp gains. DeepSnitch AI's pre-sale crossed the $500K mark. Decard DCR surged 137% in a single day to near $68 before cooling to about $33, and Dash leapt over 150% as privacy coin demand spiked. These movements have lifted bullish sentiment across the sector, though some analysts caution that such parabolic rallies often followed by pullbacks. For listeners, the takeaway is that while institutional voices like Kiyosaki are driving a renewed focus on real money, the altcoin space remains highly volatile and driven by narrative shifts around AI and privacy technology. Matador Technologies has bolstered its crypto treasury by adding 92 BTC to its balance sheet, a move that nudges the company closer to securing a spot in Bitcoin's coveted top 100 holders list. The acquisition signals a continued confidence in Bitcoin as a core reserve asset and reflects Matador's strategy of diversifying its holdings beyond traditional fiat buffers. In market chatter, the announcement has sparked a mild bullish buzz among institutional observers who view such large-scale BTC purchases as a vote of trust in the network's long-term value proposition. At the same time, some analysts caution that rapid inflows into Bitcoin could tighten liquidity and amplify short-term volatility. For listeners tracking Treasury trends, this development underscores how crypto-centric firms are increasingly treating BTC as a strategic hedge rather than just an investment play, potentially setting a precedent for other tech companies to follow suit in their balance sheet management. Cryptography experts are sounding a warning bell. Quantum computers may already be compromising the encryption that keeps blockchain data safe. Italian researcher Gianluca Di Bella argues that the harvest now, decrypt later attack vector is no longer theoretical. Modern quantum machines could store encrypted transactions today and break them tomorrow once they reach full scale. This claim has rattled the market, sparking a mix of FUD and cautious optimism among protocol developers and investors alike. While the industry remains bullish on post-quantum solutions, the immediate takeaway is clear. Protocols that rely on current elliptic curve or hash-based schemes should accelerate their migration plans. For traders and technologists, the message is simple: prepare for a quantum-ready future before the next big wave hits. eToro Group Limited, the global social trading platform, announced its third quarter 2025 results on November 11. Net contribution surged 28% year-on-year to $215 million, while assets under administration jumped 76% to $28 billion, and funded accounts grew 16% to 373 million users. The company also unveiled a $150 million share repurchase program. These numbers signal strong momentum in eToro's core pillars: trading, investing, wealth management, and neobanking, and reinforce its competitive moat built on social copy trading and AI-driven product innovation. Market sentiment remains bullish as the platform expands globally, especially in the US, and positions itself to capture macro tailwinds. Investors view the earnings as a validation of eToro's scaling strategy amid a volatile crypto backdrop. Constellation Network, a Layer 0 infrastructure that powers verified data automation for AI workloads, has just added its native DAG token to Kraken's exchange lineup. The listing unlocks direct trading on one of the world's largest cryptocurrency platforms, expanding global liquidity and cross-chain connectivity for DAG holders. Market chatter is bullish. Traders view the move as a sign that Constellation's ecosystem is gaining institutional traction, while analysts note that broader access could drive higher volume and tighter spreads. For listeners, this development means easier entry into DAG without relying on smaller exchanges, potentially smoothing price volatility and increasing confidence in the project's long-term roadmap. Ethereum's exchange on hand supply has plunged to a multi-month low, with Binance holding just $35B of ETH, levels last seen in May. This exodus from hot wallets signals a shift into private or cold storage, tightening liquidity and dampening short-term selling pressure. The dip is already reflected in the token's 175% slide to $3,544, but the trend could set the stage for a rebound if market risk appetite improves. Meanwhile, Solana sits at $162, teetering below its key $163-$165 support zone. A confirmed break could accelerate a pullback toward $155 and even the psychological $150 level, while a bounce back to $170 would tilt sentiment bullishly again. Zcash has taken a 25% hit after recent gains, trading at $485, with volume spiking over 150%. If it fails to hold above $488, the price could slide toward $371, marking a 23% decline. Bitcoin remains the market barometer at $104,500. Failure to stay above $103, zero could trigger deeper slides toward the $100, zero psychological floor. These movements illustrate a broader altcoin pullback amid lingering uncertainty, with accumulation on Ethereum hinting at potential upside, while Solana and Zcash face short-term resistance. XRP sits at a critical juncture as a wave of spot ETF filings, led by Canary Capital, Bitwise, Franklin Templeton, and others, now appear on the DTCC platform, with Canary's November 13 launch window drawing the most attention. The filings trigger automatic 20-day effectiveness windows, meaning if the SEC does not intervene, Canary's ETF could go live this month while Franklin's may follow in late November. This regulatory momentum has already prompted whales holding between 100 million and 1 billion XRP to trim positions. A 10 million XRP sell-off on November 10 marked a subtle, but telling dip in conviction among top holders. The market reaction is mixed. FOMO surrounds the potential liquidity boost and price discovery that an ETF could bring, yet many traders remain cautious. The possibility of an early government shutdown reopening could prompt fresh SEC comments, potentially delaying approvals and triggering short-term sell the news moves before any sustained rally materializes. For listeners, this means XRP's current $248 level sits near a 0.300 and 82 Fibonacci retracement within a falling wedge. A decisive breakout above $288 could open the path to $334, but only if volume backs it. Until then, sentiment hovers between bullish anticipation and defensive hedging as institutional eyes watch the regulatory clock. PerpDex Lighter has just closed a $68 million round, pushing its valuation to about $15 billion. The influx comes from a wave of venture capitalists engaging with decentralized perpetual trading infrastructure after a period of hesitation. This funding surge signals renewed confidence in the niche, suggesting that market makers and traders see value in Lighter's liquidity solutions and fee structure. For investors watching the space, the move adds momentum to the broader trend of institutional interest returning to DeFi derivatives, potentially tightening the competitive landscape for other DEXs. In short, Lighter's capital raise confirms a bullish pulse across perp platforms, while also highlighting that funding is still being allocated selectively. Only projects with clear differentiation and robust risk controls are attracting serious capital at this stage. Bitcoin's price has settled around $104,547 today, with a market cap hovering near $28 trillion and daily volume topping $79 billion. The intraday swing, from roughly $104,382 to $107,465, shows traders circling critical technical thresholds, especially the $107,000 resistance line. On the daily chart, Bitcoin appears to be fighting a consolidation phase, lacking clear directional momentum. Market sentiment is cautiously bearish. Many are wary of breaking that upper hurdle, while some FOMO fans eye potential quick gains if the level holds. For listeners, this means Bitcoin remains in a tight range and could either test higher levels or retract, impacting short-term positioning for holders and traders alike. Clear Token has secured approval from the Bank of England to operate a crypto and tokenized asset settlement platform, marking a significant step in the UK's push to modernize digital securities infrastructure. The regulatory green light means Clear Token can now process settlement for a broad range of blockchain assets under the BOE's oversight, positioning it as one of the first firms to offer fully compliant clearing services in Britain. The approval is expected to give the firm a competitive edge, allowing it to expand into clearing and margining through the bank's digital securities sandbox. By tapping into this sandbox, Clear Token can test and launch advanced settlement solutions while maintaining regulatory compliance, a crucial factor as institutional demand for secure, on-chain liquidity grows. Market sentiment skews bullish. Investors view the move as a validation of the UK's commitment to digital asset regulation, reducing FUD around clearing risk. Analysts note that early adopters could see higher throughput and lower counterparty exposure, potentially driving further institutional participation in tokenized securities. For listeners, this development signals that the regulatory environment is catching up with technology, creating new opportunities for market participants who can navigate the evolving compliance landscape. Maestro, a leading Bitcoin-native infrastructure provider, has unveiled Mezzanine, an on-chain credit platform that lets idle BTC flow directly into mining operations as secured loans. The service promises to unlock roughly $150 billion of liquidity for miners and offers institutional holders a sustainable yield stream by investing in hashpower and related assets, all settled natively on Bitcoin Loan. Market sentiment skews bullish among investors seeking non-USD denominated exposure, while some FUD remains around the risk profile of mining-backed collateral. The move comes as 75% of miners report difficulty accessing growth capital, driving centralization toward a handful of large pools. Mezzanine aims to broaden financing options and support decentralization by providing transparent, competitive borrowing terms for both public and private operators. The Bank of England's deputy governor has warned that stablecoins issued outside the UK could pose significant risks to consumers and threaten financial stability. In a recent statement, he highlighted concerns over regulatory gaps, cross-border jurisdictional challenges, and the potential for consumer protection loopholes. The comment comes amid growing pressure from regulators to tighten oversight on foreign digital asset issuers. Market sentiment has leaned bearish as traders digest the possibility of stricter rules that could limit the use of non-UK stablecoins in retail transactions. For listeners, this signals a tightening regulatory environment. Firms dealing with cross-border crypto payments may need to adjust compliance frameworks, and consumers should be cautious about using foreign stablecoins without robust safeguards. The move underscores the broader trend of central banks scrutinizing digital assets to preserve market integrity. Uniswap Labs has unveiled a sweeping UNification proposal that could reshape the flagship DEX's governance and revenue model. The plan introduces protocol fees to fund a UNI burn mechanism, including a retroactive 100 million token purge from the Treasury, what would have been burned if fees had existed since launch, to tighten supply and reward long-term holders. It also launches protocol fee discount auctions so traders can bid for lower fees, further accelerating burns. Beyond economics, the proposal merges Uniswap Labs with the Foundation's core teams under a 5-member board featuring Hayden Adams, Devin Walsh, and Ken Ng, aiming to streamline operations. Version 4 will turn into an on-chain aggregator, tapping external liquidity hooks for new fee streams, while the platform will drop monetization of its interface, wallet, and API, focusing future revenue on aligning with UNI holders. Market reaction is mixed. Bullish sentiment from supply contraction advocates who see a tighter UNI economy. Bearish caution among users wary of reduced fee income and potential governance centralization. For listeners, this move signals Uniswap's shift toward a more sustainable, holder-centric model, an evolution that could set a new precedent for decentralized exchanges, navigating post-launch growth and regulatory scrutiny. Bitcoin hyper has surged into the spotlight as Washington rolls out a bipartisan framework that pairs the Clarity Act with clear-cut rules for digital assets. The Senate draft assigns CFTC oversight to spot commodity markets like Bitcoin and SEC jurisdiction over security tokens, while explicitly safeguarding self-custody rights. This regulatory clarity trims compliance costs and reduces headline risk, an attractive backdrop for altcoins and pre-sales. The news fuels bullish sentiment. Traders see the new guardrails as a catalyst that could shift capital from BTC/ETH into higher-risk projects with real-world utility. Hyper, a Bitcoin-anchored Layer 2 built on Solana's virtual machine, promises sub-second finality and minimal fees, while anchoring state to Bitcoin for ultimate security. Its presale has already raised $26.8 million, with early staking yields at 43% APY, though those rewards will taper as the project matures. For listeners, this development signals a shift from regulatory improvisation to structured frameworks, lowering barriers for innovative L2S and potentially accelerating adoption of Bitcoin-based payment and DeFi solutions. The market reaction is one of cautious optimism, with FOMO around Hyper's execution layer and FUD mitigated by the new clarity and oversight. China has sounded a warning bell over what it claims is U.S. involvement in one of the largest Bitcoin thefts ever uncovered. The story centers on Liu Bian Mining, a Chinese mining pool that lost more than 127.0 BTC to a sophisticated hack, following the Department of Justice's announcement of its biggest forfeiture action to date, seizing the stolen coins. The U.S. authorities are now under scrutiny for how they traced and seized the assets. The move has stirred a mix of market sentiment. Some traders see it as a sign that law enforcement agencies can effectively recover large swaths of crypto, which could bolster confidence in the ecosystem's resilience. Others fear escalating regulatory pressure and potential cross-border legal battles that might dampen investor appetite for high-risk mining ventures. For listeners, this development underscores the growing tug of war between state actors and the decentralized nature of blockchain assets. While recovery efforts may provide a short-term rally in confidence, the broader implication is a reminder that even the most secure-looking operations can be vulnerable to sophisticated attacks, an ongoing risk factor for anyone exposed to crypto mining or large-scale custody solutions. The crypto market stumbled on Tuesday, sliding 189% to a $352 trillion valuation as traders braced for more volatility. Amid the broader pullback, Uniswap's native token UNI stood out, holding its ground and even nudging higher after an early dip, an encouraging sign for liquidity provision enthusiasts. The dip has sparked a muted bearish tone across major caps, but UNI's resilience hints at potential stability within DeFi platforms. For listeners watching the market's pulse, this day underscores how isolated moves can still keep certain tokens buoyant, while overall sentiment leans toward caution as the sector navigates post-pump corrections and lingering FUD over regulatory scrutiny. Uniswap's native token UNI has entered a new chapter as its governance team unveiled an aggressive burning plan aimed at tightening supply and boosting scarcity. The proposal will permanently remove a significant portion of circulating UNI from the market, with initial estimates suggesting that up to 30% of the token supply could be burned over the coming months. Market reaction has been mixed. On one side, traders see the burn as a bullish signal that could lift value by reducing dilution. On the other, some fear a short-term liquidity squeeze and potential price volatility. For listeners, this move underscores Uniswap's ongoing shift from merely a DEX to a deflationary asset class, reinforcing its position in the broader ecosystem, while sparking debate over how supply dynamics will play out in the next funding cycle. Brazil's central bank has moved to tighten its grip on the digital asset sector by rolling out new regulations that place cryptocurrency firms under a regulatory regime akin to that of traditional banks. The mandate will require crypto exchanges, custodians, and other service providers to register with the Banco Central, submit detailed operational disclosures, comply with capital adequacy rules, and adhere to anti-money laundering protocols. For market participants, the announcement has injected a mix of caution and opportunism. Some view it as a sign that Brazil is moving toward mainstream financial integration, potentially boosting investor confidence, while others fear that stricter oversight could stifle innovation and drive liquidity out of local exchanges. The broader context lies in Brazil's ambition to become a regional crypto hub. The new rules aim to balance consumer protection with fostering growth, setting a precedent for other emerging markets considering similar frameworks. Uniswap, the leading decentralized exchange platform built on Ethereum, has just passed a pivotal governance vote that will activate its protocol fee mechanism and streamline incentive structures across all liquidity pools. The decision means the DEX will now collect a 0.3% fee on trades, automatically routing those funds into a treasury that rewards UNI token holders and liquidity providers, rather than feeding back into the protocol's core functions alone. For market participants, this shift signals a more mature revenue model for Uniswap, potentially stabilizing its long-term sustainability as DeFi competition intensifies. The vote was met with mixed reactions. Some traders view the fee activation as a bullish step toward monetization and token value support, while others worry that increased fees could dampen trading volume, injecting a mild bearish tone into short-term sentiment. In context, Uniswap's move follows a broader industry trend, where top DeFi protocols are reassessing fee structures to align incentives with governance tokens. As UNI holders anticipate future treasury distributions, the announcement underscores the platform's intent to reinforce community ownership while ensuring liquidity providers receive fair compensation for market-making duties. SoFi Technologies has just launched a new mobile app that lets its users trade cryptocurrency directly within the banking interface, a first for any nationally chartered bank in the United States. The move integrates traditional finance with decentralized assets, giving customers a seamless way to buy, sell, and hold digital coins without leaving the familiar SoFi ecosystem. Market reaction is mixed. Traders see it as a bullish signal that mainstream institutions are embracing crypto, potentially boosting liquidity and legitimizing the space. Meanwhile, some skeptics worry about regulatory exposure and security risks, sparking mild FUD among risk-averse investors. For listeners, this development marks a significant step in bridging the gap between conventional banking services and the burgeoning DeFi market, hinting at broader institutional adoption while underscoring the need for vigilance as new products roll out. Zcash (ZEC), the leading privacy coin, saw its price tumble 26% in a single day, sliding from a recent high of $700 to about $485. The dip follows a sharp correction that has rattled traders and sparked debate over whether the rally is ending or merely pausing. Sentiment skews bearish, with some analysts warning that failure to hold near $487 could push ZEC lower toward $344 or even $235, while others view the pullback as a textbook mid-trend retracement before a potential rebound once Bitcoin establishes support around $110K. The slide mirrors a broader downturn in privacy tokens. Monero and Dash have also declined sharply, and has reduced the sector's market cap by roughly 34% over 24 hours, underscoring heightened FUD amid a bearish macro backdrop. 8lens, a rising player in on-chain lending, has rolled out its native utility token 8LNDS on the Base blockchain. The move marks a shift from speculative issuance to a reward model that mints tokens strictly tied to real user activity, deposits, borrowing, and protocol usage. Market reaction is mixed. Some traders view the alignment with actual platform engagement as bullish, seeing potential for sustainable demand, while others caution that early adoption remains uncertain and could temper token value in the short term. For listeners following DeFi dynamics, 8len's new token launch underscores a broader industry trend toward activity-based incentives, signaling both an opportunity to deepen user participation and a reminder that token economics still hinge on real-world usage rather than hype alone. Bitcoin has slipped below the $104,300 mark after a brief rally earlier this week, marking its first dip in over a month. The drop follows a failed attempt to breach the $107,000 resistance level, leaving the digital gold on shaky ground. Market sentiment is turning cautious. Traders are watching for any sign of renewed momentum, while FUD creeps in as daily candles struggle to stay above key Fibonacci thresholds. Institutional interest shows mixed signals. U.S.-listed spot Bitcoin ETFs logged a modest $115 million inflow, ending a six-day withdrawal streak that totaled $122 billion. Yet the overall trend remains uncertain. On the technical side, trading volume surged from $11.5 BN to $14.1 BN last week, hinting at growing liquidity. Analysts note that if Bitcoin can close above the 38.2% Fibonacci retracement around $106,453, it could rally toward the 50-day EMA near $110,000. Otherwise, a continued decline may push the price back toward the $100,353 support. For listeners, this means Bitcoin is currently in a consolidation phase with potential for a rebound or further downside, depending on how the next few sessions play out. Keep an eye on key levels and institutional flows to gauge whether the market will shift from bearish to bullish territory. The spotlight this week falls on IPO Genie, $IPO, a platform that has re-engineered crypto presales into a structured investment channel. In the first quarter of 2025, billions of dollars flowed through global presale desks, with retail participation surging over 60% year-on-year, while hedge funds and family offices began allocating significant capital to these early-stage offerings. IPO Genie's model, combining venture capital vetting, AI-driven analytics, and blockchain compliance, has attracted both camps by offering tokenized access to private deals that were once the preserve of institutional investors. This convergence fuels a bullish sentiment among participants who view presales as a bridge between public markets and private equity. The platform's recent $50K airdrop prize pool for 40 top early users underscores its commitment to measurable engagement and transparent allocation, countering typical FOMO-driven hype with data-backed participation metrics. For listeners navigating the 2025 crypto landscape, IPO Genie exemplifies how presales are shifting from speculative playgrounds to legitimate investment vehicles. The trend signals growing regulatory maturity and a demand for real-world utility in token offerings, suggesting that those tracking institutional entry points should keep an eye on platforms that blend AI insight with compliance-first execution. MEXC, the fast-growing global crypto exchange, has launched two incentive campaigns aimed at traders in Europe and the UK that promise instant, fully withdrawable USDT rewards. The first promotion gives new users a 15 USDT bonus after depositing at least 100 USDT and executing a 50 USDT futures trade. This runs until November 30, 2025. The second, a fiat and P2P lucky draw, guarantees every participant a win ranging from 1 to 5, 0 USDT, with the draw ending on December 1, 2025. Both events underscore MEXC's push to lower entry barriers and boost liquidity in the European market, generating bullish sentiment among users eager for low-risk onboarding bonuses, while keeping rewards transparent and immediately withdrawable. For traders looking to test spot, futures, or staking products with a small upfront incentive, these campaigns offer an attractive entry point into MEXC's expanding ecosystem. Bzhash has rolled out a new line of automated cloud mining contracts that let investors tap into passive crypto earnings without any hardware or technical setup. The company claims the platform handles all mining logistics, allowing users to simply stake their capital and receive regular payouts in cryptocurrency. Market chatter is mixed. Some traders see this as a bullish move that could broaden access to mining revenue streams, while skeptics point out typical concerns around cloud mining profitability and potential fee erosion. For listeners, it's another example of the sector's push toward frictionless yield generation, an opportunity worth watching, but not an outright endorsement for any particular strategy. Cardano's native token ADA has carved a bearish rising wedge pattern around the $0.61 resistance level, suggesting that the current rally may stall if buying momentum falters. The wedge forms as price action tightens between two converging trend lines, one descending and one ascending, indicating a consolidation phase that traders often interpret as a potential reversal signal. Market participants are watching closely. The pattern's presence has dampened FOMO-driven buying, while some bearish analysts warn of an imminent pullback if the wedge breaks below its lower boundary. For listeners following Cardano's trajectory, this technical shape underscores growing uncertainty. The asset may either break out to new highs or retreat back into the $0.55, $0.58 range as the market digests the recent gains and evaluates whether the upward bias remains sustainable. Brazil's federal deputy Rodrigo Valadares has tabled a legislative proposal to halt 3 recent central bank resolutions that reclassify stablecoins as foreign exchange instruments. The move aims to suspend BCB resolutions 519, 520, and 521, which would impose new regulatory and tax burdens on Bitcoin and crypto exchanges operating in the country. Market sentiment skews cautious. Traders fear a potential dump of local exchange activity if these rules take effect, while proponents argue it could spur a temporary slowdown in domestic crypto trading volumes. The context is that Brazil's 2022 crypto law did not equate stablecoins with foreign currency, and Valadares argues the central bank has exceeded its authority by extending its scope to the FX market. If the proposal gains traction, it may force a rethink of the regulatory framework and keep the crypto sector from shifting en masse to unregulated overseas platforms. The first International Crypto Asset Congress CONICRIPTO wrapped up in Brasilia after a 3-day summit that brought together law enforcement officials from every state and major Bitcoin exchanges such as Foxbit, Novadax, Chainalysis, and TechBiz. The event, organized by the Goiás Police Delegates Union Sindipal Go and the National Police Delegates Association ADEPAL, focused on how to track, seize, and custody digital assets during investigations. A key highlight was prosecutor Ana Paula Bez Batty's presentation of Crypto Jud, a judicial portal similar to CISPJUD that links courts directly with virtual asset service providers. She explained that the system, currently in testing by the National Justice Council (CNJ), could streamline block orders and reduce errors or duplicate requests, a significant step forward for anti-money laundering enforcement. The Congress also featured political voices. Deputy Alberto Braga, a former military officer, emphasized that 39 current legislators have security backgrounds and urged lawmakers to support digital crime initiatives. State Security Secretary Sandro Torres Avelar underscored the need for Brazil's forces to adapt to cyber challenges. For crypto markets, the gathering signals growing institutional attention to regulatory frameworks and law enforcement cooperation. While not a direct price driver, it boosts confidence that governments are building mechanisms to curb illicit use, potentially easing FUD around exchange compliance. Investors should note that improved legal clarity could reduce volatility for regulated exchanges in the long term. Bitcoin BTC remains the headline of today's crypto chatter. Eric Trump recently tweeted that Bitcoin will surpass $1 million and called this year's fourth quarter unbelievable, echoing similar bullish claims from CZ, Cathie Wood, and Michael Saylor. The statement has ignited a wave of FOMO among holders, while skeptics caution that 2025 hasn't followed the traditional Q4 rally pattern. October even saw the largest single-day liquidation in crypto history. Market sentiment is mixed. Bulls point to continued institutional inflows via spot ETF approvals and growing global adoption, whereas bears note the volatility and lack of a clear price trajectory. For listeners, the takeaway is that while high-profile endorsements keep the hype alive, Bitcoin's path to a seven-figure valuation remains uncertain amid ongoing market swings and regulatory developments. Cardano's commercial arm, EMURGO, has teamed up with global fintech Wirex to launch the first-ever ADA card, a multi-chain debit solution that lets users spend over 685 cryptocurrencies, including ADA, BTC, ETH, and USDC. Anywhere Visa is accepted across more than 130 countries. The Cardano card, unveiled at the 2025 summit in Berlin, integrates directly into the Wirex app, offering up to 8% cashback on purchases and ATM access, while also providing crypto-backed loans, yield accounts, and structured trading products. Market sentiment skews bullish as this move addresses a long-standing gap. Although there are over 820 million crypto wallets worldwide, only a small fraction are used for payments. By leveraging Visa's global infrastructure, Cardano positions ADA as a gateway to everyday finance and DeFi, fueling FOMO among users seeking seamless fiat crypto integration. Looking ahead, EMURGO plans a non-custodial version in 2026 with auto-staking, tokenized real-world asset yields, and deeper DeFi ties, while a portion of the card's profits will feed into the Cardano treasury to reinforce ecosystem sustainability. This partnership marks a significant step toward mainstream adoption, giving ADA a powerful entry point into global payments and expanding its footprint in the fintech landscape. Shiba Inu's core team has issued a statement that silences growing whispers of a potential collapse for the meme coin ecosystem. The announcement clarified that no shutdown or halting of development is underway, and the project remains operational. However, the confirmation arrived amid a broader crypto pause, and SHIB's price dipped sharply in the following minutes, reflecting a short-term bearish pulse as traders reacted to the uncertainty. Market chatter now leans toward FUD rather than FOMO. Investors are wary that any sign of instability could trigger further sell pressure across the meme coin segment. In context, this comes after a series of mixed signals from Shiba Inu's leadership and a broader market still grappling with volatility, leaving traders to monitor whether the team can maintain confidence in the project's long-term viability. Nobody Sausage, the quirky character brand that amassed a 33 million following on TikTok, X, and Instagram, has just launched its own token, Nobody. The move is part of an aggressive strategy to pull its massive social media audience into Web3 by offering a native crypto asset that feels invisible to users. The brand claims it won't require them to learn about wallets or trading. Early metrics show a spike in wallet creations tied to Nobody, but on-chain activity remains modest, and the token's price has hovered near its launch floor with sporadic dumps during market sell-offs. Sentiment is mixed. FOMO buzz circulates among younger fans eager for free crypto, while analysts warn of high volatility and a lack of utility beyond brand hype. In a broader context, Nobody's rollout reflects the ongoing trend of meme-based projects leveraging celebrity followings to bootstrap liquidity. Yet it also underscores the risk that, without real use cases, such tokens can become flash in the pan pumps that quickly lose traction when macro conditions turn bearish. The IRS has issued new guidance that formally recognizes staking as a tax-eligible activity for exchange-traded funds, but only under specific conditions that could reshape how crypto ETFs operate. The ruling allows grantor trusts to tweak liquidity reserves and use financing to meet redemption demands, an unprecedented flexibility in the typically rigid trust framework. However, the relief applies solely to single asset trusts, Mixed token funds are largely excluded because staking rewards would shift asset proportions. Providers must remain independent from the trust and sponsor, and they must indemnify against slashing, though liability placement remains unclear. Private or non-listed trusts also fall outside the scope, limiting eligibility to publicly listed, permissionless networks. For market participants, this signals a cautious but bullish path forward. Institutions can now pursue staking yields while staying within compliance limits, yet they must navigate single-token constraints and operational ambiguities. The guidance underscores a risk-averse regulatory stance that will likely steer future staking ETFs toward narrowly focused, well-structured products, offering investors a clearer framework for tax-efficient exposure to blockchain rewards. Ethereum is the focus of this week's market chatter. Binance has reported a sharp drop in its on-exchange supply to the lowest level since May, signaling that traders are pulling coins off the platform and possibly accumulating ahead of a rally. The move comes as price action remains muted after a broader sell-off tied to ETF pressure. Yet on-chain activity and daily volume, over $30 billion, stay robust, hinting at underlying demand. Market sentiment skews cautiously bullish. Technical patterns show a morning star breakout off the 0.1759 BTC ETH level, and weekly charts indicate that ETH is still trading above its moving averages, with an emerging higher low near $3,200. Resistance sits around $3,650 on the 4-hour chart. If breached, it could pave the way for a climb toward next year's highs. For listeners, this means Ethereum is in a transition phase. Whales may be buying while the broader market remains bearish, creating a window where a sharp move could materialize if short-term resistance holds. Injective Network has launched native Ethereum virtual machine support on its high-performance Cosmos-based chain, marking a pivotal milestone in its multi-VM roadmap aimed at unifying WASM and EVM ecosystems. The update allows developers to deploy Solidity Smart contracts directly on Injective's Layer 2 infrastructure without bridging, reducing latency and gas costs, while preserving the speed advantages of its order matching engine. Market chatter is bullish. Traders see this as a move that could attract Ethereum-centric projects seeking faster execution, potentially boosting liquidity and token activity. For listeners, the rollout underscores Injective's push to become a composable hub where disparate blockchains can interoperate seamlessly, an appealing proposition for both developers and liquidity providers navigating a fragmented DeFi landscape. Threshold Network has upgraded its TBTC protocol and relaunched its website to cement the tokenized Bitcoin's role as a bridge into DeFi. The update introduces gas-less minting and a single-step redemption flow that lets users move BTC onto Ethereum, Layer 2s, and non-EVM chains without costly bridging or loan approvals. By eliminating Layer 2 signing, institutional treasuries can deploy Bitcoin liquidity across multiple ecosystems with minimal overhead, while retail holders retain full self-custody. The rollout comes amid a surge in institutional exposure. U.S. spot ETF inflows pushed Bitcoin holdings to $414 billion last month, and corporate reserves jumped 40% in Q3. As the market digests this shift, sentiment leans bullish for TBTC. It offers a permissionless, low-friction gateway that aligns with the growing appetite for on-chain Bitcoin exposure, potentially easing the path for more institutional capital to enter DeFi. Solana's price is now flirting with a potential downside break that could push it below the $100 mark in the coming weeks. The digital asset has just formed two starkly bearish patterns on its daily chart: classic head and shoulders, and double bottom formations that traders flag as warning signs of a reversal. Even as the market buzzes about new Solana ETF inflows, which typically inject bullish momentum, the technical picture remains grim. Analysts note that the bearish signals could outweigh the fresh capital, creating a scenario where FUD outweighs any nascent FOMO. For investors watching the space, this underscores the need to monitor Solana's support levels closely. A breach could trigger further selling pressure across the broader crypto market, tightening risk appetite and potentially dragging other Layer 1 chains into a similar pullback. Ethereum's community group, the Locked Ether Collective, has unveiled a proposal for an Ethereum Fund Recovery Protocol, EFRP, aimed at addressing lost or locked ETH caused by past technical bugs. The initiative follows the 2017 Parity wallet freeze that immobilized roughly 514 ETH, worth between $150 million and over $300 million at the time, and other similar incidents stemming from early smart contract vulnerabilities. Rather than a hard fork, the EFRP would be built on decentralized smart contracts governed by a technical council DAO, offering a transparent, rule-based mechanism for legitimate owners to reclaim inaccessible funds. Market chatter is mixed. Some investors view the proposal as a constructive step towards strengthening governance and reducing long-term risk, bullish, while others fear that any recovery framework could introduce new points of failure or dilute decentralization, bearish. For listeners, this development highlights Ethereum's ongoing effort to patch legacy security gaps without altering its core protocol, signaling both potential resilience gains and the inherent trade-offs of post-hoc recovery solutions. Canary Capital's new XRP ETF, trading under XRPC on Nasdaq, has received automatic SEC approval after filing Form 8A, marking the first spot XRP fund under the 1933 Act to go live. The move comes as Ripple's token has been rallying, with prices up nearly 10% in the past week and trading around $248. Market sentiment is bullish. Volume surges, about a 40% jump in just 24 hours, and futures open interest on CME and Binance is climbing, signaling growing FOMO among investors. This launch follows months of regulatory uncertainty for XRP ETFs, so the approval removes a major hurdle and could act as a catalyst for further upside. For listeners, it means the crypto sector has secured a new vehicle to gain direct exposure to XRP, potentially reshaping liquidity dynamics and investor sentiment in the digital asset space. BlockDAG, Mantle, Tron, and Algorand are topping 2025's gainers list as their technologies and user bases continue to expand. BlockDAG closed a record-setting presale of $435 million, leaving only 42 billion tokens in circulation and attracting over 312,000 holders. Its hybrid POW/DAG architecture already hit 400 TPS on testnet and promises up to 15,000 TPS once live, positioning it as a high-throughput Layer 1 contender. Mantle's modular Layer 2 scaling, tightly aligned with Ethereum's roadmap, is gaining traction through growing liquidity and strategic partnerships, signaling potential upside for developers seeking efficient roll-ups. Tron remains the backbone of global stablecoin transfers, handling more than 60% of USDT traffic. Its low fees and rapid confirmations keep it a preferred settlement layer, with recent trading volumes nudging up slightly. Algorand's focus on interoperability and green performance continues to attract enterprise interest, reinforcing its long-term appeal. Collectively, these projects illustrate a market shift towards scalable infrastructure, stable liquidity hubs, and eco-friendly solutions, fueling bullish sentiment for the next wave of blockchain adoption. Clear Token has secured approval from the UK's Financial Conduct Authority to operate a regulated crypto settlement platform, marking a key step in the country's effort to integrate digital assets into its traditional financial ecosystem. The FCA clearance confirms that Clear Token's system meets stringent compliance and risk management standards, allowing it to offer secure, compliant settlement services for tokenized securities and other crypto products. The announcement has injected bullish sentiment among institutional players eyeing regulated infrastructure, while some market watchers note the move could pressure competitors to accelerate their own regulatory filings. The approval signals that regulators are willing to endorse robust, audited solutions rather than blanket bans, potentially easing FUD around the legal status of digital asset settlement in the UK. For traders and investors, this development underscores a broader trend. As governments tighten oversight, only platforms with proven compliance frameworks will thrive. Clear Token's nod could catalyze further institutional adoption of tokenized assets, reshaping liquidity flows across London's evolving crypto market. Coinbase has launched a new token pre-reserve platform that reopens U.S. retail participation in public token sales, for the first time since regulators shut down the ICO boom in 2018. The service will feature curated projects, fixed sale windows, and algorithmic allocation, with every purchase settled in USDC and a guaranteed listing on Coinbase's exchange. However, issuers face a 6-month secondary market lockup, and users who flip allocations within 30 days are deprioritized in future sales, a behavioral constraint designed to curb the dump on listing pattern that has plagued prior IEOs. Market sentiment is mixed, bullish for the potential of a recurring primary market that rewards patient capital, but bearish for the risk that regulators may still view these offerings as unregistered securities if the tokens trade mainly as speculative assets. The first test will run from November 17 to 22 with Monad, a Layer 1 blockchain project, using a bottom-up allocation that favors smaller orders and aims to flatten holder distribution. For listeners, this move signals Coinbase's attempt to rebuild credibility in U.S. token sales by combining compliance safeguards with market discipline, an experiment that could reshape how retail investors engage with new crypto projects if the platform gains traction. Milk Mocha's new token, $HUGS, has kicked off its presale today, with the whitelist already closed and live allocations moving at a blistering pace. The project, born from a comic about two affectionate bears, has evolved into a community-driven launch that pairs NFTs, staking rewards, and a burn mechanism to create scarcity. Early participants enjoy discounted pricing and exclusive perks, while referrals trigger bonus incentives, fueling a rapid sign-up wave. The surge has generated palpable FOMO across social media, with hashtags like #HugsPresale trending on X as fans scramble for their share before the presale caps out. Market chatter leans bullish. Liquidity is tightening, and the burn strategy suggests long-term value potential, though some observers caution that hype may inflate short-term demand. For listeners, this is a reminder that even niche, narrative-centric projects can spark significant momentum when they tap into an engaged fanbase. Keep an eye on $Hugs as it moves from presale to public listing. Its trajectory will test whether community enthusiasm translates into sustained market interest. In November 2025, a roundup of the leading crypto casinos surfaced, spotlighting 13 platforms that have carved out significant market share in the online gambling sector. The list highlights operators that combine robust live dealer experiences with blockchain-based payment options, showcasing a blend of traditional casino appeal and crypto innovation. The release signals continued growth in the niche, as more players seek transparent, low-friction betting environments powered by cryptocurrencies. Market chatter is largely bullish. Investors view the expansion as evidence of mainstream adoption, while FOMO drives new users to test these platforms' liquidity and provably fair systems. For listeners, this update underscores that crypto casinos are no longer fringe. They're entrenched competitors in the broader gaming ecosystem, offering both seasoned gamblers and newcomers a diversified portfolio of wagering choices. Transact, the crypto fiat gateway that powers seamless wallet deposits and withdrawals for thousands of exchanges, has secured 6 new state licenses across the United States. The approvals, spanning California, New York, Texas, Florida, Illinois, and Ohio, allow Transact to conduct compliant fiat to stablecoin conversions directly within each jurisdiction, eliminating the need for third-party intermediaries. This expansion strengthens Transact's regulatory footprint and positions it as a more reliable bridge between traditional banking systems and digital assets. Market observers see the move as bullish for the company. The added compliance layer boosts trust among institutional users and could drive higher transaction volumes. For investors watching the broader stablecoin ecosystem, Transact's broadened reach signals tightening U.S. regulatory standards while maintaining liquidity pathways for major stablecoins such as USDC and DAI. The development underscores the ongoing push toward fully regulated crypto infrastructure in key American markets. Turbo Energy, a Nasdaq-listed solar energy storage company, has launched a pilot in Spain that leverages Taurus's institutional tokenization platform and the Stellar blockchain to finance clean energy projects. The move marks one of the first large-scale deployments of tokenized assets for renewable infrastructure outside the United States, positioning Turbo Energy as a frontrunner in integrating DeFi tools with traditional energy financing. Market sentiment is cautiously bullish. Investors see potential for faster capital deployment and lower transaction costs, while skeptics note regulatory uncertainties around tokenized securities in Europe. For listeners, this development signals a growing convergence between mainstream renewable ventures and blockchain technology, hinting at broader adoption of tokenization to unlock liquidity for green projects across the continent. SoFi has become the first U.S. bank to embed a crypto trading platform directly into its mobile banking app. The new SoFi crypto service lets users buy and sell Bitcoin, Ethereum, Solana, and dozens of other tokens, while moving funds instantly between checking, savings, and crypto wallets. This launch follows regulatory guidance from the Office of the Controller of the Currency that clarified licensed banks can offer blockchain services, removing a major compliance hurdle. The move is bullish for institutional adoption, signaling that mainstream financial institutions are finally comfortable with digital assets. For listeners, this marks a significant convergence of traditional banking and crypto markets. Retail customers now have seamless access to volatile tokens within a regulated framework, while SoFi positions itself as a full-spectrum platform that could reshape consumer expectations around digital banking in the coming years. Coinbase has launched a UK-based savings product that pays 3.75% AER on GBP balances, partnering with Clearbank to provide daily interest, instant deposits and withdrawals, and FSCS protection up to £80.50. The move positions the crypto exchange as a direct competitor to traditional banks, offering users seamless access between fiat savings and their crypto holdings, a feature missing from most UK banks. Market chatter is bullish for Coinbase's expansion into retail banking, with FOMO among users who want higher yields and instant crypto conversion. However, regulators are watching closely. The Bank of England has proposed a £20, £0 stablecoin cap, while Coinbase's higher ceiling could spark debate over bank disintermediation and financial stability. For listeners, this development signals a blurring line between crypto platforms and conventional banking services, potentially reshaping how UK savers manage both fiat and digital assets. Fantasy sports juggernaut PrizePicks has pivoted into the prediction market arena by partnering with Polymarket, a platform that lets users bet on real-world events. The move extends PrizePicks' focus beyond daily fantasy sports and taps into the rapidly growing space, where traders speculate on outcomes from politics to sports to weather. Early data shows the new feature is already drawing attention from both seasoned bettors and casual users curious about how their fantasy experience can translate into genuine wagering opportunities. Market chatter is mixed. Some analysts see this as a bullish diversification that could broaden user engagement, while others warn that the highly regulated betting environment may introduce compliance hurdles. For listeners following crypto-related gaming trends, the partnership signals a blurring line between entertainment and financial speculation, an evolution many in the space are watching closely for its implications on liquidity, token usage, and regulatory scrutiny. Bitcoin's gifting rules are clearer than ever. While a transfer of BTC to another person isn't taxed immediately, the IRS still mandates specific reporting and record-keeping requirements. In practice, any gift that exceeds $17.00 in 2025 triggers a Form 709 filing, and the giver must retain documentation of the Bitcoin's cost basis and acquisition date for future capital gains calculations when the recipient sells. Failure to comply can result in penalties or mischaracterization of the transaction as a sale, sparking FUD among holders who fear unexpected tax liabilities. Market sentiment remains mixed. Some traders view the clarified guidance as a bullish sign. Clear rules reduce uncertainty and may encourage more institutional gifting for estate planning. Others worry that stricter reporting could dampen off-chain activity, adding a bearish undertone to the broader crypto narrative. For listeners, this means that while BTC gifting can stay tax-neutral today, staying ahead of IRS compliance is essential. Proper documentation now protects against future capital gains surprises and keeps your portfolio clean from regulatory headaches. Bitdeer, a leading cloud mining and hosting provider, saw its shares slide 30% following the release of its third-quarter earnings. The report highlighted steady growth in both self-mining operations and service contracts, yet the market reacted negatively to higher-than-expected operating costs and a sharper decline in miner demand. Investor sentiment swung bearish as traders weighed short-term pressure against the company's long-term infrastructure expansion plans. Despite the dip, several analysts maintained their bullish stance, citing Bitdeer's robust pipeline of data center projects and its strategic partnerships with major GPU manufacturers. For listeners tracking the crypto mining sector, this episode underscores the volatility that can surface even when underlying fundamentals appear solid, reminding stakeholders to focus on core performance metrics rather than headline price swings. Ripple's native token XRP is currently trading around $2.45, a slight 3% dip in the last day, but still up 9% over the week. Analysts flag the $2.70 resistance as the next key hurdle. If breached and retested as support, a rally toward roughly $3.20 could materialize. The price sits within a consolidation zone bounded by accumulation support and horizontal resistance, with the 55-week moving average acting as a critical safety net. Falling below it would push XRP toward a $1.90 lifeline. On the intraday front, the token closed bullishly near $2.55, suggesting a short-term pullback may be healthy before a new structure forms. Meanwhile, spot ETF filings from Bitwise, Franklin Templeton, 21 shares and others have advanced to DTCC listing, signaling growing institutional interest. Market sentiment remains cautiously bullish. On-chain data shows continued accumulation by large holders, while traders eye Fibonacci support around $2.41 and the possibility of a break below $2 before a larger move. Cardano's native token ADA has entered a pivotal phase after the Bank of England rolled out a new stablecoin framework that requires sterling-backed issuers to keep at least 40% of their liabilities in BOE deposits. The announcement has injected bullish sentiment into ADA, as traders see the regulatory tightening as a signal of maturity for digital fiat ecosystems and a potential catalyst for broader adoption. Meanwhile, Bitcoin is flirting with a breakout above $112.00 that could trigger a short squeeze, adding to market FOMO. In the U.S., Coinbase's re-entry into token launches via its regulated sale platform Monad underscores institutional momentum. For listeners, this confluence of regulatory clarity, institutional engagement, and bullish technical cues suggests ADA is poised for a potential rally, though it remains vulnerable to any shift in sentiment or macroeconomic pressure. Steak and Shake has announced it will accept Bitcoin at its U.S. locations, a move that signals growing mainstream adoption of digital currencies by brick-and-mortar brands. The fast food chain said the new payment option is part of a broader strategy to boost Q4 sales and enhance customer engagement through crypto incentives. For the market, the announcement adds bullish momentum to the crypto-enabled commerce narrative, as more companies validate Bitcoin's utility beyond speculation. While some investors may view the rollout skeptically, questioning whether crypto payments will significantly drive foot traffic, the sentiment overall leans toward FOMO, with analysts noting that early adopters could reap rewards if consumer uptake accelerates. For listeners, this development underscores a tangible shift. Businesses are no longer just talking about blockchain. They're integrating it into everyday transactions, potentially reshaping the retail payment landscape and reinforcing Bitcoin's role as a real-world utility. Shiba Inu has snapped back to its critical resistance level after a brief dip, sending a bullish ripple through meme coin traders who have been watching the price action closely. Meanwhile, Michael Saylor's investment arm just completed a $50 million Bitcoin purchase, marking the largest single buy by the firm in recent months and reinforcing confidence among institutional holders. In the broader crypto landscape, Ripple has emerged as a headline contender with its latest valuation hit of $40 billion, sparking renewed FOMO among market participants who see it as a potential challenger to traditional payment networks. These moves collectively suggest a cautiously optimistic mood. Meme coins are regaining traction, institutional Bitcoin buying remains steady, and the broader narrative around XRP continues to attract speculative interest. For listeners tracking sector dynamics, these developments underscore how individual asset rallies can coexist with strategic institutional purchases, shaping sentiment across both niche and mainstream crypto arenas. Zcash, ZEC, has slammed into a sharp pullback after a meteoric 500% rally that pushed it to a 7-year high of nearly $744. The privacy coin is now down more than 25% from its peak, as traders weigh whether the parabolic uptrend has peaked. Technical data shows an overbought RSI at 94.2 and a corrective channel on the daily chart, with many analysts warning that ZEC could retreat toward the $300-400 range if it fails to hold the $400 support level. While some view the dip as a temporary correction, highlighting no bearish divergence in MACD or RSI, others see it as a potential cycle top that may trigger a deeper drawdown. Amid this short-term volatility, long-term holders remain confident in Zcash's ZK Snarks technology and anticipate that renewed U.S. fiscal stimulus could revive demand for privacy assets, keeping the broader bullish case alive. In a fresh diplomatic flair, Beijing's cybersecurity watchdog has accused Washington of appropriating $13.2 billion worth of Bitcoin that allegedly fell victim to a 2020 mining pool breach. The Chinese regulator claims the U.S. seized the coins and rebranded them as proceeds from illicit activity, effectively stripping them of any legitimate origin. This allegation comes amid growing scrutiny over how digital assets are handled by foreign jurisdictions when tied to alleged cyber thefts. The claim has injected a dose of FUD into crypto circles, prompting traders to reassess the risk profile of U.S. controlled blockchains and the legal frameworks that govern asset seizures. While some market observers see this as a potential catalyst for stricter regulatory oversight, hinting at a bearish tilt for assets linked to disputed origins, others view it as an isolated geopolitical spat unlikely to derail broader bullish momentum in Bitcoin's price trajectory. For listeners, the takeaway is clear. Cross-border disputes over digital asset provenance can reverberate beyond diplomatic channels, influencing investor sentiment and potentially tightening compliance requirements. As the US and China navigate this contention, market participants should stay alert to any regulatory updates that might reshape how seized cryptocurrencies are treated under international law. LISC's native token LSK has surged nearly 63% in a single day, catapulting from around $0.18 to an intraday peak near $0.42, and pushing the price above its key support of $0.2574. The rally followed a sharp breakout from a descending wedge that had held the coin since July, and coincided with a 258% jump in open interest. $38.9 million added in just 4 hours, while a slightly negative funding rate sparked short liquidations worth about $16 million across derivatives markets. Market sentiment is decidedly bullish. Bitcoin dominance slipped to roughly 59%, freeing capital for high-growth altcoins, and LSK's trading volume exploded by over 500% to $237 million. The surge reflects a blend of technical momentum, ecosystem expansion, such as the launch of a $15 million Empower Fund targeting Web3 startups in Africa, LATAM, and Asia, and strategic moves like migrating the network to the Optimism superchain, aligning LSK with other OP stack chains. For listeners, the story signals that LSK is riding a wave of renewed investor interest, driven by both technical catalysts and tangible development milestones. The next critical levels are $0.32, a potential springboard to $0.42, $0.45, and the resistance zone between $0.3372 and $0.4591. Falling below $0.2574 could trigger a deeper correction, with $0.1891 as the next floor. Sustained volumes above $200 million per day would reinforce the breakout, while short-term retracements are likely given the current RSI positioning in oversold territory. Ethereum remains the undisputed king of tokenized assets, now holding roughly $201 billion, about two-thirds of the global $314 billion market. Institutional giants such as BlackRock and Fidelity have catapulted on-chain fund AUM by nearly 2.0% since January, flooding the network with stablecoins and real-world asset tokens that drive liquidity across DeFi protocols. Meanwhile, exchange-held ETH has slumped to its lowest level in a year, signaling that investors are pulling coins into cold storage and building long-term positions. This accumulation dynamic, coupled with the massive inflow of institutional capital, feeds a bullish narrative. Reduced sell pressure could pave the way for price stability or an upside if broader sentiment improves. For listeners tracking ETH's trajectory, the data suggests a resilient foundation that may underpin future rally potential in the coming months. Bitcoin is again riding a quirky trend, as McDonald's reintroduced its McRib sandwich this week. The fast food chain's seasonal menu comeback has historically been followed by sharp price spikes for BTC, with the most recent rally pushing Bitcoin above $126.00 in 2024, and now hovering near $104,356. Traders are watching closely, interpreting the McRib return as a potential catalyst that could fuel further FOMO-driven buying. While analysts caution that the link is likely coincidental, the narrative has injected fresh bullish sentiment into an already volatile market, sparking speculation that cultural moments can still trigger significant moves. For listeners, this highlights how non-fundamental events, like a limited-time menu item, can momentarily sway crypto markets, underscoring the importance of monitoring both macro data and pop culture cues when assessing short-term price dynamics. Ripple's native token XRP slipped on November 11 after a brief rally that had been building momentum ahead of the anticipated ETF approvals. The dip came as traders paused to reassess the impact of potential exchange-traded funds on the asset's liquidity and regulatory standing. Market chatter skews mixed. Some analysts view the pause as a cautious, take-profit move, while others warn that pending ETF decisions could still introduce volatility, casting a mild bearish shadow over XRP's short-term trajectory. For listeners, this serves as a reminder that even when a token shows bullish signs, institutional developments, like ETF approvals, can trigger swift corrections. Keeping an eye on the regulatory calendar remains essential for those tracking XRP's next move. Staking enthusiasts will find their next playbook in November's top 8 platforms, as a recent roundup ranks them by yield, security, and user experience. The list spotlights giants like Ethereum 2.0, Solana, Cardano, and emerging names such as Avalanche, Polkadot, Cosmos, Algorand, and Tezos, each offering competitive APYs ranging from roughly 3% to over 10%, depending on lock-up terms and network demand. The compilation signals a bullish mood among holders who seek passive income while supporting network consensus. But it also highlights the growing fragmentation in staking options that could dilute liquidity for smaller projects. For listeners navigating this space, understanding which protocols deliver consistent returns without compromising security is key. The report underscores that while high yields attract FOMO, volatility and validator risk remain significant considerations. Transact, the fintech bridge that powers fiat to crypto payments for a range of exchanges and wallets, has secured state-level approvals in 5 U.S. jurisdictions: California, New York, Texas, Illinois, and Pennsylvania, to expand its stablecoin service offerings. The move comes as regulators tighten oversight on digital asset transactions, pushing firms to comply with stricter anti-money laundering rules. Market watchers view the licensing win as a bullish signal for Transact's growth trajectory, suggesting it can now tap into larger institutional flows while solidifying its footprint in key U.S. markets. For listeners, this development underscores how regulatory clarity is increasingly shaping the competitive landscape. Firms that navigate state approvals gain credibility and access to broader customer bases, potentially boosting liquidity across the stablecoin ecosystem. eToro's chief financial officer announced that digital asset trading has driven a 43% jump in earnings this quarter, with crypto volumes up 84%. The brokerage's profit surge underscores the growing weight of cryptocurrency in its overall business mix, and signals a bullish trend for platforms that are expanding beyond traditional equities. Investors are watching closely as eToro's performance could validate a shift toward digital finance, while regulators remain wary of volatility risks. For traders and market watchers, this development highlights how crypto exposure is reshaping brokerage revenue